Asia a day after the president touted some $600 billion investment by Saudi Arabia in U.S. manufacturing, products and services. Donald Trump also voiced hope on Wednesday that diplomatic efforts would succeed on Iran's nuclear program, even as he vowed rigorous enforcement of sanctions. Trump, on his first visit to West Asia since returning to the White House, said he spoke about Iran with the leader of Qatar, which maintains relations with both long-time adversaries. That's all for today. Now back to you.
Dia, thanks a lot for that. And Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. You not imagine saying this so soon, but gold prices are at a one-month low.
Well, yes, they are. They're trading at a 5-week lows right now. And we did see prices go down to $3,175 an ounce. That has a quite a sharper cut. 2% of a decline in the overnight markets, and we're still trading in the negative right now. Well, clearly, the focus is shifting away from safe havens. The U.S.-China trade tension seems to be diminishing, and softer than expected U.S. inflation reading also seems to be weighing onto the markets here. It's not just about gold. Silver fell 1.5% overnight. Copper prices fell 1.5% as well, and the crude oil prices are down 1.5% right now in Asia as Iran signals to a nuclear deal with the U.S. if the sanctions are lifted from U.S. on Iran. So we are looking at a lot of easing of tensions coming in. It's a risk on, and a lot of safe haven commodities and the commodities that had gained in the recent few past weeks seem to be going in for profit taking right now.
Well, thank you so much for that, Manisha. But moving on then, tensions erupt in Gaza as Israeli airstrikes targeted various locations. This even as U.S. President Donald Trump continues his visit in the West Asian region. Take a look at this report.
Israeli military strikes killed dozens of Palestinians across the Gaza Strip on Wednesday. That's according to local health authorities. It's a significant intensification of the bombardment in Gaza, while US President Donald Trump continued his visit to the Middle East. Medics said most of those dead were killed in Israeli airstrikes targeting houses in Jabalia, an area in northern Gaza. The Israeli military had no immediate comment and said it was trying to verify the reports. Hadi Mokbel, whose relatives were killed in the strikes, said the military fired 2 rockets, killing children, a woman and a baby. Itimad al-Najjar was also in the area when the strikes hit.
We were sleeping peacefully when the oppressors hit them. They hit them and hit the whole region we're in. 14 martyrs inside the house. People are still under the rubble. Have mercy on us. Enough blood, enough martyrs, enough worries. Stop the war on us. Stop the blood.
She added that, quote, nobody is left in Gaza anymore. In strikes the day before, security officials said they believed Hamas military leader Mohammed Sinwar had been killed. That's according to Israeli press reports. Israel's intensified bombardment comes amid Palestinian hopes that Trump's visit to the region will provide pressure for a reduction of violence. And Hamas on Monday released Eden Alexander, the last known living American hostage. Trump's envoys have said they now see a better chance for a new release deal for the remaining hostages. The US has also presented a plan to reopen humanitarian aid deliveries in Gaza using private contractors. Israel has blockaded all supplies going into Gaza since March the 2nd.
And with that, we call time on this edition of Power Breakfast from Amakshimi and the team that put this show together. Thank you so much for watching. Bazaar Morning Call sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. We are coming to you as always bright and early from the CNBC-TV18 Motilal Oswal studios. Coming towards the second half or the latter half of the week, I'm Surabhi Upadhyay, as always with me Nigel D'Souza. Today we have Rima in the house. Good morning, guys.
Morning.
Hi, good morning. Things seem to be calm, right? We've gotten used to so much volatility, so many headlines. But over the last few days, markets have been in a tight range. And we've been low on headlines.
Well, I think calm is not so bad, right? After
the storm.
Yeah, after the kind of news flow that we have had. So I think markets consolidate a little bit. Broader markets are participating as well. And gradually, after a while, you're getting that feel-good factor yet again. If you check your mutual fund portfolio, you check your portfolio on the whole, things are looking a little bit better than, say, a month and a half, 2 months ago. So we'll take that, I guess.
Oh, absolutely. And, it's also calm, I think, in terms of the market just digesting the level of news flow that we've had.
Yeah.
And the news flow continues to be fairly robust, especially when it comes to geopolitics. And that's also a watch point. So actually, let's get started by talking about what happened overnight. So what happened overnight was we had a continuation of the rally on Wall Street. However, it's becoming a little narrow. So slightly mixed yesterday. The Dow couldn't be in the green, but the other two indices did fairly well. The S&P 500 as well as the NASDAQ. They kept notching on the gains, and it's been a fantastic winning spree for US tech. That continued last night because the NASDAQ managed a gain of about 0.7%. And for the week, thanks to the mega rally that we are seeing in the MAX 7, that index is up almost 7% already. I mean, and that's just counting 3 trading sessions on the US market action. Now, why am I talking about geopolitics? Because there's a lot going on. Today, specifically, this Russia-Ukraine conversation is going to be in very, very sharp focus. Remember, we had Mr. Zelensky pretty much throwing out an open invitation to Putin, saying, let's meet in Istanbul, in Turkey. So those talks are slated. It's not very clear who will turn up and who won't. International reports are indicating that Putin himself may not come for these talks. But let's see. We'll have more clarity as the day emerges. But this is going to be one important watch point. Yesterday, the developments out of the Middle East were very, very interesting as well. And in fact, they left certain sections of the Western world perhaps shocked, if I can say. And this is the fact that the US is now lifting sanctions on Syria. Donald Trump yesterday met the interim Syrian president, Ahmad al-Sharar. This was in Saudi Arabia. There was also the Turkish president Erdogan on that call as well. So a lot of these shifting equations, trade and, geopolitical equations in the Middle East are also something that the markets are tracking very, very carefully. Now, let's come back to the action in the currency and the commodity space. The yields inched up yesterday. US 10-year actually moved up to about 4.5%, slight climb higher, 2-3 basis points higher. Today is an important day in terms of data point because the consumer inflation numbers that came out of the US are fairly benign. Today, we will have the PPI data, the producer price index. That's not all. We'll have the retail sales number and the industrial, production number for the month of April as well. That will give further direction to markets, including to yields. The dollar index has been range bound. Yesterday, the dollar recovered a bit in US action. This morning, again, the index is on the back foot, as you can see. It's down a couple of basis points. The broad range this week for the dollar index has been about 100.5 on the downside, going up to 101.8. That was the peak that we've seen so far this week. So today, we are in the middle of that trading range. For India, it's been about consolidation when it comes to the large cap space, but the consolidation itself has a positive bias. There's no taking away from that. Flows are a little mixed, and, we've had a slightly patchy performance from the FPIs, but they haven't entirely gone away from the market, and we'll talk more about that as we go forward. The broader market up move is continuing. So it's telling you that there's that feel-good factor in the market. The market is willing to reward good earnings, and that's what we saw yesterday as well. And even today, we'll talk more about earnings as we go forward. We actually have some, decent surprises, Jubilant, Aisha, even Hitachi. So you do have some good numbers to talk about today as well. The only caveat here is the bank Nifty, because we're not seeing a sustained pullback on that particular index, and that outperformance is something we need to watch. And that brings me back to the point on flows, because flows are patchy. And we have this question now. The key question for the market is whether there will be this near-term tactical shift by FPIs to China. We saw that play out yesterday, and that's something that we need to sort of look at. But as I said, I don't think the FPIs have entirely gone away from the Indian market either. Reema.
Well, yesterday we had a buy figure from both the DIIs and the FIs. So that number will come up for you. The DIIs bought 316 crore in the cash market. The FIs net bought 931 crore in the cash market. So those are the numbers for yesterday. But here's what you need to know. So as Surbhi pointed out, Wall Street took a breather. The S&P 500 eked out a very minor gain of about 0.1%. But it's been a strong week for US equities across the board. The S&P 500 is up 4.1% for the week. The Dow has gained nearly 2% and the Nasdaq has surged 6.8%. And it's the tech giants leading the way. Nvidia, Tesla up 16% this week. Meta, 11.5%. Amazon, Alphabet, both soaring close to about 8%. And Nvidia, by the way, has now turned positive for 2025. And since 9th of April, which was the peak tariff uncertainty day, the Nasdaq is now up 25%. That's the extent of the gains that we've seen. Okay, getting back to the cues back home, fairly inline numbers coming in from Eicher Motors. So that's a positive. Jubilant Foodworks, Tata Power, Muthoot Finance, all perhaps in line to positive, so that's good. On the way down, Apollo Tyres earnings were a miss, so that could weigh on the stock. We'll discuss that in greater detail. As I said, both the FIs and DIIs were buyers in the cash market. The net buy from the two of them together was close to about 1250 crore rupees. Today is the Nifty 50 weekly contracts expiry, so that could add to its volatility. And in terms of earnings, it's mid-cap action. CESC, Crompton Consumer, JSW Energy, LIC Housing Finance, NCC, Page Industries, Patanjali Foods, PB Fintech, Tube Investments, just to name a few. These would be the stocks which should be on your earnings calendar for the day. But Nigel, what are you looking at?
Well, in yesterday's trading session, you had an element of short covering that did play out yet again. So if you look at the Nifty, well, we ended higher and the open interest was lower. For the Nifty Bank, well, it managed to defend a crucial level, which was the 20 DMA in yesterday's trading session, and we popped up from there. So that as well was encouraging to see a bit of a fight back that we saw in the last 60 minutes or so. A couple of big positives that I've noticed in the last few sessions. One is that the mutual fund industry is sitting on a good amount of cash. So in case things get a little bit iffy, we are sitting on a good amount of ammunition here. It's roughly around 6% or thereabouts, which is a positive. The other one is the way the VIX have schooled up. From around the 22-odd mark, we're down to around the 17-odd mark, which is good. And in fact, even yesterday's trading session, the India VIX was down close to around 4% or thereabouts. Cooling VIX is normally a bullish sign. What about positioning? The FIs, they're net short. The clients are net long. This combination isn't so bad as history suggests. In the recent past, we've seen when the FIs are aggressively net short and the clients are long, normally the clients get it correct. So this combination is good. Since today's weekly expiry, I pulled out two strikes that were fairly active in yesterday's trading session. One is the 24,700 call. It was fairly active in trade. The premium out here is around 66 rupees. And on the downside, the 24,500 put, well, that as well fairly active. Around 50 rupees is what the premium is. You just look at this particular level, that's a 24,700. You add that 67 rupees or thereabouts, and that perfectly tallies in with the high that we saw. So this becomes a crucial resistance mark. That's yesterday's high that we saw. Going by the options data, going by yesterday's high as well, this needs to get taken off to see a bit of a bounce from here on. The support you have at around 24,450. Going by the options data, 50 rupee premium, 24,500 put was seeing some kind of writing. But otherwise, the broader support comes in at around this 23,380 odd level. The question I'm asking is, since the Nifty is only 6% away from its 52-week high, can we see a broader market outperformance? Because remember, those indices, they got clobbered on the way down. And now they need to fight back. So the small cap index is still 13% away. We've seen the last few days the broader market has outperformed. Even the Nifty Next 50, that's 16% away. So I'll be tracking whether or not these indices actually can outperform the Nifty in the near future, just going by the data points that we have. The stock that I'm looking at, since the market seemed to be in a better place, and we've seen exchanges as well like BSE, MCX, etc. do quite well, I'm looking at a stock market play. Angel One is a stock that I'm looking at. Yesterday, the delivery-based buying was there. Close to 2.7 lakh shares were delivered on the NSE itself. That's much higher than the 10-day average. And if you pull up a chart, the 20 and the 50 DMA as well have got conquered. Remember, the stock is a far cry away from the highs that we saw in excess of around 3,000 rupees. But if the markets are in a better place, participation is coming back. I'll keep an eye out on Angel One.
Okay, all right. So lots of individual stocks in focus as well. Nigel, thanks for that. Let's get started by first talking about the global setup once again. Mark Franklin, Deputy Head of Multi-Asset Solutions Asia at Manulife Investments, is with us now. Mark, good morning. Thanks very much for joining us in the show today. So, I just want to understand what kind of shifts, if at all, you have planned or you have executed in the strategy in your portfolios since this big event happened, this window of conversation between China and the US, the lowering of tariffs, and at least this 90-day pause that we've got. I mean, we've seen that play out in markets, right? We've seen some tactical money shift to China. We've seen the cool off in gold. We've seen, in general, commodities start to move higher. But as an asset manager, what are the changes, if any, that you are looking at now?
Good morning. Well, if you look at the V-shaped experience that equity markets have given us over the last few weeks, it's created a number of opportunities. The first opportunity is to increasingly diversify our global equities exposure. So to lean a bit more on those regions ex the US. So you mentioned Asia, to some extent Europe and Japan as well. So we're looking for more of a breadth of participation, which founds itself on the idea that valuations increasingly will matter, risk premium will matter, particularly if markets pursue a more volatile, choppier experience over the rest of the year. The second thing that we've done in more recent times is the acknowledgement as a result of the thaw in the trade dynamics, the relation between the US and China in particular. It sort of takes the worst case scenario for the macro outlook off the table for the time being, not permanently so. And what that means in practice is that the market's focus will shift increasingly on the next policy initiative of the Trump administration, which will be tax cuts, spending plans, which are generally expected to be somewhat reflationary. The consequence of that is that we're starting to lighten up a little bit on our bond exposure, particularly US Treasuries, because the economic risks are being somewhat priced out again. And the focus will be more on a reflationary policy mix in terms of the potential. And so not just the curve steepening, but the whole of the yield curve starting to move higher as a more benign growth outlook becomes the base case again. Of course, we do recognize that narratives can subsequently shift again, but that's what we've been doing in most recent times, is just lightening up a little bit on those more defensive exposures.
Mark, hi, morning. Let's talk about India. The many factors which were supportive of India over the last few months, whether it's lower dollar, lower crude prices, trade headwinds on China, they've all reversed. So while India in a way is still relatively insulated from the disruptions that we're seeing, has the sheen come off the Indian equity markets to your mind?
We also have to bring into the equation the geopolitical dynamics as well. Thankfully, it looks like things are paused there, cooling down. That was perhaps something which represented a bit of a tangential risk to investor appetite for Indian equities. So with that put to one side for the time being, I think that foreign investors are taking a fresh look at India again, not just for the construct of the economy and markets being somewhat more domestically oriented, but the recognition that positioning, particularly amongst foreign investors, is somewhat lighter now than it was 6 months ago. And therefore, there's the potential for a re-engagement and for overseas flows to come back into the market. So we are somewhat more constructive on Indian equities at this point in time, but we do recognize that we have to be somewhat price sensitive, given that valuation multiples never really got that discounted, both relative to history, but also relative to other markets as well.
Hi, Mark. Good morning and good to see you, Ben. You had pointed out that the Indian markets are not particularly cheap. So I think this time correction, price correction, I think that will, hold well. But in terms of global markets, where is your preference right now? The US markets, there were a good amount of longs that were added in the initial part of the calendar year, which got unwound. So give and take everything, what's your top global equity market that you're looking at?
We take a barbell approach at the moment. As I mentioned earlier, a more diversified global equities portfolio than we would have run maybe 6 months ago. And so on one side of that barbell is looking for markets which are somewhat discounted relative to fundamentals and also give you a nice total return potential, not just from capital returns, but also from income. And a market that does fall into that category is the UK large caps, very discounted market, a good dividend profile, and not a reflection of the domestic UK economy, which we know has somewhat of a challenged picture. So that's an example of discounted valuations that we like. We also think that Asian equities also fall into that category as well. And then on the other side of the equation is still looking for those businesses which give you franchise value, thematic growth potential. In that context, we like cybersecurity. We also like defense technology as well. So these are sectors that are not inexpensive. They're somewhat premium valuations, but we can see with a degree of confidence that over the next several years, there's going to be a nice compound growth potential. And so the market will eventually reward that because of the delivery of earnings growth. So combination of earnings growth, thematic strength, alongside those discounted parts of global equity markets, which gives us a nice blend.
All right, Mark, we'll then leave it on that note. Thank you very much. Appreciate the perspective that you've given us today. Thank you very much for joining in. Well, that's one view coming in, and let's get you another one. India right now is the most exciting place to be in. These are words coming in from emerging market veteran Mark Mobius. Listen in to his views. This was an interview that he was in. It was done by CNBC yesterday. He speaks on a whole range of issues, including China, the trade deal and what that means, how India's placed in all this, and even whether gold should find a place in your portfolio.
China is not the only game in town. We're now seeing all these other countries entering the export market and being able to compete. So it's really very exciting to see what's happening around the world. And probably the most exciting place now is India, because India is going to be taking the place of China in many, many areas. And we've already seen companies like Apple and others come to India to manufacture and export. So India, Vietnam, Taiwan, Turkey, those are the ones that are looking very interesting for us at this stage. But as you pointed out, there are many other markets around the world that are doing better than the US. The big problem with India is bureaucracy. As you know, they inherited this incredible bureaucracy from the British, and the party that took over, the Congress party took over, perpetuated that bureaucracy. But Modi, the new prime minister, has done a tremendous job in cutting through a lot of the bureaucracy, but still there's a lot to be done. And he's digitizing the entire economy. First of all, by getting digitized identity cards for everybody, so money can be transferred directly to bank accounts, even to the poorest people in the country. But this takes time. I call it the United States of India, because you have all these states, many of them with different languages, both written and spoken languages. So to unify this country is quite a job, but still the opportunities are there because you have a lot of very smart people. And as you say, it's the most populous country in the world now. We figure about 1.2 billion people compared to, I would say, now India's bigger than China. China maybe 800 to 900 million. Well, gold is a favorite of mine. I believe everybody should have some gold, maybe 10% of the portfolio, regardless of where the price is at any point in time. It's good to dollar cost average into gold. As regards to crypto, it looks like the US is bound to become a leader in crypto, and that is going to be very important going forward. I personally am not a big fan of crypto, but members of my team are convincing me that we've got to do more in crypto. So we're looking at it more carefully. I'm particularly interested in the crypto exchanges rather than the...
Okay, interesting conversation there. Let's also tell you what the interactions we've lined up for you on our show today. So coming up first at 8:35, we've got the management of Tilaknagar Industries joining in to discuss their Q4 earnings. 9 a.m., we'll have the management of Berger Paints India to decode Q4 earnings. 9:20, Tahir Badshah of Invesco Mutual Fund will be our market master for the day. 9:30, the management of Tata Power will be with us. And following that, N. Venu of Hitachi Energy India will be chatting with us at 9:40 to talk about the way forward. At 10 o'clock, the management of Shree Cement will join in. And towards the end of the show, in our special segment, Indianomics, Lata speaks to Neeraj Seth of 3R Investment Management on Asian currency and the credit markets.
Time to slip into a short break. We got a lot of stock-specific action to track for you, though. We get to that in just a bit in our special Top 10 segment. But the stocks we're tracking, Eicher Motors, Lupin, Tata Power, Muthoot Finance, Jubilant Foodworks, Hitachi Energy and Piramal Pharma. All of them will be reacting to positive news flow. On the flip side, Torrent Power, Apollo Tyres as well as Vent India, well, they'll be tracking negative news flow. Slip into that break, come back, get into further detail on all of these names.
Welcome back. Yesterday was a range-bound session for our markets. The Nifty moved around in a 150-point band and finally ending marginally higher at 24,667. But what are the cues? What are the stocks you need to watch this Thursday morning? CNBC-TV18's list of top stocks for the day is coming up, and our team is joining in. And the big one will be Eicher Motors. Sudarshan, numbers largely in line?
That's correct. So I'm going with green for Eicher Motors mainly because of three reasons. First, company's focus on growth over margin has been playing well. Second, heightened competition situation is behind and the company is the biggest beneficiary. And third, in this premiumization trend, company would benefit the most. Now, but the question is, can the stock see the profit booking? The answer would be yes. And it's on the back of first, margin has been below expectations for third straight quarter and valuation remains rich. Now coming to the headline numbers, profit was up 27%, revenue has increased 23%, both higher than expectations. EBITDA has slipped 11% and margin was down 250 basis points and both were below expectations. But market share in more than 250cc segment where company is the leader has gained 100 basis points year-on-year, 100 basis points sequentially and 40 basis points year-on-year. Now about the outlook, company is saying it will continue to see healthy growth and outperform the industry, and one positive part is in the urban area, company is saying the positive sentiment is returning.
Okay, all right. Good commentary as well. Thanks a lot, Sud, for joining in and giving us that update. But let's hop across to Ekta. She's here to tell us about Lupin. Ekta?
Thanks for that. Well, yes, Lupin came out with its numbers late last night and revenue, and it looked good. The revenue was up around 12% odd. The street was anticipating around a 12% growth. Margins came in at around 22%. Street was anticipating 21.8%. And overall, the profit was higher than estimates as well. So that came in at around 794 odd crores. Now, in terms of the key geographies which the street was looking at, the US business came in at around $245 million. This is compared to $209 million year-on-year and versus $235 million last quarter. So higher year-on-year as well as sequentially. So positive news coming in on the US business. India was up around 7% odd year-on-year and growth markets were up around 30% odd. So overall, good set of numbers coming in from Lupin. But what is the US trajectory going forward is something that the street is going to look out for in terms of commentary.
Okay, all right, got that. Ekta, thanks very much. So Lupin is going to be on our radar. More numbers, Tata Power and Torrent Power. Vivek, good morning. How do they look?
Well, good morning. Tata Power, well, operationally good set of numbers, a 25% year-on-year growth as far as the profitability is concerned is something that the street clearly will like. Well, as far as the profitability mix is concerned, what's clearly changing as far as Tata Power is concerned is that the share of the coal JVs in the profitability is reducing. What's increasing is the share of the renewable energy as well as the share of TP Solar, which is the solar cell and module facility. That's clearly ramping up, almost 90% capacity utilization. Well, talking about the numbers themselves, revenue is higher by 8% on a year-on-year basis, EBITDA higher by 39%, EBITDA margins quite strong this time around 19% versus 14.7%, and profitability, like we mentioned, higher by 25%. Now, the solar EPC book remained very steady at a little over 11,380 crore. What is it that the streak, will be a little disappointed about? Well, the company had set aside a capex of close to 20,000 crore for FY25. They've achieved around 16,200 crore, indicating that that there has been a delay as far as capacity addition is concerned in the renewable space. They had a target of 1.4 gigawatt, have achieved close to 1 gigawatt. This is in line with industry trends where there have been issues, and this is something that we will quiz the management further. FY26 capex guidance quite strong at 26,000 crore. Expect green as far as Tata Power is concerned today. Torrent Power, on the other hand, against consensus estimates, is a clean miss. It's been a muted side, and the profitability mainly boosted by a one-off. There has been a reversal of deferred tax liability of close to 637 crore. Looking at the numbers themselves on a year-on-year basis, largely flat, down 1%. EBITDA up 2% on a year-on-year basis. EBITDA margins up 50 basis points. Profitability, well, aided by one-offs, quite higher. What aided the performance this time around? Gas plants did very well. However, the renewable energy led by lower offtake is something that did do quite well. So Torrent Power expects some red, Tata Power some green.
Thank you very much for that. In fact, we've got the management of Tata Power joining us at 9:30 a.m. for the Q4 earnings. But moving on now to Muthoot Finance. Big jump seen in the company's profitability, perhaps on the back of the rise in gold prices. Vamakshi is here to give us the Q4 lowdown.
Well, good set coming in from Muthoot Finance. NII stood at 3,355 crores. This is an uptick of almost 6% sequentially and 32.5% on a year-on-year basis. The NIMs too for the company have improved to 7.3% as compared to 7% sequentially. The AUM is also growing at a very healthy pace, up almost 11%, much faster than the growth that we saw in the third quarter. Impairments at 413.5 crores is down almost 3% quarter on quarter. The stage 3 assets to loans also, were lower at 3.4% as compared to 4.2% on a quarter-on-quarter basis. As far as the outlook for FY26 is concerned, the company appears to be quite positive. They maintain their growth guidance at 15%, and in fact, they believe that guidance could see some upward revision after the first quarter. They will be opening 115 branches under Muthoot Finance, and Muthoot Money will leverage 1,000 branches for gold loans. The key risk out here is the fact that any changes in LTV rules by RBI for NBFCs could be a negative factor. But overall, when you look at the numbers that have come in from Muthoot, it's a good set, going with the green for this counter.
All right, thanks for that, Vamakshi. Well, in fact, we'll have the management of Muthoot Finance joining us later on the show to detail their quarter 4 numbers. But Mangalam's up next. And Mangalam, going by the stock you're tracking today, you know what I'm expecting later in the day? A pizza.
Well, it is a pizza party. I'm not the one who will be treating, but I'm sure there will be a couple of team members here who would volunteer, raise their hands and say that they're treating us to a lot of pizzas. But be that as it may, Jubilant Foodworks, what numbers? 34% revenue growth on a consolidated basis, standalone revenue growth 19%. We knew that from their fourth quarter update. So what is it that the street was estimating? They were estimating for the EBITDA, margins and net profit. On all 3 counts, the company went ahead and beat street expectations. The street was working with an EBITDA number of 277 crores. The company went ahead and did 305 crores. And as a result of which, there was a beat on the margins and the profitability as well. How is it that the company managed to, beat street expectations on margins despite the gross margins dipping by over 200 basis points? Because they curtailed other expenses and employee expenses as well. So there was some rationalization that took place out there along with operating leverage. Domino's like-for-like growth at 12%. Overall ordering activity grew by about 25%. And at the same time, delivery, which accounts for nearly 73% of their sales, out there the growth was 22%. Dine-in was absolutely flat. And that's a positive because earlier few quarters, we had seen a decline in dine-in. So that decline seems to be arrested with strong growth in delivery and overall ordering. That sounds like a pizza party.
Oh, God, we're all hungry already. Remember, we haven't had breakfast. We don't mind early pizzas as well. Mangalam, just say.
Thank you very much.
Any time of the day. Thank you so much for that. Well, more numbers. Hitachi Energy seems to deliver another steady quarter. Vamakshi, morning. Tell us more.
Well, good morning, Surbhi. It's a good quarter coming in from Hitachi Energy, especially on the operational front. When you look at the revenue, that did miss what the street was expecting. Revenue came in at 1,883 crores. This is an uptick of 11%. But when we look at the operational performance, that has been quite good for Hitachi Energy. And that is because the margins have improved for the second straight quarter to 12.6%. Remember, the company had given a guidance of double-digit margins. For the full year, the margins are at 9.3%, but nevertheless, for the last 2 quarters, they managed to hold on to that guidance of double-digit margins. Net profit too, seeing a strong uptick of almost 62%, 183 crores, an uptick of almost 62% for the net profit. As far as the order inflow is concerned, that was also quite healthy. In fact, it came in much higher than what the street was penciling in. Order inflow came in at 2,190 crores, an uptick of almost 56%, and the order book too saw a very healthy healthy uptick, came in at 19,245 crores, an uptick of almost 166% as compared to the same quarter previous year. And this is given the fact that there were a lot of HVDC projects that did take that the company did win in FY25 itself. So overall, when you look at the numbers, operationally led beat for Hitachi Energy, going with the green for this counter.
Okay, we've got this management too joining us on the show today, 9:40 a.m. So do tune in to listen in to N. Venu of Hitachi Energy India. But moving on now to Apollo Tyres. Sudarshan is now joining in. Sudarshan, a bit of a miss here?
It's a minor miss to estimates. Unlike CEAT and MRF company, Apollo Tyres has missed estimates, and both their major regions, AP, MEA and Europe, have reported muted revenue growth, while EBITDA and margin have declined for both the regions. Now, profit was down 48%, revenue has increased 3%, EBITDA for the company has fallen 19%, and margin has fallen more than 300 basis points, but it was largely in line with estimates. For APMA region, revenue was up 4%, EBIT was down 35%, and margin has come down to 7.2% versus 11.6% in the same quarter last year. And for Europe, revenue was up 1%, EBIT has fallen 43%, and margin has slipped to 5.6% versus 9.8%. But all the focus would be on auto, because remember, internals for the tire industry have improved in last 2 months. So we'll have to see what exactly management says in the analyst call that's scheduled at 3:30 p.m. today.
Got it. Thanks, Sud, for that. Going back to Ekta. Ekta, Piramal Pharma, numbers look good?
Well, yes, revenue was up around 8% this quarter. EBITDA was up around 6% on a year-on-year basis, with margins at 20.4%. Stable year-on-year, but improvement of around 500 basis points sequentially, and a profit of 153 crores versus 101 crores year-on-year. So positive performance coming in from Piramal Pharma. They've crossed $1 billion in terms of revenue with 12% year-on-year growth, and they are on track, according to the company, to meet their FY30 aspiration of $2 billion in terms of revenue, 25% EBITDA margins.
Okay, all right. Ekta, thanks a lot for that. In fact, we'll have the management of Piramal Pharma who will be joining in during midday to detail their numbers. Ms. Piramal will be in touch with Ekta Batra here on CNBC-TV18. Well, there's a big OFS as well that we're tracking. Vamakshi is tracking that one. Vamakshi, tell us more.
Well, good morning, Nigel. When India will be in focus on the back of that OFS, its parent company is likely to sell up to 37.5% stake via OFS, including a green shoe option of nearly 7.5%. The floor price has been set at 6,500 rupees per share, which is coming in at a significant discount, almost 38% discount to the current market price. The offer size is at 487 crores. The OFS will be opening for non-retail investors today and for retail investors tomorrow. But, given the kind of stake sale that is taking place in the company and, the discount that the floor price is at, going with the red for Went India.
Okay, all right, got it. Thanks very much, Vamakshi, for that. So let's quickly recap our list of stocks to watch today. The ones that have positive news flow around them are Eicher Motors, Lupin, Tata Power, Muthoot Finance, Jubilant FoodWorks, Hitachi Energy and Piramal Pharma. The ones that have negative news flow around them include Torrent Power, Apollo Tyres and Wend India. Okay, that's our stock list. Let's now find out what commodities have been up to. We have Manisha Gupta joining in with a roundup of all the action. Manisha, morning.
Morning, and thank you so much for that. So, it's actually a state of profit taking across commodities in the Asian markets right now. Overnight, we've seen very sharp declines come in for gold, down by almost 2%. And with that, we are trading at a 5-week lows. Not just that we've broken below $3,200 an ounce, but we saw a low of 3,174 as well. Well, the markets are now looking at no more safe haven. The risk is on, and that is what is weighing onto the markets. Not just gold. If you look at silver prices, they fell more than 2%. Copper, after that initial bounce on the US and China trade agreement, a temporary one, also has given into some profit taking. So we've seen 1.5% of decline in copper as well. The metals that are doing well actually are not the conventional ones. So you have tin, lead, nickel. These are the metals which seem to be doing well. But copper, aluminum, zinc, silver, gold, crude, everything trading in the negative in Asia right now.
Okay, all right. Thanks a lot for that, Manisha. For the time being, though, we'll slip into a short break. On the other side, we'll get chatting with the management of Tilaknagar Industries. They'll be joining in to tell us about their past quarter and what's the way ahead.
Welcome back. You're with us on Bazaar Morning Call, and we are going over lots and lots of earnings that have come in post-market hours. Deepan Mehta is with us now. Deepan, good morning. And, for a change, it was nice to see we're coming towards the end of the earnings season. But there are some positive surprises as well. Aisha, for instance, Hitachi, we were just discussing. The margins look really good. And Jubilant Foodworks, pizza seems to be hot again. Let me start with Jubilant, actually, because it's been several quarters of drubbing. And finally, we're starting to see some good numbers. What are your thoughts on the stock, how it's poised? Would you be a buyer?
Yeah, good morning, Surabhi, and thank you for having me on your show. Yeah, I think a good set of numbers. Like-for-like sales growth also, I think, is in the mid-teens, which is very positive. After a long time, they seem to have rationalized their operations and margins also have improved. But look at the valuation that is trading at such rich multiples. And now, I would say a significant portion of their earnings is going to come from Turkey and I think Azerbaijan, where they have got they acquired the franchise of Domino's. So I wouldn't pay a very high P multiple for those businesses, considering that growth may be slightly slower over there. But nonetheless, I think good set of numbers. I don't think making a fresh acquisition or fresh buying is justified. But investors like us who are holding for a long period of time and sitting on profits, I think they can continue to remain invested. I think the stock has some more way to move up.
The stock has run up in the last 1 year. It's up close to about 48%. UBS says the stock run up in a down cycle now makes a case for profit booking. Goldman Sachs is a neutral call. Citi has a buy. CLSA has an underperformed call. So it's a mixed verdict coming in from the brokerages. Many of them have cited high valuations for Jubilant Foodworks, as Dipan is. Dipan, anything else that catches your attention? Any stock which could be in focus in the back of earnings today?
Oh, I think that Eicher Motors came with a very good set of numbers and they've gained market share across the board. Even the commercial vehicle subsidiary of theirs, that also has gained market share. And most importantly, I think over the year, we saw almost a 33% increase in the export market. And if Eicher starts to do much better over there, then clearly I think it opens up new opportunities for growth, considering that competition is heating up in the Indian market and some amount of saturation also will come through. But nonetheless, I think great set of numbers, reasonable valuations also. I thought even Bharti Airtel came with a very good set of numbers. And now finally, I think the pricing power is coming back to the telecom industry. Consumers are not complaining when they are paying 15-20 rupees per month more for their mobile bills. And these are, at least telecom businesses are great operating leverage businesses. So a lot of it may flow to the bottom line. It's coming to an end of its capex cycle also. So I think in the large cap, these two were exceptionally good set of numbers.
In the Bharti Airtel conference call, which took place yesterday, the investors also quizzed them that you made a proposal to the government, the DOT, about converting AGR.
I was thinking about that.
Yeah,
just like Vodafone Idea, right?
Just like Vodafone Idea, right? So to which Gopal Vittal said that it's actually just exploratory in nature. We wanted to assess whether we have a level playing field with Vodafone Idea, right? You approved it for Vodafone Idea. Will we also get that approval or the green signal? So he said, as of now, it's exploratory. Let's hear back from the government and then the board will take the final decision. So it's not that they want to.
Yeah, but why not? If it's available, why not?
Not even why not, right? Like, is there a level playing field? I think that's what they wanted to assess between the various players. But let's talk about Tilaknagar Industries. That's the first corporate on our show. Now, their Q4 revenue growth was healthy. It was led by a 20% volume growth as the Andhra Pradesh issues got sorted. Margins also expanded, aided by a subsidy. If you strip that out, margins would have come in a little more than 16% in line with the company's guidance. Amit Dhanukar, CMD at Tilaknagar Industries, is now with us on the show. Amit, thank you very much for joining in. Q4 volume growth of 20%. Could you break that up? How much of it was in Andhra Pradesh? How much ex of Andhra Pradesh? And in FY26, what is the volume growth that you're looking at? Historically, you've done about 13-14% kind.
Right. So I think we ended the quarter quite strong. I think I've been giving the guidance earlier on the show so that, the revenue growth will be back. The Andhra Pradesh government, as all of you all know, it went through a transition when the government changed in June of last year, and then the current government, they decided to change the policy in terms of privatizing the retail, which took place in October of last year. So there was a transition, which is why quarter 2 and quarter 3 was slightly subdued for us in terms of growth, but I think that's behind us. And we have bounced back quite strongly in quarter 4 with the overall volume growth of 20%. Of course, the growth in Andhra Pradesh would be in excess of that. I think that's looking more like 30-35%. And, with the strong momentum build up in Q4, we're carrying this forward into Q1 and this fiscal year as well. So we're very optimistic about the volume growth for this year.
Okay. All right. Hi, Amit. Good morning.
Good morning.
Thursday morning, and we have to talk about spirits because of the nature of your business. A little early in the week, but let's get a couple of numbers out of you. Last year, you did around 11.9 million cases. For this year, what kind of a volume growth can you deliver since you're saying that things have bounced back and normalcy has returned? Are we bracing for mid-teens volume growth? And what would it mean in terms of revenues? Last year, you did roughly around 1,430 crores.
Right. So, as I mentioned earlier, Nigel, I think the volume growth for this year will largely mirror, the Q4 volume growth. I think we expect clearly high teens volume growth for this entire year, and our revenue growth should roughly, track the same percentage.
So last year the revenue grew. Amit, hi, morning. Last year the revenue growth was in low single digits. I'm talking about top line, right? It's just about 3%. So are you saying it's going to be in the same vicinity? Why is that?
No, it will be in the same vicinity as the volume growth for this year. So the volume growth we are projecting in high teens, and we expect the revenue growth
to be in the same arena. Okay, let's talk margins as well. Let's talk margins and realizations. From what Mangalam tells us, your realizations per case are at 1,214. Which is a little lower than where they were in the same period last year. So what is the visibility on blended overall realizations across the portfolio, and therefore what will be the margin trajectory this year?
Yeah. So I think going forward, the NSR will remain largely in the same range. I think while we do get the benefit of premiumization and selling some premium brands, but we did a price correction on our flagship brand in Andhra Pradesh in November. So, that was done in line with, the competitive movement in that category. So that price correction now will have the full year effect in this year. So, by and large, the NSR will remain same. And the margin outlook also, will be around 15.5% to 17%. That is the outlook which we expect for this financial year.
Would it be closer to the upper end? In Q4, it was about 16.6% adjusted for the subsidy.
Right. So, while we will get operating leverage in this year, on back of, say, high teens volume growth, but, we will be investing quite heavily in A&SP in this financial year. I think they are on two fronts. One is, of course, as, I maintained before, we have been the leaders in the brandy category. And our endeavor now is to increase the share of voice for brandy. So, in line with that, there will be increased spends in terms of communication. And also we have few premium launches, which we have already done. We launched Monarch, which was a luxury brandy in September of last year. And we intend to launch a luxury whiskey in the first half of this year. So, the premium brands, the first year, the advertising and marketing is going to be slightly skewed. So, with increased A&SP spends, that will put some downward pressure on the margin as well. But, we're in an investment phase now. Our company is very healthy. I think we're looking at investing behind our distribution, our international footprint, and increased brand footprint. Yeah.
Okay. All right. Interesting, that you're looking at launching a premium whiskey as well. And in the last few years, after getting out of that debt trap, suddenly you have started diversifying from being a core brandy company. Currently, the brandy has a mix of a percentage. It's come down, I think, to around 91%. How do you see this mix evolving?
Right. So, Nigel, the previous year, brandy as a percentage of our portfolio was closer to 95%. So, we've made some progress in this year now where brandy is 91%. And, our vision is that, by 2030, which is, say, 3-4 years from now, brandy will still continue being the core of our business, but we expect it to be around 80% by 2030.
Okay, so 80% by 2030, that'll be the share of brandy.
Yes.
Amit, I'm just going back to that point of competitive intensity that you mentioned for your flagship product, which is why the overall realizations were impacted. And we'll see the flow through this year, like you're saying. I'm just a little curious. I mean, is that only for one particular product? Is it only in one state like Andhra, or is it across the board? And as a corollary, let me also ask you this. I don't know if you're impacted at all. With this UK FTA, Now, I don't know if any of your premium products will see any competition. I'm not sure about the imports. If at all we're getting brandy or, any of your portfolio products could face more competition, especially at the premium end. Just tell us that, and also a little more about this competitive intensity and whether other brands in your portfolio, can you take any price hikes at all, or will we just see pressure?
So I'll take the second question first. With regard to UK FTA, I think, our company, we've had very limited imports. So I don't really see any material impact for us right now immediately, but I think it's a good development for us in the medium long term. As we
does it add to competition? I mean, I don't even know if we import any premium brandy from the UK or not. But do you see more competition because of cheaper imports coming in from the UK?
So that's a difficult question to answer right now. I think we'll just have to wait and see how it plays out, because of course we compete at price points. So of course within brandy well leaders, but we compete with whiskies as well at similar price points, which is one of the reasons we undertook some corrective pricing in Andhra Pradesh last year, because it was more in terms of being available at a particular price point. So I hope that answers your first question.
Amit, the company has also been embroiled in a trademark dispute. I think the news came out in the month of February, where other companies are allowed to use Mansion House, Savoy Club trademarks. And you sought an injunction against that, but I think it was quashed by the Bombay High Court. So what is the latest on this particular dispute? And has there been any loss of revenue or any impact on your business, negative impact on your business on account of this?
Right.
And how will you expect this to proceed?
So there's been no negative impact, because our use of the mark, continues exclusive and uninterrupted, and we have been the exclusive and uninterrupted users of the mark in India since 1983, and that is continuing. So there's no direct impact on the business. As far as the legal proceedings go, the matter is sub judice, and currently the counterparty, the body corporate against whom we had sought an injunction, they have given an undertaking as to they will not act on the February 7th order till the next date of the hearing. So currently it's status quo.
Okay, all right. And just to clear the air, with regard to the M&A opportunity, from being heavily net debt, you've moved into the green, must be feeling good about it. But the last time around, I was quizzing you about Imperial Blue or other such brands. Anything on the horizon?
So you're right. Now, we're cash positive, and the outlook also is looking good for this year. So we'll always be alive. I think our strategy would be focused on organic thrust as well. And the outlook for organic growth also is looking good for this year. But we'll always remain, alive to inorganic opportunities if they, fit in line with our, strategic vision for, the next 3, 5, 10 years.
And Imperial Blue?
So I can't comment on specific opportunities, Nigel. That's a difficult one. But we always evaluate. I think whatever comes our way, we keenly take a look at opportunities.
Okay, all right. Thanks a lot, Amit, for joining in. That Samsara Gin, it's a very small part of your business, but that's a good one. Brandy is not something that I taste, but I think that Samsara Gin is good.
You've been a big fan of Samsara, Nigel.
Yeah, I mean, for the last few times. But y'all have still a small stake out there. So from the stock market perspective,
we have a small stake.
Are you going to, because as a brand, it's extremely popular. We all can tell you that. Are you going to be looking at increasing your stake in Samsara? How much money can you put to work? How much can you go to? And will it at some point start contributing to the consolidated numbers?
So at some point, we do expect it to start contributing towards consolidated numbers. And we do have a pathway towards increasing our stake. And we are looking at that actively.
Okay.
Maybe that's a part of the 2030 goal, where the contribution of non-brandy comes down to, increases to 20%.
Too much of alcohol in the morning. Amit, thanks a lot for joining in. We had more time. I asked you how the tequila market is shaping up to the gin market, but that's for another day.
Now we go back to
Thanks a lot, Amit, for joining in. Well, let's get in Deepan Mehta back on the show. Deepan, you heard the conversation we had with Tilaknagar. This is a company that was absolutely, bombed out, big debt in their books, but they made their way back. Any view on the stock, or what do you prefer from from the beverages space?
See, Nigel, I think investors looking for new FMCG plays, I think domestic alcobev companies can really fit that criteria, whether it's Tilaknagar, Radico Khaitan, Som Distilleries, Allied Blenders. I think all of them have done exceptionally well. I think they're managing the state regulatory environment far better and the likes of United Spirits and United Breweries, and they're all quite reasonable except for Radico. I do like the business of Tilaknagar Industries and massive market share in the brandy market, second largest brandy in the world and largest in India. But this entire cloud about this trademark issue, that really kind of puts a big scare, because should something go wrong over there, it will completely disrupt the operations of the company. They do not have any secondary brands as well. So on the whole, we like the industry, but Tilaknagar, I'm not so sure because of this particular legal case. Although I do feel that Allied Blenders and even Radico Khaitan from distilleries, I think they have great prospects going ahead.
Okay, all right, got that. So not particularly Tilaknagar, but other companies, couple of companies like Allied Blenders could look up. Got up. Deepan, I want to ask you about Eicher Motors. From the frontline pack, that came out with a set of numbers. The commentary was a little bit positive as well out there. How would you view the stock from here on?
Yeah, I think that, we were doing a quick analysis of the Nifty companies which had high teens growth in the last 10 years. And there were just 4 or 5 of them, and Eicher Motors was one of them. It went through a lull, I think, 3-4 years ago, and then started picking up, I think, from this year onwards. I'm particularly impressed with the progress made on the export markets, because if they do well over there, it opens up new opportunities. Reasonably priced share, I think. And certainly, even at these levels, despite there being some slowdown in the auto industry and two-wheeler industry, I prefer Eicher Motors. It's a great rural play also. So if monsoons do well, this company also should do much better. Having said that, it's a company in which we and our clients are invested in.
Just a reminder to our viewers, yesterday in the second half of the session, the entire railway pack suddenly got turbocharged, and that included all kinds of stocks from an IRFC to RVNL to, the entire likes, even some of the private sector names. Deepan, just your thoughts here. I mean, I'm not sure if that was just a flash in the pan because in general PSUs were up, or whether they're sensing something. But would you be looking at any railway stocks at this point?
Not really. I think they're fairly valued, and it's an old story, pretty much well discounted, well understood. These stocks move up and down based on order flows and performance. But no doubt, I think railways are going to invest more and more in the infrastructure, and that's going to benefit these companies. But I think amongst the entire investment theme, I think IRFC certainly is something which is quite interesting, given its position and given the new opportunities it has got to increase its loan book.
Deepan, hold your thought. We'll slip into a very short break. We'll come back and also get in a few technical trades. Stay tuned.
Welcome back. Hope you're having a good morning. Well, for starters, the Gift Nifty suggesting a more or less flattish start to trade. Maybe a mild positive bias, 35 points higher. But Sudarshan Sakani as well as Chandan Taparia are joining us for a quick technical check. Good morning, gentlemen, and good to see you all in as always. Sudarshan, you're maintaining your positive bias. Well, yesterday, in fact, we had a bit of an intraday dip. The markets moved into the red, but recovered swiftly. Would you recommend buying on the dip yet again?
Yeah, good morning. Yes, the trend is up, and see what happens is after a 1,000-point rally, markets will consolidate. we cannot expect markets to have some kind of a gain day after day after day. That doesn't work out. So we are in a process of consolidation, but the consolidation does not change the overall short-term trend, which is that we are slowly inching higher. So every small dip is a buying opportunity. Now there are two ways to exit. One is if you see a rally, whatever modest profits are made, get out. If you are a positional trader, if you buy on a dip, hold on to it. Now we also have an exit strategy on the lower side. That is somewhere around 24,400. So if the market, that is the place where the gap up had happened on Monday. So if the Nifty, if were to start sliding below 24,400, then obviously all bets are off and something different is happening. Till then, buy on dips.
Okay, buy on dips is the call. Sudarshan got that. We also have Chandan Taparia with us. Chandan, good morning. What about you? Mid-cap market is in party mode, but the large cap index is consolidating. What is your approach today?
Yeah, good morning. Thanks for having me. So really the Nifty managed to recover well from lower levels in last 3-4 days. However, it has been consolidating from last 2 days, witnessed some profit booking as it fell to surpass 25,000 marks. But the good part is that advanced decline ratio is better and many mid-cap and small cap stocks are doing well. In fact, many small price name from FNO and non-FNO counters are witnessing sustained buying interest, including selective railway, defense, metal, auto ancillaries. So I believe that we need to focus more on the stock specific until Nifty holds above 24,444. Overall buy on decline could continue for an upside move towards 25,000. So I believe the VIX has to cool down below 14-15 marks and Nifty needs to hold about 24,444 to continue the positive to range bound, while stock specific action could continue to buzz well in this market.
Okay, got that. Let's come to stocks as well. Sudarshan, morning. What's your stock list looking like? What are you trading today?
Yeah, good morning. Well, you talked about mid caps, and it's all mid caps and small caps, except for one. Exide Industries is a buy, the stop under 357. LIC Housing Finance and finance and banking are going to be outperforming sectors, I think. LIC Housing Finance is a buy, the stop under 604. The large cap stock is Bajaj Auto, which is a buying opportunity with a stop under 79.50. And finally, again, Ramco Cement is a buying opportunity, stop under 975. It's a good idea to focus on stocks and let the index be.
Okay, all right. Got that. Chandan, what about you?
Yeah, so first is buy on BL. We have positive on most of the defense name, be it BL, HL, in fact, counter like Mazgaon Dock, Cochin Shipyard, GRSC, Paras. So positive on the entire defense theme and expecting 5 to 10% rally in most of the counter. But here, as a top pick, I'll go with BL. The stock has been making higher tops, higher bottom from last 4 days. It has given a breakout on the daily and the weekly chart. In fact, on the monthly chart, it has given a breakout from its bullish pole and flag pattern, which has potential target of 15-20% on upside. But on immediate point of view, suggesting to buy on BL with support of 337, and this stock can head towards 360 marks. Second trading area, that is buy on Union Bank. Selective PSU banks and small private banks started to witness buying interest. Union Bank has seen the decent run-up in last 4 days from 115 to 135. It has given a consolidation breakout of last 40 weeks and delivery volume as well as the open interest activity is rising in most of the counter. So expecting further up move, one can buy with support of 131 for target towards 143. Third idea, that is buy on NMDC, positively on the metal mining name. And most of these counters have bottomed out and a small follow-up can lead to the short covering trigger. NMDC has managed to close near 70 and a small follow-up can lead the counter towards 75, 76. So one can buy with a stop loss of 68 marks in NMDC.
Thank you very much for that, gentlemen. We'll slip into a very short break. When we return, we'll get you the pre-opening rates. We'll also get chatting with the management of Berger Paints to discuss their Q4 numbers. And remember, this is a company which has outperformed its peers. Berger's volume growth in Q4 was 7.4%, ahead of Asian Paints' 1.8% growth. More details coming up with Abhijit Roy.
Back to that conversation with Deepan Mehta. Deepan, hi, morning. So we discussed railways earlier, and you made that point that this could probably just a sentiment-based move. But now let me ask you about defense, because this defense rally is something that you can't ignore. The index is already up 8% in the last 3 trading sessions. And we know that the orders are coming in. That's not the problem. And the narrative, the theme, all of that is fine. The question is figuring out where the P&L looks the best and the valuations aren't too high. So do any stocks meet that criteria for you?
What are you saying? 8% in the last 3 months. It has gone up by 45%. The India Nifty, India Defense Index, if I get it right. And look, I think these stocks are in focus because of what has happened at the border, and a lot of investors also looking to increase their exposure there. But it's a small portion of the overall market capitalization, about 2% or so. And all of the stocks over there are really, really expensive. This is not a business that you can quickly scale up and keep on doubling your profits every year or so. So investors need to temper their optimism. It's a great sector to buy when the chips are down and when there's a correction, when it is not in the limelight, as it does happen from time to time. But buying these stocks at these levels, I'm not sure the risk return profile will favor you. The PEs are so expensive in the range from minimum 40 to 100 times or so. And buying businesses at those PE multiples, 2-3 years down the line, you realize that the profits have come through, but the stock price has not made any great gains. So I would avoid all defense stocks at this point of time. It's a contrarian view, but I think it's a conservative view.
Okay, all right, Deepan, I was so happy to hear after a couple of years that you were interested in cement. Yeah. And that call's actually playing out well, because otherwise we don't have too much in common besides understanding the market. Because metals, though, you don't like, but luckily for me, cement is something that you found some interest in. Actually, the last couple of numbers have started looking up. I recall on Editor's Roundtable as well, I put out this piece that maybe cement could be the pocket that will start surprising, because not affected by Trump or any kind of global activity. What's your view on the pack? Shree Cement came out with a set of numbers. It's a good set of numbers. The problem for Shree is valuations. But your take, and what's your top pick?
See, Nigel, it's not just cement that we now have commonality, but for many, many years, we have been very positive on Aisha, you for its motorbikes and me for
I came on it.
But nonetheless, I think cement prospects are looking up. It's a cyclical industry. And certainly, I think the upcycle has started for the cement industry. Execution across the board will improve, whether it's for infrastructure projects, whether it's for real estate projects. And that, I think, will improve the demand. Also, they're getting some benefits on the cost side as well. And overall, I think that the industry is getting a little bit of price discipline in place as well. Top picks have to be ACC, Ambuja, I think, best-in-class performance. And there's an opportunity here, at least in ACC, to improve the efficiency, which can flow to the bottom line. So I would prefer those companies rather than the super efficient players like an Ultratech, or for that matter, Shree Cement.
Okay, got that. By the way, the pre-open is telling us it's going to be a slightly quiet start, which is all right. I mean, sometimes it's okay to open quiet and then build on it. 16, 17 points higher on the index. But I was looking at the result reactions, and the early indications are that Tilaknagar Industries will definitely start the day on a high. About 8% up on that stock. And you just heard the management there talking about their prospects, sounding quite optimistic. Muthoot Finance is the other one, 5.5%. And this is the management we'll speak to shortly. The others, Kalpatru project just announced a big order win. It's been flashing on the ticker as well as a pretty sizable order, over 2,000 crores. So watch out for this stock. E-Clerks, Lupin, these are some of the other positive result reactions that are coming in. But Karnataka Bank has been a disappointment. So from the earnings front, I think that could be slightly on the back foot. 4% down in the pre-open on Karnataka Bank. There we go. But since we're talking earnings, let's quickly rewind Eicher Motors. It's been a good quarter. And as Nigel's been telling us, all the Royal Enfield fans perhaps will be happy because Eicher seems to have delivered. So Darshan, do recap the numbers, the commentary, all of that for us, please.
So Eicher Motors' performance has been playing as per company's playbook because company has been saying that it will continue to focus growth over margin. So even in Q4, we saw that both profit and revenue have seen healthy growth while margin has slipped. Also, it has come slightly below our expectations. Profit was up almost 27%. Revenue has increased 23%. EBITDA has slipped 11%. And margin was down 250 basis points if you compare year on year. Also, realization was flat. It was up 1% sequentially and down 1% year-on-year. But what is good part for Eicher Motors is the market share gain that it has been seeing in the segment of more than 250cc. In there, it has gained market share of 100 basis points sequentially and 40 basis points year-on-year. Talking about the outlook, company saying that it will continue to see healthy growth even in FY26 and will outperform the industry. And one good thing that company has talked about is the positive sentiment is returning in urban, and that was reflected in the month of April numbers.
Okay, all right. Thanks a lot for that, Sud. Let's hop across to Vivek. He's here to tell us about Tata Power. Vivek?
Well, good morning. Well, Tata Power, when you're comparing it against the estimates, it's been an operational beat, now 25% year-on-year growth as far as, the profitability is concerned, and that is something that the street will like. Let's have a look at the internals and the profitability mix. Number one, what has contributed to the profit? Our contribution to the profit mainly from the renewable energy part of the business and the solar EPC business that have clearly delivered. Coal prices have been down, so the share of coal JV in profit has been lower. And along with that, one thing that the street will look forward to is the capex. So the FY25 capex, the company at the start of the year had given a guidance of close to 20,000 crore, indicating almost a 1.4 gigawatt capacity addition as far as renewable energy is concerned. What has the company achieved? Close to 16,200 crore, indicating that there has been a miss as far as capacity of renewable energy is concerned. However, the company said that it should be done within the first couple of quarters of FY26 itself. FY26 capex guidance very strong at 26,000 crore. We will have the management joining us shortly. Couple of important questions. Number one, what led to the delay as far as capex is concerned? Number two, the UP Discom privatization, and that will be something on top of most of the analyst minds. What is the status of that? And Mundra continues to operate under section level, thereby not impacting profitability, but any visibility as far as long-term PP is concerned. Yesterday, the management did allude to the fact talks are at advanced stages over there, so that'll be something that the street will look forward to.
Thank you very much for that. The big stock on the way down is Wendt, and that's where the promoters are looking to sell some stake via an offer for sale, and the stock is locked in a lower circuit. Wendt, is that the correct way I'm pronouncing it? I think, yeah, that's the one you should watch on the way down. But let's talk about Muthoot Finance. Ramakshi is here to recap the numbers.
Well, Rima, it's a strong set coming in from the company, and I stood at 3,355 crores. This is an uptick of almost 6% sequentially and 32.5% on a year-on-year basis. The NIMs too have improved from 7% to 7.3%. The AUM growth has also come in very strong, up almost 11% sequentially, much faster as compared to the 8% growth that we saw in the third quarter. Good growth is also being accompanied by good asset quality as well. Impairments were down nearly 3%, and stage 3 asset loan came in at almost 3.4%, much better than 4.2% seen in the previous quarter. FY26 outlook from the company also looks quite promising. Guidance on the growth is maintained at 15%, and in fact, they've also said that the guidance could see some upward revision in the first quarter. They will be opening 115 branches under Muthoot Finance, and Muthoot Money is also expected to leverage 1,000 branches for gold loans. So overall, when you look at the numbers that came in from Muthoot, strong set.
Thank you very much for that. Sudarshan is back with us for his 9:10 call. Sudarshan? Sudarshan?
Stop under. Hello.
Yeah, go ahead.
Okay, buy Exide Industries with a stop under 357.
Thank you very much for that. Now let's invite the management of Berger Paints. They've reported a good set of numbers. The company's volume growth came in at 7.4%. Ahead of competition, Asian Paints had a volume growth of less than 2%. And the company's margins too have expanded to 15.8% versus 13.9% in the prior quarter. We have with us Abhijit Roy, MD and CEO at Berger Paints India, to talk about the way forward. Thank you very much for joining in. Before, we have the numbers for the quarter gone by, but looking ahead, if you could help us with your expectation for FY26 in terms of volumes, revenues and margins.
So as far as volume and value is concerned, I think it will be progressively improving as the year progresses, which means, quarter one will be slightly better than quarter four. Quarter two will be even better, and quarter three will be better than quarter one and quarter two. So that's how it will progress. As far as margins are concerned, more or less it will be at similar levels as we are, currently, which is around the 16% to 17% mark. Our guidance has always been between 15 and 17. We have been operating towards the higher end of the guidance, so we will probably remain at that level.
So for the full year, what kind of volume growth will we see as you expect progressively improving numbers?
high single digit to double digit. That's where we should be.
And margins 15 to 17%, as you've always been guiding for.
That is right.
Okay, all right. Hi, Mr. Roy. Good morning and good to see you, Ben. Tell us about the competitive intensity. Last year was quite good, actually, because you have a large player that's come in, but you have still managed to go ahead and increase your market share by around 80 basis points. So what kind of a challenge is Birla Opus posing to the industry? And where do you see your market share go from around this 20.3%?
So, it's a big company and, they're spending a lot of money. Much of it, some of it, therefore is, extra than, what we have seen in terms of competitive intensity in the industry. Obviously, that buys some market share, so therefore, there is a temporary turbulence, I would say. How long that is sustainable and the type of strategy that is being followed, it has to be seen, but we have managed to stay afloat. We have our own growth opportunities, though there might be, marginal losses in some of the accounts, but we are reasonably certain that we should be able to maintain our market share at current levels.
Okay, possibility of you increasing it?
Well, it depends, as far as we are concerned, we'll continue to work, rest is up to the competition, how they shape up and what they do. It's not up to our, so market share gain is typically, what you do, different and beyond what is the normal. So we have some of our own strategy, which we think is going to work, has worked last year, will continue to work this year as well. So therefore, depending on how we execute that, how we execute those ideas, it will give us either some gain or, or we will just be able to manage our market share. But we are hoping that then we will be able to definitely maintain and if not improve a little bit.
Some of the economy categories like low-end primers, emulsion are facing the heat and there's lower pricing because of competition. Do you expect that to sustain? What is the outlook on raw materials? And I know you're maintaining margins, but your sense of raw materials in the near term and pricing of your end product?
So yes, the lower end products, as you rightly mentioned, is facing competition because those are price sensitive products. And if you start spending on those categories, you are likely to gain some share. We have been careful in not being over the line, and going overboard in order to defend. We defend to the extent that is necessary. We make up for that, marginal loss in profit from other areas of, selling more premium and luxury products. And more profitable products, therefore. We always look and strive for improvement of profitability through various means, cost initiatives, even product formulations, launching innovative products. We have launched some very innovative products recently. One of them, Roof Cool and Seal. The other is Tank Cool, which keeps the water in the overhead tank cool. In this hot summer, it becomes a big problem to bath in the afternoon. So there is, this system which we have created, which if you coat the tanks with, it will reduce the temperature by almost 8 to 9 degrees. So those are innovative products which are consumer need unmet so far and which we keep, selling in the marketplace. And there the margins are always higher. So we have our own strategy in place, which we would like to, carry on with.
Interesting innovation out there, Mr. Roy. But before we let you go, give us a split between rural as well as urban. And as of now, are you see things improving on the urban front?
So, we have some strong points in the urban markets, and some very weak areas like Mumbai or Bangalore or Hyderabad for that matter. So what we are doing is, trying to improve our distribution network in the weaker markets and maintain our strength in the stronger markets like, Kolkata, Lucknow, Delhi, etc. So these markets, we will have the maintenance job of maintaining a market share and ensuring that it doesn't get disturbed so much. And in the other areas, we have a fair chance of gaining heavily because our network itself is, an issue and which we are tackling through some, of our own distribution strategies. So this is what we are looking at. But as far as rural and demand, urban is concerned, the demand is more or less similar in nature. We haven't seen, actually in paint, we don't have pure rural, unlike FMCG. So they go into, much more villages and, penetrates it very deep. In our case, it's mostly urban, semi-urban, small towns where we, sell our paint because you need pakka houses for that purpose.
Yeah.
But more or less, the demand has been similar in nature. This talk of, urban being, different from rural doesn't hold true as far as, the
For your industry. Got that point, Mr. Roy. Thanks very much. And that's a very innovative solution. As someone who spent the better part of my early years in North India, the water heating up in tanks is a real problem in those urban and semi-urban areas. So quite interesting there. Thank you very much for joining in. That is Berger Paints. We are down to about 5 seconds to the market open. It's going to be a quiet start. Let's see if the bulls can build from there. That's the real question. About 11, 12, 15, 20 points now up on the Nifty. Mid-cap index, like yesterday, is doing better. The gain there is about 0.25%. Banks are absolutely flat. Now there's a little bit of red flashing on the screen. Bank Nifty and the Nifty flip-flopping between negative and positive. Not too much of direct leadership, visible. And banks were a problem for the market yesterday as well. Let's get the heat map up. So it's neither here nor there. You don't have too many, major pulls on the downside, but you don't have too much of leadership also. So therefore, there you see, it's almost a 50-50, even Steven kind of a screen. Net neutral, but the bias is slightly negative for the time being, and the Bank Nifty holds the key. Bank Nifty for the time being is down about 100 points.
Well, from the broader markets, a few stocks actually are calling for your attention. The ones that are doing really well is Tilaknagar Industries. Well, the stock is up close to around 10%. Management sounding extremely optimistic. Volume growth in Q4 was very, very strong. The street likes that. So that one's up close to around 10%. Vascon Engineering, well, the numbers look very, very good. They've gone ahead and for a 1,000 crore market cap company, they've raised close to around 45 crores via selling a stake in one of their, ventures that they had. So that's around 4.5% of the market cap. So that's why that stock is up. Finally, the numbers coming up. Remember, the stock has come off big time from the top. Other couple of stocks that are doing quite well today. You have Lurch Revenue is Tech. Well, that stock, in fact, is up close to 4.5%. I think it came out with a good set of numbers. Yeah. So that's one stock that's moving well. Sri Renuka as well is moving up on decent amount of volume. So good move out there. Piramal Pharma started up gap up with a gain of close to 4%. But that's given up some part of the gain as we speak. The ones that are under pressure, I think Bazaar Style Retail, stock is down 7.5%, so some selling being seen out there. Which other stock is coming on the radar? You have ADF Foods that's down close to around 5%. I don't know what's gone on there. And DAM Capital, remember it listed, it had big gains, but from the top, actually, the stock has got slammed. And I think it came out with its set of numbers. The street maybe were expecting more because the stock is down close to around 4.5%. And Karnataka Bank as well, I think we highlighted earlier.
Yeah. Muthoot and Karnataka seem to be the two result disappointments so far this morning.
Well, Eicher Motors has opened in the red. So despite in-line numbers, the stock is down close to about 1%. Numbers were in line, but valuations are expensive for Eicher Motors, and Eicher Motors is spending on growth. So margins are perhaps, according to some analysts, could get impacted as the company is now investing for growth and spending for driving growth. So Eicher Motors in the frontline pack is the one which a big move. IndusInd Bank is down over 1%. On the way up, you've got strength in JSW Steel, Hero MotoCorp. These are the only two stocks with gains of about 1.5%. On the way down, we spoke about Muthoot Finance. The other one is Karnataka Bank. Disappointing set of numbers. The NII has contracted. The stock is under pressure. Sagility is the other one. Again, stock reacting to numbers. On the way up, I think Sharda Cropchem had a positive tick early in trade. Very strong numbers. Revenue growth of close to about 6.9%. 39% revenue growth. Volume growth was about 48% in the agrochemical segment. The herbicide segment was also an outlier with a revenue growth of 57%. So strong numbers. And Apollo Tyres, we thought the numbers were a bit subdued relative to peers, but Apollo Tyres has actually opened up in the green. So that's the other one bucking the trend.
Okay, all right. So quite a few of those result reactions continue to play out. Overall, though, it is a far more cautious morning than what we had yesterday. Yesterday, right from the morning, the mid-caps were doing very well. But today, it's a little more measured at this point in time. So let's see how this plays out. Large cap screen, the losers include an IndusInd Bank, Dr. Reddy's, ONGC, M&M Eternal. So it's really mixed. It's across the board today. Not very clear sectoral trends coming out, at least so far.
Some of these railway stocks like Texmaco Rail, Ircon, I think are still continuing, extending their rally.
From yesterday, yeah. So that buzz is still on. And watch for sugar, Renuka and Bajaj Hindustan, both seeing some buying as well. All right, we've got Tahir Badshah joining in. He's our market master of the day. And of course, he is from Invesco Mutual Fund. Tahir, thank you so much for being here with us. So, you know, the market's had its hurrah moment and it's been a fabulous comeback from those early April lows, right? The question really is now what next? Because now we're back to asking about the micros, about things like earnings, till the flows come back in a big way. So when we talk about those core fundamentals, which is earnings and valuations, how are we poised after this strong pullback in April?
I think before we saw this market once again start to kind of recover significantly over the last 6 odd weeks. I think what we had seen was roughly about a 10% correction in the valuations of large caps and probably close to about 12 odd percent on the mid cap indices, and perhaps more closer to about 18-20% as far as the small cap index was concerned. From there onwards, of course, we've seen a rally, and good part of it is probably covered. So I would assume that still compared to, let's say, December 31st levels, which were where the markets probably peaked, we still probably have some valuation decline. But meanwhile, like as you rightly said, I think the focus after many of the other clouds having cleared over the space of the past few days has shifted to earnings. And on the earnings front, I think what has come out so far seems to be quite nice to see. And probably that should impart some support both to the strength of the market as well as overall valuations as well. So I think what we've seen up until now, whether it be in the large cap space, mid caps as well, there's been a fairly strong delivery of earnings. We are still halfway through the earnings season, but by and large, in terms of representation, probably about 70 to 80% of the market cap in each of these three buckets is probably now already through, and we are seeing roughly about double-digit kind of growth at an aggregate level. But mid caps have done stunningly well with probably a 18 odd percent growth, if I'm not mistaken. That's what I probably saw at an aggregate level. Small caps have trailed, but partly also on account of commodities and metals. If you strip off that, it is still single digits, not too great, but nonetheless, I think it takes away a lot of risk as far as expectation on earnings is concerned, and particularly compared to the September and December 24 quarters.
Tahir, hi. Morning. Rima here. Is there a real risk that money moves out of India into China? When you speak to other investors who have that option, is there going to be the tactical switch?
It's quite likely. I think even before probably the last week that we saw climb down as far as US-China trade tensions were concerned, we felt that, at least I was of the opinion that probably this time around, when flows return to emerging markets, there will be a fair bit of China too will be a reasonably decent beneficiary, unlike, let's say, over the last 2-3 years when generally India has dominated the scene. And that's thanks to probably, deep seek at one level, and probably the realization over a period of time that the Chinese economy is trending somewhat differently compared to what it has traditionally been. Traditional sectors have started to kind of look a little more, stable, real estate, infrastructure, their own domestic consumption. And alongside which it is now probably being viewed from the lens of, an economy which is reasonably tech oriented, whether it be in the form of things like artificial intelligence, automation, robotics, medical automation, etc. So I think the complexion of that economy is changing, and probably global investors would be inclined to look at least some parts of the economy from that lens, which perhaps is a place where India probably does not provide them that opportunity or exposure. So I think it'll be India plus China in terms of flows as we go along, and especially if emerging market flows improve on an aggregate.
Okay, all right, Tahir. Good to see you after a while, Tahir.
Thank you very much.
How would you position yourself, though? Because the domestic interest is back now. And over the last few days, you've suddenly seen that the broader markets are actually doing well. And the point you made that earnings haven't been as bad as expected. So as of now, would you be tilting towards the mid and small caps that actually took a hard hit? Or would you stick to the large cap names?
So, Nigel, actually, we didn't really back off from the mid cap and small cap space as much over the last some time. We've been through the thick and thin, and we also probably were not in the camp where we believed in terms of taking those cash calls and stuff like that. So I think generally we don't do that under most market circumstances. So I think that has kind of probably helped us to recover quite quickly, especially in this recent rally. At our end, I don't really think there's been much of a change. At the margin, probably I would have thought that our mid cap and small cap exposures would have only gone up in the recent few weeks or a couple of months. We continue to ideate out there. We continue to probably find pockets of interest, either growth oriented or probably value oriented. So I think we are pretty much there when we probably have only gained at not having actually disrupted the balance of our portfolios despite the volatility in the market.
Tahir, for mid caps, obviously it's usually always bottom up. But in terms of a theme or some sort of a segment within the mid cap or small cap arena, is there anything where you see clear visibility, something that excites you right now?
I think basically at one level we are probably a little more positive on NBFCs, for example. To some extent, that is where we probably find opportunities in the mid cap space. Few pharma companies, that is something which also probably is interesting. Some of the industrials have actually also done well, both in the mid cap, in the mid-sized market, as well as some of the larger cap names have also done well. More particularly, we all know defense has actually made a roaring comeback. So even there, we have a few mid-sized entities as well. So I think these are some of the areas which I believe have where we have probably increased our exposures. I think mid-cap tech, especially in the more recent decline, has also offered some opportunities. Maybe not as much on mid-cap, perhaps mid-cap as well as some small caps too. I think have also helped us out there, and that is an area we have looked at least from a valuation standpoint or a value standpoint, especially after the correction which happened post April 2. So I think these are the few spots where we probably have added to our exposures and weightages.
Okay, what about
just one question on mid-cap tech? Is it the IT services companies or would it be some of these ER&D companies like a KPIT
It's largely been the IT services company.
and you would go back the high growth ones because there the valuations are relatively expensive.
They have been sticky. Valuations have been sticky, but delivery has been reasonably strong in some of those names. So we have continued to back some of those. Perhaps some of the, as we've gone down along the tier, some of the small cap entities have also probably taken our attention. And it's not as much because they've done well in the last quarter, but looks like at least that they've had specific factors which have affected them. Probably looks like the worst is behind them. Some trends which are emerging, which seem to suggest that the next few quarters should turn out to be better. And then, of course, valuations have been supportive. So I think that is where we have basically set our sights.
Got it. Final question before we let you go, Tahir. I think real estate was a pack that you liked, earlier.
Real estate, right?
Real estate, yes.
Yeah,
You're maintaining a positive bias, and if you could tell us at least geography-wise, where you're more bullish.
So I think so I like real estate and especially after this correction, I think real estate is an area which I would still prefer. I think as we see decline in interest rates, that should be further supportive. By and large, from a more structural standpoint, we believe that this sector is still in its relatively early stages. I would say we have another 2-3 years to go at least for the cycle to hold itself. We've not necessarily gone by geographical preferences because quite a number of the companies that we own have their anchors in certain specific areas, locations, whether it is south or north or perhaps east. But largely, we've looked at them from a perspective that which are the ones which, if they try to become pan-India players, should be relatively easier for them to do so and should be able to extend their presence in other locations. So that has been the driver, that has been the driving theme as far as a stock selection in this space is concerned.
Okay, all right. Final question on consumption. You'll be leaning towards discretionary, I think so.
Yeah, we have that around. Within which I think we would have probably, altered a few choices. Noting the fact that, we are probably likely to see some deceleration as far as urban-centric consumption or discretionary growth is concerned, and a pickup on the other side as far as rural is concerned, or perhaps value retail is concerned. So there would have been some shift in that regard. We would have added to a few value retail, segments, and probably also a few of them which are basically in things like QSR, etc. Once again, a little more tier 2, tier 3 driven. So that's where I think our incremental choices have been. But once again, it's a fairly decent mix. At the margin, we are probably move more towards some of the value retail stories.
Tahir, it's interesting you mentioned QSR. I was looking at numbers of Westlife, came out with numbers, I think, yesterday. And even companies like Jubilant, finally, those numbers have started looking up after many, many quarters. So the entire QSR space, or this restaurant space, food space, so to speak, how are valuations here? Now the numbers, the earnings seem to be catching up. At least they're not as bad. Is there a further runway ahead? Because we all know the big talking point, of course, has been this additional 1 lakh rupee in the hands of people thanks to the income tax cut, and whether that is going to boost demand further. What's your sense?
So obviously, valuations are not of the type which are mouth-wateringly cheap. But basically, I think quite a number of these names have been at the bottom end of their business cycle itself over the last 2 years, primarily because a larger part of the incremental growth in many of these do come out of the non-urban centers, and the non-urban centers have probably been a little slow over the last some time. But things are probably likely to change. Perhaps if we get a good monsoon, interest rates are already coming down, inflation is coming down. That probably gives a little more space for discretionary spends to go up in the mass segment of the income pyramid, and that is probably what will drive incremental growth, if at all, for some of these QSR companies. So that is where we are basically laying our bets and trying to play that segment.
Tahir, great conversation as always. Thank you very much for joining in. Now, as promised, let's invite the management of Tata Power. Now, Q4 was a good quarter for them. There was an improvement in margins. Profitability too was higher. We have with us Praveer Sinha, Managing Director and CEO at Tata Power, now joining in. Mr. Sinha, morning. This is Reema here. My first question is on your capex. Now, FY26 capex was about 16,200 crore, while you had guided for 20,000 crore. So what led to the shortfall? Was there a delay in capex spend? And what can you guide on capex going ahead?
Good morning. Thank you for having me on your show. You're right that we had planned a capex of 20,000 in FY25. We could complete nearly 16,200 crores during the year. Some of our projects got delayed, especially because the evacuation lines for renewable projects, they got a little deferred, which of course will happen in the Q1 of FY26. Similarly, some of the projects of our transmission lines, which we are executing, there were issues about right-of-way, which now have been sorted out and will get completed in this quarter and next quarter. So I think it's just a question of timing, and we are very much on track to complete all these projects that have been planned last year and planned for this year.
All right, Mr. Sinha, hi, morning. Thanks very much for joining. And yeah, I guess that was one of the reasons behind the drag, right, at the top line level. On renewables, can you give us some sense of the revenue outlook? Is you're saying that a lot of these issues that impacted the performance in Q4, they'll get sorted out. So what should we expect overall from the renewable portfolio? Give us a sense of the revenue growth and also in terms of the capacity that you'd be looking to add in this particular year.
So last year, we did a capacity add of nearly 2,300, out of which 1,000 was for our own project, that is the utility scale projects that we did. This year, we have a much higher target, and those projects will get completed in this financial year. Also, last year, we had for a very brief period the cell and module plant operating. And of course, the module was for a longer period, but the cell was for a very brief period. With only about 900 megawatt of cell we could manufacture. In FY26, we are expecting that this will cross 3,700. We also expect that our rooftop business, which has now really started pumping up. In fact, in last quarter, we saw the rooftop business doing a PAT of 100 crores. And if that trend continues, then we can expect a very high number in this coming financial year. So I think all these renewable businesses have started kicking in and has started yielding very good result. If you see on year, it was nearly 47% increase in PAT for a renewable business. This year, we can expect similar numbers for growth. So I think what you would see is a very stable performance from our renewable business. And there's not only the utility scale, but also in terms of manufacturing and rooftop.
Okay. Speaking of renewables, on solar, I don't know if you're looking at exports right now at all, because the big headline in the quarter was the US imposing these humongous tariffs, right? It was almost, I think, some 3,000% or something on several ASEAN countries on, solar cells and modules, etc. Does that open up an opportunity for you at all on the solar side, exports?
Right now, we have our commitment to our own projects, which are supposed to be DCR projects. We have commitment to rooftop, as also some of the third-party EPC that we are executing, and we expect that we will complete most of them in next 6 months. And thereafter, possibly, we'll look at the opportunity of exports. But I would like to only say that there are great opportunities within the country, even for third-party sale of just modules, because the DCR has kicked in various businesses, and there is a need of DCR modules. So I think we will weigh the options, whether it makes more business sense for selling within the country or we should export certain quantity. But we'll take a call maybe in the second half of the year.
But are you facing more competition, sir, in this particular segment? Some analysts are pointing that out, which has led to lower market share for you.
I don't think there is much of competition because the cell manufacturing is still very low. We are actually one of the biggest in the country in terms of cell manufacturing. And while a lot of capacity is expected to come in next 1 to 2 years, for immediate future, I would say that we have a very, very good market share. We'll be able to cater to that.
Okay, let's talk about the Discom business, Mr. Sinha. I believe Odisha is working out very well for you, and that's partly responsible for the strong margin improvement as well that we saw in the fourth quarter. Tell us a little more about trends from the Discom business for FY26. What should we expect? And the one that's of maximum interest for everyone, UP. What are the timelines there? I mean, I think you've expressed your interest in bidding as it opens up, but what are the timelines we can expect?
So Odisha has been a great experiment for us, and the type of service improvement, whether it is in terms of reliability, customer service, all that has improved tremendously. And many of the legacy issues which were there in terms of billing collection, we have been able to sort that out, including old payments which were due, but we were not earlier able to collect. Most of it we were able to collect in the last quarter. And this trend will continue because now the processes, systems, the IT support that is required for doing that is all very well established. And I do expect that Odisha will do much better result in the coming year because what we have seen in the Q4, similar type of results we can expect in the coming year, quarter on quarter. On UP, I think the government over there is very keen to pursue this opportunity of privatization, and the PPP model, as has been done in Odisha on similar lines, we expect the bidding process to happen. From what I understand, they have already appointed a consultant and the bid documents are expected in this month end. And possibly in this calendar year itself, the bid will get finalized. And Tata Power has the unique experience of both doing this type of distribution work in urban areas as well as rural areas, which many of the other private entities do not have. And I think we have an edge compared to anyone else.
So, just coming back to that margin point, at the end of the fourth quarter, your EBITDA margin has moved up to as high as 19%. I guess the solar business is powering that. The Odisha Discom business is powering that. Is that level sustainable? Can you give us some sense of the margin profile that we can expect this year, maybe first half of the year or the year as a whole? And whether, UP, if you get it, would it become a drag at least in the initial phase?
Well, we have seen that UP will come only in the later part of the year. But the margins that we have been able to improve, this has again been sustained over a period of time. And you have seen that every quarter we have come back with an improvement in the margins. And these are on very strong foundation. This year, our performance of our core business has been exceedingly good. And that is what is the big change that you would see in Tata Power, that how our core businesses have started now yielding very good result. And that's the way it is expected to be in future.
So, for a long time, you've always said that you're committed to not expanding your coal portfolio. You want to phase out your current thermal portfolio as and when the PPAs expire. And the end goal is that you should have zero thermal exposure by 2025. So while you'll still achieve it, but you are stating or indicating that you've not ruled out any opportunistic bid for stressed thermal assets. So the question really is that in the interim, what is going to be Tata Power's thermal strategy?
So as we have been maintaining, many of our PPAs have an end date. And as and when those end dates will come, we will definitely like to decommission those plants. And we stand committed to that. Secondly, we do understand that there is also in the short term a requirement of energy security. And if there is a very good proposal which is there, we will examine it. It's not that we have committed, but we will definitely look at it. If it meets our overall objective that by 2045 will become net zero. So that date does not change, and our commitment of 2045 does not. In between, if there is something that comes up, we can consider them on merit.
Okay. All right, Mr. Sinha, thank you very much for joining in and giving us some perspective on the business. Wish you good luck for the rest of the year. Well, that's Tata Power talking about going ahead and probably looking at the UP Discom as well after the success that they've found in Odisha. Stocks down about 0.5% at this point in time. Well, we're staying with the industrial space. The next company on our radar is Hitachi Energy. The fourth quarter performance was another pretty strong performance, especially on the operational parameters. The margins were a beat on expectations, and the order book has seen a growth of 166% and profit has also increased. We have N. Venu, Managing Director and CEO at Hitachi Energy, now joining in. Mr. Venu, thank you so much and congratulations on another good quarter. Now, some will quibble and say that your top-line growth in Q4 is not as strong as what you've done historically. The top-line growth, I think, is about 11%. But obviously, those margins at 12.6%, they're looking spectacular. I'll start with the one main question. This HVDC order that you've bagged, this was a big announcement over the year that's closed out. Now, what is the revenue recognition timeline? I mean, over how many quarters? When does it start coming in? Yeah. And therefore, when will it start leading to, a stronger revenue growth?
Sure. No, I think, thank you very much having you in your show, and good morning to all of you. And as you've seen, our results, strategic focus, and also cyclical trends delivered a very strong quarter in Q4. And if you really let me give a 30 seconds deep dive of our results. And our orders are up in the quarter almost 56%. Our revenue are up by almost 13% on year-on-year basis. And our margin in the quarter is up by 62%. And our operational EBITDA came double-digit, 12.3%. And this is also our full year performance. And if you really take the whole of year, our orders are up pretty strong, 228%, primarily bagging HVDC order and others as well. And revenue is up 23%. Yes. Whole year revenue up is a very strong orders. And we have been consistently saying in your own channel that we have been growing higher than the market on the top orders especially. And then once we have the order backlog, so naturally it will convert into a revenue over a period of time. And that's exactly happened in that. But if I come back to your specific question on the HVDC order, which we have
the recognition. Yeah. So we just want to understand, I mean, just for the benefit of our viewers, the revenue that you did in FY25 was 6,385 crores.
Right.
And your EBITDA margins were already at a multi-year high, 9.3%. So we just want to understand that as the booking of this HVDC order starts, how will the FY26 P&L profile look like? Revenue, margins, how does it change?
Yeah, as you know that we don't give you a forward-looking statement, but let me give you a little bit of marker so that you understand that we have been consistently saying that, we will reach a double-digit margin by end of this financial year. In the quarter, we already reached here. And we said we will sustain that. Quarter by quarter can differ. But on an overall year, if you really look at the FY26, we said we will do a double-digit margins on that. Our HVDC's revenues this year is going to be a very small revenues. But in the year 27 and 28, we're going to have a bulk of the revenues we're going to realize in these two projects in that.
Okay, so even without the, it'll be a very small trickle of the HVDC boost that comes in this year. Yeah. Even without that, you're saying margins will be in what, low teens? When you say double digit, what does that mean? Low teens, mid teens, some range?
We don't want to give a thing. I said we will enter double digit and we'll sustain there. But again, I'm saying quarter on quarter might change. But on a year-wise, if you really look at an overall year basis, so we will, I think, sustain the double-digit.
Okay. All right, Mr. Venu. Good morning and good to see you, Ben. You can focus on business, but the markets seem to sometimes take into, factor in valuations. Could explain why the stock is down 4% or thereabouts, but the performance has been good. Now, on your order book, you have disclosed it at around 19,250 crores, but you have not factored in the second HVDC order from the Adani Group, because I think that was signed in April 2025.
Absolutely right.
This will be accounted for in the first quarter of 2026. So if that is the case, back of the envelope calculation suggests it could be around 11,000 crores, which means your order book could be around 30,000 crores. Am I around about the correct numbers?
Yeah, if you, the other order in the ballpark of 8 to 10,000 crores. So if you add that, so naturally it will be there.
Okay, all right. So around 30,000 crores, 30,000 crores is what we can assume, going by what you have disclosed and what you will disclose at the end of quarter one. Exactly. That's out of the way. Now, services is a smaller part of your business, but you've separated that as well. You've put it on, in your numbers. Yeah. How big can services become as a percentage of your business? And also exports, that's the other one that drives business, right? How much will services scale up? How much can exports contribute to the pie? Because they are both margin accretive. Go ahead, sir.
So on there's two other levers for our growth, as well as both top line and bottom line, as the services and exports we have been consistently saying and consistently driving. Services right now is a single digit, and we have a plans to take it to the mid-teens, maybe double digit. And we also talked about previously that the potential is based on our install base. We have a close to 2,000 crores order book possibilities there. It won't happen overnight, but we are looking at anywhere between 3 to 4 years' time. Today, we are around 500, 600 crores level of the service in that. So there is a potential. On the exports, if you take a last year exports without HVDC, our exports are in the 30-35% of our total orders. And we have been consistently saying that we would like to, in the range bound of 25-30%. We're already there in that. But we will add more and more exports. But our key focus is going to be a domestic market. We see a lot of pipeline, very huge pipeline, and not only on the renewable, but also on the transmission, but energy storage, data centers. All those things are a huge tailwinds for us. I think we are focusing. And you all know that we announced a 2,000 crores capex, and as we speak, and many of these projects are underway. So this will also add to increase our installed capacity in India.
In fact, I wanted to talk to you about your capex, 2,000 crore over the next 4 to 5 years. I think the cash in the books now is 3,800 crore. Is that correct?
Right.
So what lines are you adding capacity in? What will be the incremental revenue, the margin potential from your capex, and when will it come on stream?
Yeah. So again, it won't happen overnight. So we are talking about a 4 to 5 year thing, and there are many projects we are taking. For example, some of our large power transformer capacities we are adding, some of the very critical components required for the transformer insulation material, so that we are expanding it. Some bushings we are expanding it. Some of the new technologies, first time we are bringing it to India. For example, HVDC bushings is a very, very clear component, very important component. We are bringing those things. So these are all coming in a phased manner. And generally, our asset turnover is in the range of 3 to 4 times to start with, because they're quite a big capex, and then afterwards it might go higher in that. So it is coming in a phased manner. And we are on track as far as our planned capex is concerned, and we see that in the next 4 to 5 years we complete what we have committed, what we have promised.
Just a quick word on the data center opportunity. Will you be able to quantify?
No, data center is quite a big opportunity. Every data center
Yes.
put in around.
But for you, will you be able to put a number to that? You know, we know the total addressable market is huge.
I'll tell you, our addressable market in every data center cap at 15 to 20%, depending upon the hyperscale. Every hyperscale coming into the picture, 15% of the data center capex is our addressable market.
And how much will you be able to realize?
As we speak now, every one out of the 3 data center is powered by us, especially on the grid connection and on that. So we are looking at to maintain that our market share.
Mr. Venu, I'm just going back to HVDC for a second, sir. This 30,000 crores of rough order book, I mean, if we count in the April, so I mean, as of today, if we talk about it, roughly 30,000 crores.
Yeah.
What is the split between HVDC and non-HVDC as of now? Just percentage, rough percentage?
As I said, as we speak, as of end of this last financial year, our order backlog is 19,245 crores. And the new order we have booked only in the month of April, so which we're going to tell you after the end of the quarter closure. But on the 19,245 crores is the only one HVDC is sitting in this thing. The rest of the things is non-HVDC, like your data center, industrial things, services, exports, etc.
No, what I'm trying to now get at is that two-part question. FY26, what is the, and you'll eventually book this one, and I don't know if the third HVDC order, whether that comes up for bidding this year itself or not. Just tell us that. And, by the end of this year, what will your mix be between HVDC and non-HVDC?
No, we don't do that way, mix, because HVDC is also one of our levers. It's not the only one, because take, for example, HVDC, all our 4 business units portfolio go into this particular project. So that way, we don't make separate HVDCs are separate, and that way we don't treat that.
You don't bifurcate that. Okay, and I get your point that FY26, you said it'll be a very small, quantum of revenue that will be booked. If you could give us some sense, and then just give us some sense of FY27, because the market discounts the future, right? We're just trying to understand that from a P&L standpoint, what kind of revenue will be booked in FY27 from this large HVDC chunk that you have? Let
me give you a little bit of marker for you to understand. The HVDC projects normally we complete in 48 to 54 months. So 48 is the first bipole, and 54 is the second bipole in that. So normally in the first year, we do a lot of engineering and the small revenues. So that will be a very small percentage, low single digit in that. The second year will be slightly higher, and the third year is where the bulk of the revenue comes in that.
So FY28 is where the bulk of the revenue comes
27
in.
also, 27 second half also is quite a thing, and 28 will be definitely much higher.
All right.
Understand these 2 projects has around 6 months delay, so naturally that particular revenue delay also will be there.
Okay. All right. Mr. Venu, very quickly before we let you go, small nuclear reactors, well, that's been in focus in India as well. Now, your parent, Hitachi, has globally very strong nuclear capabilities. If and when this opportunity opens up in India, will it be pursued under the listed entity, Hitachi Energy India?
See, Hitachi Energy India, what we do is whatever is required for the, this nuclear thing we do, but not on the technology standpoint, is a separate company.
Okay, so then it would not entirely come under this entity, right?
Yeah, but what is required for that, powering the nuclear thing, like offshore and auxiliaries, etc., will come from us.
Okay, all right. We'll press you a little bit more on this, but thanks a lot for joining in. I recall when I visited your unit, you all were gunning for double-digit margins. Now margins are improving. Exports and services are going to be a larger share of your contribution, which will help profitability. Thanks a lot for joining in, Mr. Venu. Looking forward to chatting up with you as the year progresses. For the time being, slip into a short break. On the other side, we'll be joined by the management of Muthoot Finance. Stay with us.
Welcome back. Now let's invite the management of Muthoot Finance. The stock is a bit under pressure despite a decent set of Q4 numbers. The AUM saw a growth and they've maintained their gold loan guidance for FY26. George Alexander Muthoot, Managing Director at Muthoot Finance, is now with us on the show. Thank you very much for joining in. Well, sir, you're talking about a minimum growth of about 15% for FY26. You have also kept the option open that you will revise it higher. But, considering that you achieved a 40% growth last year, a minimum 15% appears to be a bit conservative. Tell us what's gone into this guidance and what could be the realistic number. Already we are halfway through Q1.
Thank you. Thank you and good morning. Over the last, maybe to my remembrance, maybe last 10 years, we've always been giving the guidance of 15% only. But always we have been achieving 20, 25, 30, and last year 40%. So it is just a number that we give in the beginning of the year. Probably we will revisit it. We will look at it probably after Q2. We will revisit the guidance number also. But the market is good. The business is good. We see good growth coming in this year also.
Are you worried that a lot of your AUM growth is driven by the rise in gold prices? If gold prices retreat, and we've already seen gold prices come down, cool off a bit, is there a risk to your AUM growth? On the AUM front, how are you seeing this volatility surge, then risk of a cool off in gold prices? And what could your AUM guidance be?
Yeah, there are always fluctuations in gold prices. Maybe goes up, goes down. But over the last years, it has always been going up only. But of course, in the last 6 to 7 months, it has gone up too high. Probably it may cool down a bit. But of course, we give only 75% of the current value. And that also is a 30-day moving average. So today, if you look, our gold loans advance which are given, it's only 62% of today's price. If you look at the value of the gold we have with us and today's gold price, it's only 62%. So that is the margin or the headroom we have. So some corrections in the gold loan will not be affecting us. Second, as always, we have seen so many such cycles. We have seen the cycle of gold price fall in 2013, 14, and occasionally over several years, you see some months of gold price fall, etc. But people don't abandon their gold. So gold price is not a big factor. But having said that, why the people, the business is going up is mainly because of the demand for funding. The unsecured loan sector is not the people are not getting the money they required. So people are using gold loan, and banks are also doing it. The pie is increasing. More and more people are actually looking to gold loan for a quick and easy finance. That is why business is growing. Of course, gold prices help because they don't need to bring extra gold. With the same gold, they can get more and more money.
Okay, so as of today, as on today's prices, you're maintaining about a 62% LTV, right? So we got that.
So I think not the exact number, maybe 60,
around that.
What we have given,
around 60%. So give us a sense. I mean, the fourth quarter, obviously, it looked absolutely. It was an outlier, 40% growth in AUM because of the way, gold prices move. But steady state, what is the AUM growth in the loan book that you're expecting on the gold business this year, FY26?
That's what I have been saying. We will get good business, but don't be carried away or don't be concerned with the ultra conservative guidance which you are giving. We have 5,000 plus 6,000 branches in Muthoot. So people are there, the money is there, the requirement is there, our branches are there, staff is there. This will go up only.
Okay, so you're just being conservative. You're admitting you're being conservative at 15%. All right. Sir, just a word on cost of funds as well. How is that moving? Because I think for you, the NIM quarter on quarter, there was a little bit of a pressure that was coming in. But now there are a lot of moving parts. I mean, we are in a rate cut regime from the RBI as well. What are you expecting on cost of funds and NIMs over the next couple of quarters?
So we have been maintaining our spread. NIM should be about 11%. Spread should be in the 9.5%. I think in the last 4 or 5 quarters, our spread has always been 9.5, and we actually maintained it. If the cost of funding goes up, we try to absorb it for 1 quarter or so. Afterwards, it's still going up. We increase our yield, but we maintain our spread. The same thing if the cost of fund. Today, the cost of funds is coming down a little. So it will take for a few months for it to maybe stabilize. If it is really coming down, we will reduce our yield, but maintaining our spread. So if there is an advantage in the borrowing cost, we pass it on to our customer. That is what our NIM and spread, etc., have been almost constant in the last several quarters.
You just spoke about
the cost of operations. Yes, the new guidelines.
Go ahead.
All the new guidelines, the compliance cost is also going up. But only advantage with Muthoot is that our per branch business is also going up. So in that respect, our cost of operations will stabilize. So last year, our per branch business is about 15 crores. Today, it is about 21 crores. So that will help in maybe absorbing some of the extra, compliance cost, etc.
Can it go higher than from this 21 crores? If yes, what is the kind of outlook?
Definitely, it should go up. That is why we are all here.
To what? To what level, sir? If you have a target, as you're saying, you've been ultra conservative, stock is down 5%, you're on the best business news channel and everyone is hearing, you can go ahead and up the guidance as well, sir. Do you want to do that?
So I think a branch, it was 15 crores last year, it was 21 crores this year. I'm sure we have branches with 50 crores, 60 crores, 70 crores also. So optimistically, all the branches can reach 50, 60 crores.
Okay, all right. But you want to up the guidance from 15% that you've given conservatively?
Not today, sir. Maybe after Q2.
Very quickly, you mentioned about yields. There could be some pressure there because competitive intensity could come back. PSUs, banks, they are eyeing this gold loan market share as well. And now Manappuram, that's been, not really a big competitor to you. They could pull up their socks because Bain has come in. A quick comment on competitive intensity and could yields come down from the current levels? I think it's ballpark around 18%.
I think I just mentioned that if the cost of fund is going up, we will increase our yield because these are all small loans. The 20,000, 30,000, 50,000, 1 lakh, and 0.5% increase in the yield will not maybe change the sentiment of the customer because it's a quick loan, short-term loan, 2 months, 3 months, 4 months. So in absolute terms, the interest payment is not much. So if the cost of fund is going up, we actually increase our yield. We have been maintaining our spread and net interest margin spread of about 9.5% is what we have been maintaining all the way. And we should be able to maintain that. Competition intensity is there. It is because this is a good sector. Everybody wants to enter there. But the pie is also growing. It is not that we are the only ones who are growing at the cost of somebody else. Yeah. Banks are also having 20, 30, 40% gold loan in their growth in their gold loan portfolio. So if everybody is growing, the market is increasing, sir.
Okay. All right. Good speaking to you, Mr. Muthoot. You're not taking the opportunity this time around to go ahead and increase your guidance. We'll chat soon. Maybe that's the time you'll go ahead and up it. Appreciate you joining in. Let's focus on the cement pack then. We have Neeraj Akhoury, the Managing Director at Cheese Cement, who joins us on the show. Hi, Mr. Akhoury. Good morning and congratulations on a good set of numbers. What's the strategy going to be, sir? Volume growth actually has been lagging the industry, at least in the past year, but pricing has improved and profitability has improved. For this year, what kind of a volume outlook do you have? Point number one. And premium as a percentage of your trade mix, that's moved up. Where is that number headed from around the 15% mark?
Good morning. I think as we always have liked to believe that the cement demand growth would be in line with the GDP. If we are expecting the GDP to grow by 6 to 7%, then to my mind, cement demand growth will also be around that, 6 to 5%, 6 to 7%. Yeah. For us, we would be adding some new capacities this year. We have already added 2 plants this year, and we will be adding 2 more in the coming quarters. And that should give us a volume which will be slightly higher than the industry average, industry growth. That is how I see. On premium, we have been working on it. We've already reached from 9% to roughly about 15.5% now. And this trajectory will continue. We expect it to touch somewhere around 17-18% soon. That is a trajectory that we have decided. The focus is on profitable growth. The focus is how to make sure that our efficiency parameters as well as our pricing works well for our results.
Okay, so high teens is what you're gunning for in terms of premium as a percentage of your trade mix. Got that. And on volumes, we are working with 6-7% growth for the year, a GDP growth that is 6.5% or thereabouts. So, and normally, as you said, cement grows at a faster clip. So for your company, sir, after underperforming in the last year, this year, fair to assume 9 to 10% volume growth?
No, I would rather keep it at 8% for now.
8%, you're being conservative because I'll hold you at this number as well the next time around you join in. Got that. On the cost side, you have been, focusing a lot out there. And if I look at it, green power, the share is at around 60%. It's the highest in the full industry. And that's moved up. Where do you see this number headed? And since you have cost levels in place, what does it mean in terms of an EBITDA per ton? For the year, you were at around 1,000 rupees or thereabouts. This year, what is the range we can work with?
So it's not right to give me an estimate like but I would say that given that we are having better prices than what we had last year in the same quarter, along with the fact that some of the costs continue to decline, including the fuel prices, we expect that the fuel prices will at least remain at this level and not go up. In that case, I would say that the EBITDA would be in there. Should be better than what we have seen for full year last year at 1,000. But we'll not be able to give an exact number at this moment.
And DAM Capital is saying by FY27, they're expecting the number to go to 1,370. You agree?
Let's see. It's too early in the year. It's just quarter one of the full year. Let's see. Yeah.
And green power is a percentage of the mix. Where does it go?
We are working a lot on the green power, and 60% is what we have achieved. Happy to note that we are one of the best in the industry, most probably globally as well. And I would expect this to go up. We are already working on some more sites across the country, so it should go up in the coming quarters.
Mr. Kuri, you all will have to do something more exciting now, because I mentioned this to Mr. Bangur as well. Shree Cement always gets the best valuation in the full cement pack, because of the ROC. You all were the first ones to get into petcoke, all that taken on board. But Street is looking for something more exciting. What is that going to be from here on? You're sitting on cash of around 5,400 crores, which is a good amount. You have a capex plan of around 3,000 crores for this year. Some kind of inorganic growth could be the trigger. Are you looking?
Nigel, as I said, we are very intensely focused on being the most profitable cement company in the industry. And that is something that we would like to fiercely protect in the coming quarters and coming years as well. We have a lot of plans on organic growth. We have a plan to reach 80 million tons by FY28. And with that ambition, I think through organic routes, we will reach there. We are not against any inorganic growth. But it should make sense to us in terms of valuation, in terms of strategic fit. But currently, the focus will remain on how to reach 80 million tons on the organic route.
You have, you're currently in the vicinity of around 60 to 63 million tons.
Yes.
And I think what's on the drawing board is to reach 70 million tons. So from 70 to 80 will all be organic? Is that part of the plan as of now?
Yes, absolutely.
And you mentioned a couple of times that profitable growth is something, you want to be the low-cost producer and in turn, focus on profitability. But if it's a toss-up between profitability and volumes, what you'll choose? Because last year, volume growth was very, very low. It was low single digit and you lagged the industry. So a toss-up between the two, which one are you selecting, Mr. Kuri?
We are very clear that value is what we should be chasing and not just volumes. Volumes are important, but at the same time, we would be following that. How can we get more profitable growth and not just volume growth?
Okay, all right. Profitability over volumes. We got that on board. We'll hold you to a few of these numbers. Thanks a lot, Mr. Kuri, for joining in and detailing those set of numbers and the way ahead.
Pleasure.
By the way, when we're having the chat with the managements of Muthoot as well as Shree Cement, the markets are actually down close to under 150 points. Number of stocks advancing, still more than the number of stocks declining. Though, in fact, the mid-cap index is almost moved into the red. Slip into a break, come back. Manisha Gupta will be joining in to tell us what's going on in the commodity space.
Welcome back. Down 0.5% now on the benchmark indices. Let's find out what the situation is in the commodity markets and what the rates look like. Manisha.
Thank you for that, Rima. It's profit-taking across commodities as well. And I want to start with the gold prices because we saw all-time highs here when we saw those tariffs come in, and $3,500 an ounce of an all-time high is what the gold prices hit. Well, since it has been US and China trade agreement, even if it's temporary and for 90 days, we have seen that constant profit-taking continue in case of gold prices. So 3150 and below that is how the gold prices are trading now. It is a 5-week close coming in for the gold prices. Let me still remind you that for the year, we are up by nearly 24%. And for the last 12 months, it still is 40% higher for the gold prices. But from its all-time highs, the gold prices now have declined by nearly 10%. So huge profit taking coming in, and this is in less than a month that we've seen the gold prices see that kind of a decline there. Well, one is, of course, the focus has shifted away from the safe havens, it's risk on, and we've seen money flow into various other asset classes. And majorly, it is profit taking because the street believes that various cues, the reason that the gold prices went higher, seem to be easing off now. One, of course, is the US and China trade tensions, though it seems to be diminishing right now. And then the US also has been reiterating that the trade agreements are processing well from various countries like India, Japan and South Korea as well. The third point really is about Trump lifting sanctions on Syria. This was announced in Riyadh when he was visiting Middle East, and that also has eased pressures a bit. It also is about India-Pakistan tensions not escalating, stabilizing even. And then it also has to do with the softer than expected US inflation numbers that also have led to this decline in gold prices. But it's not just gold. If you look at silver prices, they also fell 2% in the overnight markets. We are trading at a 1-month lows for silver as well. So when you look at on a week-on-week basis, we have seen the gold prices decline by 5% and silver is down 2% in the same time as well. And it's not just about the precious metals. The industrial metals also have seen a sharp decline. Whether it is about copper, aluminum, zinc, we have seen prices decline. And if you look at the crude oil prices, there has been a very sharp cut coming in for this as well. It has been 2% of a cut on 2 days now come for the crude oil prices. And with that, now we are off those 2-month highs that we were trading in. Well, the major factor here also is that Iran has said that they are ready for a nuclear conversation. Remember, there has been 4 rounds of talks there. And Iran also says that once the sanctions are taken off, they can talk about nuclear deal here. So there seems to be some progress in conversations coming in there as well. Apart from that, when you look at the US crude inventories, well, they also have seen a surge by 3.5 million barrels. Street was anticipating a 2 million barrel of an increase, so that has been weighing. And then you have the OPEC trimming supply growth from non-OPEC countries, suggesting that if the crude oil prices stay where they are, then for US and for the non-OPEC countries, it wouldn't be very profitable to continue to produce crude at these current levels. And then US OPEC and oil supplies also have been increasing, even as OPEC is looking to increase production for the month of May and June. We have seen some internal disparity not continuing to work there, and that seems to be weighing onto the markets there. So whether it has been about precious metals, industrial metals, energy prices, all of that has started Asia on a weaker note today. What the markets will want to watch out from here is the US PPI numbers, and that would give you further direction from here.
Thank you very much for that. And Reliance Industries chairman and MD Mukesh Ambani went to Qatar to meet the US President Donald Trump, who is on a tour of the Gulf nations. You can see the visuals on your screen. Mukesh Ambani also met the Emir of Qatar. This is Reliance's chairman's second meeting since Trump's return to presidency in January this year. Okay, still down more than about 100 points on the benchmark indices. Reliance Industries share price is down more than about 0.5%. Also under pressure, you've got Power Grid, Dr. Reddy's, NTPC. So power is cooled off today. Some of the pharma names are weak. So we spoke about Dr. Reddy's, but other than that, you've got Cipla, and banks continue to tread with weakness. Yesterday, the Nifty Bank underperformed, and today as well, the Nifty Bank is down close to about 250 points. Mid-caps are relatively outperforming. No gains to boast of. The mid-cap index is up 0.1%, but at least there is that relative outperformance. Advanced decline ratio in favor of more stocks advancing. With that, we'll get into a break. We'll come back with our special segment, Indianomics, on the other side, where Lata speaks to Neeraj Seth, CEO of 3R Investments, on Asian currency and credit markets.
risk markets have clearly come a full circle. So is the worst of the reciprocal tariff scare behind us? That's the question we're asking in today's Indianomics. Now watch this, the table that will come up for you. Pre-April 2nd, that is the pre-reciprocal tariffs, the US indexes, say S&P for instance, was at 5670, NASDAQ 17,150 thereabouts. Post-reciprocal tariffs, they fell about 15%, as you can see. And now, after the US-China deal over the weekend, they are back above their April 2nd levels. Likewise, you can look at the Nifty, or you can look at the dollar index. The Nifty as well, 23,350, falls about 15% after the reciprocal tariffs, and now back above the April 2nd, or back above the reciprocal tariff levels. Likewise, for the dollar index, it's not quite climbed back to the pre-reciprocal index levels, but the rupee definitely has. It fell to a low of 86.50. Gold is the other way around. Gold being a haven when risk aversion is high. It was high during the time. It was low during the pre-reciprocal tariff. After the tariff, because risk aversion was at its height, gold went to a high of 3,500 and now is back to the pre-reciprocal times level. So the question we are asking is the worst of the tariff threat over? And if yes, which assets will smart money chase? First, I'm joined by Neeraj Seth, founder and CEO of 3R Investments and formerly head of fixed income at BlackRock. Neeraj, thank you very much indeed for your time. That really is the first I'll ask you the big question and then come to the nitty-gritties. Do you think the markets have priced the worst of risk aversion?
I think the markets certainly have priced out all of the risk from the tariff and more. Obviously, there's an element of positioning that plays a role here, but I do think looking at the 120-degree turn, not 180, from President Trump, I do think the worst of the tariff scare is behind us. It's not done, it's not over. And the fascinating thing is that the investors are actually celebrating a 10% across the board tariff and still the remaining uncertainties in front of us. But it's not as bad as what we saw on April 2nd.
Yes, I agree that it is 120-degree turn and not a 180-degree turn because the president has said this is a 90-day truce. But is the market seriously pricing in something worse than 30% tariffs on China or a return to very high tariffs?
So I do think the markets, in fact, are moving more towards pricing even below whatever the last number, around 30, that was in the news, for a simple reason that in any negotiation, if you start from 0 or whatever the last number was, or 10, that cross-the-board tariff versus 30 as the discussion point, the markets would expect the meeting point to be somewhere in the middle. So the pricing that I see at this point actually is reflecting a better outcome than even that 10 and 30 that obviously President Trump has been talking about.
Okay, let me ask you some unfair questions first. You are a fixed income expert, but I'm going to ask you if the best of gold is over for the moment. If risk aversion of the worst kind is already priced in, then gold doesn't go back to $3,500 for now?
If I have to predict, gold will go back to 3,500, but it'll take time. Part of the reason, exactly what you said, the near-term risk averseness and the uncertainty has come down, which is bringing gold back down. But if I take a step back and think about the world that we live in and the global reserves that sit in US dollars, the exposure the world has in US dollars, I do think the systematic reallocation is still going to happen over the coming years, and gold will be one of the beneficiaries, whether it's in the central bank portfolios or individual portfolios. So it's going to be a structural bull run, but a cyclical correction that we are going through. And I do think right now, near term, you probably have more to correct on the gold, given the uncertainties coming down and market is pricing the other side. But longer term, I still think gold will go higher.
Okay, so that is something like a buy on dip strategy that you're giving us. Okay, let me come to now the Asian, where smart money will go. Do you think now smart money chases risk assets like equities?
I think there is some reallocation happening. There's also, as I said, the technical backdrop of positioning. The CDAs were short given post the moves in the market post April 2nd. I think that readjustment is happening. I do think the smart money will still look at more diversification, first of all. Very high concentration that you see at this point in the US equities and US tech for a number of investors. So I think diversification is going to be one element. And if I take that lens, and think about the markets that will benefit. In my view, Europe will get a little bit of that reallocation benefit. Japan and India, in case of Asia Pac, will get that benefit. So you will see some of that money flowing back in these markets.
Okay. Now let me come to credit. India, even at the worst of times, continued to receive money in the bond funds. I think there was practically a couple of weeks when we didn't get, otherwise money was coming. How will bond funds look at Asian credit and particularly Indian credit?
So broadly, the Asian credit, I would say, is at this point fairly priced. I do think the spreads have a risk of widening, and because credit is not an asset class that loves uncertainty, and that's something which hasn't gone away from the market. So credit, I think, still has a little more risk of widening if you take a 6 to 12 month view. India is slightly different, and part of what we have talked about in the past, that when you look at the Indian markets, one, you have a fairly big high quality market, including the government bonds, PSU, and small corporates in the capital market perspective. And then you have the growth of private credit markets. And the global exposure, the foreign exposure in the India onshore story, despite all the news flow, is still not very high. So I do think India will continue to see those flows on a structural basis, at least for the foreseeable future.
Oh, yes. We also got a lower than expected inflation number for the 4th month running. So there are other reasons why Indian bonds are looking very attractive, even for domestic investors. But coming to the one, asset class which has defied all the risk move up and down, US bonds. I mean, 4.53 after you've seen what one must say is, some end of uncertainty. What explains the rise and rise of US yields?
Well, part of it is obviously the markets are going through the respite, and hence you are seeing the sell-off in the bonds, which had a little bit of a tailwind or a support because of uncertainty and the risk of recessions that the markets are pricing in. Okay. And equally importantly, if we look at the fiscal financing and the monetary policy path, I still think there's a challenge there. On the fiscal financing, US still has a fairly heavy fiscal financing with close to $2 trillion of deficit that needs to be funded this year, and it's not coming down anytime soon. And on the monetary policy path, which is even more complex, I do think the Fed is sitting in the middle of very dense fog of uncertainty, both on the inflation as well as the employment front. So it's going to be hard for the Fed to move. Their best case scenario is to sit and wait. So between the financing, which is pushing the term premium higher, and the Fed uncertainty or the lack of Fed moves, which is keeping the front end also pricing out a little bit of the rate cuts. I think looking at the curve, the way it's behaving, I'm not at all surprised. If anything, I do believe the long end can actually keep backing up more.
Oh, going towards 5, you think?
I think 30-year crossing 5 is, well, we're not very far to begin with, but I don't think that should be a surprise. You still, when you think of fiscal financing, end of the day, the clearing price is a function of supply, demand, and where obviously you could get the investor interest. And the foreign demand is, although hasn't gone away, but it's not as strong for the US treasuries at this point.
Okay. Time permitting, I wanted to ask you a little more about US treasuries, but let me come to the dollar index. We have seen the dollar index recover somewhat from the sub-100 levels, but give us your view on whether dollar strengthens from here on, and therefore the dollar rupee in particular, not other Asian currencies.
So medium horizon, I'm still in the camp of dollar weaker. And that's mainly to do with more of the flow picture that you see on the back of the tariffs, the global exposure to the US assets, which is north of $30 trillion in the liquid markets. And hence, as some of that reallocation happens, I do think the dollar still has potential to weaken further. On the dollar INR is interesting because you have, in addition to what happens to the dollar, you have RBI sitting on the other side. I think that stays more sideways with potentials, like, if anything, over time, some strengthening driven by the flows.
Okay. Well, some strengthening because of the flows, yes. Neeraj, now a big question. We may not have time to flesh it out completely. Do you think the next big problem for all financial markets will not be the end of this 90-day period, but potential tax cuts by the US government, which perhaps is just a few weeks down the line?
So interestingly, that's an important point because the market can normally focus on only one thing at a time. And that focus will go towards tax cuts as we cross middle of the year. So you're right. I think that focus shift will happen. That also to some extent keeps the tailwind for the markets in the near term, because obviously the regulatory aspect and the tax cuts still have a bit more of room for the tailwind to be there. So I think that will move. Now, the interesting thing will be, I would say the bigger point the markets will focus on as we get into July will be the earnings from the second quarter, because the uncertainty that got created was April 2nd onwards, which is not captured at all in the first quarter earnings. So the second quarter earnings, you start to see a little bit of initial impact of these changes. And I think that will be more important in my view.
Okay, then a quick last question. Because of that, will US exceptionalism fade or will it rise?
I think
because of the tax cuts.
I think on the margin, the US exceptionalism little bit fades, partly to do with obviously the policy uncertainty that has been created. But when I look more from a corporate perspective in terms of innovation, growth, the technology aspect, the overall focus on shareholder value creation, the depth of the capital markets, I think US still remains an important market. It's more a question of how much exposure a non-US investor should have in that market. But it doesn't change the focus on the return on equity and the shareholder value creation that we have seen over the last 40 years.
Okay. Well, out of time. Thank you very much for joining us, Neeraj Seth. But we will pursue this theme of whether the worst of the reciprocal tariff fear is out of the market. Thanks much for watching this edition of Indianomics. We'll be back with Chartbusters.
E-Clark's rally is more than 11% on the back of a strong fourth quarter performance. The numbers beat analyst expectations with rupee revenue rising 5.2% on a sequential basis. Contract value of new deals is at an all-time high of $51 million as well.
And Muthoot Finance slips close to 5% after reporting its fourth quarter numbers. The net interest comes in a little slower on a sequential basis. The management tells CNBC-TV18 that the cost of operations has stabilized. That's the cost of borrowing has stabilized more or less. The street seems to be disappointed with the 15% AUM growth guidance.
Tilaknagar Industries zooms nearly 10% following its results. The company reported good revenue growth led by 20% volume growth. The management tells CNBC-TV18 this will sustain. They are targeting high teens revenue growth in FY26.
Shree Cement climbs nearly 3% after reporting a good set of numbers. The management tells CNBC-TV18 that they expect a 8% volume growth in FY26 and they plan to reach 80 million tons, all of it by the organic growth. They also say that they'll go towards profitability in comparison to volumes.
Wendt tanks nearly 15% after its parent company announces an offer for sale to divest up to 37.5% equity in the company with a floor price of 6,500 rupees per share at a near 37% discount, a sharp discount to yesterday's closing price.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and as we speak, the market's actually looking quite good. Yes, the Nifty is down close to around 70 points, but in fact, 30 minutes ago, we were down 170 points. It's telling you that this market is shifted to a buy on dips market, and what's doing well today yet again is the broader markets. The Nifty bank is taking support at around the 20-day MA. The broader market's looking quite good. The breadth of the market quite good. Well, you'll have to say it's a fairly good trading session, Mangalam.
Good trading session. You know, major events are behind the market, so maybe some consolidation is on the cards. Because the downside is protected, the mid-cap index doing a lot better. That provides a lot of comfort to those who are looking at their portfolios this morning itself. Let's talk about earnings, though. The company on our radar is AkzoNobel. They've seen a revenue growth of 5% year on year, which is among the highest ones that we've seen in the industry so far, the second highest from the numbers that have been reported so far. Rajiv Rajgopal, who's the chairman and managing director of the company, joins in now. Rajiv, I wonder if people are looking at your numbers every quarter anymore or not, because yes, the numbers are good. You've been gaining market share for the last 10, 12 quarters, but everyone's wondering what's happening with the deal. How far are you away? Because I remember the last time you joined in, you said we're very close to the deal with the parent when it comes to, you know, the B2B business, the R&D center, the industrial products business. Where are you? At what stage of, deal making are you when it comes to the decorative business?
Mangalam, good morning. Good morning to both you and Nigel. Thank you for having me on your show. Wonderful to be back. I perhaps do not have the same luxury that a lot of people have of not looking at numbers. That's the nature of my role, and my team are doing an incredible job, as you would agree, in an environment which is both hyper competitive and the fact that there is an overhang of a strategic review, the fact that we've come with another quarter of industry leading growth is a testimony to the fact that we are very focused, like a horse with blinkers, really focusing on what the goals that we are targeting. And I think that's the way it should be. We are really focusing on our execution. The industry has gone through a tepid, quarter in a year that just got done. And I'm surprised to say in the quarter, and if you look at the full year, we've had industry leading growth. Yeah? So I think that's the first. The second, and I'll come back to your second part of the question. I think the good part is in decorative, we've started seeing a good bounce back. At least for us, the growth has come back in urban towns and in the premium segments, which is a little away from some of the other players. We've had some challenges in the mass and economy where the real battle is happening in the market with deep discounting, pricing, which is significantly below where we operate. And hence, we chose a little bit of a step back in the last quarter, particularly in our mass markets and categories like putty, texture, etc. For a simple reason that we said, look, the industry is going through a quarter closer. There's no point of trying to exaggerate some of these discounts, and we said we just be normal, and we are sure that April will bounce back, and that's what's happened. Yeah? So really, from my perspective, pretty happy with what's happening there. Yes, I'm not happy with the fact that we still want to really win in the market, in each of our business. On coatings, we've had double-digit growth, and it's
right. Rajiv, you still haven't answered the second part of the question.
Rajiv, you're talking about a horse with blinkers, but the street believes it's a bride looking for a prospective match. So we want an update on that front.
Nigel, whichever way you look at it, at the end of the day, the bride is more attractive when the performances are stronger. So, let me keep it at that. But coming to the second part of the question that Nigel asked, look, I think our global CEO Greg has already mentioned in the global analyst call in the last quarter in April that this transaction should see certainty in terms of how AkzoNobel N.V. decides to proceed by the end of the quarter. And I stick to the same timeline. I'd said it. I'd mentioned a timeline of the end of third and fourth week of June. I think we are pretty much on it. Now, if it happens a little earlier, closer, it's a function because these deals are quite exhaustive in nature. It's not just simple thing like valuation. A lot of detailing. It's a massive organization. So I think those things will need to be looked at. It's being handled by the parent. So I think as soon as I get an update, which is material, as of now I have none, I will be able to comment on that.
The large players that there were, a lot of them who looked at it, and we've been speaking to a lot of them here as well, barring one or two, not many have pursued with their bid for AkzoNobel. I remember, some backing out because of maybe competition issues, with the Competition Commission issues, some backing out because of valuations, some saying that they tried, but the other bids were a lot more aggressive, and they don't see value in, AkzoNobel at the market cap that it is right now. What do you have to say to that? Because, if there aren't many takers, barring one or two, then the end result may not perhaps be beneficial to the shareholders.
Look, I would only say a couple of things. First and foremost, look, these are personal choices, strategic choices companies make, right? And if people or bidders have decided not to proceed, I'm sure it's not just valuation. There are other influencing factors which may be specific to the company. But, as I always say, it's, this is a business which has demonstrated performance, not in this quarter. Over the last 4-5 years, we've been gaining market share with all the challenges that we've had. And really, from my perspective, I think the business to the final buyer is worth its weight in gold. Yeah. So that's what I would like to say. I've seen the profile of the business. I've run it now for, I've been running this business for as a managing director and now as chairman and managing director for last 2 years, but overall for about 6.5 years. And you've seen the performance. It's a solid business. These are premium brands. I think this is something which is truly a generational asset. And I think finally, I think whoever's the winner will take it all, and you will see. I do think that the final buyer, whoever is the winner of the race, you would see a distinct performance shift, uplift in the performance. And mark my words, you take it once the whole thing is done, we will discuss maybe 5-6 quarters, and maybe with the buyer, etc. You would see a shift in the way this industry moves, and you will see the brands. These are terrific brands. Having a brand like Dulux, and International, etc., phenomenal in the portfolio. So, again, these are strategic choices company have to make, so I cannot comment on that, Nigel.
All right, Rajiv, we'll wait by to see, who comes out trumps in this. But, since your focus is on business, give us a few numbers. What kind of volume growth do you target for this year? What is the outlook in terms of margins? And since you mentioned market share a few times, what is the targeted market share? I think in the last year, as you said, you gained some. Where is it at? Where is it headed?
Yeah. So first and foremost, let me start from the reverse order. Market share, we've inched back from about 4.2 to about 5. We are now tracking, and this is decorative. If you look at overall, we are at about 7.4. I think we are trying to target to increase it at least meaningfully, and to at least about closer to 8 in the next year or so. Second, in terms of volume growth, look, in the last quarter, unlike the rest of the industry, we started bringing volume and value closer because we've had a limited play in some of the economy and mass, and we are obviously not getting out of it, but we wanted to make sure that we are doing it in a profitable manner. Yeah. So, however, from a full year, guidance perspective, I still maintain that the industry, I believe that we should now get back to a mid-single digit, high single digit growth for the year, for the full year in terms of value. Volume will be a little ahead of value by the end of the year.
And I also hope that, the negotiations that take place, the deal have you as an important part of that, in the sense that you will lead the company no matter who owns it, and perhaps get some more of the others when they come into your fold too. Is that a possibility?
Mangalam, I don't think I would be in a position to comment on all that, but that's a decision that the buyer has to take, and obviously, So I think for the moment I'm very much running the ship, and the team is really focused, and our performance is what it is. And what we can assure through you to all our shareholders is we are not going to leave an inch for anybody to take. We are going to grab every inch that comes our way.
All right, we take that point. Thank you so much for joining in and giving us the details on the business performance and the updates that are happening outside of business as well. We hope to get an update soon from you itself. With that, let's shift focus to our segment where we get you ideas for profit from our colleagues at Money Control Pro. And today we have our colleague joining in. Anant Chaudhary has a stock.
So today let's talk about Jyoti Labs Limited, leading home and personal care FMCG company. You might know it for its popular detergent brand Ujala, but now it has many other brands too, like Henko, Maxo, Margo, Exo and Prill. They are into detergent and dishwashing segments and also other categories. Over the last 7 to 8 quarters, the company has shown steady volume growth in the high single digits, beating many other FMCG companies. Jyoti is also expanding its liquid detergent range, not just Ujala and Henko, but also More Light and Mr. White, which are placed at value for money pricing. Henko, their biggest detergent brand, is doing well as more consumers shift from powder to liquid detergents, part of a trend towards premium products. The company is also working to grow pan-India, especially for its dishwashing brand Exo and Prill, which were earlier focused on southern region. However, the other two segments, household insecticides and personal care, they are facing some challenges due to fewer product options. But as a change in the brand ambassador and higher ad spending, they should help drive demand soon. Stock is trading at reasonable valuation of 26 times on FY27 earnings. It offers a decent margin of safety and potential for upside.
Right, with that, we'll take a short break. On the other side, don't go anywhere, because we have with us Rahul Mithal, who's Chairman and Managing Director of RITES, to discuss the quarter gone by, but more importantly, the year coming ahead. Welcome back. Well, as we speak, just take a look at the markets. The Nifty was down, we mentioned, around 150 points. And as we had that chat with Akzo Nobel, it's done a big U-turn, big recovery from the low point of the day. In fact, we're up close to around 250 points from the day's low. The Nifty Bank as well had a sudden burst, and now it's cooled off. So the Nifty Bank, from being down close to 150 points, it was up 150 points, and now it's trading around the flat line. It appears there's either some big flow that came in, or there's a big short covering bounce that did take place in that span of from 10 to around 15 minutes. So a sharp spike is what we saw, just in the last 15 minutes or so. But let's focus on RITES. That's the management on the show. We have with us Mr. Rahul Mithal, the Chairman and Managing Director of the company. Hi, sir.
Good morning and good to see you in. Well, let's look at the way ahead. I recall you telling us earlier that in FY26, you're working with a 20% revenue growth and you're expecting a 10% growth on the bottom line with margins around the 20% mark. You want to reiterate the guidance, change it a little bit, higher or lower? Please go ahead.
Good morning. Yes, I recall that, and you see the trend of orders which came in Q4. We got about 150 plus orders totaling to more than 1400 crores, making us achieve the highest ever order book. We closed the year with an order book of nearly 8,900, 9,000 crores. So with that and the kind of operational efficiency which you saw in execution in Q4 also, we are raring to go and we are aspiring to see a growth of revenue of about 20% in the coming FY and corresponding growth in the bottom line.
All right, so 20% growth and 20% growth on the bottom line with 20% margins is what you are guiding. 10% growth on the bottom line with 20% margins.
No, I think you're revising the bottom line growth as well to 20%. Is that correct?
No. The top line growth at 20% and the guidance which I said aiming to about 10% growth in the bottom.
That stays. Okay. What about orders? Because your order book is very close to the 10,000 crore mark. The way you're winning orders, maybe in the next couple of quarters, you will reach that 10,000 crore mark. But at the same time, there are some orders that require some sort of confirmation on, right? One is the Bangladesh order. What has happened out there? The second part is you had a cancellation of order coming in from the UP. And there was also this MOU with Middle East for the railway corridor. Can you give us an update on all of this and give us a sense of what kind of order inflow are you targeting for this year?
So let me go one by one. The Bangladesh order is a confirmed order. In fact, the order book of 8,900 crores includes all orders which are confirmed orders on which work is happening. In fact, for the Bangladesh order, the prototype designs are in the final stage of approval. There are about 5 types of coaches, and we are aiming to start delivery by latter part of the year. It's 200 coaches, so the phase-wise delivery will start. As far as the order inflow is concerned, this year saw a 60% growth in the fresh orders coming in vis-a-vis last year. So we got fresh orders of about 5,500 crores. We maintained a strike rate of 1 order a day. We maintained our strike rate of 1 export order in every quarter. So with that, as I said, we have ended the order, the year with an order book of 8,900 crores. And we are confident that we'll be able to maintain this trend in the coming FY also.
You're maintaining 5,500 to 6,000 crore worth order inflows in FY26 as well.
Yes, so we are aiming that, as you said, reaching about 10,000 crore order book definitely in very soon in maybe the next or the third quarter, and being able to aim at least the same strike rate of 1 order a day and at least the same levels of addition in order books.
Okay, all right. Sir, if you could help us out, what would the mix look like between consultancy, turnkey, if you could tell us domestic as well as exports? Give us a brief product revenue mix, so to call it, for this year.
So you see the order book, which at 8,900 crores has 3,000 crores in consultancy, 4,200 crore in cost plus turnkey, and 1,350 in export, and balance in leasing and our subsidiaries. So consultancy and export, which are our core focus, continues to get us many orders. As I said, we have broken the hiatus for the last 4 years and we did not get an export order. And because of that, you saw this dip in the export revenue, nearly nil in FY24-25. We have continued to get 1 export order every quarter. And the way the visibility is for the coming FY, we are confident that we should be able to maintain this strike rate. Consultancy across segments, we continue to get orders, whether it is the rail infra sector, whether it is the building sector, whether it is studies in new alignments, whether it is the metro studies. So across sectors, we are getting orders. Internationally, internationally also we are getting orders. We've got fresh orders of about 400 crores in pure consultancy in the last year in pure consultancy besides the export orders.
Right, that's great, sir. So, if you could give us a sense on the orders that you're L1 in, because you've told us the order book entails what you've got confirmed. How many orders or what is your L1 position right now?
So you see, whatever is L1 at whatever stage when we are declared L1, we declare it to the stock exchange. So it won't be correct for me right now to give information which is still in work in process. But as I said, to reiterate, all orders which are included in 8,900 crores are finite orders where agreements and LOIs have been received.
Got it. And what about your exports? You said that exports last year were virtually nil. I'm looking at export revenue per quarter, 5 to 7 crores for the last 5 quarters all through. With the order in contribution that you have from exports, which is close to 20% that you said right now, how much can you generate in terms of revenue from exports this year?
So this 1350 crore order book, which was amassed in the last 4 to 5 quarters, this will now start execution in this FY. And that will give a big boost to our top line and bottom line. And we are expecting at least about, minimum of 300 to 400 crores revenue coming in this FY. So we're going to start deliveries starting from end of this Q1 or at least beginning of Q2. And let's see how the rest of the quarters pan out. But definitely this is going to contribute in a big way to our top and bottom line.
Okay. All right, sir. Appreciate you joining in. Thanks a lot for giving us all of those details. We'll hold you to some of these numbers and we look forward to chatting up with you as the year progresses. Well, on that note, though, time to slip into a short break. As we do that, here's some good news for all our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Download the CNBC-TV18 app from the Apple Store or from the Google Play Store. Or you can simply just scan the QR code that comes up for you on the screen.
Near 200-point recovery from the lows that we've seen on the market. The Nifty banks still below the flat line right now, though has seen a fair amount of recovery. What are the stocks that are leading the Nifty higher then? It has to be metals and some of these auto names. So pull up Tata Steel for the second day running, doing well. In fact, this week it's put on gains of almost 10%. We're seeing some traction in Hindalco as well as, Grasim. So you have across the board gains coming in. And look at Hero MotoCorp. That stock has moved higher. In fact, it's one of the bigger gainers this week. We've also seen some traction in JSW Steel. Perhaps, the US-China trade bodes well for metals. And Shriram Finance is the other one which continues to do well. Looking at individual conglomerates, the Adani Group stocks, that should come up for you. We have Adani Ports, Adani Ent, and all the Adani Group stocks which are spiking. From the broader markets as well, no real problems. Intellect Design up 5%. We have Macrotech Developers up 3%, Nalco up 3% as well. So by and large, good looking screen, notwithstanding the underperformance that we're seeing on the Nifty Bank.
Well, on that note, though, let's wrap up on this edition of Chartbusters. The team of Trading Hour is waiting for you on the other side.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fatakia. And at 11 o'clock, the market is staging a recovery. The Nifty's climbed above 24,750, trying to make a dash towards that 24,800. The Sensex is now in the green, up nearly about 300 points. Compared to an hour back when we were down nearly about 0.5%, there has been a sudden surge in the market, especially large caps.
Oh, absolutely. What a U-shaped recovery, or V-shaped recovery, as if I can call it that.
Right now, the graph is vertical.
The graph is vertical, indeed. Already getting feels of expiry within the first couple of hours of the trading session, and it is a strong recovery that we are seeing on the index. Of course, can't not take away from a lot of these stock-specific reactions that are coming in. Apar Industries with the top gainers on the Nifty 500 now 12% higher, but earnings reactions, look at eClerx up 9%. And of course, there are other names as well that are reacting to results. On the downside, there is Muthoot Finance, that's down 5%, Hitachi Energy too down 4.5%, along with names like Piramal Pharma and Godrej Industries. So plenty of earnings reactions, but Persistent Systems also, just before we move on to Sheela Foam, Persistent Systems too is reacting. In just a few minutes earlier, we put out a news on our screens that one of its key clients, which is United Health in the US, is facing some issues with regards to a company-specific issue, and it's a major client for Persistent Systems, and it is weighing down on the stock in today's session. 2.5% lower is where Persistent Systems is. But earnings reactions continue, and Sheela Foam is the management that we put the spotlight on. The company reported a 66% fall in its net profit. Margins also narrowed. To discuss more on the quarter gone by, we are now being joined by Rahul Gautam, who's the executive chairman of Sheela Foam, who's joining. Mr. Gautam, good morning. Thank you for joining in. After the year that you have had in FY26, FY25, what are the kind of targets that you are penciling in for FY26 on the revenue front and on the margin front as well?
Thank you. Thank you for inviting me, and it's a pleasure to be here. So, yes, it's true that the last year has been flat as far as the top line is concerned, and there has been a drop in the earnings part. But let me just share with you that last year was primarily setting the base right, and after the big acquisition that we have kind of gone through, most of the base work has been complete. The back end was, of course, completed long time back. The front end is settling down, and the targets that we have taken for this coming year, FY26, is at least a top line increase of 10 to 15%, and a bottom and an EBITDA levels of also 11-12%.
You're saying margins will increase from 3.9% exit rate to 11 to 12%.
3.9% is probably not an accurate number. Okay. We have, on a consolidated basis, we have finished off at 8.3. But if I look at standalone Sheela Foam, that has been also upwards of 8%.
Okay. So top line 10 to 15%, margins 11 to 12%.
10 to 11%. Yes.
10 to 12%, which compares with about 8.5% that you clocked in.
Right.
In the quarter.
That's right. That's right.
Right. What about market share? What is your current market share? Did you lose market share in the year gone by, considering that you had flat growth? And what is the outlook on exports going ahead?
So, ma'am, as far as the market share is concerned, we have actually gained market share. The volume growths have been far more. I can say that the volumes would have gone up by about 8-9%, 10%, while the value would have been flat. Actually, the raw material prices, which contribute a lot to, let's say, the industrial part of our business, where it is just the raw material prices plus the margin, the raw material prices have been low, and actually on one of the lowest in the last decade that I would say. So that's why the top line appears as far less, or far, and obviously even on a percentage basis, it's a struggle to sort of cover up the expenses. But I would say most of the time was spent on consolidating, setting the base right, and all that has been said. You mentioned about exports. Exports have never been the strength of our business. The products are highly voluminous, whether it's mattresses or polyurethane foam per se. And it's only in between that we just got a little bit of a ray of hope that's post-COVID when US was exploring the China plus one factor. But post that, even the Chinese imports into the US or subsequently, wherever they have been shifting bases, the Chinese exporters, whether they went to the Europe or even up to Mexico, etc., it has not. It's not been working. I mean, today, of course, we know what the struggle going on in the US is of trying to manufacture within US. So our exports are going to be very, very nominal because it's only highly technical proprietary foams which go by and large foam products, whether mattresses or furniture, is difficult to export.
Mr. Gautam, just before I get to Kurlon, since you mentioned about the difficulties that you faced in manufacturing in the US, if you could shed some light on that, and would it be fair to assume that this tariff drama that happened over the last month and a half with them, US and China increasing tariffs on each other, and then the opportunity that came in for the Indian markets, would it be fair to assume that there was no such benefit that accrued for your company?
No such benefit that accrued. Absolutely. I mean, it's except that at that time when people, especially the American importers were looking at a China plus one, then that's why India appeared as the normal thing to go by. But, by the time we also set up an export unit, but it's everything else, it's handling the freight, it's the freight cost, it's the availability of containers, etc. And then very rapidly, it went to the import tariffs that US was levying. So on products like that, it had gone up to almost about 100% level. And now, of course, it is still under settlement. But whether something big will come out of it, probably not.
What's the expansion footprint for Sheela Foams? I'm not talking just about FY26. Say 3 years down the line, how many outlets would you like to have? Exclusive outlets or in MBO format, and what's the amount that you're planning to commit to expansion?
So at the moment, as I said, I keep the last year as a kind of a stabilizing process with the acquisition of Kurlon. Today we have active footprint of about 4,500 outlets. This is increasing by about 500 per month, per quarter as of now. And I would say that if the current quarter that's gone by, whatever has passed is any indication, we are well on track of that. So if you are looking at a 3-year period, what I see is about a 6,500 outlets at the end of that 3-year period. And they would be mostly exclusive. Of course, there are areas where MBOs have to be taken care of and have their connections and relationships in that area. And we have our program to take care of them. But by and large, the proven, let's say, format has been that of an exclusive outlet.
One final question, Mr. Gautam, very quickly, if you could tell us how is the integration of Kurlon panning out for you? You had mentioned earlier that you would get to 1,000 crore annual run rate by the fourth quarter with 12 to 13% margins. How has that shaped up in the fourth quarter, and how much of the additional cost synergies are you still left to realize?
So let me start with the last part of your question, which is the cost synergies. So we had expected or we had targeted for cost synergies of about 220 to 230 crores. We have realized about 140 out of them. Rest delayed a little bit, but it should be should be realized in this quarter itself. The integration part of it, which we all know that acquisition is a far simpler thing to do and integration takes time. The back-end integration is complete from a footprint where just the total of 18 units have been now reduced to 12 units, which are the optimum number for now and actually also for the next 3 years as far as India is concerned. So that consolidation has taken place. The front end is taking place where, they were completely two different ways of doing businesses. And we have zeroed down to exactly how it needs to be done, activating the distributors, looking at your own warehouses or your distribution centers, etc. And that we are absolutely well on track. Actual realization will begin to happen post this quarter.
All right, Mr. Gautam, thank you so much for sparing time and joining us today on the show. Wish you good luck for the rest of the year as well. The management there of Sheela Foams on tariffs and the acquisition of Kurlon as well.
By the way, just see how choppy the markets are. In the last 30 minutes, the Nifty has moved 100 points 4 times. So starting 10:45, the Nifty moved from levels of 24,650. It went up to 24,750. Actually, more than that, almost to the 24,800. It retraced 100 points, went back up, and again, it's slipped now below the 24,700 mark. So get into a break. Things are choppy, moving around. Manisha Gupta joins in on the other side with commodities.
Welcome back. Shifting focus now to commodities, and Manisha Gupta is now joining in and with an update. And today we are focusing on all that glitters, but gold is not glittering today, Manisha.
Well, it is not. And it's a very sharp decline that we have seen coming for the prices. Much on the anticipated lines, because after we did see the US and China trade negotiations go through well, it's a temporary halt for the next 90 days in sense of those very high tariffs. You have seen that profit taking coming in. Remember, it was only after these tariffs and concerns in the global markets that we saw prices hit an all-time high of $3,500 an ounce. Since those negotiations have gone through and we heard that conference, we have seen gold prices continue to decline. So it's been falling actually 2% on a day basis. And if you look at from the all-time highs, we have seen $350 an ounce of a decline, which is 10% from the all-time high of $3,500. With the kind of fall that we've seen in case of gold prices, we are trading at a 5-week close at this point in time, and we have seen prices go below 31.75, even 31.50 at this point in time, with many analysts telling you that 3,070 and then the very crucial psychological mark of $3,000 per ounce is the next support that you could be looking at in sense of gold prices. Well, the good that it has done is that you've seen physical buying come into the markets, also because this is wedding season coming on in India, so there is good physical buying that the market's anticipating that you could be looking at in sense of gold. Well, some reasons which have led to this decline coming in. One, of course, is about the US and China trade conversation. And then US has been reiterating that they have been having stronger conversations. There's a good progress when it comes to tariff conversations from India, with Japan, with South Korea as well. And that also seems to have eased a bit of a pressure. And then there has been a statement from US saying that they have removed sanctions from Syria. So those geopolitical tensions that we saw between India, Pakistan and other countries also seem to be easing a bit and leading to gold prices declining further.
Thank you very much for that. Moving on now to Karnataka Bank, and here the stock is under pressure. The net interest income of the bank was down 6.4%. The net interest margin NIMs have contracted. That said, the asset quality has improved. We have with us the MD and CEO of Karnataka Bank, Shri Krishnan, joining in. Thank you very much, sir, for joining in. This is Rima here. First, if you could talk about this NII decline that we've seen in the quarter. What is the reason behind that, and do you anticipate growth in Q1 and FY26?
Thank you for this opportunity. Specifically on the overall results, I'll talk about it later. But on NII, your question is that, there is a decline. This is a market phenomena, as you're aware, that, there have been 2 rate cuts. Over 70% of our loans are EBLR linked. And of course, this is, when I say EBLR, external benchmark to the treasury bills. Fortunately, the treasury bills has not corrected as much as repo in the past, and that is very good news for us. So we believe that this is in a steady state and will continue to be as we grow our asset book. So the next year, which is this financial year, the NII will increase marginally, but however, this would be a conjunction of the growth in the book.
What about advances growth then? Your advances growth on a gross level was up about 6.8%. Retail is up close to about 15.5%.
Correct. So this is the focus for us. What we are doing is that, there is a churn that we are doing as far as our overall advances book is concerned. There were some bulk advances which we have had in the past, which we have turned around and churned around rather. And the second is that we have some large NBFC advances also, which we are now kind of shifted to direct to corporate. So between retail and the direct to corporate, mid market, mid corporate, as well as the large corporate direct to lending to them, we have increased the book by over 7,000 crores. So this is where I believe that the growth will happen, and that will also have a significant improvement in the yield because the earlier assets that were put were opportunistic because of the surplus liquidity in the bank. Our deposit franchise is doing well. All the various financial metrics of the bank, capital adequacy, LCR, our PCR, our NPA, slippages, credit costs, everything is very, very favorable. We are very well poised as a bank for this financial year.
Mr. Srikrishnan, good morning. Thank you for joining in. The street is looking for some numbers, sir. You mentioned that your net interest income will grow marginally from what it was in FY25. If you could quantify marginally, and if you could also specify the loan growth and deposit growth targets that you have set for FY26.
So why I said marginally is because the market is anticipating some more cuts, which you are aware. So what will happen is that while we will be able to maintain the margins, the NII is not really the function of making profits alone. So there are other parameters. As far as the loan growth is concerned, this year we believe that the book will grow by about 14%, but that will also include some amount of retiring bulk advances again this year. So technically, the book will grow much more than 14% in our case. Likewise, on the deposit side, we believe that the growth will be averaging anywhere between 10% to 11%. But the idea here is that between advances and the deposit numbers, based on the bank's position, we are calibrating because we do not want a deposit franchise kicking in without opportunity to lend. And that has been happening in the past, which is why our CD ratio was low in the mid-60s about 2 years ago, which we brought to mid-70s. And we believe that it will really increase as we go forward if we are working towards the right kind of targets on the advances and also ensuring that the supply of funds from the deposit franchise is calibrated.
This 14%, book guidance, advances guidance, that's at a gross level or retail?
That's at the gross level, please. And so our 78,000 book will be closer to 90,000 crores.
And retail in that would be growing much faster.
Of course. So that has been the phenomena last 12 to 18 months right now. And our deposit franchise as well as our retail asset franchise both have sales structures now, which was not the case in the bank. And because of this, there is outbound sales. We also created various processes whereby we have created the retail asset centers in 2 locations, and we are going ahead with other locations also. So these are all investment phases in the bank right now.
Okay. Sir, on your advances, just trying to understand the way your NIMs will move from here on. What percentage of your loans are linked to repo, MCLR or fixed price loans? And what is the outlook on net interest margin considering we are in a rate cutting cycle?
So we have up to 70% of our loans, which is external benchmark, basically treasury linked, treasury bills. So this is not repo. And the balance is all floating rate interest. And this again has a quarterly reset. And this is more for the larger corporate advances. So as a result, what happens is that, we are very, closely linked to the market. And EBLR T-bills, as you know, is not reacting the same way as a repo rate cut in a falling interest rate scenario. And that is something the bank is well positioned for. And we believe that, there will be advantages for the bank in this financial year.
Mr. Sri Krishnan, your deposit growth has outpaced advances, but your CASA was down. So does that mean that your higher share of term deposits, and are you pushing for more term deposits this time around? And if that is the case, what does that do for your incremental cost of funds? If you could share a number on that, sir.
So just to clarify there, the CASA has not come down. It was 31.94% the previous year. We are 31.75%. So there is not much of a difference there. We have actually grown alongside the growth in the overall deposit number. That is one. Secondly, we are also doing a churn on the retail term deposits, because retail term deposit is a big push for the bank, and that is granular rather than relying on the bulk deposit. So we are not in the market to pitch for open market high cost deposits, which in the last 2 quarters we have desisted from. And for relationship accounts, larger relationships, we continue doing that. So our ratio of our bulk deposit is less than 6% right now on the total deposits.
You said you're well placed on NIMs. Is there a number that you are targeting, say in the first half of the year or the end of next year?
So there are two elements to NIM. In the last year, as you are aware, there was a penal charges which got implemented as against penal interest. So it moved away from the NIM. So I have to adjust the NIM. So the adjusted NIM is anywhere around 3.18% right now. And we believe that, this will grow at least about 10 to 12 bips now additionally because of this churn that we are doing on the advances portfolio. Whereby the overall yield on the loans that we are incrementally putting on, and plus the pressure on deposits will come down because there are 2 rate cuts. So there have been changes to our deposit rate structure on the retail side. We have repriced them. But the transmission of this across the portfolio will take a little while because most of the deposits are, as you're aware, 365 to 375 days. So I would say that 50% of the deposit number would get repriced this year. So there is a positive impact on both sides, which is the churn in the corporate portfolio and the EBLR advantage, plus the fact that the deposit rate repricing has already been put in place.
All right, Mr. Sri Krishnan, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Karnataka Bank, the stock closing to the lowest point of the day, now 4% lower there on the stock. The markets continue to remain choppy, but we take a short break. The management of Sagility India joins us on the other side. Stay tuned.
Investing.
Welcome back. Sagility India posted its Q4 numbers largely in line with expectations. They have reported about a 5.7% quarter-on-quarter revenue growth, 17.7% on a year-on-year basis. Ramesh Gopalan, MD and Group CEO at Sagility, is now with us on the show. Thank you very much for joining in. I believe this quarter there would have been an impact of the BroadPath acquisition. Is that correct, Mr. Gopalan?
Yes.
And if yes, could you tell us what was the contribution on account of that? What was the organic growth, quarter-on-quarter, year-on-year, and how much did it impact your margins?
Yes, so BroadPath acquisition, like you said, we did that end of January.
So 2 months of the quarter, BroadPath was included. So if we exclude BroadPath revenue for the quarter, the organic growth for FY25 was 13.3% in USD terms, constant currency terms, and 15.6% in INR terms. And on a Q-on-Q basis, excluding BroadPath, the INR growth was 2.7% and the constant currency was 0.5%.
13.5% was the full year growth number, right? Organic growth?
No, the full year growth, like I said, was 13.3 constant currency and 15.6 in INR terms. And the Q-on-Q growth was 2.7 in INR terms and 0.5 in constant currency without BroadPath.
Okay. And what about the impact of all the acquisition-related expenses on your margins?
Look, the BroadPath in Q4 was the impact on margins was about 110 basis points on the EBITDA margins.
Okay, but even if you strip that out, I think your margins are still down on a quarter-on-quarter basis. So what explains that?
Look, we were following a fiscal calendar, a calendar fiscal, which is Jan through December. So we gave salary increases effective Jan 2025. So there was an impact of roughly about 70-80 basis points because of the salary increases. The other difference is basis the other income, right? So other income in the previous quarter to this quarter, there was a difference of almost 260 basis points because of that. And then the balance is because of the Forex on the balance sheet, which is classified under Forex loss in other expenses, right? So those were the reasons why there is a dip on the EBITDA Q-on-Q. Operationally, we still performed very well.
Mr. Gopalan, good morning. What about FY26 then? What are the targets that you have set in terms of growth in INR terms? And what do you expect to be the growth drivers? Would it be the existing clients, the new clients that you onboard, or a mix of both of them?
Both of them, right? So we continue to grow on our existing clients. The relationships are strong. We identify newer opportunities in all of our existing clients, and they still continue to drive our business. And like I mentioned the last time, BroadPath acquisition gave us access to 30+ mid-market clients. And we're trying to cross-sell our services into BroadPath clients. So that's also expected to generate additional revenue. So it's going to be a mix of both existing clients and new revenue. We are guiding the same low to mid-teens growth organically in constant currency for FY26 as well. But given that BroadPath acquisition happened in end of January, that will play out for the full year. So including BroadPath, our top line growth would be in excess of 20% for next year.
So 20% is your top line guidance for FY26, including BroadPath. Stripped of that, would organic growth
organic growth, like I said, it will be low to mid-teens like we did this year.
Okay, so similar. And what about margins? Because analysts feared that BroadPath, given how on-site centric it is, the margins are lower than Sagility's India, and that could drag your margins.
Yes. So yeah, we mentioned that at the time of acquisition, right? So it's going to be dilutive to our EBITDA margins by 120 basis points. But with that, we are still projecting a close to 24% EBITDA margins for 26.
Mr. Gopalan, you've been aware of what has been happening in the US for the last 40-45 days now with all this tariff drama, the back and forth that has happened. Has there been any change in sentiment on ground when it comes to your clients over there? What are you penciling in, or is it too difficult to project a growth outlook for a market like US considering the situation that is there on ground currently?
Look, the specific impact on tariffs, especially on our clients, which is more payer-centric, has been minimal, right? So the tariff in itself isn't having any impact. But our clients have been under profitability pressures last year as well. So that's not specifically with respect to tariff, but because of other factors. But like I've mentioned in the past, what we impact is the operational expenditure of our clients, right? So that doesn't get really impacted in terms of decision making. So we don't see too much of an impact on the decision-making cycle or our deal cycles. And that's why we continue to project the same low to mid-teens growth like we projected in the past. So technically, we are not expecting any impact to our revenues.
How much is your exposure to the US, Mr. Gopalan, if you could quantify that as a part of your overall top line?
Our exposure is 100%.
So all of it. Oh, okay.
Yeah,
Right. And what about your top 10 clients, Mr. Gopalan? Currently stands still at around 90% with FY25, and that number has remained constant across the last 3 years. Is there a plan to bring that down and focus on expanding the client base, or does this remain the same even this year?
No, it will come down this year. Again, thanks to BroadPath acquisition, we've gotten a lot of logos outside of our top 10. So that in itself will bring the concentration down across all the numbers, right? Top 3, top 5, and top 10. So you would see changes in all of those numbers in FY26.
So it comes down to 80%?
Maybe not 80%, but definitely around the mid-80s.
And final question, sir, your debt reduction as well. You've brought your debt down from 2,200 in FY23 to almost 1,000 crores now in FY25. What do you expect to bring it down by the end of this year?
See, the whole debt is the promoter debt, right? So there is a pay down schedule that we've given as part of our earnings release. So the full debt would be paid down by FY27.
All right, Mr. Gopalan, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Sagility saying that low to mid-teens organic growth in FY26 and hope to pay down the entire promoter debt by FY27. Take a short break. On the other side, more market conversations with George Thomas from Quantum AMC. Stay tuned.
Welcome back. Persistent is weak in trade. I think the stock is down close to about 2.7%. Even IT, the Nifty IT index is on the back foot, but Persistent is underperforming. And here the news is that one of its top clients is under stress. Now, no IT company discloses the names of its clients, right? But you end up knowing, right? So analysts are saying that United Health, which is in the eye of the storm, is one of Persistent's top clients. In fact, some say, some sales notes say, top 5 clients, revenue run rate is about $100 million. And we know the news flow surrounding United Health. One, their CEO stepped down, they withdrew their guidance, and now it's under potential investigation for some Medicaid fraud. So the street is clearly worried because healthcare is about 28% of your revenues. It's perhaps been a fast-growing component of the company. So if one of your clients is under stress, the street would be a tad bit worried, and you're seeing that stock price collapse on the back of that. And not to forget that this has been an outperformer. The stock is up 200% in the last 3 years, and valuations are expensive. So bad news coupled when the stock has done well, and high valuations, is quite the recipe for a correction.
Oh, absolutely. 2.75% gain on persistent, and it's not only persistent because United Health is putting pressure on the Dow futures also. It's down 250 points. It's the largest constituent on the Dow Jones.
Post, I think after hours, United Health was down about 8-9%.
Yes, and therefore it's putting pressure on the Dow futures, and of course it's the biggest constituent on the Dow, and as a result of which the Dow has underperformed over the last couple of trading sessions compared to the S&P 500 and the Nasdaq. We'll take a short break here on Trading Hour. More on the other side. Stay tuned. Welcome back onto a conversation with George Thomas from Quantum AMC now. George, good morning. Thank you for joining in. I was reading about your fact sheet and you mentioned that in your small cap fund, you have increased your positions in the auto ancillary stocks and also initiated fresh positions in an auto ancillary company. Now, what's your take on this entire space? It's assumed that you're bullish on the space, but if you could tell us your rationale behind this move.
Hi, good morning. Thanks for having me on the show. See, generally, from an overall market perspective, our sense is going forward, the earnings expectations are not very high. So coming, the base has kind of reset to a very low base, and then again, going to the tailwinds, which we are seeing in terms of the moderating inflation and the rate cuts coming in. And even the monsoon expected to be in a reasonably good monsoon. Our sense is, earnings growth is likely to improve from here on. And therefore, on an overall level, when we look at our portfolio upside, though it is slightly lower than what we have seen in terms of, historic long-term average, but it still looks reasonably good in terms of, making into fresh allocations.
George, the other bit that you mentioned is that you have exited an FMCG stock, but the others you've also added your weights to existing positions in the FMCG space. So in terms of the entire space, right, you divide that into staples, durables. Where does your preference lie? You would go for staples, which have been struggling for a while now, or would you go for the consumer durable companies?
See, in Quantum Value Fund, historically for a very long time, we have not had any exposure to staples. A lot of those valuation expansion in this bucket happened between 2017 to 20, when growth was absent in the broader markets and very few names like the FMCG or the staple names kind of reported the earnings growth. And that was a period context when the market kind of, valued them to quite irrational levels. But over the last few quarters, what is visible is very clear. One, the defensive nature of the sector itself was kind of questioned. And again, there has been a lot of competition in the space from private labels and things. So even at these levels, the kind of valuations where they trade at, does not look very, enticing for us to, make fresh additions. We have exposure to a consumer durable company, which is mostly into fans, lightings, and some of the kitchen appliances, where we feel there is a lot of room in terms of improving penetration and considering the levels at which it is currently trading, we feel there is reasonably good upside to that.
George, what are the other sectors that you are putting your money to work as of now? What are you recommending your clients, and are there sectors that you are recommending to avoid, more importantly?
See, when we look at our portfolio action over the last recent months, the addition has been to a health insurance company, which has been seeing some bit of increase in their claims ratio. And our sense is the company has taken steps in terms of pricing action and has taken some bit of pricing action and ensured that, how claims can be, well validated and stuff like that, or even educating their customer base in terms of what are the allowable limits and stuff like that. So we are hopeful that the increase in claims ratio is kind of transient, and therefore we have made an allocation there. And the other addition has been to a pharma name where the company had seen some bit of bumper profits from a single drug, and they have reinvested those gains into other segments where we are hopeful could lead to reasonable earnings compounding over the years. But the market is worried about a cliff from one of the drug which could go, off patent. But we are hopeful that the kind of investments which the company has done should give them a reasonable earnings compounding over the long term. So these are a couple of major additions, but of course, other than that, we have added weight into a large cap IT company when the valuations were slightly more benign, and the sector was going through peak pessimism. And when we looked at what was the kind of earnings expectation which was baked into these companies, it looked quite conservative, and there we saw a potential for earnings growth to be higher than the street's estimates. And these were some of the few additions which we did. In terms of trims, so some of the pockets where the earnings growth has been fairly strong, we have made certain reductions where valuations were at full. And a couple of them were a two-wheeler premium player where volume numbers are still fairly strong, and where we felt, the valuations had kind of fully priced in the underlying fundamentals. And a NPFC player who is into CV refinancing in the secondary CV market, where we felt the valuations had kind of fully priced in the robust growth and a reasonable outlook in the next couple of years.
George, very quickly, if you could tell us what's your positioning on the defense theme, because the stocks have run up quite a bit over the last couple of weeks, and from almost being down 30-60% from their top, they are now almost back to their record high levels. What's your call on defense?
See, like you said, many of the stocks had seen sharp correction, but the point to note is it's very unlikely that defense spends can grow at a rate which can justify those valuations which existed prior to those corrections. And our sense is, so of course, over the recent times, we saw some flare up in terms of, wars and escalations. But our sense is it's very unlikely that, these companies could compound at very high growth rates, even high double digits or high double digits looks quite unlikely for long periods of time, which is required to justify these valuations.
All right, George, thank you so much for sparing time and joining us today with your views on the various sectors. George Thomas there, or Quantum AMC. By the way, Muthoot Finance is now at the lowest point of the day, 6.5% lower now on the stock. Hitachi Energy too, another negative earnings reaction. That too is down around 5.5%. So negative moves coming in there for Muthoot and for Hitachi Energy as well. Of course, brokerage opinion on Muthoot was also divided. Jefferies called it a play on asset quality, but Morgan Stanley has warned that this fall that you're seeing in gold prices could be potential negative for the stock. Also pull up Cochin Shipyard reporting results today, and defense as a theme has been in the reckoning over the last couple of weeks, as we were just talking about, almost 6% higher in today's session as well. In the last last 5 sessions where the stock has been gaining consecutively has seen the stock surge almost 20%. So reporting results today is Cochin Shipyard, so keep your eyes there as well. And Hero MotoCorp has now moved to the highest point of the day, 4% higher there as well, and after some better than expected results and strong earnings commentary as well. So Hero MotoCorp now 4% higher on that stock as well. Some of the other names that are not doing well though are some of the pharma, mid-cap pharma names. Be it Newland Laboratories is down 4%, Piramal Pharma is down 3.5%, and some of the diagnostic names as well, be it Vijaya Diagnostics, that is down around 2.5% in today's trading session as well. Then but of course, KC International is one of them, 5.5% higher. And pull up Kalpataru as well. The company announced an order win earlier in the day, 2.5%, 2,500 crores almost is where the order win for Kalpataru. So 3.5% higher on that stock as well. But moving to corporate conversations, then Lupin, after reporting their fourth quarter numbers where revenue grew 12%, EBITDA also rose 22.5% from last year. Our colleague Ekta spoke to the management of Lupin and began by asking them about the company losing the patent case on Mybetriq generic and how it plans to move forward from it. Listen.
Yeah, so I'd say that there was an interim decision. You know, we don't consider the decision as final because the trial is in February of 26, and we're preparing for it. And, you know, the decision was on a particular defense, while Lupin has multiple defenses on the multiple patents that Astellas has tried to enforce on the product. You know, the product is a significant contributor. It has been a significant contributor during fiscal year 25 and will continue in fiscal year 26. And we will, you know, defend ourselves on a very strong basis in the upcoming trial in February. And beyond, you know, once a decision is final, we'll also appeal if need be.
All right. Well, you just launched Tolvaptan generic in the US markets. Tell us how much of an opportunity it is for Lupin. Estimates are around $150 million per annum is what it could rake up. And as well as X-Way generic, which you have exclusivity on as well.
Yeah, so we just launched the product earlier this week, Tolvaptan, and it was a very unique launch for us, given that it's a specialty REMS program, establishing relationship with all of the specialty distributors. Our team did a terrific job with that, but it meant a little bit of work up front in trying to get the specialty distributors on board. We believe that the product will be a significant contributor. I will refrain from any number guidance, but it should be a material product for us based on the partnerships we've established, as well as the product supply that we have in place. Really excited about starting the year with this product launch.
All right. How much do you think you can do in the US on a quarterly basis? You did $245 million this quarter. What can we expect in the next couple of quarters?
Yeah, I'd say this is a new base for us, you know, given the price erosion on the older products, but continued ramp up of products like Spiriva and others. You know, we also have Rivaroxaban as well as Predfort that continue to be strong contributors in terms of new product launches. Apart from our existing portfolio, and the Tolvaptan now in the market, as well as injectables launching second half of the year, we believe that $250 million per quarter should be the new base.
All right. Ramesh, guidance on margins was 22 to 23%. When do you get there on a sustainable basis?
I think from our perspective, we've done pretty well. You know, the momentum that we had set several quarters ago just continues. And if you look at the current quarter's margin, 23.2%, this is after taking into account a much higher R&D spend, close to about 100 crores, and in fact, a much lower PLI. You know, from our perspective, if you were to add that, we are looking at least another 2.8 percentage points. 26% would have been the rate. And of course, if you look at, in fact, the losses made by adjacencies, which have been, which are newly set up, digital diagnostics, then you could also include the CDMO business and the like. All of this, if you were to take into account, it'd be another 4 percentage points, so to speak. But that said, Yes, this journey is continuous. We still, the R&D spend would be of the same level in the quarters to come as well, because we are spending a lot on more complex stuff. There's a lot of initiatives in terms of containing the costs as well, and that's pretty evident. The buoyancy on the top line, of course, contributes, but there's, of course, a lot of things happening on various lines, alternate vendor development and the like as well, which has contributed to gross margins. So from our perspective, it is a continuous journey, and we remain optimistic about continuously improving it over quarters.
All right. Is there any opportunity from weight loss drugs, say, such as liraglutide? And are you looking to launch semaglutide when it goes off patent in emerging markets in Canada?
Yeah, so I can speak about India, and then Vinita can add for other geographies. In India, like we said, metabolic disorders is going to be a big play. It is a big play where we're, depending on the time, either the number 3 or the number 2 company in that space. I think weight loss clearly is a category as well, both with liraglutide, but also importantly with semaglutide and eventually with products like Mounjaro. We do hope to be in the first wave of generics, sometime next year from a launch perspective. And I think it's just going to be an important therapy area. It's already a very rapidly growing market in India. And clearly, we have the reach, we have the breadth of experience, we have the depth of experience to be able to capitalize on making sure that this becomes commercially very successful in India.
Okay.
I'd say that the products are important overseas as well. Liraglutide is an important part of the injectables strategy in the US in particular. And we have licenses in place in a couple of markets, like South Africa, Philippines for semaglutide, and continuing to work on other opportunities that we have to bring these products to market as market opens next year in a few countries.
Okay. Vinita, how are you reading President Trump's executive order and any impact on generics according to you?
No, I think it's very early to really interpret the impact of the recent order on the brand products, the MFN plus that the order entailed. I mean, it's pharma is still trying to interpret it and believes that there is it's not clear what the implications will be. For us, I mean, of course, the pricing of brand drugs impacts the pricing of generics overall, so we watch it very carefully. We are looking out for, what will likely come down the road on tariffs, which can have a material impact, and have, provided our comments as part of the Commerce Department 232 investigations to emphasize the importance of generics in the pharmaceutical industry and drug spend in the US, and the impact of cost increases on tariffs, on inflation, as well as drug shortages. So hopeful that that message is resonating and will not cause material disruptions in the industry.
Are you planning to increase onshore manufacturing in the US?
Yeah, so we were already in an expansion mode in the US, in particular on the respiratory front. We had started to build out our Ellipta and Respimat footprint in the US, in Florida. So that is ongoing, and depending on the incentives the government puts in place and the requirements that it has on essential medicine in the US, we'll certainly consider if it's economically viable to set up additional manufacturing in the US.
Okay. Nilesh, the US FDA is increasing unannounced inspections in the US as well. In India. What is your reading?
Mm-hmm. Yeah, I think... first of all, unannounced inspections is not a new thing in itself. I think there's a guidance for, increased number of inspections itself. And I think our aim very clearly is all-time readiness, right? So, if FDA was to walk in tomorrow, we should be ready. It's not something that you get a pre-scheduled thing. And the days of pre-scheduled inspections have long been over. So I think the goal is all-time readiness and best-in-class compliance, right? So from our perspective, it's both of those goals, not just from FDA, but from any other regulator as well. We feel, dozens of inspections, sometimes dozens of inspections each month. Obviously, we have to be ready at all times, and quality has to be built into it. So I think we were very clear about our quality agenda. We want to very clearly be best in class. We had 5 sites which were in an unacceptable state of compliance. We're down to 2. Whenever FDA does come, we want to obviously clear the other 2 sites as well. And I think that'll be a great story. But the game doesn't end there. I think the game there is all-time compliance thereafter.
Okay. And just quickly, Vinita, expectations from President Trump in terms of tariffs on Indian pharma?
Yes, I was mentioning we're watching that very carefully. We are hopeful that the bilateral trade negotiation is going well based on the comments that we've heard in the US. It's hard to predict, though, unless we see something concrete. And we're also engaging with the administration in the US to emphasize the importance of India, emphasize the importance of lupin, in terms of the products that we supply, essential medicines that we supply, and the willingness to consider additional manufacturing in the US, where if we have economic incentives in place to make that happen.
The management there of Lupin in a conversation with Ekta. The stock, though, continues to trade around about 0.7% higher as its result reaction. Take a short break. More on the other side. Stay tuned.
Welcome back. So eClerx is having a very good day. The company's reported strong numbers of 4.4% constant currency revenue growth quarter on quarter. Year on year, it's a growth of about 12.5%. But that's not the only metric which has excited the street. Look at the deal wins of the company. The deal wins are at an all-time high of $51.2 million, and that is a jump of 50% on a quarter-on-quarter basis. So the street is clearly excited. Growth higher and deal wins up, which means there is revenue visibility going ahead. The other one on the way down is Wendt, and here the promoter is going to be selling a 37.5% stake. The floor price is at 6,500 rupees, which means even after the 15% cut that you're seeing today, we're looking at a big downside from here on. So this offer for sale, this supply pressure from the promoters is weighing on the stock. And that brings us to a close on Trading Hour. From Hormus, myself, the entire team, thank you for watching.
Stocks swing between losses and gains on mixed global cues and a rapidly evolving geopolitical situation. Metals and industrials gain while utilities and IT drag. Eicher Motors revs up growth with strong sales and market share gains even as it compromises a little on margins. While some analysts fret over valuations, others bet on gains from premiumization. Muthoot Finance slides despite a strong performance as concerns over the impact of draft RBI norms on gold loans and volatility in gold prices weigh. The management hints at growth well above its guidance. Gold slides sharply to below $3,150 per ounce as trade tensions ebb and US expands ties with the Middle East, also lifting sanctions on Syria. A weak inflation print also aids the fall. Silver too slips. Good afternoon, you're watching us here on Halftime Report. I'm Mangalam Malu, with me Ekta Batra. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. It's been an interesting day because of the consolidation that we've seen. At the top of your screens, you can see both the Sensex as well as the Nifty lower by a smidge. But remember, from the lows, we've seen a rally of almost 140 points on the Nifty. From the highs, we've seen some supply as well. So around the flat line is where we're consolidating, with the broader markets doing a lot better, Ekta.
Hi, Mangalam. Yes, absolutely. You know, the mid-cap index is just about holding with a gain of around 0.14% at this point in time. We have the advanced decline ratio, which is holding at around 2:1, so no problems coming in there. Let's see whether this sustains. It's a lot about specific stocks today, so just want to point out stocks such as Piramal Pharma is down around 4% at this point in time, so we will be talking about the numbers very soon. But besides that, we also have a couple of other stocks such as Brigade Enterprises, which is down around 2% Newland Labs, which comes out with its numbers today, is down around 3% On the upside, a couple of the defense stocks continue to see some amount of interest. So Paras Defense is now up around 4% Mazagon Dock Shipyards is up around 3.5%. So that seems to sum up what's taking place in the markets at this point. But we have a lot of numbers to reckon with. So let's kick off the show, Mangalam, with Jubilant FoodWorks.
Well, Jubilant FoodWorks was a good performance that came in, but a large part of that was already factored in, which is why the street is, in the mood for profit taking on that stock. Valuations are a bit of a concern as well. But no real problems for as far as, these numbers were reported. 34% growth in their consolidated revenue. That's something that the company had given in the fourth quarter update itself. Standalone revenue growth coming in at 19%. So what is it that the street was trying to make an estimate for? It was the EBITDA, margins and net profit. On all those three counts, the company has actually outperformed expectations. 305 crores on the EBITDA versus expectations of 277 crores. That's flown down to the margins, which are about the 200 basis points beat, and the net profit as well. Fairly handsome beat as against street expectations. We also have the gross margins of the company this time around lower by 200 basis points. But because of the operational efficiencies and the operating leverage in the company, they managed to curtail other expenses and employee expenses, leading to the EBITDA margin staying flat year on year. So the key internals which really stand out. Domino's like-for-like growth has come in at 12%. The order growth of 24% has been higher across all tiers. And like-for-like growth in delivery has been 22%, whereas dine-in channel is flat versus last year. So the good part is delivery continues its growth. It's accounting for about 73% of their revenues. And we have the dine-in channel, which is absolutely flat. So over the last few quarters, we had seen a bit of a decline out there. That decline has been arrested, perhaps on account of the initiatives that the company is taking with regards to, sending value offers in dine-in. They have a 99 rupee lunch offer, etc. Let's look at the market, however, and continue looking at a couple of these stocks which are spiking as we speak. And as we wait for another management to join us on the show, Macrotech Developers, that's one stock which has been doing well all through this week, up around 10% this week and currently at the high point of trade. We're also seeing some traction in names like Yes Bank, which continues to do well ever since the Sumitomo deal was announced, and a couple of days before that as well, on the back of the buzz of that deal taking place. In the absolute broader markets, where you have, the cash stocks, Zaggle Prepaid really stands out. Was up 7-8% in yesterday's session, is up 8% today, once again taking the weekly gains to 26%. The management joined us here, post their numbers, and they did guide for strong growth this year, 35 to 40% growth on their top line, with margins moving towards 10 to 11% in the second half of this year. So that's a positive. And Tilaknagar Industries continues to do well on the back of good numbers yesterday.
Yes, absolutely. Quite a vibrant market in terms of specific stocks. So that seems to be the key theme that is playing out today, that the indices itself are consolidating, but we have specific stocks which continue to be in focus. Just want to point out BLS Services also, which is showing quite a lot of traction on the volume as well as the price front. So that stock is up around 14.5% at this point in time. And it's gained around 31% for this week. So do watch out for that one. Popular Vehicles also doing well, so up around 4% for that particular counter. On the downside, like I mentioned, there are a lot of the pharma/diagnostic stocks which are under pressure today. So Piramal Pharma post numbers, Newland Labs which comes out with numbers, Aarti Pharma which is down around 1.5%, Vijaya Diagnostics which has lost around 8% numbers this week. That stock is down around 2% at this point in time. So it is a lot of these stocks, including even something like an Ipca Labs, which is down around 1.2% at this point. But nonetheless, we have a lot more numbers to reckon with. eClerx is buzzing in trade on the back of gains of more than around 8% on the back of its Q4 numbers. Vinny's here with more.
Hi, afternoon. Thanks so much for that. So what we're seeing in terms of eClerx, a strong performance coming in Q4 FY25 from the company, beating the analyst estimates that were there on the street. Dollar revenue is seeing a growth of around 4.17% on a quarter-on-quarter basis, coming in at $105 million, while in terms of rupee revenue, that's seen a growth of around 5% as well. EBIT margins almost slightly flattish, 19.7% versus 20.1%. The key highlight is that the ACV deal wins for the company was at $51.2 million, which is at an all-time high, 54% uptick on a quarter-on-quarter basis. Top 10 clients grew by 7.3% for the company. Emerging clients, that has also seen a good growth. So overall, a very strong performance that we've seen coming in from the company on a sequential basis as well. And deal wins, that is something that is exciting as well.
All right, deal wins were exciting, but let's talk about the quick service restaurant space. We just spoke about Jubilant FoodWorks. They did about 12% like-for-like growth. Will the burger space be as exciting going forward or not? There is gradual improvement. We've seen, on a base of negative 5%, same-store sales growth of plus 0.07% for Westlife. And the previous quarter was a 2.8%. Again, the base was a lot more favorable as well. Akshay Jatia, who's the president and CEO at Westlife Foodworld, now joins in. Akshay, thank you so much for joining in. The last couple of quarters, you've seen a smidge of an improvement, and you have your target of high single-digit same-store sales growth. What are you doing to, propel that sort of growth? What is it that you're doing to revive demand at a time when consumption is slightly weak? Is it because of weak overall consumption scenario, or people generally moving away in the metros from, say, quick service restaurants, staying away from unhealthy food, etc.? Is there an underlying macro trend? Just wanted to understand what is it that is happening in the marketplace, and what are you doing to revive demand to that targeted high single-digit same-store sales growth?
Thank you for having me. So I don't think that, growth is not coming back, in the sense that from a macro point of view, we are seeing a marginal increase, in terms of habits, in terms of people eating out. And here at Westlife, our biggest focus is to ensure that, the customer gets that what he or she wants. So I think number one, we're focusing on ensuring that we give a great value for money offering to our customers, whether it's across, different ranges of products, or even, across beverages like McCafe. So, we've been very successful in doing that over the last few quarters, and we are seeing momentum come back into the business. Number two, we're also ensuring that the experience that customers get in the restaurants is superior. And we do think that brands like us, Westlife, will continue to perform well as we keep offering these experiences to our customers at the quality that we offer them at. So we're very confident that as macro growth is also reviving, we are doing what it takes to ensure that Westlife Foodworld gets back into the positive trajectory and moves towards the Vision 2027 that we've set.
Okay. Can you give us a sense in terms of what the geographical breakup was like for you this quarter? How much did you do in terms of your key geographies when it came to revenues?
So we don't break it up by geography in terms of exact numbers. However, what I can say is the West is a region where we've established very strong brand connect. And as a result, we have seen strong momentum in the West, especially cities like Mumbai, Pune, and states like Gujarat, where a lot of our offerings have now started bringing strong momentum into the restaurants. In terms of the South, which is our second key region, we've done a lot of work in terms of building that relevance with the customers. And while it does lag a little bit, we are seeing momentum there as well, especially in cities like Hyderabad. And we're very confident that with the right offerings, with the right brand connect, we will see that momentum come back in the South as well. And as a result, we're confident about delivering that SSSG momentum that we've committed in Vision 2027.
All right. So I guess the reason why I wanted to know is because you had this target of moving west and south to about 50% of your revenue as well, currently more skewed towards the west, as you earlier pointed out. So as that happens, and whenever that happens, for this year in particular, FY26, what are you looking at when it comes to revenue growth, same-store sales growth, and margins? If you could give us a sense.
So again, we don't give year-on-year forward guidance. Vision 2027 remains our marker in terms of overall guidance. But what I can say for the current year in terms of indication is that we definitely want to get back to that trajectory of mid to high single-digit SSSG, and all effort is there in terms of bringing that momentum back into our restaurants. And even in terms of margin, as we see operating leverage play out, we're doing a lot of solid work in terms of cost savings as well as pro mix in terms of reviving those as well. So we are quite confident that FY26 will be the start of that trajectory that we require for Vision 2027.
Okay. Give us a sense in terms of what the addition would be in terms of stores going forward. What is the capex that you have lined up? And since we did speak about maybe demand still on the cusp of reviving, is there any change to your capex plans?
In terms of number of stores, the guidance again remains that by 2027, we plan to be at 580 to 630 restaurants. Obviously, that implies that our range will be between 40 to 55 restaurants over the next couple of years. And in that context, our capex remains more or less similar because we are doing a lot of work in terms of also optimizing our capex as we are opening more stores. So capex will be in the range of 200 to 250 crores year on year. But again, funded through internal accruals and ensuring that return on capital remains our primary marker of guidance.
What about McCafe? You aspire to have about 15 to 18% of your revenues by 2027 coming in from McCafe. Where does that number stand? And does your entire network now have a McCafe?
We're moving closer towards it. In fact, obviously, our internal aspiration is to beat that because you are seeing the coffee market explode, and us being leaders in terms of both quality cup of coffee as well as in terms of presence. We have exactly what it takes to take advantage of that macro growth. And adding, to answer your question, we've covered almost 100% of our network with McCafes.
And what about paneer? There is a fair amount of outrage on social media around paneer. And India has a fairly large vegetarian population. I'm vegetarian myself. And I constantly wonder whether the paneer served at all these quick service restaurants, is it fake or is it real? There's so much clamor around this. Earlier it was cheese, now it is paneer. How do we stay confident that everything that is served in all these quick service restaurants are healthy? At least, if not healthy, the real thing.
So I can assure you myself that, the paneer is made of 100% milk. In fact, our quality standards at McDonald's, I say this as a very health conscious customer as well, are at the highest level. And if I was to eat out, it would primarily be at a McDonald's because I know what goes into our food is the real ingredients, and even our process of making the same is at the highest levels of quality, versus many other, areas of eating out that you may venture at.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in, Akshay. And let's, touch base for a longer conversation, because there seems to be some structural shift taking place in the Indian market. One, considering that there's a huge influx of weight loss drugs which will come through. So whether or not the same model is going to survive or not when it comes to fast food is something that we can discuss at a later time. We'll take a short break, but up next we'll focus on the IT sector with Sandeep Agarwal, Fund Manager at Sowillow Investment Managers. Stay tuned.
Investing.
Welcome back. You're still tuned into Halftime Report on CNBC TV18. Well, Persistent Systems has slipped in trade as analysts say the top client, United Health, is in trouble. Sandeep Agarwal, who is a fund manager at Sowillow Investment Managers, joins in with his take on this. Sandeep, hi, welcome to the show. Well, if we could just start by talking about this issue with United Health. Have you looked at the news, and what kind of impact do you think it could have on a stock such as Persistent?
Hi, good afternoon, and thanks for having me on the show. So, we run a PMS and our clients hold some of the stocks, so it will be very hard for me to comment on any particular stock. But let me put it this way, that, there is a lot of disruption going around in the healthcare side in the US market, and also there is some disruption going on in the auto and manufacturing pieces in Europe. And that's the reason the R&D companies are seeing very volatile numbers. Some of them are seeing very good numbers. Some of them are seeing little poor numbers. And I think this volatility will be there for some more time. And wherever, there is a combination of disappointment due to volatility along with higher valuation, we have seen the stocks getting corrected.
So in a situation like this, what is it that you're doing? Because, what we understand is it could be a little more than 10% of revenues for Persistent and a little more than 3% for Wipro as well. I just wanted to know if those estimates are correct in one's understanding. And if that was to happen, could there be some more uncertainty here? Is that revenue at risk?
So I will tell you generally what happens. I have seen this during 2 decades of my working in this sector, that, a particular client's revenue could be X percentage, but out of that, generally not everything gets impacted. A certain portion of that gets impacted unless the client has gone for bankruptcy, or the client has completely shifted to a new client, or those sort of things happen, which is not clearly the case right now. So so in this kind of situation, generally a portion of the overall contribution which comes to the revenue does generally get impacted. And remember that, it is not permanently impacted. Once this thing settle down, then, they come back also very strongly. We have seen this multiple times, not exactly same kind of issues, but different kind of issues which have paused spends for some time, but they have come back very strong after some time. Because see, this is the lowest possible price at which you can execute. So generally, the execution of outsourcers doesn't get cancelled or totally. It only gets delayed by some time. The worst hits are one which are, which are the front-end discretionary ones where the rates are very high and they are nearshore vendors. Those get hit very hard.
Okay. What do you, while we can't talk stocks, what do you think is the impact on a larger number of IT stocks because of this particular piece of news? Do you think it's limited or do you think that is going to have a widespread impact?
I think, see, there will be impact, but this impact, prima facie, the issue which has cropped up, this impact is a time impact and not a actual loss of revenue. It will be postponement of revenue. So maybe 3 to 6 months, you will see some postponement, but I don't see as a permanent impact because, in the US healthcare, we are very deeply entrenched and we are the lowest cost executioner there. So we have not seen any impact for longer term in US in last 10 years in the healthcare sector. Anytime this kind of issues have happened, it is company specific and generally it remains for 1 or 2 quarters and then, it starts normalizing.
So as a PMS owner, are you looking at this as an opportunity to increase your stake in these companies, or are you looking at this as an uncertain time, so maybe reduce some weight and perhaps get back when the things are looking a little better?
So Mangalam, we were massively overweight IT last year in August when, there was gloom and doom. All the stocks were trading like at a very, very low valuation. And since last 4-5 months, we have clearly said our view also on national channels that, we are cutting down our IT weight. We are not comfortable at these valuations because, see, this is a sector where large caps can grow between 5 to 8% on a regular basis and the good quality mid caps maybe 10 to 14%. And for that, giving a PEG ratio of more than 3 times, 4 times is very difficult for us. We are very, very, value conscious fund. So we have trimmed down our IT position in a very, very significant way in last 4 months. And we have very minimal position now. We will enter when we find that, the risk rewards are favorable and the valuations are little reasonable. Right now, the rally which has happened is broad rally. I think that, this year will be a weak year for IT. I don't see big numbers coming in this year.
Okay. All right, Sandeep, we're going to leave it on that note. Thanks very much for your quick take and for joining in and telling us about your thoughts with regards to the IT space. We'll take a short break now. Aditya Agarwal of Invest for Edu will join in with his trading call. Stay tuned.
Welcome back. You're watching us here on Halftime Report. It's absolutely flat for the market, so fair amount of consolidation. It's also weekly options expiry today. So let's look at how the markets have fared so far in at midday. So if you look at it, the key indices, Nifty as well as Sensex are absolutely flat. The Nifty Bank is a slight underperformer. The mid-cap index is an outperformer. The Nifty high-low today tells you the range that the street is working with. Yesterday we had pointed out that at lower levels, at 24,500, there would be some support. At high levels, there would be some supply. 24,808 is today's high. 24,500 is today's low. The Nifty Bank is meandering around the 20-day moving average of 54,695. The advanced decline will make your portfolios feel a lot better because a lot of stocks are gaining as against the number of stocks which are declining today. And if you look at the active options today, though no one's betting on a big move on either side towards the end. 24,600 put writers, fairly active, telling you 24 525 is an important support. 24,550 put writers also. So 24,500 to 24,525 is a support. On the way up though, 24,800, which is today's high, will continue to see some supply. That's what the 24,800 call writers are hoping for. A lot of long positions added on names like Hero MotoCorp and JSW Steel, whereas we are seeing some shorts added on Muthoot Finance. So we'll keep an eye out on that, Ekta.
Okay, all right. Aditya Agarwal joins in now to discuss all his calls for today. Aditya, hi, welcome to the show. Well, it seems as though it's going to be a lot about specific stocks today. So let's start with that, your specific stock strategy.
I've got a couple of buy recommendations, Ekta. Hi, good afternoon. Thanks for having the show. Given that markets are consolidating right now, I don't see too much of a downside or an upside. So as you mentioned, it's more of a stock-specific idea. So DLF is a buy for me. I'm seeing a good up move in all the real estate stocks. It's broken out from a downward sloping channel. So for me, DLF is a buy for a target of 750 on the upside with a stop loss at 680 on the downside. Trent is another stock which is looking very interesting to me, and it's just making a move towards that breakout point of 54, 54, 60. So I think Trend can also be bought at current levels for a target of 5,600 on the upside with a stop loss at 5,300 on the downside. What is the most comforting factor for me, Ekta, is the fact that VIX is now correcting, and it's comfortably below that level of 18. So I think matter of time before you will see a short covering rally on the market. Not too much of a downside from here, and that can lead to a good short covering rally in all these stocks which have been beaten down of late.
And individual stocks, what are you liking?
So a couple of them, Mangalam, DLF and Trent. DLF is a buy for a target of 750, a stop loss at 680 on the downside. So from the real estate pack, DLF is something that I like. Trent is also something that is on my radar. It's on the verge of a breakout from a downward sloping channel. So for a target of 5,600, I'll buy with a stop loss at 5,300 on the downside.
Take that point. Thank you so much for joining in. On the other side of this short break, we have the management of Piramal Pharma talking about their fourth quarter numbers.
Welcome back. Well, very quiet for the markets at this point. So we have the Nifty, which is just about lower by around 25 odd points. The Sensex, which is down by around 149 odd points. In terms of specific stocks within the Nifty space, Hero Motor is doing well. So that stock is up around 4.8%. It's gained around 10% this week. We have Tata Motors, which is following suit. So both these stocks have been in focus this week on the back of news, up around 3% for that particular counter. A couple of others on the downside, which you should probably really watch out for is Cipla, which is down for another day in the row. So that stock is down around 1.2%. Remember that the conference call takeaways were a bit subdued. So the street is a bit skeptical about growth post-Revlimid generic for Cipla. So that stock is lower. Dr. Reddy's is also down around 0.7%. A couple of other stocks, Power Grid, IndusInd Bank, NTPC, Infosys, all of these stocks are currently in the red as we speak. From the broader markets, we've been pointing out that as of now, the mid-cap index is holding with a gain of around 0.13%. But let's focus on a specific stock then. Piramal Pharma reported what was a strong margin recovery sequentially, while profit also saw a strong growth. I did catch up with Nandini Piramal, chairperson at Piramal Pharma, to discuss their Q4 performance and began by asking about the key trends in the CDMO business in the quarter gone by.
Overall, the last 2 years actually have been very good for the business, and I would urge people to look at the yearly year-on-year revenue, where we've actually grown 14% over the year. So I think we've had good, we've seen a 500 basis points improvement in the EBITDA margin for the year, and we've actually seen a turnaround in the net profit. So, we had a 190 crore loss in FY23, and we've seen a 90 crore profit in FY25. We've also reduced our net debt a bit to EBITDA from 5.6 times in FY23 to 2.7 times in FY25. So we've seen, again, a very good increase in our innovation-related work this year. It crossed over 50% of our CDMO revenue, and we've seen a strong growth in our differentiated offerings and our unpatented commercial offerings.
Okay. Well, Nandini, I just wanted to, drill down on biotech funding, the scenario in the US. How did that impact you all this quarter? Was there any kind of improvement?
So I think overall there has been an uneven recovery in biotech funding, and I will say there is a lot more uncertainty going forward. So we have seen decision-making continuing to sort of be prolonged. But I will say there is reasonable biotech funding for late-stage clinical assets. So that's where we've seen the good order demand there. But I would say the early phase biotech funding still remains uneven.
Okay. Could you just give us more details about the inhalation vertical this quarter, as well as your ADC platform?
So the ADC platform, I think we've seen a lot of growth there. It's a very hot area. We've seen growth both in the standalone Grangemouth facility, where we have the bioconjugation, but we are offering of integrated services, which includes the payload linker, the fill finish services at Lexington, as well as the early phase MAB platform in Yapan, and a peptide facility at Dubai. We've actually seen very good demand there. So I think we're one of the first people. We've done bioconjugation for about 20 years now, and amongst the commercial assets that are on market, we've actually had a hand in a lot of them. So I think people come to us for the science, and they come to us for the customer flexibility and the customer service that we show.
All right.
In our inhalation anesthesia, we've also seen reasonable growth. We actually opened our commercial facility at Digwal in Telangana in March. And we should see that actually coming on stream. I mean, we've done some sales so far before the end of the year, and we should see more impact of that coming on stream for the rest of the year as the regulatory kind of submissions happen.
Okay. Your OTC business did well. It was up around 15% odd. Can you tell us more about the India consumer healthcare segment? What led to this growth, and what are you projecting?
So overall, India consumer healthcare business reached 1,000 crore milestone for us, and I think that's in a way a significant milestone because it demonstrates the scale of the business. We've seen our power brands, which are Lacto, Littles, iPill, also grow at about 20%. over the year, and it's a mix of astute media and trade promotion that we've been continuing, but also new products and new SKUs that have contributed to this growth.
Okay, all right. That's on the India consumer healthcare segment. But the roadmap to get to $2 billion and 25% margins by FY30, how would you propose that? What's the roadmap?
I think overall, we're still excited and we still believe that we're on track for the FY30, but I will say that there is near-term uncertainty, whether you say the macros, overall macro, whether we talked a little bit about uneven biotech funding over the year, as well as, trade and tariffs. So I think I would say that the next year in the short term might be a bit uncertain, but once the uncertainty resolves, I do believe that we have one of the best networks. Especially we've been investing in the US for a while. We just actually said we're going to do a $90 million investment in Riverview for the payload linker, as well as continuing to do a sterile fill finish in Lexington. So we have the capabilities and the capacities. If people decide they want to onshore in the US, we do have those available.
Okay, all right. The company is looking to invest $90 million to expand 2 US facilities. What is the strategic rationale behind that?
So we talked a little bit about the ADCs, right? They're, again, a hot subject. The Riverview facility has the ability and has done some work in payload linker, which is part of the ADC and the integrated offering. And we're expanding those facilities because we've seen our clients actually want us to do more in that. So that's something that will actually come on stream over this next year. The Lexington fill finish, again, is a sterile injectable facility that we have customers there that are doing work. And as those projects actually go through the pipeline, we were running up against our own capacity bottlenecks. So as these customers succeed, we would like to keep them rather than having them go elsewhere. And so that's why we're doing the expansion. Now, that will take a bit longer. It will take at least till, calendar year 27 for it to come online. But that's something we're quite excited about.
Will costs increase for Piramal Pharma with onshoring? And is this in line with the broader trend of the US government asking for increased onshoring?
I think overall, I will say it's a bit too early to say about how the US will respond. So, but I will say that there are various customers that are looking at supply chain diversification and how do they want to continue to manage their supply chains. I will say that yes, costs are higher in the US for manufacturing, but for on patent things, the prices in a way are also higher. So customers do understand and do manage and where the costs are.
Okay. What is your sense in terms of the executive order from President Trump? Do you think that is going to be beneficial for companies such as yours when it comes to opportunities to reduce cost of production?
I think right now, honestly, I'd say it's a bit too early to say of how it will all shape out because it is a statement of intent, but we have to understand the details behind it.
And the expectations on tariffs?
Again, I think too early to say as to what it will shake out to be.
Okay, all right, fair enough. Is Piramal working on any GLP-1 drug opportunity?
I think that the focus is we'll continue to focus on our peptides and we'll work on what our customers want us to do.
All right, semaglutide is going off patent in many countries. Lots of CDMO players have said that it is an opportunity for them. Where do you stand?
I think at the moment, as I said, I don't think we're working on something right now.
Okay, all right. That's a tight-lipped Piramal Pharma there, but nonetheless, they would be expanding 2 of their facilities in the US markets. That's what they've mentioned should come on stream probably by 2027. The stock is down around 4% at this point in time. Debt figures continue to remain high at around 4,000 odd crores for that particular stock. Well, we'll take a short break and come back with a lot more. Stay tuned.
Welcome back. Flitting between red and green, we have PVR Inox, which has now moved to the high point of trade. It's just a big surge that we're seeing. Are people going back to the movies or not? Something we'll keep an eye out on. The stock has actually done okay-ish this week, up around 6.5%, 7%. But Ixigo is the other one. Latravenues Tech, as we know it, it's reacting to its fourth quarter numbers, and solid set of numbers coming in from Ixigo. If you look at it, the strong fourth quarter performance was led by higher train and bus bookings. Also, flight and hotels bookings growing on a low base, and you had some contribution coming in from the Mahakumbh in the quarter too. So if you look at the reported revenues and the EBITDA of the company, 72% growth in their overall revenue. Margins have come off a bit, but remember the EBITDA has grown 58%, and on a favorable base, the net profit has more than doubled. 128% growth is what we've seen out there. If you look at the key internals as well, gross ticketing value has grown by about 65%, and flight and bus, both of them have seen a gross ticketing growth of 92%. And we're talking about the Kumbh impact, while on an overall basis, it contributed just mid-single digit of the gross transaction value that can be attributed to Kumbh. But if you look at it over the years, during this period, bookings to Prayagraj, where the Kumbh was happening, surged by 20 times for buses, 5.5 times for flights, and 4 times for trains. So it did see a big surge. The other interesting parts, it was a lot of solo travelers and a lot of Gen Z travelers going to the Kumbh this time. Solo travelers made up for more than half of the train bookings to Prayagraj, and 50% plus of all visitors to the Mahakumbh across all modes were all under 30. So that leaves out, a big runway for growth for spiritual tourism in India. That was an interesting insight that we got from there.
Okay, all right, interesting there. But let's keep it with interesting insights. And this is our Insight Edge segment. Manglam, you're focusing on Tilaknagar Industries. Tell us why.
Yes, on the one hand, you have the rise for spirits growing, and the other, you have the rise for spiritual tourism growing as well. So that's interesting. In India, everything happens, right? Tilaknagar Industries, 13% growth in their revenue, 62% jump in their EBITDA, margins growing by almost 600 basis points, and we have the net profit growing by 145 points. Remember, a lot of it has to do with the subsidy as well. Even if you adjust for that, the EBITDA's moved to around 65 crores and the net profit at 64 crores, which is a big booster that we've seen compared to last year. What is it that led to the 20% volume growth? Remember, we had the shift in Andhra take place when it comes to the route to market policies. So the fourth quarter volume growth of 20% was led by a volume growth of 33% in Andhra, which is among the key markets for Tilaknagar Industries. And they said that next year as well, they will continue the volume momentum in high teens, which will also reflect in their revenue growth of high teens. And margins would expand to 15.5% to 17%, despite them spending more on ads on account of premium launches that they're doing. And this is a, by and large, brandy company. Last year, they did 95% of their revenues from brandy. This year, that contribution has come down to 91% because of them moving into whiskey-flavored products, some gin, etc. as well. And now they're believing that by the end of this decade, by 2030, the brandy contribution will go down to 80%, making it a whole fuller portfolio while still being positively skewed towards brandy itself. Let's listen in to what the management of Tilaknagar Industries said to us this morning.
We have bounced back quite strongly in Q4 with the overall volume growth of 20%. Of course, the growth in Andhra Pradesh would be in excess of that. I think that's looking more like 30-35%. And, with the strong momentum build up in Q4, we're carrying this forward into Q1 and this fiscal year as well. I think the volume growth for this year will largely mirror, the Q4 volume growth. I think we expect clearly high teens volume growth for this entire year, and our revenue growth should roughly, track the same percentage. I think going forward, the NSR will, remain largely in the same range. I think while we do get the benefit of premiumization and selling some premium brands, but we did a price correction on our flagship brand in Andhra Pradesh in November. So, that was done in line with, the competitive movement in that category. So that price correction now we'll have the full year effect in this year. So, by and large, the NSR will remain same. And the margin outlook also, will be around 15.5 to 17%. That is the outlook which we expect for this financial year. We have few premium launches which we have already done. We launched Monarch, which was a luxury brandy in September of last year, and we intend to launch a luxury whiskey in the first half of this year. So, the premium brands, the first year, the advertising and marketing is going to be slightly skewed. So, with increased A&SP spends, that will put some downward pressure on the margin as well. The previous year, brandy as a percentage of our portfolio was closer to 95%. So we've made some progress in this year now where brandy is 91%. And, our vision is that, by 2030, which is say, 3-4 years from now, brandy will still continue being the core of our business, but we expect it to be around 80% by 2030.
Okay, all right. Well, let's move on. Muthoot Finance is under pressure despite a good set of earnings in Q4. Their AUM saw good growth and they have maintained their gold loan growth guidance for FY26. Earlier today, we did speak with the MD of the company. Let's listen in.
There are always fluctuations in gold prices. Maybe goes up, goes down. But over the last years, it has always been going up only. But of course, in the last 6 to 7 months, it has gone up too high. Probably it may cool down a bit. But of course, we give only 75% of the current value. And that also is a 30-day moving average. So today, if you look, our gold loans advance which are given, it's only 62% of today's price. If you look at the value of the gold we have with us and today's gold price, it's only 62%. So that is the margin or the headroom we have. So some corrections in the gold loan will not be affecting us. We have been maintaining our spread. NIM should be about 11%. Spread should be in the 9.5%. I think in the last 4 or 5 quarters, our spread has always been 9.15. And we actually maintain it. If the cost of funding goes up, we try to absorb it for 1 quarter or so. Afterwards, it's still going up. We increase our yield, but we maintain our spread. The same thing if the cost of fund. Today, the cost of funds is coming down a little. So it will take for a few months for it to maybe stabilize. If it is really coming down, we will reduce our yield, but maintaining our spread. So if there is an advantage in the borrowing cost, we pass it on to our customer. That is what our NIM and spread, etc., have been almost constant in the last several quarters.
All right, as we speak, there are important flashes coming in from the Prime Minister's office. The Prime Minister has actually chaired a meeting to review the progress and future plans of the fisheries sector that has a positive rub-off on names like Apex Frozen, you have Avanti Feeds, you have Waterbase. All those stocks have seen a bit of a spike as soon as that flash hit the ticker. But we have Wendt, which is a stock which is moving lower today, and that's because it's announced some direction on what was earlier said, the promoter beginning to pare down its stake in the India business via an offer for sale that opens for non-retail investors today and the floor price is a steep discount to what was the earlier price of this stock. So today is down 14%, but the floor price is 6,500 rupees is still a lot lower. Vamakshi joins in with more on that. Vamakshi.
Well, Mangalam, absolutely. Wendt is taking a knock in the trading session today on the back of that OFS announcement that came through from the parent. Keep in mind that the parent itself had announced back in Jan 2025 that they will be looking to sell their 37.5% stake going forward, and it has materialized right now. The base size of the OFS is at 30%. They do have the option to upsize this by almost 7.5% to 37.5%, selling their entire stake in the company. The floor price for this offer has come in at 6,500. This is coming in at a steep discount to the closing price yesterday. It's a discount of almost 38%. The offer size is at 487 odd crores, and it opens for non-retail investors today. It will be open for retail investors tomorrow. But because given the kind of chunk that is coming into the market, as well as the kind of discount that it's coming at, the stock is taking a knock in the trading session today.
Okay, all right, Vamakshi, thanks very much for that. Well, we need to take a short break, but on the other side, Manisha Gupta will join in with her. She has the Chief Operating Officer of Gujarat Ambuja Exports. Stay tuned.
Welcome back, and joining us on the show now is Shreyan Gupta. He's Chief Operating Officer at Gujarat Ambuja Exports. Shreyan, hi, good to have you on the show. We've been talking about ethanol, but more in sense of sugar. But what really seems to have taken precedence and how is the maize? Because when you look at the production numbers there, we're looking at very strong numbers coming in from maize right now. How do you see, first of all, this disruption, and what are those numbers right now?
Hi, good afternoon. So maize has been a very important topic, which is circling around the commodity circle for the last 2 to 3 years, predominantly because of the ethanol sector. The ethanol sector has rapidly grown in the last 4 years, consuming from less than 1 million tons in 2021 to more than 9 million tons this year. The total corn crop in India is somewhere roughly about 30 to 34 million tons, which is at least 15% less than the government estimates of 40 million tons. But the ethanol sector, from the shift towards grain ethanol, which was predominantly a sugar-based industry, had created a crunch last year, which forced a lot of people to face extremely high prices, along with people importing about 700,000 to 800,000 tons of maize from Ukraine and neighboring countries. So maize till FY24 and in the first quarter of FY24-25 has seen a very big pressure. However, currently with the new Rabi crop in place and with a bumper Kharif crop, we don't seem to have a very big pressure on maize this year. The Kharif crop was roughly 23 to 24 million tons, wherein the Rabi crop is expected roughly 11 to 12 million tons, which is about 25% higher than last year's Kharif and Rabi crop So last year the Kharif crop was roughly 18 million tons, and the Rabi crop was roughly 9 million tons. Now the 27 million ton crop with 8 million ton of ethanol demand created such a big panic last year that people didn't know what to do. So they resorted to paying higher prices, importing the raw material. However, in a very short span, due to government initiatives, due to private companies taking up charge to, encourage farmers sowing the corn crop, and subsequently the farmers were also realizing good margins of corn, because if you just look back around the pandemic, the corn price was about 11 to 12 rupees a ton. Today, it is sitting at 23, 24 rupees. And last year, during this time, and in July, August, it went up to 28, 29. Now, when the farmers see such a dramatic shift in the pricing, certainly they will be more motivated to, replace their existing wheat crop, soybeans crop, and to some extent, in some states, even rice crop, and shift to corn crop. So all that has now given us a crop which we feel is sufficient for the Indian demand of maize.
Clearly. Shreyan, we do understand that Gujarat Ambuja as well, when it comes to maize processing, seems to be increasing capacity. Absolutely. What are the kind of investments you're putting in? Where do you stand right now, and what are the targets?
So Gujarat Ambuja exports currently consumes about 4% of India's maize, which is roughly 1.3 million tons. Our current processing capacity into the maize starch and maize derivatives business is roughly 4,000 tons per day. We just inaugurated a new plant in our Sitarganj unit, which was about 1,200 tons per day, ramping up our existing 4,000 tons per day capacity to 5,200 tons per day capacity. Our investments in the maize division have been quite consecutive since 2010, wherein we set up our unit in Karnataka. So looking forward, we feel that the maize crop and our capacity should align with the India's demand. We are further diversifying into a fermentation sector, wherein fermented products, which are huge amount of import substitutes made from maize, we're going to try and make it in India, which is going to be another vertical of ours. It is all going to be derivatives of starch as well as maize. So we feel the maize sector still has a lot of potential. The starch industry from about with a capacity of 2 million tons in 2010 today stands at 7 million tons, which is also going at an increasing pace. However, last year, due to some challenges, there was some dent in the consumption demand due to high prices of the finished products, high prices of the raw materials, difficult for smaller industries to sustain. However, we feel that that was a short duration of time, and things will materialize, fall in place, the demand will adjust, everything will adjust in the coming quarters, because the farmers have really supported us this time. Because a Kharif crop of 23 million ton and a Rabi crop of 12 million ton is something which is way beyond our expectation. So the industry is quite happy in terms of the maize availability. Even the ethanol industry is quite happy, because now they also have a substitute of FCI rice, which the government is committed to supply about 4.8 million tons of FCI rice to the ethanol sector for ethanol making. So the ethanol sector is happy because they have a substitute crop. The poultry sector is getting maize at reasonable prices. The starch industry is also getting good availability of maize.
Well, this year, the kind of numbers that you're giving us, Shreyan, it does look quite positive. Last year was a bit of a scare, but as you've told us, that the prices from 28, 29 have come down to 24. But I can tell you this, Mangalam, that corn clearly has been a hero when it comes to ethanol. Not so much sugar, but rice is picking up, and maize absolutely killing it there.
Yes. I take that point. Thank you so much for taking us through with that conversation, Manisha. As we do that, let's look at the bottom of your screen. Interesting source-based information coming in from our colleagues. Yash says that NSE has 1 lakh shareholders. So it's become the largest unlisted or widely held unlisted company. Everyone's awaiting the NSE IPO. That flash at the bottom of your screen. The NSE has 1 lakh shareholders now, and it's an unlisted company. Take a short break, come back. On the other side, we have Business Lunch taking all the market action ahead.
Stocks swing between losses and gains on mixed global cues and rapid evolving geopolitical situation. Metals and industrials gain, while utilities and IT drag. Mid-caps were better. Eicher Motor revs up growth with strong sales and market share gains, even as it comprises on a little in terms of margins. While some analysts fret over valuations, others bet on gains from premiumization. Muthoot Finance slides despite a strong performance as concerns over the impact of draft RBI norms on gold loans and volatility in gold prices weigh on the stock. The management hints at a growth well above its guidance. Gold slides sharply to below $3,150 per ounce as trade tensions ebb and US expands ties with Middle East, also lifting sanctions on Syria. A weak inflation print also aids the fall. Silver too slips. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, and thank you so much for tuning in as always. In terms of the market, obviously we have the expiry today. We're seeing a bit of a volatility coming in, and that is why we're seeing the market swing between the red and the green, just flip-flopping on that side as well. As of now, Nifty 24,700, about that mark is what the Nifty is managing to hold on to. 0.2% is what gain we're seeing coming in for the Nifty. Nifty Bank, a recovery is coming for the Nifty Bank as well, right? From the day's lowest point, we're seeing overall a recovery coming in for the market. Nifty Bank 54,799, 54,800, around that mark. Mid and small cap, the outperformance is continuing on at that front. Yes, off the day's highest point is what the mid cap is trading at. But yesterday also we had seen the outperformance for the mid and small cap. Today also is what we're seeing in terms of our outperformance that is coming in for the mid and small cap. Now let's pull up the IT and the pharma pack today. That's under pressure today. Both these company sectors are down and out in trade. Though recovery coming in for the Nifty IT, As of now, from the day's lowest point, we're seeing a good amount of recovery, down 0.1%. Pharma, 0.3% of decline is what we're seeing. Earning gainers, a lot of them in terms of stocks are moving on the back of earnings. So we have Power Industries, Concall highlights of very strong, very positive highlight, and that is why the stock is buzzing in trade today. Kirloskar Oil Engines also buzzing on the back of earnings. Eclux also among the gainers on a good set of numbers coming in Q4 FY25. On the flip side, we have Muthoot Finance, Hitachi Energy, Sigility, Piramal Pharma. All these names are down and out because of a weak set of numbers that was reported by the company. So yes, that's how the roundup is looking like in terms of the market. But let's get started with the big story for today, and a big statement coming from US President Donald Trump, who has told Apple CEO Tim Cook that he didn't want him to build in India. Listen in to what he had to say.
We have Apple, as you know, it's coming in. And I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I've treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India, because India is the highest, one of the highest tariff nations in the world. It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff. So we go from the highest tariff, you couldn't do business in India. We're not even a top 30 in India because the tariff is so high, to a point where they have actually told us, I assume you too, Scott, you were working on that also, that there will be no tariff, right? Would you say that's a difference? They're the highest, and now they're saying no tariff. But I said to Tim, Tim, look, we've treated you really good. We put up with all the plants that you built in China for years. Now you got to build us. We're not interested in you building in India. India can take care of themselves. They're doing very well.
And moving on, as we discuss the market, let's focus on views of the country's market outlook. India right now is the most exciting place to be in. These are not my words, but coming in from the emerging market veteran, Mark Mobius. Listen in to some excerpts from his conversation and interview with CNBC.
China is not the only game in town. We're now seeing all these other countries entering the export market and being able to compete. So it's really very exciting to see what's happening around the world. And probably the most exciting place now is India, because India is going to be taking the place of China in many, many areas. And we've already seen companies like Apple and others come to India to manufacture and export. So India, Vietnam, Taiwan, Turkey, those are the ones that are looking very interesting for us at this stage. But as you pointed out, there are many other markets around the world that are doing better than the US. The big problem with India is bureaucracy. As you know, they inherited this incredible bureaucracy from the British, and the party that took over, the Congress party took over, perpetuated that bureaucracy. But Modi, the new prime minister, has done a tremendous job in cutting through a lot of the bureaucracy, but still there's a lot to be done. And he's digitizing the entire economy. First of all, by getting digitized identity cards for everybody, so money can be transferred directly to bank accounts, even to the poorest people in the country. But this takes time. I call it the United States of India, because you have all these states, many of them with different languages, both written and spoken languages. So to unify this country is quite a job, but still the opportunities are there because you have a lot of very smart people. And as you say, it's the most populous country in the world now. We figure about 1.2 billion people compared to, I would say, now India's bigger than China. China maybe 800 to 900 million.
And let's move on now and get more stock specific, right? We had Eicher Motors that reported their numbers. It was a largely inline set of numbers that came in Q4 FY25. But what is the key highlights coming in from this, the fine print for this? We have Sudarshan joining in with us to take us through all of that. Afternoon, Sudarshan. As of now, the stock is down 0.2%. What were the numbers like? If it's in line, why the stock is down?
The stock is trading with minor cuts, and if you talk about the performance has been playing as per its playbook, company's playbook. Company has been saying that its focus is on growth over margin. Also in Q4, if you would have seen that both profit and revenue have seen a healthy growth. Also for the upper side of the segment in two-wheeler, premiumization trend has continued, and for that, Eicher Motors is the biggest beneficiary. Also, heightened competition that we had seen last year is behind, and company continues to gain market share. As far as earnings are concerned, profit was up 27%, revenue has increased 23%, and both were higher than expectations. But margin has come below expectations for third straight quarter. Also, if you talk about the valuations, it's one of the companies in two-wheeler space for which valuations are very rich. And EBITDA has slipped 11%, margin was down 250 basis points. But if you talk about the market share in the segment, up more than 250 cc, it has gained market share of 100 basis points sequentially, and it has gained 40 basis points if you compare YOY. What about the outlook? Company is saying that it will outperform the industry and will continue to see a healthy growth. Also, one positive thing that company has talked about, that while the rural growth has been healthy, for urban area, it's saying that positive sentiment has been returning.
Okay, Sudarshan, thank you so much for that and giving us those highlights, what came in from the con call as well. But let's move on to the next stock for today. We have Tata Power, that's in focus on the back of its earnings as well. They posted a good Q4 number this time. Healthy improvements in terms of margins, increase in profitability. And earlier today, we spoke to Praveer Sinha, Managing Director and the CEO at Tata Power. Listen into his comments coming in on the quarter gone by.
We had planned a capex of 20,000 in FY25. We could complete nearly 16,200 crores during the year. Some of our projects got delayed, especially because the evacuation lines for renewable projects, they got a little deferred, which of course will happen in the Q1 of FY26. Similarly, some of the projects of our transmission lines, which we are executing, there were issues about right-of-way, which now have been sorted out and will get completed in this quarter and next quarter. So I think it's just a question of timing, and we are very much on track to complete all these projects. So Odisha has been a great experiment for us, and the type of service improvement, whether it is in terms of reliability, customer service, all that has improved tremendously. And many of the legacy issues which were there in terms of billing collection, we have been able to sort that out. On UP, I think the government over there is very keen to pursue this opportunity of privatization, and the PPP model, as has been done in Odisha on similar lines, we expect the bidding process to happen. From what I understand, they have already appointed a consultant, and the bid documents are expected in this month end. And possibly in this calendar year itself, the bid will get finalized.
And now shifting focus to Lupin, because that also reported its numbers, a steady set of numbers that came in from this company. We spoke to the management on expectation from the US business in the coming quarters and the impact of President Trump's executive order. Listen to what their view was.
For us, given the price erosion on the older products, but continued ramp up of products like Spiriva and others, we also have Rivaroxaban as well as Predfort that continue to be strong contributors in terms of new product launches, apart from our existing portfolio. And the Tolvaptan now in the market, as well as injectables launching second half of the year, we believe that $250 million per quarter should be the new base. No, I think it's very early to really interpret the impact of the recent order on the brand products, the MFN plus that the order entailed. I mean, it's the pharma is still trying to interpret it and believes that there is it's not clear what the implications will be. For us, I mean, of course, the pricing of brand drugs impacts the pricing of generics overall, so we watch it very carefully. We are looking out for what will likely come down the road on tariffs, which can have a material impact, and have provided our comments as part of the Commerce Department 232 investigations.
Okay, on that note, we're going to slip into a very short break. And after the break, when we return, we'll get you more updates on Operation Sindoor and India-Pakistan tensions. Welcome back to Business Lunch on CNBC-TV18. A quick look at what the market is doing because we've seen a bit of a spike up coming in the last 10 minutes. Since we started the show to now, we're seeing a spike up. Look at it. As of now, Nifty is trading at the day's highest point, 24,867. So almost a more than 100-point jump up that we've seen in the last 15 minutes. 0.8% of gain is what we're seeing coming in for the Nifty 50. So keep an eye out on that in terms of the market and where it's going to be headed in the second half of the trading session. But the Defence Minister, Rajnath Singh, arrived in Jammu and Kashmir's Srinagar today and this morning in a first visit to the valley after India's Operation Sindoor. He was accompanied by Jammu and Kashmir's Lieutenant Governor Manoj Sinha, and during the visit, Defence Minister reviewed the overall security scenario and the combat readiness of the Indian Armed Forces and inspected Pakistani shells that were dropped in the border areas. Calling Operation Sindoor a big commitment, the Defence Minister said that this was the biggest operation against terror. He also added that Pakistan's nuclear arsenals should be kept under IAEA monitoring. Listen in to what more he had to say.
आज आतंकवाद के खिलाफ भारत की प्रतिज्ञा कितनी कठोर है, इसका पता इसी बात से चलता है कि हमने उनके न्यूक्लियर ब्लैकमेल की भी परवाह नहीं की है। पूरी दुनिया ने देखा है कि कैसे गैर जिम्मेदाराना तरीके से पाकिस्तान द्वारा भारत को अनेक बार एटमी धमकियां दी गई हैं। आज श्रीनगर की धरती से मैं पूरी दुनिया के सामने यह सवाल उठाना चाहता हूं कि क्या ऐसे गैर जिम्मेदार और रोग नेशन के हाथों में परमाणु हथियार सुरक्षित हैं? मैं दुनिया के सामने यह सवाल खड़ा करना चाहता हूं। मैं मानता हूं कि पाकिस्तान के एटमी हथियारों को IAEA इंटरनेशनल एटॉमिक एनर्जी एजेंसी की निगरानी में लिया जाना चाहिए। मैं ये कहना चाहूंगा और साफ तौर पर कहना चाहूंगा।
Okay, and a quick look at what Vodafone Idea is doing. That is in focus as company has filed a fresh plea at the Supreme Court seeking 30,000 crores for waiver. The company is seeking a relief on AGR dues. The company says that the government is handicapped in granting relief due to the AGR judgment that was there, and government is now a partner with 49% stake that has converted into AGR spectrum dues into equity. So company is seeking urgent hearing on May 19th. That is what we'll be watching out for. Vodafone Idea is up 3% right now. Keep an eye out on it. The company is seeking waiver of over 30,000 crores on account of penalties as well as interest. But let's move on then. And the government has now confirmed that Indian Air Forces bypassed the jammed Pakistan's air defense system during Operation Sindoor. The centre also said that all strikes were executed without any loss of Indian asset. Parikshit, take us through how India thwarted Pakistan's attempt to attack us. Take us through all of that.
This is extremely important. This goes to show the amount of planning that had gone into the technological warfare that India was about to indulge in to eliminate those terror caps in Pakistan as part of Operation Sindoor. So all of this happened on 6th night and 7th morning, and sources tell us that meticulous planning was done to bypass and jam Pakistan's Chinese-supplied air defense systems, and India was successful in doing so. The entire mission was completed in 23 minutes, and this shows the strength of Indian technology, Indian defense shields, and indigenous manufacturing as well. Post-Operation Sindoor, we have seized, and this is evidence in the hands of Indian forces, Chinese PL-15 missiles which are used against India, Turkish Yaya drones. These are armed drones which are also used against the Indian forces and Indian civilian areas. India's loitering munitions, we're told, carried out offensive strikes on Pakistan's Noor Khan and Rahim Yar airbase. All strikes were executed without loss of Indian assets. Now, this is important because it has been said that there was significant damage caused to Indian air bases. None of that has happened. The government again and again saying that we did not lose our assets in this entire operation, be it our air defense systems, be it our air bases. So none of that has been damaged. Indian forces were able to complete the mission successfully. We were able to carry out extensive attacks on Pakistani air bases on the 9th and 10th. At the same time, there was 10 satellites working round the clock to ensure safety and security of citizens and also support our armed forces.
Thank you so much for that. Meanwhile, the products from Turkey have been caught in the crosshairs of India-Pakistan tensions. Boycott Turkey is trending on Indian social media. Last evening, the traders industry body CAIT said that it would push for the suspension of trade with both nations at the National Conference on the 16th of May. Shivani Bajaj is joining in with us and here to tell us more in terms of what triggered the backlash as well as the stakes that are involved here.
Well, yes, a growing online movement is gaining serious traction. Boycott Turkey is trending across Indian social media, with users calling for a complete economic and tourism boycott of Turkish products and services. But what triggered the sharp backlash? It began with the wave of anger on social media after Turkey publicly condemned India's military strikes on terror camps in Pakistan and POK. On May 7th, the Turkish foreign minister issued a strong statement warning that India's action raises the risk of an all-out war. But the backlash escalated further when forensic analysis of drones shot down by Indian forces revealed a disturbing detail. The drones were of Turkish origin, allegedly used in attacks launched from Pakistani territory. Soon after, Indian users began circulating lists of Turkish brands from appliances and food to fashion and travel, urging fellow consumers to stop supporting Turkish-linked businesses. Posts that read, "India helped Turkey in its darkest hour, Turkey helped Pakistan in ours," quickly went viral. The anger wasn't limited to social media. The travel industry took swift action. Ease My Trip issued an advisory urging tourists to avoid non-essential travel to Turkey. Cox & King and Ixigo followed by suspending new bookings to the country, citing rising geopolitical tensions. Now let's take a look at the stakes involved. Bilateral trade between India and Pakistan stood at $13.8 billion in 2022-23 and $10.43 billion last year, with Indian exports leading the numbers. Turkey also has received over $227 million in FDI from India till March 2024, and Indian companies have invested nearly $200 million there. But the biggest hit could come from tourism. In 2024 alone, more than 2.75 lakh Indian tourists visited Turkey, contributing nearly 3,000 crore rupees to its economy. With growing calls to disengage, this flow could now slow down dramatically. With over 3,000 crore rupees in tourism revenue from Indian travelers and $10.4 billion in annual bilateral trade, Turkey has a lot riding on its ties with India. If the boycott Turkey sentiment translates into real action, fewer bookings, falling demand for Turkish products, or paused investment decisions, the economic hit could be hard and visible. Back to you.
Thank you so much for that, Shivani. But shifting focus to other geopolitical developments, as US President Donald Trump continues his tour in West Asia, we have Dia joining in with us to get us some updates on the deals that he's signed so far. Dia.
Power deals, political signals, and a pause in global trade war. It's been a high-stakes day in international affairs. The U.S. is deepening economic ties in West Asia, eyeing diplomacy with Iran and cooling tensions with China, all in a matter of hours. We begin in Doha, where the numbers are making headlines. The White House announced that President Donald Trump has secured deals totaling more than $243.5 billion with Qatar, laying the groundwork for a bigger $1.2 trillion economic pledge with the tiny Gulf country. The president also said Qatar Airways had placed a record order for 210 planes from Boeing as he signed a raft of deals in Doha alongside Qatar's Emir. The order, Boeing's largest ever for its wide-body jets, deepens ties between the U.S. aerospace giant and the joint carrier. The announcements came on the second leg of Trump's swing through West Asia, a day after the president touted some $600 billion investment by Saudi Arabia in U.S. manufacturing, products and services. Donald Trump also voiced hope on Wednesday that diplomatic efforts would succeed on Iran's nuclear program, even as he vowed rigorous enforcement of sanctions. Trump, on his first visit to West Asia since returning to the White House, said he spoke about Iran with the leader of Qatar, which maintains relations with both longtime adversaries. That's all for today. Now back to you.
Thank you so much for that, Dia. And as the president continues his tour of the Gulf nations, Reliance Industries chairman and managing director Mukesh Ambani went to Qatar to meet with him. Mukesh Ambani also met with the Emir of Qatar, and this is Reliance chairman's second meeting since Trump's return to presidency in January this year. Okay, on that note, we're going to actually take a break and we get you more news and updates on the other side, so don't go anywhere. Welcome back to Business Lunch on CNBC-TV18. Now, tensions erupt in Gaza as Israeli airstrikes targeted various locations, resulting in significant casualties. Take a look at this report.
Israeli military strikes killed dozens of Palestinians across the Gaza Strip on Wednesday. That's according to local health authorities. It's a significant intensification of the bombardment in Gaza, while US President Donald Trump continued his visit to the Middle East. Medics said most of those dead were killed in Israeli airstrikes targeting houses in Jabalia, an area in northern Gaza. The Israeli military had no immediate comment and said it was trying to verify the reports. Hadi Mokbel, whose relatives were killed in the strikes, said the military fired 2 rockets, killing children, a woman and a baby. Itimad al-Najjar was also in the area when the strikes hit.
We were sleeping peacefully when the oppressors hit them. They hit them and hit the whole region we're in. 14 martyrs inside the house. People are still under the rubble. Have mercy on us. Enough blood, enough martyrs, enough worries. Stop the war on us. Stop the blood.
She added that, quote, nobody is left in Gaza anymore. In strikes the day before, security officials said they believed Hamas military leader Mohammed Sinwar had been killed. That's according to Israeli press reports. Israel's intensified bombardment comes amid Palestinian hopes that Trump's visit to the region will provide pressure for a reduction of violence. And Hamas on Monday released Eden Alexander, the last known living American hostage. Trump's envoys have said they now see a better chance for a new release deal for the remaining hostages. The US has also presented a plan to reopen humanitarian aid deliveries in Gaza using private contractors. Israel has blockaded all supplies going into Gaza since March the 2nd.
More geopolitical news. Russian President Vladimir Putin has decided to skip the peace talks in Turkey, instead sending a junior-level delegation. CNBC's Sylvia Amaro has more updates on this front.
Russian President Vladimir Putin will not attend peace talks in Istanbul today, instead sending a delegation on his behalf. The Ukrainian President Volodymyr Zelensky had said that he will not attend if Putin refused. After the Kremlin's announcement, US President Donald Trump said he will not be joining the talks, just days after hinting that he might. The EU has agreed to a fresh slate of sanctions against Russia, its 17th package since the war against Ukraine began. The agreement targets chemicals used to make weapons, more Shadow Fleet ships, and bans companies from doing business with Russia via third parties, while also targeting individuals with visa bans and asset freezes. The German Chancellor Friedrich Merz has urged the West to be united on Ukraine ahead of peace talks later today. In his first major speech to Parliament since taking office, Merz said he's working hard to ensure the US and Europe do not accept a dictated peace and do not submit to Russia's status quo. He also vowed to make Germany's army the strongest in Europe. This as NATO foreign affairs ministers are set to meet in the Turkish city of Antalya today for an informal gathering. Ukraine's foreign minister has already met with the U.S. Secretary of State, Marco Rubio, to, quote, coordinate positions during this critical week.
Thanks so much for that. But with that, we're absolutely out of time on this edition of Business Lunch, leaving the Nifty at 22,892 levels at the day's highest point. Up next, your Midcap Radar to take you through all the market action.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Vamakshi Doria and with me is Vivek Iyer. Vivek, very good afternoon to you. The markets have made a roaring comeback in the last few minutes of trade. The Nifty as of now has recovered almost 400 points from the day's lowest point.
That's right. Good afternoon. Just around 40 points away from 25,000 as far as the Nifty is concerned. Broader end of the market is very strong. Last hour has seen a significant surge. We have quite a lot lined up on the show, quite a few managements as well. Let's start off with the top headlines. Markets at the day's highest points as Nifty and Sensex recover from morning lows. Mid-caps hold steady.
Defense stocks continue to surge post-Operation Sindoor. Nifty Defense Index is up almost 15.5% in the last 12 sessions. Stocks like Cochin Shipyard, Garden Reach Shipbuilders and Hindustan Aeronautics surge between 2 to 5%.
Wendt tags nearly 15% in trade after its parent company announces an offer for sale to divest up to 37.5% in the company with a floor price of 6,500 rupees a share.
Tilaknagar Industries zooms over 10% following its Q4 results. The company reports good revenue growth led by 20% volume growth. The management tells CNBC-TV18 that the company will see high teens revenue growth in FY26.
E-Clerks rallies nearly 9% on the back of a strong fourth quarter that beat analyst estimates. Rupee revenue rises 5.18% on a sequential basis. Contract value of new deals is at an all-time high of $51.2 million.
24,960, that is where the Nifty is at. The markets have made a roaring comeback. The benchmark indices so far were underperforming the gains on the broader indices, but it is in fact the benchmark indices which are now gaining and leading the charge in today's trading session. Most of the sectoral indices have now turned into the positive. The gains are being led by the Nifty Media. Z Entertainment is up almost 3%. Saregama, Hathway, all of these counters are seeing good gains. Auto as well as realty stocks are also surging higher in trade today. But there's a lot of vibrant action happening in the mid-cap space, and in a special segment, Mid-Cap Movers, we now have Hormas to take us through the mid-caps that are moving around in trade. Good afternoon, Hormas.
Good afternoon, Vamakshi, and a slew of results that have been trickling in over the last 15 to 20 minutes. But there are a lot of other movers as well within the broader markets, and the topsy-turvy move that you have seen on the benchmark indices. Look at the moves here. Triveni Engineering at one point was up almost 7 to 8%, has given up most of its gains now. Ramakrishna Forgings, though, is at the highest point of the day, as is Netweb Technologies. KEC International, it won an order yesterday, is reacting to that today, 7.5% higher in today's trading session. This spoke of earnings, the numbers of CESC flashing at the bottom of your screen, but there are a lot of other result reactions as well. Look at Kirloskar Oil, 14% higher now. Muthoot Finance, on the other hand, is at the day's low, as is Hitachi Energy and as is Piramal Pharma, losses of anywhere between 4.5% to 7.5% now for Muthoot Finance. Some of the other stocks that have been doing well, and of course it is the defense names. Look at Cochin Shipyard reporting results today, 6% higher, another 5% circuit for Zen Technologies. Expectations are high for Masgao Dock as well, up 3% in today's session as well. Stocks that are doing well on the volumes front, look at eClerx, that's another result reaction. At one point was up almost in double digits, still holding on to gains of around 9%. Linde India and Sri Renuka Sugars have given up some of the gains, still holding on very strong volumes. And lastly, some of the other newsmakers in today's session. Persistent Systems, of course, on concerns of over a large client in the US facing issues. Kalpataru on the order win. Brigade Enterprises and earnings reaction, and of course some property-related developments as well. Some of the stocks having mixed reactions today with regards to news flow. Back to you guys.
Thank you so much, Harmaz, for joining us and taking us through the list of stocks that are making all the moves as far as the broader end of the markets are concerned. Well, we'll quickly look at the results of CESC, as you can see flashing on the bottom of your screen. It's been a steady quarter. PAT appears to be impacted by a couple of one-off items. We'll delve into that. But we'll now slip into a short break. On the other side, Pavitra Shankar, Managing Director of Brigade Enterprises, joins us to discuss their Q4 performance. Welcome back to Midcap Radar. Well, Brigade Enterprises recently reported their Q4 numbers. The company saw their pre-sales and collections surge on a year-on-year basis. To discuss this and more, Pavitra Shankar, Managing Director, Brigade Enterprises, joins us now. Thank you so much, Pavitra, for joining us. It's a pleasure to have you on the show. First up, as far as FY25 was concerned, we understand that it was marked to a certain extent on account of various delays when it came to regulatory approvals coming in for project developments. First up, have most of these issues been resolved? How did it impact project launches and development in FY25? And secondly, please update us on the timeline, likely size of the upcoming hospitality IPO as well.
Yes, so thank you for having me. I actually think we had a pretty good year. Despite the delays and approvals that we did see impacting our portfolio, especially in Bangalore. That said, we were still able to pull off very good numbers. Basically, the approvals delayed some of our launches from happening within the financial year. Some got pushed beyond the financial year of FY25, but we will see those start coming into our pipeline in the upcoming 4 quarters. So last year, we had actually intended to launch about 12 to 13 million square feet of residential space. We were still able to launch almost 10 million square feet of residential. And in that, we were able to sell almost half of whatever we did launch that reflected in our last year's pre-sales as well. So overall, we were still able to do about 7 million square feet of sales, which value was around 7,800 crores of pre-sales value. So yes, there was some delay in the launches. There is still some amount of delay when it comes to approvals, but we are working through them and able to bring our projects to the market for launch. And when that happens, we're still seeing very good demand from customers across the board, whether it is mid-segment, upper mid-segment, and since we have also launched multiple premium and super luxury projects in our portfolio, we're seeing very good demand for that as well.
Sure. Pavitra, hi, this is Vamakshi joining in. If I understand this correct, like your pre-sales stood at 7,850 odd crores. This has far exceeded the guidance that you had started off with earlier. So what is the outlook that you're looking at for FY26 on the pre-sales as well as the launches?
So yes, last year the number was 31% increase on the previous financial year. Typically, we don't give guidance, but we generally say we like to show at least a 15% growth year over year. And I think this is something that is a good number, especially as the base keeps increasing, and we'll aim to do something similar year over year. Of course, as we go into different markets, say Hyderabad and Chennai, where a substantial amount of our upcoming launches and pipeline will be there in those two markets, in addition to Bangalore and Mysore, we will see that number keep changing depending on the mix of the kind of product that we have as well. So it's not just in terms of area, but also in terms of value that we're looking to see the numbers grow.
Pavitra, just a follow-up, what is the update as far as the Hospitality Ventures IPO is concerned? We understand you have the approval on board now. Can we expect it to launch in FY26? And how does it alter your debt picture?
So I will have to actually maintain that since we received the approval for the DRHP back in October, we're still under publicity restrictions, and we're not able to speak too much about it.
And, just coming back to the business then, what is the expectation for further land acquisitions, especially in the southern markets? How much land is there available, for this? And what would be your, strategy, especially in the southern markets beyond Bangalore?
Bangalore has been our home turf, but in the last couple of years, we have launched projects both in Chennai and Hyderabad, which is testament to the increasing levels of business development we've been doing in both those markets. As recently as yesterday, we closed a transaction in Chennai for a very prime parcel, about almost 5.5 acres in a very good locality in Chennai, and that should give us around 2,000 crores of gross development value for a residential project. So I'm happy to say that in Chennai, our position is very firm as one of the leading developers in the residential space. We also have commercial and hospitality spaces in Chennai. Hyderabad, we launched a project called Brigade Gateway in Neopolis. It is a mixed-use project, and we have already sold 1 million square feet of that. It was extremely successful in terms of the way it was absorbed by the market there, and continue to have another 1.5 million square feet for launch in Chennai in the coming in Hyderabad in the coming pipeline. So going forward, we hope to see greater contribution from both Chennai and Hyderabad, maybe 20 to 30%, depending on how much we can launch and sell in the next 4 quarters to be coming from those two markets. Of course, we still expect to have a strong showing from Bangalore. We also have a few smaller projects coming up in Mysore. But again, our focus is on southern cities, and we aim to continue to do that.
Pavitra, you just alluded to Chennai plans. Yesterday, you went ahead and signed that project. Could you reiterate the GDV or the potential over there? And also, have you bought this particular property from the Rane Group? Because we understand that is where they had significant land as well.
No, this is not from the Rane Group. It is 0.8 million square feet is what we have planned to build there. And I think I got the number wrong. It's actually 1,600 crores in terms of GDV. I mentioned 2,000, but it's 1,600 crores.
Understood that. So going into FY26, you have a pretty strong launch pipeline. Could you break up, the launch pipeline for us for Q1 and Q2? What is it that the street can anticipate? And also give us a sense of how demand trends are panning out. We did see a lot of registration-related delays, but has demand remained steady, especially as far as, demand from IT is concerned?
Yeah, so for the next 4 quarters, we track it on a rolling 4 quarters basis. Our total pipeline for launch is around 16 million square feet. Around 12 to 13 of that would come from the residential sector and the rest from our lease portfolio in that order. In terms of quarterly breakup, it's a little difficult to say. While we are planning internally, it's so heavily dependent on approvals, which is why we look out on a 4-quarter basis. But going forward, I think the next few launches will come from Chennai and Bangalore, and towards the end of maybe the first half of the year, probably also Hyderabad. So it's and Mysore as well. So actually, we're fortunate. We're in a position where all 4 of the cities where we have a very strong presence will continue to see these launches. In terms of demand, we've seen an amazing run-up in terms of demand and pricing, especially in Bangalore and Hyderabad, and supported by Chennai over the last 2 to 3 years. That's also been the reason why we've pushed into more of premium housing in certain projects in these markets, while overall we look at mid-segment to upper mid-segment in residential as a whole. That said, the demand for premium housing is very good, but I don't see pricing continuing to increase at the rates that we've seen over the last couple of years. Also, in our portfolio, especially in what we would call the mid-segment, where the ticket size has increased dramatically from what used to be 1.5 crores was seen as a very good mid-segment ticket size. We've seen that number cross 2 crores. The time taken by customers to make those kind of decisions is definitely taking a little bit longer, but that does not concern us, or that does not sort of give us cause for concern, because we still feel that they are coming to the table. They're very strong, pickup in terms of leads. There are a lot of walk-ins coming into the site across the board. So we're still seeing people interested. They do take a little longer to convert because naturally the ticket size is more than what we've seen. In terms of your question on IT, despite whatever people are talking about, whether it is in terms of the impact of AI or in terms of the hiring of IT services companies, we've seen still our typical customer is from a tech background. I would say it's shifting more towards people who work in GCCs. There's a lot of embedded technology and digital transformation work that's happening across almost every company. And we're seeing a lot of those kind of profiles. So maybe 10 years ago, a lot of the demand was your traditional IT services firms, but now we're seeing that shift to, homegrown companies, GCCs, and so on. So it also means that the customer is a little more, able to afford some more highly priced product as well. So these are the trends that we see.
Right. Thank you so much for that, Pavitra. Thank you so much for joining in with us after your Q4 numbers. Wish you luck for the quarters ahead. That was the management of Berger Enterprises. They're saying they expect 15% year-on-year growth in their pre-sales, and they still see very strong demand across the mid, upper, and premium, as well as the super luxury segment. But just before we take a short break, pull up the chart for Prism Johnson. The company just reported its numbers as we were in conversation with Berger Enterprises. When we look at the numbers, the EBITDA margin has surged to 8.9%. Right after the numbers were reported, the stock has seen a very sharp surge. But time for a short break. Management of Transport Corporation of India joins us on the other side to discuss their numbers as well.
Well, when we started the show, first up, welcome back to Midcap Radar. When we started the show, we were around 50 points of drift as far as Mount 25,000 was concerned. In just the last 19 minutes of the session, we've seen almost a 100-point rally, and the markets have now well above the 25,000 mark. What has led the markets higher? Well, it's largely led by the heavyweights. Have a look at a name like Reliance Industries. That particular stock now at the day's highest points. Some of the banking heavyweights, names like HDFC Bank, ICICI Bank. Have a look at Larsen and Toubro. That particular stock surging to the day's highest point. And it's actually a broad-based rally. Have a look at the Nifty Bank Index as well. Now up about 1%. The mid-cap and small-cap index, they were actually outperforming. But given the sharp surge that we've seen in the Nifty as well as the Bank Nifty, both of them still in the green, still around 0.5% higher, but doing quite well. It's an absolute rocket as far as the Nifty is concerned, especially the last half hour or the last 20 minutes of the session especially.
Well, absolutely, Vivek. In fact, we managed to hit the 25,000 mark, and this is important. For the first time after October 17, 2024. That is why it's so important. But from one management to another, Transport Corporation of India is on our radar now. For Q4, the company has seen margin expansion driven largely by their seaways business. But there is some slowdown in the revenue growth. To talk more on the Q4 performance, we now have Vineet Agarwal, who's the MD of Transport Corporation of India, joining us now. Good afternoon to you, Vineet. Let me first start off by asking you about your revenue as well as profit growth guidance. Now, you say that you're expecting 10 to 12% revenue and profit growth in FY26. My question to you is, why have you lowered the upper end of the guidance? Because typically, you tend to give a revenue growth guidance of anywhere between 10 to 15%.
Yes, well, thank you for having me. The first quarter of the year is usually a little bit more suppressed compared to the full year, compared to quarter four. And the guidance is slightly softer because, the conflict that has happened recently, India-Pakistan, has actually disrupted supply chains to some extent. We've seen that some of the factories and warehouses were shut in the northern part of the country. Some labor shifted also to the eastern part. Supply chains have been also hampered. So like we run warehouses for a few companies and we had to invoke the business continuity processes there, as well as dealers are not taking enough inventory for cars, etc. Business delegations have also slowed down and there is a certain amount of risk factor that has come in. I think this will impact business for the next few weeks, months. And this means that the quarter might get a little softer going forward. However, the festival season looks attractive and I think perhaps how things progress with the first 6 months, we can probably look at a revision. But a 10 to 12% seems to be more on the ideal number this time.
Okay, so we need 10 to 12% on a conservative side, given the kind of geopolitical tensions that we're seeing. Well, that is as far as the top line is concerned. What are the sustainable EBITDA margins? We're talking about the consolidated EBITDA margins. You've earlier given a target to be in the range of 10 to 11%. You've ended the FY25 closer a little lower than the 10.5% mark. FY26, first couple of quarters, post-disruption, where do you expect that to be? And H2, do you see a recovery?
Yes, I think the margin side things are a lot more visible, I guess, to some extent, because the shipping business has done well. Our other logistics businesses, the supply chain business is doing well. Our joint ventures are doing well. So in that context, the margin structure remains stable. There could be some pressure, as always, with the economic situation and some amount of economies of scale not coming in because of the increase in revenues. But notwithstanding, we think this guidance of 10 to 12% on the bottom line also remains. See, I think what has happened is that several factors that used to be earlier impact in terms of our profitability are reducing quite a lot. For example, fuel prices. Now, fuel prices have been benign for the last several months and now, in fact, years. So that has gone away to a great extent. On the road side, toll taxes have gone up quite a lot in the last 2 years. So that impacts a certain amount of cost structures. But general inflation, general cost of people, and other such factors definitely keep up the cost pressures.
Sure. And what is your outlook on the seaway freight rates? And what would be the impact of higher freight rates on your business?
Currently, the freight rates are also quite high. We are not really impacted by international freight rates. So we are a domestic company. We operate on the west coast and the east coast of India, really connecting nation through multimodal network. What happens is that when international freight rates are high, as it has been in the last few months, some capacity shifts from the domestic sector to the international sector, which creates a supply constraint locally, and hence prices go up. Going forward, I do not expect that if the geopolitical tensions reduce, then freight rates will also come down globally, and hence over here in domestic sector also freight rates might stabilize a little bit more. So our estimation for the full year is that the freight rate should be almost stable on the seaways side.
Understood that. But so Seaways, you're expecting it to be stable, so we can expect stable margins as well over there, we understand. Also talking about the cold chain segment, how did that particular business perform as per your own internal estimates for FY25? What is the target over there for FY26?
The cold chain business is actually very attractive right now. We've grown moderately, about 50 to 20% in the last fiscal, but we've added a lot of capacity when it comes to new trucks into cold storage facilities. We're building a state-of-the-art facility in NCR. We've acquired a lot of contracts, especially not just in the QSR side, in the quick commerce side, in the pharmaceutical side, but we're also looking at other fast-growing sectors like semiconductors, etc., where the demand for cold movement will be very, very high. So the next few years, we should be looking at a 15 to 20% CAGR in terms of growth, and some amount of investment also per year. It is a joint venture that we have with a Japanese company, Mitsui, where they own 20%. So the capacity and the ability to grow this company is extremely high.
Well, Vineet, one other hot sector as of now is quick commerce. It has been quite good for you, as you've said in the past. Fulfillment is also growing quite well. So, how much of Q-commerce now accounts for in your overall sales? And one more question is actually on the freight division. What is your FTL versus LTL mix and the outlook on volumes and realization? So, Q-com and freight division, can you please elaborate?
Quick commerce is not really a substantial part of the overall business. It's a business that's growing, but we do not expect it to become really, really very large as a business specifically, because we operate on a sliver of activity which is essentially just fulfillment. So we bring in the merchandise, we do inventory management, and then we supply to the dark stores. So it's a fast-growing business, but not really very large in terms of size. In terms of freight business, our LTL business is about 36% out of the overall freight business. And the outlook for this is that we want to increase this to 40% in the next year or two. And the idea is that LTL business has a lot more margin compared to the FTL business, and hence our focus is going to be there.
Thank you so much, Vineet, for joining us, giving us a sense of what exactly transpired as far as Q4 as well as FY25 is concerned and the way ahead for FY26. Well, when we are looking at the markets, the strength over there continues to remain quite astounding. The Nifty now firmly perched above the 25,050 mark. The Nifty IT index led by TCS, led by HCL Tech, all of these names now near the day's highest points. The Pharma Pack 2 is rallying. It's an all-round rally that we're seeing. So we are leaving the team of RMF Corner in very strong hands. Thank you so much for watching Midcap Radar.
Hello, good afternoon. Welcome to MF Corner on CNBC-TV18. I'm Vinny Motiwala. Thank you so much for tuning in as always. Today, we are going to be putting the spotlight on new fund offers, NFOs. Now, obviously, we had seen that rush coming in 2024, where we had 239 NFOs that were launched in that year. Now, we're seeing a bit of a reduction coming in, but still, there are launches that come in terms of NFOs. Now, how should you, as an investor, choose the fund which is best suited for you? What are the risk appetite that you have? What are the factors that you should be continuing when you're looking at NFOs? To discuss all of this, today we have our guest joining in with us, Kirtan Shah, founder at Credence Wealth, to talk to us about all of this. Kirtan, good afternoon. Thank you so much for joining in with us as always. Kirtan, want to just start with, how should I evaluate NFOs? There's so much that's happening in the market as well. You already have mutual fund options. Why and when should one be looking at NFOs? What should be my checklist?
Winnie, thank you so much for having me on the show. Winnie, like you rightly put, I think there are more than 2,000 funds already available. And the NFO really needs to have something unique for you to really want to invest in it. Otherwise, there is absolutely no reason, in my opinion, for anybody who would want to look at investing in NFO. So a couple of things maybe here. Let's say, is there something new that the NFO is bringing on board which is not currently or existingly available? I think that is a point in time you probably might want to look at the NFO that has come out. Or there is something that this NFO brings on table, again, which is not existingly available, but it is solving a problem in the kind of portfolio that you are really willing to build. So why is this important? Is because you might come up with a new fund offer which is not available in the market at this point in time, but you should only invest in that fund if that fund is actually solving some problem with respect to the way you want to build the portfolio. Just because it is new and it's offering something that is not existingly available does not really mean for you to invest in it. And probably you might also look at some funds which there are fund managers that you've been tracking for a long time. They've got a great history in terms of performance, but for some reason, they've either moved to a new AMC or done something else, which is why they are coming out with new funds. Probably those are the kind of funds that you might want to look at. In my opinion, outside of these three reasons, there's really no fourth reason to look at investing in an NFO.
Right, absolutely. Because sometimes when I see these new NFO launches coming in as well, right, what is a unique feature that maybe you could give an example where you have seen some unique feature as well coming in versus the existing funds? Like sometimes you just have those Nifty 50 ETF NFO launches that are coming in. You have something that is already there, multi-asset which is there. So why would I be looking at the fund? What is that difference then? And there's no comparison in terms of return that I have still, right? Other than maybe the fund manager, if I may know them. That is the only thing. So how and what is a differentiating factor or unique factor that you may have seen?
So like I said, Vinny, you definitely don't want to invest in a Nifty 50 fund that has come out, or a smart beta fund that has come out, or an active fund that has come out, which is already existing in the market. If there is something new that comes out and it is able to solve a problem in your portfolio, you look at it. So to give you an example, let's say soon we will see a lot of SIFs, NFOs getting launched. Now that's a very unique product because the mutual fund industry has not offered anything like this in the past. It is probably the only product in the ecosystem that we deal with where you are going to be allowed to take 20-25% unhedged derivative positions. And I think that's very unique as a proposition. So when somebody comes out with an SIF as an NFO, then you don't look at it as an NFO. That is a product which is not available. But like I said, that does not mean that you would go ahead and invest in that. Only if you really have a need for something like that in your portfolio, you would want to look at an SIF in that context, even if it's an NFO, because it brings something unique that the industry does not currently offer. Or probably over the last 2-3 months, you would have seen a lot of NFOs coming out on income plus arbitrage kind of category. Now, this category did not really exist in the past, but because of the new tax regime and the way capital gains are taxed on the debt side, this is a new kind of product which is introduced, which will give you debt kind of a risk appetite, but equity kind of a taxation, right? Probably also there's been a lot of interest in silver over the last 6-8 months, and silver's not been, it's not a very popular mutual fund product that exists for a long time. So some of these offerings may look look interesting, but only if it solves some problem in your portfolio.
Absolutely looks interesting, but if they solve the problem in your portfolio, just something that I want to clarify on. So SIF is normally like, if you have 10 lakhs as an investment, that's the minimum investment that's required, right, for an SIF. So how will these funds also be working? So then I can go in for an SIP option for all this, or how would that work if that NFO comes out?
So the minimum that you have to invest, Winnie, like you rightly said, is 10 lakh, and also that is per AMC. You cannot distribute 10 lakhs around 3 AMCs. You will have to put 10 lakhs in one particular AMC that you choose for. So let's say if that AMC comes out with 2 or 3 different categories of SIF, you only have those 2-3 SIFs categories in which you will have to deploy 10 lakhs. Okay. Now, what you have to understand is the minimum requirement is 10 lakhs. So if because of mark to market, if it falls from 10 lakhs to 9 lakhs, that's okay, right? But when you invest 10 lakhs, then you cannot go back to the AMC and say that I want to withdraw 1 lakh. Because once you withdraw 1 lakh, that will bring it down below the minimum threshold, which is 10 lakhs. So at 10 lakhs, if you want to withdraw, you will have to withdraw your entire amount. You can't withdraw 1 or 2 lakhs. Now, let's say after you've satisfied the minimum criteria, which is 10 lakhs, then you can do an SIP or an STP or an SWP, whatever you would want to do, provided you're able to make sure that the minimum required 10 lakhs is always maintained, except for M2M, because of which if it falls, it's okay.
Kirtan, what are the main risks that one should factor in while investing in an NFO? How do they normally differ from in terms of established mutual funds? What is it that an investor should look at?
See, ideally, the problem with NFO in that context are probably 2-3, right? First, because the grading of how much TER can the AMC charge you depends on the AUM of the fund. So higher the AUM of the fund, there is a grading system by which the TER or the charges automatically go down. Now, because this is an NFO and it does not have an AUM, so it has the flexibility to charge you the highest possible, right? So you will typically see that the total expense ratio in an NFO is very high. That's one problem. Second is you have no performance precedence, right? So if somebody is coming out with probably a small cap fund, you have at least 40-50 funds available in the market which 5-year, 10-year, 15-year of history, right? So that's another risk. And also, because this fund has not actually existed, you don't really know if the fund manager is going to follow the objective of the fund. Now, what do I mean here is, let's say, when the fund manager talks to the distributor or the investor community, the fund manager says that I'm a value investor and I will stand cash when markets look expensive. But when markets are expensive, they don't stand on cash. Now, you don't have a precedence to go back to. So this is another problem, because you will never be able to understand whether the fund will stay to the objective that it originally started off with.
So then your point comes in, right, that the reputation of the fund manager, his track record, as well as the AMC's track record, I think that also will come into play, right, when you're evaluating to enter into a new fund offer.
Oh, 100%. I think like we just mentioned, right, there are more than 40 AMCs and continuously new AMCs coming up. Why would you want to work with somebody or invest in somebody's fund who's got a tainted reputation for whatever reason when you have so many other options available? And also, let's say, just to give you an example, let's say if you've seen an AMC offer a large cap, mid cap, small cap fund, you've seen the performance over a longer period of time. And now if they come out with a multi-cap fund, which invariably is going to invest in large, mid, small, and the fund managers are largely the same, it only gives you more confidence that this fund, though is an NFO, probably is not a new fund, and it probably is going to draw the same strategy and the same fund managers do the same output, right? So both of these things definitely matter a lot, in my opinion.
Kirtan, is there a time when you have ever looked at an NFO, maybe even though it may be a one that already exists, like maybe you see a multi-asset fund or an equity side, anything in terms of arbitrage active fund, have you ever seen that and said, oh, maybe this is interesting? Why is it interesting for someone versus an existing fund house? What was it that in terms of a differentiation that you may have found?
See, actually, like I said, there are 2-3 things that you will typically, want to look at. The first is, of course, if at all, like I gave you an example of a multi-cap fund, though it may look new, but it is invariably going to invest in large, mid, small only. And if they are going to be the same kind of fund managers, then I would want to look at it. Or let's say if I've been following a fund manager for a very long time, I'm very impressed with the kind of work that the fund manager has done. But the fund managers moved to a new AMC, and that new AMC is offering a new NFO. Then I would probably not look at it as a new NFO, because I know and I've seen the fund manager's performance in the past in some other product that the fund managers offered. Or let's say, for example, if you go 2-3 years back, multi-asset funds as a category was not very prominent, right? Now when something like a multi-asset fund is made available for the investor community to invest in, where it's the fund manager's discretion to move between a REIT or a fixed income or an equity or gold, I think that actually may be able to solve a lot of problems in a lot of investors' portfolio. And then you don't look at it as an NFO because it's a new category. You don't have a precedent. There are some cases where you definitely might want to look at those kind of funds.
Kirtan, anything, you have to give me some names now. Anything that you think that is there or in the recent months that you've seen that has piqued your interest in terms of an NFO?
I think 2-3 categories. So first, silver, because I don't think there are a lot of silver funds available. And this, for some reason, maybe a lot of commodity kind of exposure that you want in the portfolio is not currently available, because the only thing that you end up going to is gold at the end of the day. And because of the spiked interest in silver, and I'm not saying that you should invest in silver at this point in time, but I'm saying silver is an interesting thing that probably people can look at. And like I also made a mention, you have these debt plus arbitrage funds or income plus arbitrage funds that have come out. It actually can appeal to a lot of investors who are probably looking at, not a lot of volatility in the portfolio, but want to take advantage of equity taxation. So I think these are two categories that definitely, in my opinion, the investor community can look at. And probably the SIFs, once they get rolled up, will definitely pique a lot of interest, in my opinion.
Okay, thank you so much for that, Kirtan. Keep an eye out on all those updates. One is in terms of silver, SIF, and that comes in, as well as arbitrage in terms of the funds that are there recently launched. Maybe in terms of the taxation side, some bit of a benefit on that front is something that you all could watch out for. On that note, I beg your pardon, we're going to sip into a very short break. Don't go anywhere. We'll be back with more on the Mutual Fund Corner after this break. Welcome back to MF Corner on CNBC-TV18. Now we're going to shift our focus and talk about direct and regular mutual funds. So when you see a direct fund or regular mutual fund, why should you be investing in direct? Why should you be investing in a regular mutual fund? Which is a better one? What are the options that you have? What are the pros and cons of both these? And what will we see going forward in terms of a trend as well? In terms of returns for you as well, and what are the mistakes that you should be avoiding here? Kirtan is still with us to discuss all of this. Kirtan, let's start by talking about the main difference that you have between a direct mutual fund and a regular mutual fund. What is the difference that you are keeping an eye out on? And in terms of expense ratio that is there, that is a key one that I would know. And how does it impact in terms of a long-term return as well?
Vinny, yes, the only or the largest difference between a direct and a regular is the total expense ratio, right? Which means that if I have to talk about equity as a case, typically regular mutual funds will have 1% moreover, so higher as a cost in terms versus the direct. And if you are looking at probably a debt fund, it might have cost impact of anywhere between 0.25 to 0.35. So when you take direct schemes, your cost is by that margin lower. Or the other way of looking at it is when you invest in regular funds, your cost is by that margin higher than the direct funds. Over a longer period of time, definitely it can end up making a lot of difference. To give you an example, because of trying to put this in context, let's say if you do a 10,000 rupee of SIP over 20 years, at 11%, you will be able to generate 81.5 lakhs. But at 12%, you will be able to generate 91.98 lakhs. So that 1% can make a difference of 10.5 lakhs on a 10,000 rupee of SIP spread over 20 years.
So regular is a bit more expensive by 1% if you're going in for the equity side. And for debt, it's around the percent that you mentioned, 0.25 and around that range. So that would, in the long-term story, make a very big difference that comes in. Kirtan, which type of investors should go in for a direct plan and who should actually go in for a regular plan or consider a regular plan instead?
See, I think in my opinion, the decision typically relies on two things. How much time do you really have and how much understanding in terms of mutual fund investing do you have? So if I can give you three different examples, let's say example one, if you have time and if you have the understanding of investment, you might as well want to do direct and save on that cost that we spoke of. But let's say if you don't have the time, neither do you have the understanding, then regular is great for you, right? Because you will work with somebody who will help you in terms of investing. Now, the gray area here is, let's say you have the time, but you don't have the understanding, right? Then I would suggest that, it's probably a 50-50, but I would still suggest that you go for a regular. The reason why I make this comment is because, trying to save that 1% or a 0.5% sometimes, and we've seen this in real life, that the investor community is not able to stay disciplined over a longer period of time, which when the advisor or the RIA comes on board, takes care of it, right? But again, the third case that I discussed with you is open for debate, but I would rather say that you take help of somebody so that you have the discipline and the portfolio construct works in your favor, given your risk appetite and your goals.
Okay. Kirtan, while obviously your goals, risk appetite, all of that you explained as well, and why one should be selecting what plan according to the time period and the understanding they have in terms of holding it. What services support do investors miss out when they're choosing a direct plan, right? Because that is also something that you get when you're choosing a regular plan. So what is it that they're missing out on in terms of selecting a direct plan?
So Vinny, when an investor typically opts for a regular plan, in my opinion, there are a lot of things that the advisor actually brings on board. So to give you a couple of examples, I think typically when investors do direct, the way of selecting a particular fund for them is looking at the last 1 year, 3 year kind of returns, and whatever schemes have done well is the scheme that most in general people end up investing in. But when you get an advisor on board, ideally the advisor will look at your risk profile. The advisor will look at what goals do you really want to achieve, and then try and curate the right portfolio for you, right? So while you might say that I might just invest in a large cap ETF or a mid cap index fund, but how do you bring those 5 funds together is also in itself an art, because that will make sure that your risk is lower and the risk-adjusted return that you generate on the portfolio becomes a little higher. So I think curating the right portfolio is a large advantage, in my opinion. Also, hand-holding during volatile times. And I'm sure all of us have realized how, let's say from October 24 to March 25, when the markets were falling, how SIPs got stopped, how redemptions happened. Typically, you need somebody to handhold you in such a situation and try and explain to you that, this is very normal of the market to fall, and that is no reason for them to really get out of investing. Another point that I really want to highlight is rebalancing. Rebalancing is extremely important over a longer period of time, which I believe that a lot of investors, when they choose direct, may not be able to do by themselves. And general operational help, comes as an advantage as well.
Absolutely. Rebalancing is a very important part in terms of your overall mutual fund strategy. But Kirtan, is there an option if I have picked out a regular plan or a direct plan and I want to switch to another one, vice versa, maybe from a regular to a direct or a direct to a regular? When should you be considering switching it, one? And is there an option to do that easily?
Let me answer the second question first. Is there an option? There is definitely an option. So this typically works as if you are selling one fund and buying the other fund. Okay. So let's say if you are in regular and you want to move to direct, what you typically end up doing is you sell the regular fund and you end up buying the direct fund. Now, while you are trying to do this, there are two things that I would suggest in the hindsight for a lot of investors to take care of. That while you are trying to switch between a direct to a regular or regular to direct, there is definitely going to be a capital gains incidence, because like I said, it is like selling one fund and buying the other fund, right? And also there may be a case of exit load. So while you're trying to do this switch, make sure that you look at both of these things, exit load and capital gains. Now, when do you decide whether do you or should you move? I think the answer, in my opinion, is again very clear. If you have the time and if you have the understanding, right, then you might want to switch from a regular to a direct, right? Even if that comes at a cost of paying a little capital gains, because over a longer period of time, it might help. But let's say if you've been investing over the last 3, 4, 5 years and you've realized that, you probably might have the time but don't have the understanding, or you don't have either of them, then I would sincerely suggest that you get hold of somebody who can help you in the right direction and do the hand holding and move from direct to regular.
Okay. Kirtan, are there any specific risks or common mistakes investors normally make, or you've seen them make, or when they come to you and ask for advice in terms of while picking up these plans as well? A typical one which they make.
Yeah, I think a couple of typical mistakes that I always see the investor community end up doing. The first and the most important one is the selection of the scheme. So unfortunately what happens, and I did make a mention of it in one of your last questions, that the problem is that the selection process out of the 2,000 odd schemes available in the market is only looking at the returns. So the community looks at the 1 year, 3 year, 5 year, 7 year, 10 year kind of returns, and then decides that, this particular fund has done really well, let me invest in this particular fund, right? So the choice of selecting the fund is typically the 1 year, 2, 3 years kind of return, and that's one of the biggest mistakes. And I would really want to say this, that if you look at the last 3 years of return and enter into a fund, 9 out of 10 times you are up for a bad surprise, because in the coming 2-3 years, this fund will underperform because of the styles of the fund management and the market, right? What do I mean? If you look at the last 12-18 months, you will typically see a lot of funds who follow the value style of investing they have ended up doing very well, because the market favored value style of investing. But now looking at this, if you enter into that fund, probably the fund might not be able to continue the same kind of performance that it showed. So if you look at the last 1 year, 3 year return and buy into a fund, that's the first mistake that I see most investors do. Second also is curation of funds, in my opinion, Winnie, because, it's not as simple as saying that, I will end up buying a flexi cap fund and let the fund manager do whatever he wants to do. Because while you are trying to curate a portfolio, at least in my opinion and the way I look at it, you need a market cap level diversification. You need a diversification at the AMC level, and you also need diversification at the style level. So while you are trying to build a 4-5 fund portfolio, you want to make sure that, some money is allocated to large, some is allocated to mid, some is allocated to small. And also you have growth, value, momentum, all three styles of investing that you are investing in, so that it's well diversified.
Okay. A quick one, Kirtan. I just want to know that, is there a percent that maybe I should hold as a direct or indirect? Does that matter as well, or regular as well?
Not really. I think, but if I still have to answer that question, I would rather say that whatever large cap allocation that you want to put to your portfolio, you might want to look at doing a Nifty 500, a Nifty 50 or a Sensex fund, right? But on a mid cap, small cap, you probably might want to get active funds, and that can be a great combination of fund that you would want to hold.
Okay, Kirtan, thank you so much for that. And thank you so much for joining in with us as always and helping our viewers understand concepts in the mutual fund world and mutual fund corner. So thank you so much for joining in with us. And viewers, thank you so much for tuning in. Up next, we have Closing Bell, so don't go anywhere.
Headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng is down 0.5%. The Taiwanese index is below the flat line as well.
The entire mission was completed in 23 minutes, and this shows the strength of Indian technology.
11, 12, 15, 20 points now up on the Nifty.
Small caps have trailed, but partly also on account of commodities and metals.
This year, our performance of our core business has been exceedingly good.
5,000 plus 6,000 branches in Muthoot. So people are there, the money is there, the requirement is there.
Trying to make a dash towards that 24,800. The Sensex is now in the green, up nearly about 300 points.
$250 million per quarter should be the new base.
24,960, that is where the Nifty is at. The markets have made a roaring comeback.
Hello and welcome to Closing Bell. We're coming to you live as always from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay with me, Reema Tendulkar and Nigel D'Souza. And guys, what a blooming green market.
Yeah.
Started out quiet. And I remember we said this, Nigel, in the morning, right? That we were talking about this, that sometimes slow and steady is okay. But the way these gains have gotten built on, I mean, we're looking at a 400 plus point rally on the Nifty. Oof.
It's complete domination by the bulls. The bulls have charged ahead. Forget 25,000 now. It's conquering even 25,100. It's a 1.7% rally for the day. And now look at the week. Remember, we started the week. Monday was this big blockbuster day. Then Tuesday, we retraced a bit. Yesterday, we consolidated. And today, we've added on another. And now, week to date, the Nifty is up 4.5%. And the mid-cap index is up 6%.
Well, that's right. A few factors that could have played out. One is the weekly expiry factor, because the positioning was such that we don't get past the 24,770 to around 24,800. That's got breached, and that's why post we got that past the 24,800, we had a quick 250-point rally, because now the those call writers, they've got squeezed out. That's point number one. Point number two is with regard to the flows. The cash balance or the liquid money available with mutual funds is actually at the highest in multiple years. I'm just working on that data. It's the highest that we've seen in multiple years, which is telling you domestic money is sitting at the sidelines waiting to get deployed. And with macros improving and hopefully earnings catch up as well, sitting on the sidelines may not be helping. So they'll be forced to get in, and that's what could push prices higher. And just one more thing, the FI flows haven't been that great so far this week. And there's that fear about the shift to China. But just going by the Nifty Bank rally today, it's up 700 points. The Nifty Bank has been doing a relative underperformance because of the high FI ownership in banking and financial names. Let's see whether or not we can get a relatively better FII number today because of this. So flows, the expiry-related factor, and the Nifty bank coming back to the party. I think those could be the key cues today.
Mid-caps have taken a bit of a backseat, right? Because in the start of the week, the mid-caps were outperforming. But today, it's the large caps who've taken the lead.
Oh, absolutely. And I completely take Nigel's point. I think these are going to be two very important things that we'll watch out for. How much of this move is entirely led by short covering, and it seems a lot of that is because of the short covering phenomena. But if it's also backed by some FPI buying, because today, if you contrast, I was always looking at China last couple of days since that deal got announced with the US. Today, the Chinese market's cooled off. It's not like it's, moving on rockets or steroids. It's pretty okay. Let's pull up the final closing rate for the Hang Seng and the Shanghai markets. They have been kind of even Steven. In fact, there was a bit of correction in Hong Kong, about 0.8% lower. And the Chinese market is also down by about 0.7, 0.8%. So therefore, the hope is that FPIs will also know that they need to spread their bets across perhaps both of these markets. Anyway, let's talk about what's worked. I mean, one no-brainer is defense. That index, the Nifty Defense Index, is up 10% this week. And we've not even closed the day, and there's tomorrow's session to go. So that's a very clear theme that's still working out. But other than that, it's total large cap domination, you'd have to say. And it's across the board large cap domination. Metals, for sure, are doing extremely well. So the likes of JSW Steel, for instance, up 4.5%. But beyond that, I mean, look at a stock like Hero Moto. Hero Moto is surging 6% as we speak. Then you have the biggies, Reliance, HDFC Bank and ICICI Bank. Together, they are pulling in plenty of those points out there. Actually, look at the market. If you pull up the Nifty heat map now, there is only one stock in red. That's the extent of today's move. It's so dominant in terms of the gainers. It's only IndusInd Bank. Other than that, 49 Nifty stocks in the green. Let's get the heat map if we can. It just kind of gives the sentiment of the day, and it's overwhelmingly positive.
And it's not that global cues are, supportive. You spoke about Asia, China, Hang Seng. Look at Europe right now. Frontline European indices are actually in the red, not losing a whole lot, down close to about 0.3%. But it's not that global cues today are supportive.
Well, that's right. Let's address, though, the sector that's been on fire for all of this week. Metal stocks, they are seeing strong gains all through the week. That's supported by a combination of factors. Macroeconomic as well as sector-specific tailwinds. Let's run it through the top reasons first. The announcement of a provisional trade agreement between the United States and China. That's improved global risk sentiment, encouraging flows into cyclicals and metals included as well. Next up, the positive commentary we got in from Tata Steel on demand outlook as well as on margin stability. That's what's added to a bit of a bullish sentiment, particularly in the steel segment of the ferrous space. Now, the broader markets have leaned towards risk on this week. That's what's benefited commodities as well as industrials. Now, a key driver of the rally is aluminium-related stocks. They have seen a sharp rebound because of the sharp rebound we have seen in alumina prices. Let me explain this to you. Reports suggest that Guinea is considering cancelling Emirates' global aluminium's mining license. Why is this important? Because EGA exported close to 10.8 million tons of bauxite in 2024. Now, around 10 million tons, 10.8 million tons will support roughly around 3.5 million tons of alumina production. Now, this potential disruption has raised fears of near-term alumina shortage. That's what's prompted some pre-buying and also some speculative positioning as well. Because of this, alumina prices have surged more than 10% from the lows that we saw in April 2024. Nalco, that's the one that's doing a relative outperformance. That stands to benefit because it derives a portion of its earnings from alumina sales, which could lift its margins in the near term. So risk on sentiment, macroeconomic tailwinds, as well as for Nalco, well, we've seen a big jump up actually in the last few trading sessions. Alumina, that corrected from around $750 per ton, came down to around $330 per ton. That's currently trading at around $370 per ton. Nalco sells alumina on the open market, while you have Hindalco that's backward integrated. So alumina price increasing will help them. Vedanta could be the one that gets a little bit hurt because they buy some part of the alumina from the open market. So that explains why we are seeing Nalco do a relative outperformance.
Okay, all right, got that. So that explains the move on Nalco today. Aside of that, let's see what else. Tata Motors, Trent, HCL Tech, Eternal. It's pretty much, and by the way, a lot of auto stocks are having a good session today. It's not just Tata Motors, Bajaj Auto, Maruti, all of them on the upside as well. On the on the watch list in terms of specific mid-cap movers, Tilaknagar Industries is a stock that we're going to focus on in just a bit. And that's because of earnings. And look at the earnings reaction you've got. You heard the management commentary as well, sounding quite optimistic about their overall margin trajectory, what they're going to do in terms of volumes, sounding very, very optimistic. 14% up on that stock. Lee, Travenues, Tech, which is Exigo, that, eClerx, Sanofi, these are some of the reactions to earnings that have worked very well. On the volumes charts, though, of course, overall the mid-cap index is, paling in comparison to the Nifty. The advanced decline ratio is positive. So just to talk about some of the names that are holding up quite okay. Once again, it's a bit of a PSU day. So Nalco, of course, Nigel spoke of. It has specific reasons around it. But look at BHEL, look at something like an Aircon. These are names which are finding takers this afternoon. So looking pretty okay overall. Let's see if we can get to Nagaraj Shetty. I think he's joining in. We can discuss a couple of trading ideas. Nagaraj, good afternoon. If you can hear me. It's such a strong day for the large caps, and the Nifty is sailing past levels, 25,000 on the screen now. What are the next levels you're tracking, and what's the trading strategy?
Hi, good afternoon, Surabhi. Yes, indeed, Nifty has witnessed a spectacular upside bounce from the lower levels in today's session. And having surpassed above the hurdle of around 25,000 odd levels, I'm expecting the next overhead upside target to be watched around 25,500, another 500 points in the short term, at least in the 7-8 sessions. And the overall chart pattern, broader markets are looking very positive at this point of time. I have two stocks from a large cap segment. First one I would like to mention as a trend. Chartically, Trent was moving in a range-bound action at the strong gap resistance over the last couple of weeks. Today, it has witnessed a decisive upside breakout of the hurdle range as well as the downsloping trend line, currently trading around 55.80, 55.90 levels. One can look to buy at this point of time. And 58.50 is going to be the upside target for the near term, and one can place a stop loss at 54.50. Second one is from the real estate side, DLF. Real estate was the underdog recently. It has not performed that much compared to the Nifty. And I think in the real estate front, DLF is the one looking very attractive at this point of time. Currently placed at the edge of upside breakout of the consolidation band, now trading around 709.50, somewhere around 710. One can look to buy at this point of time, and upside target would be around 750, which is in the short term, and one can place a stop loss at 690.
Jubilant Foodworks, the expectation was that, given the strong numbers, industry-leading like-for-like growth at 12.1%, the company's plans to expand margins by 200 basis points over the next 3 years, the stock would do well, but in a strong day, Jubilant Foodworks is down nearly 1.5%. Nagaraj, thank you very much for joining in. Deven Choksi is now with us on the show. Deven, first comment on Jubilant Foodworks. What is it that's disappointed the street when it comes to the numbers? Because prima facie, it looked fine.
Yeah, good afternoon. Well, I believe that I think the numbers probably may look, I think, in the face of it, I think they look fine. Not completely sure till the time I read all the details about, I think, any internal numbers, I think, which probably are missed some of our attention. Market has definitely negatively reacted to an extent, but I would refrain from putting that any view at this point of time till the time properly going through the numbers.
Okay, all right. We'll talk more about this space in a bit. Deven, stay on. Good afternoon. Yeah. We want to talk to you about the EMS space as well, and I'll tell you why, because this is probably the biggest story of the hour. It's coming in from none other than the US president, who else but Mr. Donald Trump. Let's actually see do we have Hormaz. I mean, this was a very big statement. Okay, I think Hormaz is going to join in just a bit. So what Mr. Donald Trump has said in Doha, I think today, is that he says he called up Tim Cook and told Tim Cook that he doesn't think that Apple should make in India for the US. He says India can take care of itself. Very, very, very important and sensitive statement coming in. Let's listen into the US president.
We have Apple, as you know, it's coming in. And I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India, because India is one of the highest tariff nations in the world. It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff. So we go from the highest tariff, you couldn't do business in India. We're not even a top 30 in India because the tariff is so high, to a point where they have actually told us, I assume you too, Scott, you were working on that also, that there will be no tariff, right? Would you say that's a difference? They're the highest, and now they're saying no tariff. But I said to Tim, Tim, look, we've treated you really good. We put up with all the plants that you built in China for years. Now you got to build us. We're not interested in you building in India. India can take care of themselves. They're doing very well.
Wow, those are big statements from the US president. Two big statements actually there, not just one. He's saying, I mean, his claim is that India has offered to reduce tariffs to zero from being one of the highest tariff countries. He's saying India's going down to zero. That's his claim. And he was referring to Scott, that's Mr. Scott Bessent, checking if he's heard the same from India. And the second important statement, I mean, he's just announced it. He's told Tim Cook, don't make in India, only make in India for the Indian requirement. And the iPhones you plan to sell in India, do not make in India otherwise for the US. Hormaz, I'm speechless. But that's Mr. Trump, right? He usually leaves us speechless.
It's something that the summary of what Donald Trump said is what you just mentioned, right? If you want to make in India for the Indian markets, great. Don't make it in India and send it to the US, because this is in very important context to what Tim Cook said during Apple's earnings call as well, which was just a couple of weeks earlier. And he had mentioned there very categorically that majority of the iPhones that will be sold in the US during the ongoing quarter will have India as their country of origin. Of course, he did not put a specific number to it. Neither did he put a target as to where he sees that production going into by the end of the year. But he did mention that majority of these iPhones will be manufactured in India. But of course, you need to contextualize this simply because when Tim Cook made these remarks, the US and the China was still locked in this tariff war, which has only reached a temporary agreement earlier this week. So now what does Apple do with its strategy? That remains to be seen. And of course, it's not as if Apple has not committed any investments to the US. They did this long ago. Just 3 months earlier in February, they had announced that they'll be investing $500 billion in the US economy over the next 4 years. And that will be to expand their facilities in Michigan, Texas, California, Nevada, and a lot of other places. They are also planning to put up a new facility in Texas, invest in AI, set up an academy for in silicon engineering, and so on and so forth. So $500 billion already committed by Tim Cook for the US economy. Now, Apple does not work with any directly listed entities in India. This is what PL Capital told us last month. And they had mentioned that in case Apple does manage to increase its supply chain or its manufacturing in India, Dixon could be a potential beneficiary, although the company does not have any direct exposure to Apple just yet. Other than that, the Motherson Group had joined Apple's supply chain last month. Not necessarily Samvardhana Motherson, but on a group level, they had joined Apple supply chain in August of last year. So as of now, things still hang in the balance. It will be interesting to see what Apple has to say on Donald Trump's remarks, whether they would still continue to manufacture in India and sell to the US. That remains a developing subject.
Thank you. Thank you very much for that. Devin, you want to quickly comment on this? As Subi pointed out, there are two sets of information that we're digesting. One, the possibility that tariffs to the US are now zero. That's what India has offered in terms of a trade deal. And secondly, no more Apple manufacturing in India, at least not make India as a manufacturing hub for exports. What does this mean for the entire EMS ecosystem? Because Apple was seen as this poster child that, if Apple comes to India and we can make Apple iPhones in India, then we're really setting the example.
Well, I think my common understanding, and I think the subject understanding says that when the cost of manufacturing and the economics, I think that we are talking about, the manufacturing economics that we are talking about, is working in favor of any part of the world, I think the companies do go to there, and I think they do it. EMS suppliers today, I think, are making a difference to the OEMs like Apple, wherein I think they're 30 to 40% cheaper compared to elsewhere where they manufacture a similar kind of a product. Now, if that is a kind of economic rationale that one is talking about, how easy or how difficult it would be for anybody to just switch on, switch off from one country to another country for manufacturing. it's not going to be so easy. So economic rationales will prevail upon. That's what my first point is. Having said that, I think the most of the businesses basically are becoming extremely competitive globally. And India is among those countries where we are providing the most cost-efficient kind of a solution, be it in the area of logistic cost now, be it in the area of power cost, that is energy cost, and also now, I think along with that, the lower inflation, lower interest rate. So all in all put together, I think we become a really big challenger to any other part of the world as far as the cost economics is concerned. And that's where I believe and remain confident that things are not going to be easily shifted out of India, even if I think the statement comes from the President of America, for that matter.
All right. Hi, Deven. Good afternoon. Good to see you in. I am not sure whether you heard my take on the metal stocks. You know, the macroeconomic situation is improving. There's a fear that could be a bit of a shortage on bauxite, which in turn will affect alumina prices and then in turn impact aluminium prices as well. Nalco is the one that has a direct relation to alumina sales. So that's why that stock has bounced back. I think it hit a low of around 140. Now it's at around 180. How would you play this and your preference between non-ferrous and ferrous?
So Nigel, I think my point remains very clear here that I think given the kind of demand trajectory which is emerging into the global economy, be it in the area of ferrous or be it in the area of non-ferrous, I think the price of the metal commodity as a commodity is going to be on rise. Now there may be shortage situation for raw material at one end, there may be I think the higher prices of the finished products on the other end. That's a reality. At the same time, I think the bigger advantage to a country like India would be, and the manufacturers in India would be, that we are blending the energy cost with the renewable and supplementing it, I think, along with the conventional energy. So that is basically giving us an advantage on the cost side, resulting into better margin. And on the other side, the demand scenario is going to remain upbeat hereafter. I believe that 6 months fast forward from now, probably we'll be seeing, I think, very strong capital commodity prices in the global economy. And that should work well for the argument of the stocks prices as well. So in my viewpoint, I think most of the stocks are getting into that situation wherein the conviction is coming up about the trend on the momentum side of the prices, which is going to result into the stock price surge also eventually. So remains relatively more confident than before as far as the metal outlook is concerned.
Okay, all right. So those are some of the names. Deven, give us your, earnings pick of the season. It could be mid cap, it could be a large cap, but a stock that really stood out for you, where the numbers are good, where perhaps it even warrants a fresh buy at this point.
So largely, I think in the financial space where we have found, I think, ourselves more comfortable in this particular earnings season, where the consistency is there. The Bajaj Finance and Bajaj Housing Finance, these two companies, I think they remain relatively more stronger pick comparatively. Two reasons. On one side, I think the higher amount of growth rate in the AUM which is taking place, which is allowing, I think, the 25-30% kind of a CAGR kind of a growth in housing finance business and 20-25% CAGR kind of a growth in the retail finance, the NBFC business of Bajaj Finance. So that gives you a good amount of visibility of 3.5 years, doubling the size from current levels. And at the same time, in the lower interest rate trajectory that we are experiencing and will be further experiencing, the NIMs are going to be better hereafter. So we find that I think these two companies would remain relatively more stronger, even on a forward outlook basis if one has to look at these companies. Otherwise, I think on a potential basis, we see the good amount of potential now returning back to metal stocks, which I talked a while back. Believe that I think 6 to 9 months from now on, probably I think we should be seeing a very different price picture of some of these metal stocks into the marketplace.
Deven, what about Muthoot Finance? Again, here the numbers were fine. Maybe the street doesn't like the guidance that they've shared. They're talking about a minimum 15% revenue growth to begin FY26 with, though they will revise it higher. They could look at revising it higher as the year progresses in Q2. But maybe it's the guidance which has disappointed the street. Also, there is that risk, right? If gold prices don't stay at these elevated levels, then can you continue to boast of the kind of growth rates that we've seen? Do you own Muthoot Finance? Is this a stock that you've liked? Because it's done well.
Yes, I think we have been refraining from buying into a pure focus gold finance NBFC companies into the portfolio, largely because of variety of reasons about non-clarity on the subject of the valuations of the underlying commodities, gold in this case. So that's where probably I think we refrain all along, I think, in buying into the portfolio of these kind of businesses. Whereas we remain more comfortable buying a stable business, which is a retail NBFC kind of franchises, which we spoke about a while back. Particularly in this case, I think the market concern, as I see it at this point of time, is going to be on the gold prices. And any inventory in pipeline or any inventory which is in working progress for manufacturing could possibly have some kind of a mark-to-market impact if the prices do not support current levels and go down further. So that is a concern which market is having, which is justifiably so. Otherwise, valuation-wise, I think that they are reasonably placed at this point of time. There is some amount of premium compared to what they were before.
Okay, all right. Devin, thank you very much for all the perspective and all the stocks that we've discussed today. Appreciate you joining in. You have a good rest of the day and we'll connect again soon. But for now, let's go back and revisit that big story that's coming out of the Middle East, where the US president has said that he's called up Tim Cook and he has told Tim Cook not to make in India when it comes to iPhones that are meant for the US markets. He's saying it's okay to make iPhones in India, which are for the local market, for the Indian market, but not otherwise. He says he's put up with Tim Cook or Apple manufacturing in China for many, many years. They should not now do the same in India as well. What does this mean for the entire Indian electronics manufacturing ecosystem and the monies and the investments that were already being put to work? Let's discuss this and get some perspective with Raju Goyal, Secretary General of ELCINA, which is the industry body of the electronics manufacturing fraternity. Mr. Goyal, thanks for joining in. That's quite a dramatic statement from the US president. I mean, it doesn't get clearer than that. I don't know how Apple, in the face of that, can continue with its plans on India, because the company was already on its way of scaling up its production in the country. Your thoughts?
Yes, I think this is actually quite a strong statement and quite unexpected coming from Mr. Trump. But I guess he has been like that for the last few months, and we should never really be surprised at what he comes up with. I don't know how things are going to work out, in the coming months. The most recent one has been that now, the tariffs have been lowered against China. So I believe now India and China are almost at par. So, there isn't, that much advantage that India has. But I still feel that I think India should maintain its path. We have a large, domestic market. We need to actually focus on more value addition. So what has been happening till now is that in the mobile phone industry, we have been doing a lot of work, assembling the phones. But I think we need to go deeper down into the value chain and do more of the components locally, develop our ecosystem, which actually requires very high-end manufacturing. So that is, I think, what we're going to do now. And we have the new electronic component manufacturing scheme, which is something that the industry and particularly ELCINA has been pursuing, I think, for the last almost 2 years now. And we are really happy to see it happen. So I would say that there is still a lot for us to do. Let us not get, disheartened by this. I'm sure, Mr. Trump might change his...
I mean, let's see what kind of response this gets from Apple. But, what does this do in the interim to the investments that have been put to work? Because, Apple has been working with Foxtron, with the Tatas, to scale up production. India was supposed to become Apple's biggest manufacturing base as it shifted away from China. Do you see that shift halting because of what we've heard today?
I think it is, it is too early for me to say something. I don't think I would really understand, the depth of this issue so much. It may slow down things a bit, but I really don't think that it is going to impact India that much, because we are still doing a very small share of the global market for Apple. So I think, and this is just a statement. I think let's see Mr. Tim Cook's response. He is the right person to really, respond on this issue. I do feel that it could give a bit of a hiccup, but I think India is on a very strong wicket in electronics, and we need not worry so much only about, one particular product, which is mobile phones. It is a major part of our manufacturing and exports, no doubt. But I think we need to focus more on the value addition. I would really not worry so much about it. That is what my opinion is, yeah.
All right. Got that point. Apple, I think at last count, sold 60 million phones in the US market, and 80% of those phones were made in China, and that's what it was looking to shift away from China towards India. Let's see how the story plays out, but thank you very much for joining in with that quick perspective. We'll take a break, come back and get you more on the markets in just a bit. We'll also have more perspective. Varun Goyal will join in on the market construct.
up.
Welcome back. The Nifty is holding above that 25,000 mark. It's a 400-point uptick on the Nifty, while the Sensex has seen a gain of close to about 1,200 points. Varun Goyal, Senior Fund Manager, Equity and Mirae Asset Investment Managers, is now with us on the show. Varun, thank you very much for joining in. We've seen the markets consolidate and now take off in today's trading session. In the last 1 month, what changes have has there been any change in your thought process? And have you made any changes to your portfolio? Any tweaks, any additions, any deletions?
Good afternoon, Reema. Thank you so much for having me on the show. I think broadly our view that there is a cyclical recovery in India, which is underway, is playing out quite well. Our sense was that we are looking at economic growth, which kind of bottomed out at 5.5% last year. It's seeing a cyclical recovery. I think the significant monetary easing that RBI is doing, along with the tax cuts and a good monsoon, should aid economic recovery in India. Of course, there are two external factors in terms of what happens to US tariff scenario and what happens to the geopolitical situation. But I think, and both seem to be much better placed today as compared to what the things were like last month. So I think broadly, the cyclical recovery is on track. We expect low double-digit to mid double-digit kind of earnings growth for broader markets. And I think, markets definitely would respond to that strong earnings growth in the next 3 to 4 quarters. As far as our portfolio changes are concerned, I think we have added a little bit to IT. That sector has corrected significantly in the last couple of months. Other than that, I think the broader portfolio is largely intact.
All right. Hi, Varun. Good afternoon. Good to see you in. Varun, in terms of cash levels, how much are you all sitting on?
As a fund house, we don't take very big cash calls. I guess a couple of percentage points here and there, but we have been almost fully invested through the last few months.
All right, Varun, at the start of this year, we're only halfway through, and we've seen so many headwinds, and still the markets are up, I think, by around 4.5% or thereabouts. For the year, what kind of a return should we expect? And do you believe that after, the large caps actually have been getting bulk of the share, now if things are stabilizing, if Trump's tariffs are behind us, if the geopolitical scenario is better, do you think the mid and the small caps can do a relative outperformance, or would you stick to the large cap names?
Yeah, I think we've seen FY25 was a year with low single-digit kind of earnings growth, and the market returns were also broadly similar. I think fiscal 26 should be the year of cyclical recovery in India, and as I mentioned, we expect low to mid double-digit kind of earnings growth for the broader markets. And some of the small and the mid-cap names can actually deliver strong earnings growth. Our own internal assessment is that for the for FY26-27, we should expect somewhere between 20 to 25% kind of earnings growth for the small cap space as a whole. So I think this is a great year. Calendar year 25 should be a great year for bottom-up stock picking. I don't know how much return small cap will make this year, but broadly, I think if you look back at calendar year 25, 2 to 3 years down the line, one would think that it was a great year to create that high-quality small and mid-cap portfolio.
Okay. Varun, hi, good afternoon. Let's talk themes. What are you liking in the market right now? Where do you find, reasonable scope for growth and prices which are not too out of whack?
Yeah, good afternoon, Surabhi. So I think we have seen several pockets of the market where the price damage has been quite disproportionate. I think some of the cyclical sectors like real estate, if we see 100 to 125 basis points of rate cut during the course of this year, that will definitely make your home loan payments, EMIs, more affordable. So we expect that the real estate cycle should continue for the next 2 to 3 years. So that is one sector we believe should do well. I think select capital goods stocks, which have again corrected 50, 60, 70%. So while there are, there were definitely pockets of froth where things have got, extended way too much. But I think selectively we should see value emerging in that space. And we are gradual, adding to some of those sectors. I think if you look at the whole rural consumption story, which has been at pause for almost 2-3 years, will come back. So our sense is this year we should see both discretionary and rural consumption making a comeback thanks to the tax cuts and the monetary easing that is currently under play. And also those are again, you would find bottom-up opportunities in that sector too.
Okay. And just in terms of the portfolio bias, Varun, the split between mid, large and small, what would you go with at this point? I mean, as a blend across portfolios, what would the call be?
Yeah, I think, so I can talk about the FlexiCap fund, which I manage. Yeah. That's where, we are 2/3 large cap and 1/3 small and mid cap. And I think we are comfortable with that allocation at this point of time.
And I guess it's worked well for you because it's been the year of the large caps so far, and the Nifty now is just about, I think, 4.5% away from getting back to the all-time highs. Definitely outperforming the mid and small cap space. Good to have you on. Thanks, Varun, for joining in with that perspective on the show today. Well, that's thank you very much. Well, that's a word coming in from Mireille. But we have Page Industries numbers coming through. EBITDA is up 43%, and the margin has also improved. So looking good. Page Industries after, again, stocks like Jubilant, Page Industries, they're stars of yesteryears. And they completely fell off the radar in the last 2-3 years because of multiple reasons. And now we have seen a good show by both of them, and the stock is really reacting very well to that operational performance. We'll get the top line figure as well. I missed the top line. It'll flash on the screen. But the stock is definitely running away like a jockey, should I say.
Well, that's right. In fact, that margin number, if I saw it correctly, I think it was somewhere around 21%, which is a sharp improvement on a year-on-year basis compared with around 16.6%. But you need to note that in the previous 2 quarters, that's Q2 as well as Q3, they actually delivered 23% of margins. So on a sequential basis, actually, there's a bit of a dip. These numbers look good in terms of the growth on a year-on-year basis, but the margins actually have come down a little bit. We'll have to see what's the steady state. From those high teens, it had moved to around 23%, and in the past quarter, it's come in at around 21.5%. I think for the time being, the street is taking the absolute number as a positive, 40% up, and that's where the stock is up. But after going up close to around 2%, I think it's cooled off a little bit from the top. I'll tell you what, we'll slip into a short break. We'll come back. We'll have Nimesh who will be joining in. He'll tell us what he's picking up in terms of D-Street chatter. And also, we'll get in our technical picks. Stay with us. Welcome back. Well, we started the show by telling you that the metal stocks actually are doing well. But there's another sector actually that's doing well. In fact, a part of this sector, you have the two-wheeler makers that are doing pretty well. Sudarshan joins in to help us out with what's causing Hero MotoCorp. Sud, they have changed the gear, top gear, and revving the engine as we speak. Tell us more.
Looks like that. So just a month ago, Nifty Auto Index was at 52-week low. And from there, it has gained 23%. Now it's just 14% away from the record high. So most of the auto names are higher in today's trade, but I'll focus on two names which have announced results in the last 2 days. And the first in that list is Hero MotoCorp, which is top Nifty gainer, up more than 6% today. Now, why is it that? So yesterday, company held management analyst call after reporting a strong set of earnings. And in that call, the outlook that company has given looks very positive. Company is saying for the month of May and June, sales are going to be higher because of the number of marriage dates in 2025 will be more than 2024, and Hero Moto, being the leader in the entry-level segment, will be the biggest beneficiary. Also on the margin front, company is saying that it will continue to hold margin in the range of 14 to 16%, and it believes that recent income tax cut announced by government will also aid growth, and in FY25, it will outperform the industry. Now coming to Eicher Motors. So stock had opened in the green, but it had slipped into the red. Now again, it has recovered, now trading with gains. Now, why is it there? So Eicher also has talked about the outlook, and it's saying that, again, like Hero MotoCorp, it will also outperform the industry. And it's saying that while rural has been growing, it basically growing at a healthy rate, last month, in the month of April, the sales indicate that positive sentiment is returning in urban area also. In one segment where Eicher Motor is the leader is the segment that is above 250cc. In that one, company continues to gain the market share. Just if you look at in Q4, sequentially its market share has jumped by 100 basis points. And if you look at year on year, market share has jumped by 40 basis points. So overall, looking very positive for two-wheeler names after the earnings announced by Hero Moto and Eicher.
Thank you very much for that and explaining that. Nagraj Shetty is now back with us. Nagraj, any more stocks that you would have? Last 20 minutes to go to trade this up session.
Yeah, market has been a strong uptrend. Nifty sustaining the gains. Even mid-cap, small-caps are also showing some strength in the upside momentum. I think we have some in automobile two-wheeler space and metal space are buzzing in today's session. In two-wheeler, TVS Motor is the one was showing in a consolidation moment over the last 2 to 3 weeks, currently placed at the edge of upside breakout of the bullish flag kind of a pattern on technically. I think looking very strong, and I'm expecting this to move further with the upside breakout, and the next upside target would be around 2950 in the near term.
Okay, all right. Well, thanks a lot for that. Well, it's 3 p.m., so let's hop across to Nimesh. He's here to tell us about what he's picking up into D Street Chatter. Nimesh, what's the buzz today? Should we brace for a big institutional buy number?
Well, I'm not sure whether it's a very large buy number, but there is a buy number for sure, and the buy-sell ratio is close to 2:1. So clearly, 2 buy for a 1 sell. So that way, I guess the numbers will be positive. But I guess, today's move, Nigel, clearly has surprised me as well. I mean, nobody expected 400 points kind of a rally on the Nifty. I guess there is a bit of the weekly expiry element, which is getting played out today. But having said that, there is a bit of risk on as well. All the bad news, whether it's a tariff-related or war-related, seems to be behind now. So maybe that also explains that there is a bit of rally or a risk-on rally, so to speak, for the Indian markets. Within the sectors, you rightly pointed out, metals is one sector which has done well today. But even beyond metals, the rate sensitives is where there is a bit of buying traction as well. So real estate stocks have done well. They are well bid, and so are the bank stocks as well. The overall feedback is maybe the next leg of rally you will see in the PSU bank stocks, which has relatively underperformed the banking sector. So watch out for those in the days to come. Within the, there is, as I said, there is a lot of momentum in the broader markets now. But I guess today's big move seems to be, there is a bit of element of weekly expiry as well, which is spread out on the Nifty and the Bank Nifty.
Okay, and what about stocks, Nimesh? What have you picked up?
Well, Rima, in this kind of a market, you'll see a lot of buzz and rumors as well. So I need to be a bit careful, but the first stock on my list is VIP. After a long time, the stock has seen some bit of traction. The volumes are on the higher side. And again, there is a very strong buzz of some corporate development in VIP very soon. So, well, it's been in the works for a very long time. So again, every now and then it does comes up. But looks like, there is some corporate development expected in VIP, and that's the reason why it's buzzing in trade. The second, couple of stocks where there are some large blocks expected. I've been highlighting on a daily basis that, so in today's list, it's Aptus value, whether it could be a large block, a PE could be a seller there. Ami Organics could be another stock where you'll see a large block. And third one is OneSource. The company reported the earnings yesterday. Again, there the expectation is that maybe one PE investor will sell some stakes. So these are the stocks where you're going to expect large blocks. Third, couple of stocks, stocks where there is delivery-based buying. Indian Hotels and Sun Pharma both stands out in terms of aggressive buying or at least aggressive bids from larger FIs in today's market. And the last one is Bandhan Bank. The stock has recovered from the lows, but there has been a selling pressure from a very large long-only fund. There has been an official disclosure as well that they are looking to sell. They hold close to 9 crore shares, so that supply overhang is likely to be there in Bandhan Bank, at least in the near term.
Thank you very much for that. One of the big movers today is actually Tilaknagar Industries. Numbers were good. The company in Q4 reported a volume growth of 20% as the issues in Andhra Pradesh seem to be behind the company. But going ahead, the management guidance was also fairly upbeat. They're talking about high teens volume growth in FY26. They will maintain margins at 15.5% to 17%. They're investing a lot in advertising and promotion because they've got a lot of launches coming up, luxury launches in whiskey and brandy. But despite that, they will hold on to margins, and they're also planning to increase the contribution of the non-brandy segment from current 9% to up to 20%. Say by 2030. So stock is up close to about 15%. Listen in to an excerpt from that conversation that we had with the CMD Amit Dhanukar.
We have bounced back quite strongly in Q4 with the overall volume growth of 20%. Of course, the growth in Andhra Pradesh would be in excess of that. I think that's looking more like 30-35%. And, with the strong momentum build up in Q4, we're carrying this forward into Q1 and this fiscal year as well. I think the volume growth for this year will largely mirror, the Q4 volume growth. I think we expect clearly high teens volume growth for this entire year, and our revenue growth should roughly, track the same percentage. I think going forward, the NSR will, remain largely in the same range. I think while we do get the benefit of premiumization and selling some premium brands, but we did a price correction on our flagship brand in Andhra Pradesh in November. So, that was done in line with, the competitive movement in that category. So that price correction now we'll have the full year effect in this year. So, by and large, the NSR will remain same. And the margin outlook also, will be around 15.5% to 17%. That is the outlook which we expect for this financial year. We have few premium launches which we have already done. We launched Monarch, which was a luxury brandy in September of last year, and we intend to launch a luxury whiskey in the first half of this year. So, the premium brands, the first year, the advertising and marketing is going to be slightly skewed. So, with increased A&SP spends, that will put some downward pressure on the margin as well. The previous year, brandy as a percentage of our portfolio was closer to 95%. So we've made some progress in this year now where brandy is 91%. And, our vision is that, by 2030, which is say, 3-4 years from now, brandy will still continue, being the core of our business, but we expect it to be around 80% by 2030.
Okay, all right. So that was some commentary that came in from Tilaknagar today. The stock started off in the green. Well, I'll tell you what, it's currently holding at the high point of the day. Good numbers and good commentary as well on the path ahead. Amrish Baliga, our market expert, joins us on the show. Hi, Amrish. Good afternoon. Good to see you. Well, I've got a couple of stock questions for you. But before that, let me throw this one to you. What's that one stock that you'll recommend for our viewers?
See, my pick is Godrej Consumer. A prominent player in the FMCG space, focuses on personal care and home care segments. Second largest player in the soap segment in India. They have presence in about 85 countries across categories, and the major geographies are Africa, USA, Middle East, and Southeast Asia. But India still gives them 2/3 of their revenue. A home care segment is about 46%, and personal care is about 50% of their revenue. And they've recently launched a pet food segment, and I think this is one of the fastest growing segments in India. Godrej has adopted a volume-led growth strategy now, and there's a strong push for rural expansion and premiumization. And with the food inflation also coming down, I think the consumption should improve going ahead. And especially with the good monsoons, I think FMCG overall should do well. which includes Godrej. So expected revenue CAGR for the next 3 years is about 11%. With the PAT CAGR, I'm expecting about 21%. EPS for FY27 should be closer to about 28. And with this, my price target is about 1540.
Amrish, did you have a look at the news surrounding Persistent? That one of their top clients, United Health, that's facing a lot of headwinds. We know the stock price at after hours trading is down close to about 8-9%. But CEO is gone, they've withdrawn their guidance and now, facing a potential criminal investigation. What happens in such situations? If you own Persistent and one of their top clients is facing these headwinds, what's the advice?
See, whenever one of your top clients is facing headwinds, that's going to have an effect, at least in the short to medium term. So I think clearly that effect would be felt at least over the next 2 to 3 quarters, if not more. And one of those recent examples was Sirma. I mean, they also had one of the largest clients facing issues, and we have seen the sort of a correction. And this happens across. It's just not 1 or 2 stocks. I think it happens across whenever the issues like these come up. So someone who's possibly holding Persistent, I would say it could be a good time. Even now, it's not corrected too much. So I think it's time to book at least book partial profits.
Okay, all right. Amrish, I'm not sure whether you tracked this one, but VIP, it came out with its set of numbers. They were absolutely horrific, actually. The numbers didn't look good at all. In fact, I was mentioning to my colleagues in the studio yesterday at the start of trade, Surbhi, Prashant as well were there. I said that, going by the numbers, the stock should be down. But if we see a big recovery, means the street is expecting something more. Nimesh has told us that the street is speculating with regard to a corporate announcement.
Absolutely.
Now that could be the reason why the stock, I think, even in this, in the last 1 month or so, it's moved from 280 to 360 and it's moving on very, very large volumes. What's your view? Do you believe that things can only get better from here? That could be one point that's driving the stock. And the second point is, could there be a new owner? That's the other speculation, so to say.
Who's going to bag it?
Yeah, who's going to bag it?
Who's going to bag it? Sorry.
And it's still the leader with regard to market share. Good enough reason for you to buy? Or will you stay away and say, if I want to buy, rather play Safari that's been growing so well, margin improvement, Mr. Jatia at the helm has, turned things around. Your take.
No, see, if you see from a fundamental angle, there is no reason for you to buy VIP.
Correct.
Clearly, Safari has been doing consistently well, and VIP has been doing badly consistently. I mean, if you see the last at least 6 to 8 quarters. And I think with these sort of numbers, I think it becomes, like more the reason to find a buyer sooner than later. Because we've been hearing about this, a new promoter coming in. I think we've been hearing this for the last 12 to 15 months, if not more. So I think with these sort of numbers, it makes much more sense to possibly pare down on the expectations and possibly sell to a new owner. And I think that's what the street is now speculating. And because of which we have seen this sort of a move.
Okay. All right. Stay on, Amrish. We'll come back to you for more questions. Need to take a very quick break. As we take this break, let's get you a big global view as well on India. India is the most exciting market at this point in time. Those words are coming in from emerging market veteran investor Mark Mobius. Listen in to these excerpts. We'll come right back after the break.
China is not the only game in town. We're now seeing all these other countries entering the export market and being able to compete. So it's really very exciting to see what's happening around the world. And probably the most exciting place now is India, because India is going to be taking the place of China in many, many areas. And we've already seen companies like Apple and others come to India to manufacture and export. So India, Vietnam, Taiwan, Turkey, those are the ones that are looking very interesting for us at this stage. But as you pointed out, there are many other markets around the world that are doing better than the US. The big problem with India is bureaucracy. As you know, they inherited this incredible bureaucracy from the British, and the party that took over, the Congress party took over, perpetuated that bureaucracy. But Modi, the new prime minister, has done a tremendous job in cutting through a lot of the bureaucracy, but still there's a lot to be done. And he's digitizing the entire economy. First of all, by getting digitized identity cards for everybody, so money can be transferred directly to bank accounts, even to the poorest people in the country. But this takes time. I call it the United States of India because you have all these states, many of them with different languages, both written and spoken languages. So to unify this country is quite a job, but still the opportunities are there because you have a lot of very smart people. And as you say, it's the most populous country in the world now. We figure about 1.2 billion people compared to, I would say, now India's bigger than China. China maybe 800 to 900 million. Well, gold is a favorite of mine. I believe everybody should have some gold, maybe 10% of the portfolio, regardless of where the price is at any point in time. It's good at dollar cost average into gold. As regards to crypto, it looks like the U.S. is bound to become a leader in crypto, and that is going to be very important going forward. I personally am not a big fan of crypto, but members of my team are convincing me that we've got to do more in crypto. So we're looking at it more carefully. I'm particularly interested in the crypto exchanges rather than the
Welcome back. Well, the markets are doing well, but one stock that's under pressure is actually Muthoot Finance. You pull up the stock, it's actually virtually at the low point of the day. What's weighing on it? One was the conservative guidance that the management laid out of around 15% AUM growth. The other factors on valuations. It currently trades at around 2.8 times core book value. On an average, it's traded at around 2.4 times. So it's a little bit more expensive than what it had been in the past. And gold prices have come off a little bit from the recent peak. But all this together, the stock is under pressure despite reporting fairly good set of numbers. Well, earlier today, we spoke to the management, the managing director, Mr. George Alexander Muthoot. He spoke about the impact of gold price volatility and also how does he see the business evolve. Let's listen in to an excerpt of that conversation.
There are always fluctuations in gold prices. Maybe goes up, goes down. But over the last years, it has always been going up only. But of course, in the last 6 to 7 months, it has gone up too high. Probably it may cool down a bit. But of course, we give only 75% of the current value. And that also is a 30-day moving average. So today, if you look, our gold loans advance which are given, it's only 62% of today's price. If you look at the value of the gold we have with us and today's gold price, it's only 62%. So that is the margin or the headroom we have. So some corrections in the gold loan will not be affecting us. We have been maintaining our spread. NIM should be about 11%. Spread should be in the 9.5%. I think in the last 4 or 5 quarters, our spread has always been 9.15. And we actually maintain it. If the cost of funding goes up, we try to absorb it for 1 quarter or so. Afterwards, it's still going up. We increase our yield, but we maintain our spread. The same thing if the cost of fund today, the cost of funds is coming down a little. So it will take for a few months for it to maybe stabilize. If it is really coming down, we will reduce our yield, but maintaining our spread. So if there is an advantage in the borrowing cost, we pass it on to our customer. That is what our NIM and spread, etc., have been almost constant in the last several quarters.
All right, that was Muthoot Finance. Amrish, Muthoot, any interest? And then since we're ending, let's end with some food for thought. Jubilant Foodworks, Westlife, some interesting numbers have come. And at least for Jubilant, it's not been such a bad quarter. Any interest?
No, when you talk of Muthoot, I think the valuation is quite high, and I really don't expect the performance to improve further from here. It is in the near future. So I think the best is priced in, and you're seeing the gold prices coming down. And we've seen a lot of pain at the bottom of the pyramid as far as the microfinance industry is concerned. So even in this case, we are seeing some amount of pain at the borrower end because these borrowers are just one notch above the microfinance sector. So I think one should be a bit careful as far as that is concerned. When we talk of Jubilant, I mean, despite the sort of results, I think what is going to affect them, or at least affect the sentiment, is about Turkey. So I think I think that would weigh on the stock at least for a while.
Any view on Amrish on Piramal Pharma? The numbers look quite good. The problem is the street was expecting more, it seems. In fact, Ekta spoke to Ms. Piramal earlier today, and she sounded quite optimistic. But the stock is down 4.5%. From the high, I think it's down 7.5%. Your take?
See, I mean, Piramal has done extremely well. If you see the last 12 months, I mean, like it's been a major outperformer. So clearly, I think the expectations were high from the analysts. So I think that's what is playing out. But I would say that in case it corrects further, say if we see levels of say about 190, 195, I think it's a good time to buy for a slightly longer term, because then we are looking at levels of about 250, 260.
Okay, what about Z Enterprises? The stock went down to 100 rupees, the promoter bought a little bit more. 3 days ago, the promoter bought again. The promoter holding is only 4%, but when they go and they buy 16, 20 lakh shares, the street gets excited. Would you buy it at 127?
See, I mean, again, here, there's the same story like VIP. I mean, if there's if there's a white knight, a new buyer comes in because the Sony thing was, I mean, clearly is out of the window. And when the Sony discussion was going on, we had seen this stock going to levels of about 250, 260. So, I mean, if we have a new buyer coming in at some point of time, maybe in the next 2 or 3 quarters, yes, I think that would be the only story which can take the stock up.
Okay, all right. Amrish, stay with us. We have a few more questions, but we'll address that in Markets Forward. For the time being, let's do a quick recap of today's trading action. Super trading session. 380 points on the Nifty. The Nifty Bank, it found its form today. It was up close to around 550 points. What did well? Well, autos did pretty well in today's trading session. You had Tata Motors that was up close to around 4.5% in trade today. You had Hero MotoCorp as well that was up close to around 6.5%. So those are the top gainers from the auto pack. JSW Steel as well, twinkling away. Remember when that Bhushan Power and Steel order did come in, that it could be up for liquidation. The stock had corrected to around 950 rupees. Guess what? It's recovered all of the losses that we have seen from that day. And today, in fact, it was up close to 5%. Trent as well seems to be finding its way up. It was up 4%. Grasim up close to around 3%. What was losing out from the Nifty pack? Only Innocent Bank, that too mildly in the red. There was a big party though in the broader markets. A lot of stocks up and about. Vascon, solid number, stock up 13%. Tilaknagar, solid number, stock up 13%. Kochi Shipyard up close to around 7.5%. Big move is what we saw there. Sugar-related stocks, Sri Renuka, Bajaj Hindustan, both of them up. Nalco saw a sharp correction in line with what alumina prices saw from around $800 per ton. Alumina came down to around $330 per ton. Now it's around $370 per ton. So Nalco is participating as well. Big up move is what we saw there. Stocks that come in for selling post their numbers. We had Piramal Pharma, Muthoot Finance, as well as Jubilant Foodworks. All three of those stocks were actually underperformers in trade. Nonetheless, a solid trading session. Headline index did well, while the broader markets, today for a change, did a relative underperformance. We slip into that short break. We wrap up on closing bell, but you stay with us because Markets Forward comes up next.
The Wall Street sees major buying intraday to hit its highest level in 7 months. The Nifty crosses 25,000 for the first time since October last year. Broader markets underperformed the blue chips.
Metal stocks shine on risk-on sentiment. Nalco surges on the back of the bounce that we saw in alumina prices. Muthoot Finance cracks 7% on a tepid AUM growth guidance of 15%, and a fall in gold prices weigh as well.
Ixigo soars 5% on a strong Q4 performance, while Jubilant Food falls despite a good fourth quarter. Tilaknagar Industries rallies 14% on good revenue growth, and Wendt cracks 15% after the parent sell stake via offer for sale.
Hello and welcome to a fresh new edition of Markets Forward, your go-to show where we tell you what went on in today's trading session and set you up for tomorrow's trading session as well. I'm Nigel. With me is Rima. Well, Rima, beautiful trading session. The bulls, all guns blazing.
Oh, indeed. The bulls charged ahead and in complete control of our markets. And, today we scaled past even that psychologically important level of 25,000 mark, which will give investors a lot of confidence because we were stuck in sort of this trading range, and now you're getting the sense that we've broken out.
Well, Rima, imagine, right? We've had Trump's tariffs. We've also had the skirmish on the border. And after that as well, we're at 25,000 odd. That's telling you the kind of resilient performance that our markets have seen. And we hit 25,000 for the first time since October 17th, 2024. So it was a big move in today's trading session. What could have caused it? When one was the Nifty weekly expiry did play out today, and the bears were positioned that they can defend the 24,800 mark. It seems they've got stumped in today's trading session because once we breached the 24,800 mark, we had a quick fire 200-point rally, and that's why we managed to conquer the 25,000 mark. What did well in today's trading session? Well, metals, they continue to shine. Risk on sentiment globally, so that did participate. And two-wheelers from the auto pack, whether you look at Hero MotoCorp or even Eicher, both of them did pretty well. The sore point would be after a couple of sessions of outperformance, actually, the broader markets, well, they did a relative underperformance. So the index ended in the green, but relatively lower in comparison to what the Nifty did. One would have to say that for the time being, the near-term bottom for the Nifty could be around that 24,500 odd, because that was a bit of a resistance. We almost went there in the last couple of trading sessions, held on to that level and moved up. The big trigger, though, for the Nifty from here on is going to be the Nifty Bank. Yet again, it's added on that 55,400 mark. 56,000 has got rejected numerous times in the last 1 month. If we can breach that, the fresh leg of the up move starts, Rima, but a super trading session.
Oh, indeed. And we'll get chatting with our guests. But before that, let's tell you what we've lined up for you on our show. The top movers and shakers of the day, and there were so many. Hormus will join in. Hero MotoCorp is the top Nifty gainer. We decode and tell you what fueled the rally. Ixigo, Jubilant Foods in focus after the Q4 performance. And metals shining, led by the US-China deal. So we'll get you all that and more, and then the key events to watch tomorrow. But first up, as always, it's over to Hormus now. And he's at the big wall with the big stock movers of the day.
400-point move on the index explains itself, right? That the heavyweights were the big contributors in today's session. And look at Reliance Industries leading from the front. They're 2% higher in today's session. ICICI, HDFC, Infosys, Bharti Airtel nearing record highs yet again, and another 2% on that stock as well. So it was the day that belonged to the index heavyweights. It was also a day that belonged to a lot of the broader market names that reacted to results, and some of those names that we don't talk about very often. Kirloskar Oil was one of them, 17% higher on that stock. E-Clerks too ending 15% higher, but Muthoot Finance after that subdued / conservative guidance ending 7% lower. Hitachi Energy and earnings reaction as well, and Tube Investments after the results that were reported just a few minutes earlier ending 4% lower. Now a lot of the newsmakers as well, and Wendt was one of them. The management just mentioned that the non-retail portion of the OFS is fully subscribed, yet the stock ended 17% lower. Kalpataru after the order win that it had earlier in the day. Persistent Systems recovered from the lows but still ended lower. South Indian Bank, of course, an earnings reaction 4% higher there, and Sagility, we spoke to the management earlier in the day, 4.5% lower there as well. And of course, it was another day that belonged to the defense names. They continue to go from strength to strength. Cochin Shipyard, another earnings reaction, 6.5% higher today. Another upper circuit for Zen Technologies. Masgaon Dock about to report results, and Bharat Dynamics and BEL too having a good day at the office.
Thanks a lot for that, Hormus. Well, let's go across to our guests now. We have market expert Ambrish Palika. who joins in to help us out with the fundamentals, and Ruchi Jain of Motilal Oswal Financial Services joins in on the show. Hi, gentlemen. Thanks a lot for joining in. Ruchi, you go first. What a brilliant trading session. Where do we head from here? Could we be seeing fresh all-time highs soon? Would you go as far as that? And what about the Nifty Bank? I was just mentioning 56,000 has got rejected numerous times. Does it have enough to take it past that mark?
Yes, hi, very good afternoon, Nigel. Very good afternoon, everyone. At the start of this week itself, we witnessed a breakout of that very important resistance, which was 24,500 to 550. That was the 61.8% retracement level of the entire downtrend that we have seen. In last couple of trading sessions, the market witnessed some pullback or some consolidation on the index front, not on the broader markets. But what you can notice that earlier resistance of 24,550, 500 became a support, and we have resumed the next leg of up move again. So the support base has shifted higher. 24,500, 24,600 now becomes a very strong support zone for the market. And I think, yes, initial resistance is around 25,200, which was the previous swing high. And once the index managed to surpass that with an ease, which I believe there's a high probability of doing that, then we may be heading in this rally towards even 26,000 mark quite soon. Now, if you look at the leadership coming in this entire bull market, the banking and the NBFC were the first to take the leadership from the second half of March month, where the move was mainly led by banking NBFCs and the defense space, where the outperformance is seen. But in this leg of up move from this 25,500, I think this is a buying participation across the market. You look at stocks which are underperforming, such as auto space, even realty space, or some metal space. Those underperformers have also started witnessing momentum. So I believe that since this is a broad market participation going on, this is the next leg of uptrend which has started in last 2 or 3 days. And this could head much higher from current levels.
Okay, next leg of the uptrend has just begun. Let's talk about two-wheeler names because they gained in trade. Hero MotoCorp, of course, was the big winner. Eicher Motors flip-flop post the Q4 earnings but ended in the green. Sudarshan is now joining in with the details.
Will you believe that just a month ago, auto index was at 52-week low, and from that level, the index has surged 23%. Now it's just 13% away from record high. Today, most of the auto names were higher, but I'll talk about two major names which have announced results in the last 2 days. In that first is Hero MotoCorp, which was top Nifty gainer today, has gained more than 6%, and it's on the back of first strong set of earnings that company has reported for Q4, and after that, commentary that company has given in the analyst call was very positive. So company has talked about next 2 months, in the month of May and June, it's going to be strong, considering the more number of marriage dates this year versus last year. Also, it's saying that it will continue to outperform the industry even in FY26. Two-wheeler industry growth is seen in the range of 6 to 7%. Company saying it will outperform that. And second is that recent announcement of income tax cut, company believes that it will also aid growth. And on the margin front, it continues to believe that it will hold in the range of 14 to 16%. Now is Eicher Motor. So stock today had opened with a gain of almost 2%, but after that it had slipped into the red. Again, after that it recovered, and at the end it closed with minor gains. Now, results were largely in line, but commentary even from Eicher Motors was largely positive. Company is saying that, again, like Hero MotoCorp, it will outperform the industry. And one positive for the company is that in the segment that is more than 250cc, in which company is market leader, in that segment, company continues to gain market share. If you look at sequentially, market share has gained by 100 basis points. If you look at YOY, market share has surged by 40 basis points. And also, in the premiumization trend, company would be the biggest beneficiary, and heightened competition that the industry had seen last year, it's now behind, and it believes that it will continue to gain market share even going forward.
Okay, all right. Thanks a lot for that, sir. Well, Amrish, coming across to you. What do you like from the two-wheeler pack?
So for the two-wheeler pack, clearly I like Hero Moto as well as TVS because even from here on, I see the two-wheeler sales improving. Last year was not that good a year, but still we saw a 9% sort of increase in sales. And now we are seeing inflation is down, good monsoons are expected. Wedding season is going to be, I think, extremely decent this time. And again, more money in the account of salaried employees, especially the mid to lower end, who are basically the two-wheeler buyers. So from all these points of view, I think two-wheelers should do well and should buy the leaders there.
What about the technicals? Richard, how would you look at the technicals of any of these two-wheelers? Is there a trade?
So I think Hero MotoCo looks quite interesting over here because this is one of the stock which has already seen a good price-wise correction over last few months. And I know the volumes have started picking up compared to some other two-wheeler names such as TVS Motors or Eicher Motors. There has been a relative underperformance. So I think a catch-up move, that's what we have seen in today's trading session as well. And that rally could continue going ahead with the price moves have also been supported by very high volumes. So Hero MotoCo, I think, should stand out. We could see targets in the near term somewhere around 4,700, which could be another 8 to 10% higher from current levels.
Okay, all right. Well, let's talk about a couple of earnings reactions then that we saw today. Ixigo gained on the back of a good showing in Q4, while Jubilant Foodworks, well, it fell despite reporting a strong fourth quarter numbers. We had Mangalam who joins in to fill us in with the key highlights. Mangalam?
Well, for Ixigo, there were a couple of things that did well for them this time around. There were higher train bookings, higher bus bookings, and also the company has been ramping up its airline portfolio, so flights and hotels growing on a low base as well. Add to all of this, the fourth quarter did have the Mahakumbh, so that contributed mid-single digits to their overall gross transaction value. Put all these things together and the numbers tell you a story. 72% jump in their revenues, 58% jump in their EBITDA, and the net profit on a feeble base of 7 crores actually more than doubled to 16.7 crores itself. And we saw near, doubling of flight and bus GTV. The company said mid-single digit percentage of their gross transaction value was directly attributable to the Mahakumbh because bookings to Prayagraj surged by 20 times for buses, 5.5 times for flights, and 4 times for trains this time around. Let's move on to Jubilant Foodworks. That stock ended lower in today's trading session, but remember has been an outperformer over the last 6 months or so, and that's largely because of improving prospects for the business. We know that the revenue grew 34%, standalone revenue grew by 19%. That is something that the company had told already. But then below the EBITDA line as well, we had margins do better than what the street was anticipating, as were the net profits. Gross margins did decline, but because of better operating metrics, we did see improvement in their other expenses and employee expenses as well. What this basically means is more people are ordering more pizzas at home. 22% jump in their like-for-like growth for delivery, and overall like-for-like growth coming in at 12% is something that tells you there was a pizza party underway. Not so much for Jubilant Foodworks in the stock market today, largely because of valuations and profit booking post numbers.
Thank you very much for that. Ambrish, interest has come back in many of these beaten down QSR names, and now they're reporting good numbers. As Mangalam is pointing out, a 12% plus like-for-like growth for Domino's for 2 quarters in a row. Are you interested in any of these QSR names? Which one would be your pick?
No, in fact, Jubilant was my pick earlier, but now, what we hear as far as the Turkey issue is concerned, I think that's going to weigh on the stock, at least for the next couple of quarters. So at this point of time, I would be a bit cautious.
Okay, all right. Let's focus on metal stocks. Remember, they have been seeing strong gains this week. That's been supported by a combination of macroeconomic as well as sector-specific tailwinds. The first point, though, is that the announcement of the provisional trade agreement between the United States and China, that's what's improved global risk sentiment, encouraging flows into various cyclicals, metals included. The next up, you have a positive commentary that came in from Tata Steel, both on demand, pricing, as well as margin stability. That's what's added some bullish sentiment to the fairest names. And the broader markets, well, they're leaning towards risk on trade. And that's what's benefiting, commodities as well as industrial. Now, a key driver of this rally has been the aluminium-related stocks. They saw a sharp rebound with the rebound that we have seen in alumina prices. That's because reports suggest that Guinea is considering cancelling Emirates Global Aluminium's mining license. Why is this important? EGA exported close to around 10.8 million tons of bauxite in 2024, which could have supported roughly around 3.5 million tons of alumina production. Now, this potential disruption, that's raised fears of a near-term alumina shortage, which has prompted pre-buying and some speculative positioning. Because of that, alumina prices have surged up more than 10% from the lows that we saw in April. And Nalco is a stock that stands to benefit the most. It derives a good portion of its earnings from alumina sales, which in the near term will benefit its margins and its profitability as well. So explains why some of these metal stocks this week itself have been big outperformers. Well, staying with the commodity pack though, but let's talk about the precious metals. Gold and silver, they're seeing some profit taking, a shift away from the safe haven buying that we've seen as the trade tensions between US and China diminish. Manisha Gupta joins in to fill us in with all of those details. Manisha.
Well, thank you so much for that. Yes, there's some profit taking finally coming in case of precious metals. And as you rightly said, the safe haven is getting off. It's the risk on that's coming back. And a much awaited due profit taking finally coming in for this space. Well, let me remind you that the gold price has started to gain from $1,800 per ounce. And from there up to $3,500 an ounce. There were very minor corrections coming in. So a major correction is something that the markets are waiting for. We haven't seen that yet because from where we stand at $3,500 per ounce of an all-time high, that is when the whole tariff situation was emerging. To the China and US trade agreement, a temporary one though, we have seen some easing of concerns, not just come in here, but also in sense of India, Pakistan, US also saying that they are waiving off sanctions on Syria. The US also saying that they are progressing in conversation when it comes to trade agreements with other countries like India and Japan and South Korea. Seems to be really soothing some nerves here. And then apart from that, the US inflation data also was slightly on the weaker side. That also has led to some decline coming in for gold. When you look at the latest CFTC reports and the ETF redemption numbers, that also tells you that the investors also seem to be taking some profit, also weighing in case of gold prices. So from its all-time highs, we have seen the gold prices come off by 10%. The 5% decline has come in the previous week itself. We're just about holding that $3,150 an ounce of a level, with markets anticipating that since every news is now factored in, you could be looking at $30,050, even $3,000 an ounce on the lower side in this current correction itself. Same is the case with silver also. We've seen 2% of a decline in the overnight markets. And with that, silver prices are now trading below $32 an ounce. It's a one-month lows as well coming in for silver.
Thank you very much for that. Talking about gold and silver, let's talk about Muthoot Finance. Now, shares were under pressure. Stock price down nearly 7% after a tepid AUM growth guidance of just 15% and perhaps a fall in gold prices. Speaking to CNBC-TV18, George Alexander, MD of the company, said the fall in gold prices is unlikely to directly impact the business, while the gold spread may have remained stable over the past 4 to 5 quarters.
There are always fluctuations in gold prices. Maybe goes up, goes down. But over the last years, it has always been going up only. But of course, in the last 6 to 7 months, it has gone up too high. Probably it may cool down a bit. But of course, we give only 75% of the current value. And that also is a 30-day moving average. So today, if you look, our gold loans advance which are given, it's only 62% of today's price. If you look at the value of the gold we have with us and today's gold price, it's only 62%. So that is the margin or the headroom we have. So some corrections in the gold loan will not be affecting us. We have been maintaining our spread. NIM should be about 11%. Spread should be in the 9.5%. I think in the last 4 or 5 quarters, our spread has always been 9.15. And we actually maintain it. If the cost of funding goes up, we try to absorb it for 1 quarter or so. Afterwards, it's still going up. We increase our yield, but we maintain our spread. The same thing if the cost of fund. Today, the cost of funds is coming down a little. So it will take for a few months for it to maybe stabilize. If it is really coming down, we will reduce our yield, but maintaining our spread. So if there is an advantage in the borrowing cost, we pass it on to our customer. That is what our NIM and spread, etc., have been almost constant in the last several quarters.
Okay, all right. Let's come across to you, Ruchit. Muthoot Finance, the problem actually was that the stock on a valuation parameter, it's trading at around 2.8 times its core book value. History suggests it normally trades around 2.3 to around 2.4 times. In addition to that, the guidance seems a little bit tepid, and that's why we're seeing some profit taking. On the charts, though, what's it looking like? Because I recall it breached the 2000 mark, but it rebounded very, very swiftly. At 2100, what levels are you tracking?
Nigel, I think the correction in the stock has already started from the start of April itself, where we witnessed a sell-off from 2400 to 2000 in the first week of April with very high volumes. Then some pullback move was there towards 2300, 2320, but the volumes were quite missing in the pullback move. So when the stock price is going down, volumes are high. When the pullback move is there, the volumes are low. So I think these are not good signs. The 200 DMA support is around that 2,000-2,100 mark, but no, we believe that the relative underperformance would be seen in this stock now, compared to many other NBFC names. So I think it's a good time to switch from Muthoot Finance to some other NBFCs, where the returns could be much better.
Thank you, gentlemen, for joining in. We will slip into a very short break on that note. On the other side, we'll come back and get you the corporate conversations that we had through the day and the big events to watch tomorrow.
Welcome back. You're tuned in to Markets Forward here on CNBC-TV18. As promised, let's get you all the key corporate voices that joined us during the course of the day. First up, Shree Cement. Reported actually a good set of numbers in the fourth quarter. The company has guided for an 8% volume growth in FY26 with commitment to scale up capacity to around 80 million tons organically by FY28. Shree Cement's focus continues to remain on profitability over volume expansion.
Hitachi Energy is targeting double-digit margins in FY26 with a strong focus on increasing the share of services and exports as a percentage of its revenues. The company's order book stands at 29 to 30,000 crore rupees, bolstered by a second HVDC order win in April.
And Tilaknagar Industries reported a solid set of numbers in the fourth quarter. For FY26, the company is guiding for high teens revenue growth with margins in the range of 15.5% to around 17%. However, the brandy contribution is expected to drop to around 80% by 2030 from around 91% in the past year.
And finally, Tata Power reported a good set of Q4 numbers. The management said that they had planned for a capex of 20,000 crore rupees in FY25, but managed to achieve only 16,200 on account of some project delays due to evacuation line issues. The renewable energy business is now delivering strong results. The PAT was up 47% on a year-on-year basis, and a similar trend in PAT, growth PAT, is seen even in FY26.
All right, well, before we wrap up, let's hop across to Manglam. He's put together an interesting list of all the key events we need to track. Manglam, over to you.
Well, important results to track tomorrow. We have from the auto pack, we have Hyundai Motors, then we have BHEL, Delivery, Imami, all of them reporting their fourth quarter numbers, but that's stock specific. Also keep an eye out on Donald Trump. Why is that? Because tomorrow his, trip to the Middle East, Saudi Arabia, Qatar, UAE concludes. We'll watch out for any statements coming in from there itself. Today, the US markets will be reacting to a slew of data, and as a result of which, we will have the Indian markets reacting to that as well. Producer price index, there's the retail sales, industrial production, and weekly jobless claims coming in too. And thereafter, just before we start trade tomorrow, we will have some macro data coming from Japan. The Japanese first quarter GDP and industrial output would be revealed tomorrow. That may have a bearing on how the Asian markets pan out, and in turn, the Indian markets, which actually will have a lot more result-related focus in tomorrow's session.
Thank you very much for that. And that brings us to a close in this edition of Markets Forward. Thank you for watching. We'll be back with more news and updates.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening.
I said, Tim, look, we've treated you really good. We put up with all the plants that you built in China for years. Now you got to build us. We're not interested in you building in India. India can take care of themselves. They're doing very well.
President Trump says he's told Apple CEO Tim Cook that his administration is not interested in Apple building in India. Also hints that a trade deal with India may be close. Claims that India has offered America a deal with zero tariffs. Donald Trump bags mega deals in Doha, announces that Qatar Airways has signed a record $200 billion deal with Boeing to buy up to 210 wide-body airplanes. Reliance Chairman Mukesh Ambani meets President Trump at the Emir State dinner. Defence Minister Rajnath Singh meets Indian Army personnel in Srinagar, calls for global intervention to supervise Pakistan's nuclear arsenal. The International Atomic Energy Agency tells the Indian Express there has been no radiation leak or release from any nuclear facility in Pakistan. Strong buying in heavyweights and President Trump's hint at a possible trade deal help Indian equities rise to a 7-month high. The Nifty regains 25,000 for the first time since October of 2024. Gold prices continue to fall as trade tensions between US and China cool. The yellow metal drops to a 5-week low in India. Telecom major Vodafone Idea files a fresh plea in the Supreme Court, seeks relief on AGR dues worth 30,000 crores, comprising mainly penalties and interest, argues that the government is handicapped in granting further relief due to constraints imposed by the Apex Court's judgment. President Murmu seeks the Supreme Court's opinion on 14 key legal questions concerning the roles and powers of the president and governors, asked if the court has the constitutional powers to impose timelines for granting assent to bills. Ukrainian President Zelensky lands in Turkey to hold the first direct talks with Russia in 3 years, but President Putin skips the meet. Reports suggest Zelensky may also leave talks up to a delegation. Gaza officials claim over 57 Palestinians, including women and children, have been killed in a barrage of strikes on residential areas by Israel overnight. Reports of Israel planning strikes in the West Bank add to tensions as Palestine marks 77 years of mass expulsion by Israel. US President Trump says he believes the US should take Gaza and turn it into a freedom zone. The Supreme Court reprimands Madhya Pradesh Minister Vijay Shah for his comments on Colonel Sophia Qureshi. Says a person holding a constitutional office should be responsible. Refuses to intervene on a plea by the minister to stay the MP High Court's order that a criminal case be filed against him, but lists the matter for Friday. Well, the top story this evening, the US President Donald Trump has said that he has told Apple CEO Tim Cook that he's not interested in the company building in India. Trump's remarks came while he was addressing the Gulf Cooperation Council leaders meeting in Doha. Now, President Trump is in Qatar for the second leg of his West Asia visit. Trump said that he told Cook that India can take care of themselves. Remember, Apple in February had announced that it would invest $500 billion in the United States over the next 4 years. Now, speaking at the same event, Trump said that India has offered the US a trade deal with basically, and I quote him, no tariffs. Take a look at what President Trump had to say.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India, because India is the highest, one of the highest tariff nations in the world. It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff. I said, Tim, look, we've treated you really good. We put up with all the plants that you built in China for years. Now you got to build us. We're not interested in you building in India. India can take care of themselves. They're doing very well. You couldn't do business in India. We're not even a top 30 in India because the tariff is so high, to a point where they have actually told us, I assume you too, Scott, you were working on that also, that there will be no tariff, right? Would you say that's a difference? They're the highest, and now they're saying no tariff.
Well, that's President Trump there saying he made it clear to Tim Cook, Apple CEO, that he's not interested in Apple building more in India. Hormuz joins us now to make sense of President Trump's statement. Hormuz, let's look at this in the context of where things currently stand. Let's highlight for our viewers
how Apple has been steadily, incrementally increasing its Make in India, and perhaps what could be the cause or the trigger for this statement from President Trump could have its roots in the earnings call where Tim Cook spoke about Make in India.
You know, more than what Donald Trump says, the bigger context is to actually try and interpret what he means when he says something. And this is something what he said earlier in the day as well, when he mentioned that he had spoken to Apple CEO Tim Cook and said that he's not interested in Apple manufacturing in India. If he does want to manufacture to take care of India, he can do so. India can take care of itself. But of course, that is subject to interpretation as to what he actually meant when he made that statement. Of course, it also comes in at a very important time, because Tim Cook just a couple of weeks earlier during Apple's earnings call had mentioned that majority of the iPhones, which is the flagship product of Apple, which gets sold in the US market in the ongoing quarter, will have India as its country of origin. Of course, he did not specify a number, nor did he put a target to it for the end of the year as well. But he did mention that majority of those iPhones that are sold in the US in the ongoing quarter will be manufactured in India. Of course, this also needs to be put in context, because when he made those statements, US and China were still at loggerheads with regards to their tariffs. The settlement or a temporary truce was only reached a couple of days earlier. So now what will Apple's strategy be now that the tariffs have come down on both products from US and from China? It remains to be seen, because Apple has not put out an official statement on that regard. And Apple earlier, just a couple of months earlier as well, in February this year, had announced a $500 billion investment in the US over the next 4 years. They plan on expanding their manufacturing facilities at multiple locations. They also plan to put up a new facility in Texas, accelerate investments in AI, and also establish an academy for silicon engineering. So lots of plans that Apple already has for the US market. Now, when it comes to India, Apple does not work directly with any listed entity, although Motherson Group, not Samvardhana Motherson, but Motherson Group had joined Apple's supply chain back in August of 2024, and a lot of other unlisted entities is what Apple works with. Now, PL Capital last month had told us at the height of the tariff war that in case Apple does increase its production in India, Dixon Technologies could be a potential beneficiary, but Dixon was just in talks with Apple and it does not have any specific exposure to Apple per se. So as of now, things remain fluid. It remains to be seen what Apple does going forward and what would be their strategy now that a lot of things have changed over the last 2 weeks.
Well, Hormuz, many thanks for joining us. And as Hormuz was pointing out, Apple has increased its production from India and its production from India for the US. Now, in that comment that came in there from President Trump, he seemed to be indicating that Make in India for India is fine, but perhaps Make in India for the US will not pass muster. But we will have to wait to see. Now, government sources have told CNBC-TV18 that Apple has assured the Indian government that it proposes to continue to have India as a major manufacturing base for its products, adding that there is no change in Apple's investment plans in India. Donald Trump is currently in the middle of the first official West Asia visit of his second presidency, and he's bagging major investment commitments. Qatar Airways has signed an agreement to purchase up to 210 Boeing jets. This includes an option of an additional 50 aircraft. The deal, worth $200 billion, was signed in President Trump's presence. The deal will be the largest wide-body aircraft order in Boeing's history. This is also Qatar Airways' largest order. The Doha-based airline has signed an agreement with GE Aerospace for more than 400 engines to power Boeing planes. The deal between Boeing and Qatar Airways is one of the biggest highlights of the president's visit to Doha. He also signed agreements with the Qatari Emir that would generate an economic exchange of at least $1.2 trillion. Meanwhile, Mukesh Ambani, the chairman and managing director of Reliance Industries, met President Trump at a state dinner. This is the second public meeting between Mukesh Ambani and President Trump after the U.S. presidential inauguration in January this year. President Trump is now expected to head to the UAE as part of this tour. His visit comes at a time when the region is witnessing a war in Gaza. CNBC's Dan Murphy has more details on what's on President Trump's agenda in Abu Dhabi. Dan.
So much of the conversation around the president's visit has really been on the transaction volume and the momentum that we're seeing in the technology space, in artificial intelligence, in energy, in advanced manufacturing. But there hasn't been so much of a focus on what's happening in the region itself, including the war that continues to rage on in Gaza and those Iran talks that are also happening in the background. These are critical issues for leaders in this part of the world. So as he arrives in the UAE, we can expect to see perhaps more news flow and maybe even more talks about how those critical issues can be addressed. Trump also weighing in on the Iran nuclear negotiations while he was in Qatar, calling on his Qatari counterpart, the Qatari Emir, to do more to assist in getting those talks to some kind of conclusion. Listen in.
I want them to succeed. I want them to end up being a great country, frankly, but they can't have a nuclear weapon. That's the only thing. It's very simple. It's not like I have to give you 30 pages worth of details. There's only one sentence: they can't have a nuclear weapon. And I think we're getting close to maybe doing a deal without having to do this. There's two steps. There's a very, very nice step, and there's a violent step. The violence like people haven't seen before. And I hope we're not going to have to do this. I don't want to do the second step. Some people do. Many people do. I don't want to do that step. So we'll see what happens. But we're in very serious negotiations with Iran for long-term peace. And if we do that, it'll be fantastic.
Well, President Trump there talking about doing a deal even with Iran. Back home, Defence Minister Rajnath Singh made his first visit to Srinagar since Operation Sindoor and reviewed the security in Jammu and Kashmir. He questioned whether it was safe for Pakistan to have nuclear weapons. He's called for global intervention to supervise Pakistan's nuclear arsenal. Singh also met Indian Army soldiers in Srinagar and paid his respects to those who died in the line of duty during the operation. The International Atomic Energy Agency told the Indian Express that there has been no radiation leak or release from any nuclear facility in Pakistan. This comes days after the Indian Air Force denied hitting Kirana Hills or any nuclear installation in Pakistan. Reports suggest that Pakistan's Water Resources Ministry has reached out to India to discuss the terms of the Indus Waters Treaty that has been kept in abeyance. External Affairs Minister S. Jaishankar said the treaty will remain in abeyance.
दुनिया जानती है हमारी सेनाओं का निशाना अचूक है और वो जब वो निशाना लगाते हैं तो गिनती करने का काम वह दुश्मनों पर छोड़ देते हैं। साथियों, आज आतंकवाद के खिलाफ भारत की प्रतिज्ञा कितनी कठोर है इसका पता इसी बात से चलता है कि हमने उनके न्यूक्लियर ब्लैकमेल की भी परवाह नहीं की है। पूरी दुनिया ने देखा है कि कैसे गैर जिम्मेदाराना तरीके से पाकिस्तान द्वारा भारत को अनेक बार एटमी धमकियां दी गई हैं। आज श्रीनगर की धरती से मैं पूरी दुनिया के सामने यह सवाल उठाना चाहता हूं कि क्या ऐसे गैर जिम्मेदार और रोग नेशन के हाथों में परमाणु हथियार सुरक्षित हैं?
Got a lot of international support. Many ministers, many leaders called up PM, many ministers called me up. We had a Security Council resolution which very clearly said that the perpetrators of the attack should be held accountable. Water issues have been raised. Again, you all know, and I re-emphasize, the Cabinet Committee on Security and the government, obviously, was very clear that the Indus Waters Treaty is held in abeyance and will be continued to be held in abeyance until cross-border terrorism by Pakistan is credibly and irrevocably stopped.
Well, that's the External Affairs Minister. Meanwhile, 3 terrorists have been killed in an encounter in Jammu and Kashmir's Tral region. Officials say the security forces launched search operations in the region after getting specific input about the presence of terrorists. The operation was underway with forces maintaining a cordon around the region. Ishan Bani joins us now from Tral. Ishan, take us through what transpired.
The anti-terror operation which was launched in South Kashmir's Tral has concluded with the elimination of 3 militants in an operation which lasted for more than 5 hours. It's a major success for the security forces considering the fact that they were from Jaish-e-Mohammed, and apart from them, what we have been given to understand is that in the last 3 days there have been 6 total of number of militants who have been killed in 2 different operations in Shopia and Tral. It's a major success given the fact that there's a lot of pressure on the security agencies to carry out operations in Kashmir, and all of them are believed to be locals and are from Jaish-e-Mohammed. Though the Inspector General of Police Kashmir Range VK Birdi said that they cannot comment if they have a direct link with the Pahalgam attack. But since they're from Jaish-e-Mohammed, so there's a possibility they might not be directly affiliated to the organization called Lashkar-e-Taiba or the TRF, which has carried out attack in Pahalgam. But the operation is very much on. The searches are going on, though the operation has concluded officially. It might take some time for the forces to carry out their identification because now their process will start to identify them and also check their digital gadgets and also try to see that if they're able to figure out whether they were directly connected to Pahalgam attack or not. But the operation is still going on. However, 3 have been killed and all of them have been neutralized and their bodies have been spotted through drone. Now sources are trying to tell us that there is a clearance operation that's going on around the house where the encounter took place. With Bashir Lone in Tral Shanmani for CNBC-TV18.
Ishan, thanks very much. On to the day's market action. The market hitting its highest level in 7 months, largely led by strong intraday buying. The Nifty crossed the 25,000 mark, closing 400 points higher. The Sensex 1,200 points higher. That is what we saw. The Nifty Bank was up by about 550 points and a 400-point mark up there on the Nifty mid-cap. So momentum across the board. Surbi joins us now to sum up the day's market action. Strong close, Surbi.
Well, what a powerful move. The second half turned out to be absolutely different for the market compared to the first half. We started slow, but then the momentum started building. And by the end of it, the Nifty was up almost 400 points. We're talking about a 1.5% move on that index. And India outclassed all major markets around the world today. The Asian region saw lots of profit taking. The Japanese market was down. Hang Seng and Shanghai, those markets were also on the lower side. Europe was either flat or slightly negative while we were trading. So this was a bit of an outlier move that came in. And it was basically a large cap move. Today was also Thursday. So there is that phenomena of the expiry playing out, and that perhaps added to the fact that they were short covering. We'll get to see the FII positioning as well by the end of it, but a solid move from the large cap space. Mid caps did relatively underperform, but it wasn't a bad looking mid cap screen either. And I'll come to the specific names in just a bit. The advance decline ratio was also positive, more than 2 stocks advancing for every one that was declining. So not too bad. What led the rally? Once again, defense. That index up now over 10% for this week. The other sectors included, gainers from the realty space. Autos were really revved up. Metals was strong. But basically, all pockets of the market, every single sectoral index was in positive territory. That was the extent of the breadth of this increase that we're talking about. Let's talk about the gainers then. Hero Moto, JSW Steel, a couple of consumer names like Trent, Eternal, Tata Consumers, all up and about on the Nifty. Tata Motors, Bajaj Auto, Maruti, M&M's, the entire auto pack, like I said, was revved up as well. HCL Tech, etc. Then there were the big boys that came in and they were getting counted quite nicely. Reliance, ICICI Bank, L&T, Infosys, all of them adding to the Nifty's tally. In fact, there was hardly any stock on the Nifty that was negative. Just a minor red tinge on IndusInd Bank as we were winding up trade. The mid-cap movers, lots of names here. Apar Industries rising up in double digits. KC International announcing order wins. The stock was up in about. E-Clerks on results again. ITD Cementation was up in double digits yesterday. Today it put on another 7-8%. Astra Micro, as I said, the defense story is still running very strong. Kajaria Ceramics, Tilaknagar Industries on a solid fourth quarter performance. The list is pretty much endless. Now the Nifty is just about 4.5% away from the all-time high. It's been a spectacular comeback, especially by the large cap side of the market. Tomorrow is Friday. We'll come back and we'll also analyze a couple of the important data points from the US. So it's industrial production, retail sales, and the producer price inflation number from the US for April. That will set the stage as we come back to trade on Friday morning.
Yes, Surbi, many thanks for joining us. And on to the energy markets where oil prices continue to fall today. This on hopes of US easing sanctions on Iran after President Trump said the two nations are closer to finalizing a nuclear deal. Investor concerns about oversupply on account of a rise in US crude oil inventories last week also continued to weigh on prices. Meanwhile, gold prices have softened. The yellow metals prices are now at a 5-week low as rising trade optimism has boosted risk appetite. Now, SEBI is set to be probing disclosures made by Yes Bank in connection with its ongoing share sale to Japanese lender Sumitomo Mitsui. According to a money control report, the market regulator is probing Yes Bank's disclosure, denying reports on a possible deal with SMBC on the 6th of May, although the transaction was close to a completion. Remember, SEBI's market rumor verification rules mandate true disclosure of ongoing deals. Amazon has laid off about 100 employees from its devices and services division. The company said the cuts were part of efforts to streamline operations. Amazon has not specified which teams were affected, but said it continues to hire for the division. The move follows cost-cutting efforts under CEO Andy Jassy, with 27,000 job cuts since 2022. Now, telecom major Vodafone Idea has filed a fresh plea in the Supreme Court seeking additional relief from its AGR dues. The company is seeking a waiver of over 30,000 crore rupees in dues. This includes the penalty and interest on the penalty component of the AGR levy. Ashmit is standing by. Ashmit, Vodafone Idea once again moving the Supreme Court to take us through what it's asking for.
Well, a fresh roll of the dice for Vodafone Idea, making a fresh pitch for seeking further relief on the AGR front, seeking relief north of 30,000 crore rupees. Now, we understand that Vodafone Idea has filed a fresh application before the Apex Court. This is after their curative petition had been rejected. This is a fresh application, and in this, they've basically cited stress in the sector. They've cited stress on their own balance sheet, saying that if relief is not granted, it will lead to the collapse of the sector. There are only 3 private players, Vodafone Idea being one of them, that without government relief, they will collapse, and therefore, as a result, the sector will also get impacted. What they're basically arguing is that as a part of the AGR burden, they were slapped with a penalty as well as an interest on penalty component. Both these components, Vodafone Idea estimates, is north of 30,000 crore rupees. This is the relief that they're seeking here before the Apex Court of the country. What they argue is that the AGR judgment handicaps the government. That's the language used, handicaps the government from granting any further relief. And now that the government is a partner, Vodafone Idea argues that the government should consider granting this relief. Bear in mind that the reason they're citing the government as a partner is because the government just previous month in April, had converted dues of nearly 37,000 crore rupees into equity, which took the government shareholding to 49%. So here today, their counsels arguing that the government as a partner should allow them that relief, and to that end, seeking urgent hearing. This case, we understand, is likely to be taken up next week.
Ashmit, thanks very much. Up next, Ukrainian President Zelensky lands in Turkey to hold the first direct talks with Russia in 3 years. But President Putin skips the meeting. That and more when we return. You're watching Business 360. The Supreme Court has reprimanded Madhya Pradesh Minister Vijay Shah for his comments on Colonel Sophia Qureshi. The court said that a person holding a constitutional office should be responsible. The top court refused to intervene on a plea by the minister to stay the MP High Court's order that a criminal case be filed against him. However, the matter will be heard on Friday. President Murmu has sought the Supreme Court's opinion on whether the top court can impose timelines on constitutional authorities to clear bills passed by the legislature. The move follows a recent Supreme Court judgment which directed that a decision on reserved bills be taken within 3 months. The presidential reference poses 14 questions seeking clarity on the constitutional options before a governor when a bill is presented to him or her. In international news, Israeli forces continue to deepen the offensive into Gaza, even as ceasefire talks carry on. Israeli Prime Minister Netanyahu has said that there is no way Israel will halt the war in Gaza until Hamas is defeated. This statement comes after forces bombed 2 hospitals in the enclave yesterday, killing dozens.
Israeli military strikes killed dozens of Palestinians across the Gaza Strip on Wednesday. That's according to local health authorities. It's a significant intensification of the bombardment in Gaza, while US President Donald Trump continued his visit to the Middle East. Medics said most of those dead were killed in Israeli airstrikes targeting houses in Jabalia, an area in northern Gaza. The Israeli military had no immediate comment and said it was trying to verify the reports. Hadi Mokbel, whose relatives were killed in the strikes, said the military fired 2 rockets, killing children, a woman and a baby. Itimad al-Najjar was also in the area when the strikes hit.
We were sleeping peacefully when the oppressors hit them. They hit them and hit the whole region we're in. 14 martyrs inside the house. People are still under the rubble. Have mercy on us. Enough blood, enough martyrs, enough worries. Stop the war on us. Stop the blood.
She added that, quote, nobody is left in Gaza anymore. In strikes the day before, security officials said they believed Hamas military leader Mohammed Sinwar had been killed. That's according to Israeli press reports. Israel's intensified bombardment comes amid Palestinian hopes that Trump's visit to the region will provide pressure for a reduction of violence. And Hamas on Monday released Eden Alexander, the last known living American hostage. Trump's envoys have said they now see a better chance for a new release deal for the remaining hostages. The US has also presented a plan to reopen humanitarian aid deliveries in Gaza using private contractors. Israel has blockaded all supplies going into Gaza since March the 2nd.
And President Putin will not attend the peace talks with Ukraine and Turkey. Russia's delegation, led by Putin's aide Vladimir Medinsky, has arrived in Istanbul. Ukrainian President Zelensky has criticized Putin for his absence, calling Moscow's delegation a theater prop. Sylvia Amaro here with more. Sylvia, Russia being represented there, but no Putin, and Zelensky very much there.
Russian President Vladimir Putin will not attend peace talks in Istanbul today, instead sending a delegation on his behalf. The Ukrainian President Volodymyr Zelensky had said that he will not attend if Putin refused. After the Kremlin's announcement, U.S. President Donald Trump said he will not be joining the talks, just days after hinting that he might. The EU has agreed to a fresh slate of sanctions against Russia, its 17th package since the war against Ukraine began. The agreement targets chemicals used to make weapons, more Shadow Fleet ships, and bans companies from doing business with Russia via third parties, while also targeting individuals with visa bans and asset freezes. The German Chancellor Friedrich Merz has urged the West to be united on Ukraine ahead of peace talks later today. In his first major speech to Parliament since taking office, Merz said he's working hard to ensure the US and Europe do not accept a dictated peace and do not submit to Russia's status quo. He also vowed to make Germany's army the strongest in Europe. This as NATO foreign affairs ministers are set to meet in the Turkish city of Antalya today for an informal gathering. Ukraine's foreign minister has already met with the U.S. Secretary of State, Marco Rubio, to, quote, coordinate positions during this critical week.
And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. This week, we are going to put the spotlight on investing in global equity markets via global funds, or you can call them international funds. Now, mind you, these are funds that are being run by Indian asset managers. So why do you need to look at these funds in the first place for your portfolio? What is their taxation structure? And what funds could perhaps be suitable for investors given the risk appetite and the risk-taking ability? Well, this is what we talk about, and to help us demystify this world of international investing, we have with us Nasir Salim of Flexi Capital and Niranjan Avasthi of Edelweiss Mutual Fund. Gentlemen, great to have both of you on the show. Thank you so much for joining in. And I thought perhaps it's an apt time, right? Because I don't think we've seen so much of volatility in the Indian market, in the international market. The headlines are changing by the minute. And you realize that perhaps for an involved investor, it might make sense to have some exposure to shores that go beyond India as well. So let's get your opening thoughts. And Niranjan, you folks at Edelweiss have so many of these global funds, from China to US tech to I think even Europe, right?
Yeah.
Why should one go global?
Yeah. First of all, thanks, Surabhi, for having me. Broadly, over the last 2-3 years, we have seen huge traction for investing globally. And especially in last 1 or 2 years, when we have seen global markets, Indian markets going through volatile times, it is very, very important to study this category and take exposure. 2-3 reasons, One, if you see last 10 years, India has been amongst the top 3 performing markets maybe 3 to 4 times. US has been there 6 times and China has been 2 times. Now, if you want these winning markets to be in your portfolio, you need to invest beyond India. And if you have them, it's basically easier to navigate, cycles in the market. The second is, if you see India as a market cap, contributes maybe 3 to 4% in the MSCI World Index. It's broadly 3-4%. US, on the other hand, is roughly around 65 to 70%. China is around 14-18%. Now, if you look at a portfolio, you can't ignore a large cap in your portfolio, right? From a market perspective, these are large cap names, or these are large cap nations out there which you need to have in your portfolio. Second, if you see the top 100 market cap companies in the world, 50 plus are from US. Only 2 are from India, and maybe 16 are from China. Now, again, you can't ignore these, heavyweights, big global companies. And for all these, you need to invest globally. Last, but very important, you need to build some dollar assets. If you see our INR against dollar over the last 30 years, it has depreciated every year by 3 to 4%. In last 10 years, US S&P 500, if you see, has given somewhere around 12.75% returns, whereas in INR terms, it has given 16%. So 3.25% return just adding up just because of INR depreciation. So these 3 are very, very important reason why you should have some exposure to global.
Oh, I can't argue against any of those 3 points. They seem perfectly logical, actually. Let me ask Nasir as well. Nasir, your thoughts. And the thing is that now that everybody has access to information, typically it ends up being a bit of fad investing. When the NASDAQ is going up, you see people want to invest in NASDAQ and they want to invest in NVIDIA. When suddenly there is a boom in China or some stimulus in China, everybody starts talking about China. But there has to be better reason and scientific logic behind looking at global funds, right? What would you say?
Good morning. Thank you once again for having me back on your show, Surabhi. Always a pleasure. So, great question again there. I think, there are multiple reasons why global funds need to be part of your portfolio. And I think it stems from the very fact that, the decision starting from the basics of core and satellite, I think that is something which, is one of the main constructs and the reasons for one holding global funds. But I think broadly 4 broad reasons, So number 1 is geographical diversification. I think, lowers dependency on India-specific macro cycles, politics and weather-linked risks. So that's one major reason. The other one is access to sectors absent in India. For example, very thin that are only available in India. World-class tech platforms, you've seen FANGs of the world, semiconductor majors, global healthcare, innovators, luxury brands would be, some of these are not available in India to Indian investors. Third, I think, one of the very important factors, while, index and indices keep changing, I think currency hedge is a very, very important factor which needs to be kind of factored in. The INR has depreciated over 3 to 4% per annum versus the USD. over the last decade or so. Foreign assets priced in USD act as a natural hedge survey for long-term rupee obligations, such as overseas education for children, for example. Then there is the entire valuation and cycle, which you just mentioned. US-China bear phases often coincide with rich valuations at home. And owning both of those markets kind of smooth the ride. And our view is that, for example, the 2025 market note recommends that one should, in current times when we spoke about, at least 10 to 15% allocation should be to international funds for precisely these main reasons.
Oh, okay. So 10 to 15% allocation, that's fairly sizable that Nasir is talking about. But Niranjan, let me ask you the same question. We want to do this scientifically for long-term wealth creation, right? In and out, timing the market, knowing that, okay, China is bouncing in the next 3 months, China will do better than India, and then buying a fund, getting out of it. That I think requires some next level rocket science, market predicting ability.
Yeah.
Now, we don't want to talk about that because not everybody might have that.
True.
Then how can you benefit? And over longer periods, what is the kind of wealth generation that these international funds have given investors?
Right. So broadly, it should be satellite portion of your portfolio, but this satellite portion also needs to be invested in a strategic way, right? Now, Nasir mentioned that 5 to 10% or maybe 10 to 20%, depending on which way you are looking at your portfolio.
Yeah.
For most beginners, maybe 5 to 10% is a good starter to get into these funds.
Okay.
Strategically, if you want to invest structurally, what you need to see is 3 things. One is go for countries which complements India, which are large. Like US definitely is one country where you cannot ignore to have in your portfolio. It's growing. Most innovative companies are coming from US. The market size is huge. That is one. Second is also look for a region, if at all, which again has maybe lower correlation with India.
Okay.
Again, US comes up first because it has probably 0.3, 0.25 correlation with Indian markets, which means when Indian markets aren't doing well, probably US markets along with currency depreciation will add to your portfolios and improve your risk adjusted returns. So strategically select these kind of countries. Go for plain vanilla index funds or diversified funds in these countries and go for maybe SIP and long-term allocation. There are people who want to do it tactically, as you mentioned, forget about US or China. Even in India, it's very difficult to tactically get in and get out.
Yeah.
But if you still want to do it, maybe spot a market which is trading at lower valuation, take that contrarian bet. Maybe China, for instance, last year we gave that call. China was trading at less than 10 forward P.
Yep.
From there, it's up almost 30-40%.
Yeah.
Even today, amongst the top countries or top markets, China is still very cheap. It's below their long-term average in terms of forward P. So China kind of market can be a contrarian market. But again, it's very, very difficult. As you mentioned, you need to time it well. So for most investors, go for a strategic allocation, select a country like US or even maybe China for long-term allocation. These are 2 superpowers we already have. Go for SIP, simple 5 to 10% allocation. I think so you should be done.
Since we're on the subject, Nasir, I have to ask you as well. Let's talk about China and US, these 2 big markets, right? If someone has to make fresh exposure to international funds, would you look at international funds that are investing onwards into China right now and the US?
Absolutely. So, with specific question to your US and China, see, as far as US is concerned, US indices have rallied since the tariff war has gradually eased off, right, which we're currently in the middle of it. NASDAQ 6.13, S&P 500 4.9% are close to all-time high levels. Negative 6.13 and negative 4.9%. Staggered approach to a US equity is currently a more prudent strategy. I completely agree. An SIP or an STP does warrant at this kind of point of time. A strong positive is the US-China trade war de-escalating. So it's a very, very strong positive for both US. And as far as China is concerned, we have some very interesting themes which you usually don't get to capture otherwise. So there is energy transition, there's frontier China, but active alpha still exists. And this entire lithium space, survey, I think, opportunities there if you have enough active fund of funds or some index, where we can index funds or passive routes which are available currently, those both can be explored between US and China. Our view, of course, is that currently, until things don't get more clear in terms of, the tariff war, which is kind of starting to de-escalate, Until then, we should still feel that there's a lot of opportunity in market neutral options available, which we can talk about as we go along.
Okay, fair enough. So let's now talk about the other aspect of this. In the Indian market, when you have decided that you want to invest in international funds, you have to then make the next choice. An active fund, one that's actively managed, where a human being is deciding what stocks will go in that fund, or a passive fund, which will only track an index. It could be any underlying index, like the S&P 500, like the NASDAQ, or many others. Nasir, I know you've done a lot of homework on sort of looking at the buckets and what is available in the market. So tell us, how many funds are there? How many are active? How many are passive? Where are the AUMs greater?
Okay, so before we get into that, so I think currently in the active space, between active and all the international funds that are available right now, we have 66. That's the last count that I have, and out of those, again, we need to check which ones are open currently for subscription for investors. I believe the Edelweiss are all open and available at the moment. But broadly, to answer your question on active versus passive, see, a passive fund basically tracks the index, or it's an FOF into an ETF. FOF is a fund of fund which is investing underlying into ETFs, and those basically track the S&P 500, for example, the Nasdaq 100 or the MSCI China, or other such indices. And 38 of the 66 of these international schemes are currently, which is about 57%, are passive, right? Those are US and China focused, and typically a broad market for holding low cost, no manager risk in a typical passive fund. Now, if you come down to the active fund of funds, we have roughly 28 schemes, about 43% of these, where usually Indian fund by units often oversees the active fund. For example, JPM Global Equity Schroders is another example, the Global Innovation Fund, which tracks that particular fund. And most of these, again, they capture niche themes, which are not available in India to investors. And that's where we feel there are a lot of active alpha can still be generated on portfolios. So that's broadly it. Amongst the ones which are, by and large open, we have a fairly large list between passive and active. In passive, we have the Mirai Asset, FANG, which is available. It's an ETF plus FOF. We have something on the passive side again, Motilal Oswal S&P 500, which is available. We have the ICICI Prudential Nasdaq 100 Index. In the active space, we have Investco, India Investco Global Consumer Trends, which is doing very, it's active and it's open at the moment. As I said to you, Edelweiss Europe Dynamic Equity Offshore Fund is there. Edelweiss US Tech Equity Fund of Fund is there. And then on the fixed income side, because that's again something which one can't ignore completely, we have DSP US Treasury, which is a fund of fund, and something which comes in from the Aditya Birla Sun Life Group as well, which is the US Treasury 3 to 10 year bond ETF fund of fund. So again, some of these between active, equity, passive equity, and then fixed income.
Okay, so lots of choices out there. But on the active-passive bit, Niranjan, I think this could be confounding for investors, right? You have, like Nasir said, you have 66 funds. Many are active, many are passive. So what should the approach be? I mean, because you're ultimately trusting maybe a foreign, not even an Indian fund manager, right. A foreign fund manager, probably don't know if, what is the underlying portfolio. So is it safer to just, dovetail on an index? Or should you look at some active management as well?
So I think so. Like in India, we also say midway is a better approach. Over here also, specifically if you're investing in US, probably a mix of active and passive makes sense. Go for a FOF active fund, underlying active fund, which has a long track record. Like we have tie-up with JP Morgan. These funds have been in India for almost 10 years or even more than that, 15 years. Look for an active fund, FOF. Passive, you can definitely go for passive, but specifically if you're going for an ETF and buying it in India, it is very, very important to see whether the ETF is trading at a discount or at a premium. What has happened over the last couple of months, or in fact a year, that because the inflows have been stopped, many of these ETFs are trading at a huge premium. In some cases, the premium is as high as 20%. Now, mind you, even if market gives you zero returns and this premium comes down to zero, your return can be negative 20%. So if you're investing in passive, and unfortunately we don't have any index funds, most of these passives are via ETFs, and ETFs trade on Indian markets, Indian exchanges. They trade at a premium because the underlying is closed.
So you have to just buy in, sell the units of that
only
ETF.
on the exchange.
So you're already paying a premium.
Already paying
to
a premium.
the underlying NAV.
The moment the underlying fund flows open up, this premium can come down. And we have seen premium hovering from 10% to 30%. So be very mindful if you're picking for a passive. My bet today would be go for a simple active FOF, which doesn't have this issue for retail investor. Go via SIPs and all and don't worry about all this.
Okay. Fair enough. We do have to take a very quick break on that note, but we'll come back on the other side to discuss the other important aspect, which is taxation. A lot of the international funds now enjoy better, favorable taxation compared to where we were historically. But still, how does that eat into your returns? What should be your return expectation? We'll discuss that on the other side.
Let's talk money. Let's talk money.
Welcome back. This week we are discussing how you can take advantage of global equities, international equities, via the Indian mutual fund route. And as we've discussed, lots of options. There are actively managed funds, there are passive funds, but we need to understand the technicalities of that investment now. One thing that we must keep in mind is the best part is that we have to invest in Indian rupees. We don't have to take the pain of the whole exchange rate, whether it's China, US, or any other market that you're investing in. But then there is tax, Niranjan, and we need to understand how taxation is arrived at, because there's capital gains, there could be dividends that companies are giving, or any other formats of taxes. There's TCS otherwise when you're remitting money overseas.
Right.
So I don't know, just explain all the tax layers to us.
Right. So broadly, you have two routes to invest outside India today. One is LRS route, one is mutual fund route. Let's talk about mutual fund route. It's very simple. You invest in an FOF or an ETF. Any capital gains after 2 years is taxed at 12.5%. Anything before that is short-term capital gain as per your tax slab. Dividends, whichever you get from these funds, are taxed as per your tax slab, like any other mutual fund. That's very, very simple. Now, these funds investing in maybe US funds and all, they may attract some withholding tax depending on which jurisdiction they invest, but you don't need to worry about, because everything is built in the NAV.
Okay.
On the other hand, if you're investing via LRS, there are two taxation that you need to be aware. Three, in fact. One is while you are investing, there is a TCS, which is tax collected at source. There is a 20% TCS if you are investing about 10 lakh in any, whether it is US or China.
That is through the direct. If you're directly going to buy stocks, send your money overseas through LRS, then you need to pay this TCS.
This tax. When you invest, and if these companies pay you dividend, there is a withholding tax. If you're investing in US, the withholding tax as per the DTA is 25%. So you need to pay 25%. If you're investing in Chinese stocks, that tax rate is around 10%. So that is second layer of tax. Third layer of tax is capital gain, which is equally, which is similar to what you pay in MF. After 2 years, 12.5%. Before 2 years, short-term capital gain as per your slab rate.
Okay, this
so
is
that's how it
is. It's a little complicated. Let me try and recap. So let's start first with capital gains. Capital gains is what's become favorable for international funds now. So if you're holding on your investment for 2 years, then you have to pay long-term capital gains at 12.5%. And short-term would be less than 2 years at your slab rate, right?
Yes.
TCS, we don't have to bother. If you're going through the mutual fund route, then tax collected as source is not a worry.
No.
What happens to the dividends if $100 is coming as dividends from a US company? Then what is
fund?
In the fund? I'm just bothered about the dividend that I'm getting, along with my return.
So basically, if the fund is investing in a stock or maybe a fund which is paying dividend, then at the fund level, right, there is a withholding tax which the fund pays, or it's deducted at source, and you don't need to worry as an investor.
Okay.
Now, dividend, if the fund which you are investing in, if that pays a dividend, it is equally like, an equity fund in India paying you dividend, it is taxed at slab rate.
Okay.
So you don't need to worry about the underlying paying dividend, you need to pay tax on it.
Okay.
It's not like that.
Okay.
So in fund of fund or a mutual fund route, it is very, very simple.
Okay.
Better to go for a growth option and in a fund of fund structure. The only thing you need to worry is stay invested for more than 2 years and pay that 12.5, nothing else.
Now, if I'm invested for at least 3 to 5 years in a global fund, what should be the return expectation? For Indian equities, everybody says that 12 to 15% steady state returns, good returns. What about these international funds?
So for US, if you see, I think so, because the way market has been structured in US, it's completely different. It is no more linked to the nominal growth like we calculate in India, because US tech stocks are, just buzzing. They are giving extraordinary returns, which may continue because even today, the earnings growth expectation over the next 10 years or so is above 15-20%.
Okay.
Looking at that, I think so anything between 10 to 15% is a reasonable return to expect. Over and above, you should add maybe 2-3% return from currency depreciation.
Oh, yes, yes.
So whatever return US market gives you, we saw that example 12.75, but last 10 years in INR, it's 16%. So I think so same expectation you can take over the next 5 to 10 years. But be mindful because tech stocks specifically are highly valued. There can be bouts of volatility. The drawdowns could be higher. Better way is to, as Nasir mentioned, go in a staggered way, start an SIP. Even if you are investing lump sum, invest now, start an additional SIP so that even when markets fall, you buy in more.
Okay, got that point. Nasir, coming down to final thoughts then, you've already given us some ideas, the kind of funds that you like, but recap it all for us. The do's and the don'ts and the mistakes to avoid when you're taking this 10 to 15% exposure to global funds in the portfolio.
The question between active and passive, that is something that remains, as one of the main reasons for construction of the overseas portfolio. But clearly, I think, first and foremost, please do not chase returns because of momentum. There are enough changes happening dynamically as we speak. US-China was never thought of that they will come in with a trade agreement so soon, but we see it happening. It's obviously going to ease tension between both US and China. A few weeks ago, we were market neutral. We continue to be market neutral, but US started to look interesting. So don't chase themes basis news flow. You have to be more pragmatic. Look at medium to long term generation of wealth. Number one. Number two, I think very, very important is the end objective, your expectation on returns. I think on international returns, the global fund returns, an investment opportunity vis-a-vis expectation has to be staggered. It can't be lump sum. Please do not look at any money which is lump sum going into any of these funds, because a lot of it's changing dynamically, and we feel that a lump sum approach, staggered approach, and again, currency hedge. I think please make sure cognizant of the fact that your underlying investments are going into a different currency. Are you adequately hedged or not from an overall portfolio perspective? I think some of these are very, very important. And last but not the least, I think we need to look at whether the funds that you're investing in are those currently open or not, because there are enough regulations in place today which have been brought in by RBI, and in terms of freezing some of those investments, there's partial relief, and what may or may not be open today. So those are again something which need to be very, very clearly looked into when you're looking at the international funds broadly. And I think the last but not the least is, please don't expect superior risk-adjusted returns very quickly. I remember this old saying that it is not the time, but the timing. It's not the timing, but the time spent in these markets. And the same holds true also for international funds and international markets. So I think broadly we focus on some of these, and of course not to forget your taxation impact, which we discussed right now. I think those are again something which need to be factored in when you're looking at international funds between active investors.
Okay. All right. Good points there. Thanks for that. Niranjan, any final tip, word of advice, word of caution to investors as they're getting set on this global journey?
Be measured in your approach. Look for long term, because end of the day, these are also equity funds that you are taking exposure. Don't try to be over smart with the market, because it will, hit back.
If it doesn't work in India, chances are it won't work internationally.
Absolutely. The risks are same. There is no easy way to make money. Be very methodical, and your approach should be staggered way.
Okay. All right, gentlemen, thank you so much. Niranjan as well as Nasir, thank you for joining in and giving us a nice sort of bird's eye view on the whole, piece of international funds. Plenty of choices. And now, as you know, a lot of the funds are opened up in India. At least partially they're open. So you have some choices. You can go out, do your homework, and then decide if you want to invest or not. Thank you very much for joining in. It's a wrap on this edition of Let's Talk Money. We'll see you again with another theme next week.
Let's talk money.
Hello and welcome to our special broadcast. It's been over a week since Operation Sindoor, when the Indian Armed Forces first struck 9 terror camps in Pakistan and Pakistan-occupied Kashmir. India called the May 7 strikes, which were in retaliation to the terror attack in Pahalgam on 22nd April, measured and non-escalatory. But that was the only start. 2 days later, India targeted several Pakistani air bases in precision strikes. These included the Rafiki Air Base, the Sialkot Air Base and the Rahim Yar Khan Air Base, among others. The government later claimed that India's loitering munitions accomplished the objective in just 23 minutes. Both the nations have since agreed to halt military actions. However, Prime Minister Modi made it clear that Operation Sindoor is the new normal for India's stance on terror. In a series of press conferences over the past few days, the armed forces confirmed that Pakistan attempted to engage a number of military targets in northern and western India using drones and missiles. However, these were swiftly neutralized by the Indian air defense systems. The government also said that the Indian Air Force bypassed and jammed Pakistan's Chinese-supplied air defense systems during their strikes on Pakistan Air Base. The centre added that all strikes were executed without any loss of Indian assets. The Chinese government have voiced its concerns over the escalating tension between the two nations and urged them to exercise restraint. Defence Minister Rajnath Singh visited Srinagar today. He also called for a global supervision of Pakistan's nuclear capabilities. Reports suggest that Pakistan's Water Resources Ministry has reached out to India to discuss the terms of the Indus Waters Treaty that has been kept in abeyance. External Affairs Minister Subramaniam Jaishankar, however, has said that the treaty will remain in abeyance.
कैसे गैर जिम्मेदाराना तरीके से पाकिस्तान द्वारा भारत को अनेक बार एटमी धमकियां दी गई हैं। आज श्रीनगर की धरती से मैं पूरी दुनिया के सामने यह सवाल उठाना चाहता हूं कि क्या ऐसे गैर जिम्मेदार और रोग नेशन के हाथों में परमाणु हथियार सुरक्षित हैं?
The cabinet committee on security and the government obviously was very clear that the Indus Waters Treaty is held in abeyance and will be continued to be held in abeyance until cross-border terrorism by Pakistan is credibly and irrevocably stopped.
To take this forward, we're now joined by Ashok Kanta, former Indian ambassador to China. Master Kanta, thank you very much for joining us on the program. What would be your sense, your reading on China's role in the India-Pakistan conflict that we saw last week? China has said on record that they were in touch with both nations. NSA Ajit Doval spoke to Wang Yi also during the crisis. And one statement that really stood out is the Chinese Foreign Ministry saying that they will continue to stand by Pakistan in upholding its sovereignty, territorial integrity and independence. So how do you see China's role in the conflict between India and Pakistan after Operation Sindoor?
You know, we have to look at China's role at multiple levels. One, in terms of its diplomatic pronouncements, it made certain comments that you just referred to when we carried out strikes against 9 terrorist targets on 7th May. It issued a statement from Foreign Office which described our action as regrettable. Subsequently, it did not use any terminology of condemnation. It was relatively measured in its comments, but clearly tilting towards Pakistan's side. But I'm more interested in China's action, what it has been doing. In UN Security Council, it was clearly supporting Pakistan, though we managed to get a resolution which was quite all right from our perspective. Also, later when the whole thing was sort of coming to an understanding through bilateral consultations between DGMOs, China sought to interject itself into this matter. Wang Yi spoke to our national security advisor, and Pakistan sought to project that China had played a mediatory role, which is not correct. In fact, as far as I'm aware, India had reached out to all members of UN Security Council, with exception of Pakistan, of course. And China also, it was Wang Yi who got in touch with us. So there was no mediatory role by China in this matter, as Pakistan has sought to make out. But we have to see, today Pakistan's entire defense hardware is of Chinese origin. Last 5 years, more than 80% of defense imports have have come from Pakistan, and they were deployed quite extensively against us with very mixed results. As you mentioned, China supplied air defense system, as also US supplied air defense system, failed quite miserably. Our Air Force could access through missiles and drones well inside Pakistani territory and inflict fairly heavy damage, which has come across very clearly now from satellite imagery. I would also like to point out that China had just come out with a national security white paper on 12th May. It's a paper we are still studying. But from what we understand, there's a specific reference to regional hotspots, India-Pakistan situation, as also to Kashmir. So this is an old attempt to once again hyphenate India and Pakistan and seek to project Pakistan's behavior in context of so-called regional hotspot, trying to equate India and Pakistan. So on the whole, I'll say that China has been cautious, but definitely tilting in favor of Pakistan.
Okay, I'd also like to ask you about the use of Chinese equipment. You referred to that and how well Indian equipment performed in competition. Now, you had the Indian government saying yesterday on record that Indian Air Force managed to bypass and jam Pakistan Chinese supplied air defense systems, including the HQ-9. We managed to complete the mission in 23 minutes. We also downed PL-15 missiles as well, and we've got evidence of that because some of these missiles have been seized by the Indian forces. So would you say that the Indian equipment, our indigenously built defense equipment, sir, and also our fighter jets, our drone systems, our forces altogether were able to dominate Pakistan despite the Chinese equipment, and our equipment performed better?
When it comes to air defense system, you referred to China-supplied HQ-9 air defense system. Pakistan also had US-supplied air defense system. They did not perform well. It's very evident the fact that we could launch precision attacks against air bases and other targets within Pakistan. So on that side, I think clearly we had the upper hand. We are still a little unclear about what happened on the morning of 7th May. If you look at Chinese social media as also Western media, they're abuzz with claims on how Chinese J-10C and PL-15 performed rather well. In fact, South China Morning Post has referred to deployment of hypersonic missiles for the first time by Pakistan, China-supplied missiles. This is something we'll have to wait and watch. I think we have to now work on the assumption, and this is not a new assumption, that China will double down on supply of military hardware to Pakistan. And China has a reasonably good quality military hardware. They are, in fact, rather excited about the fact that their military hardware, for the first time in combat situation, performed relatively well with Western platforms. So it might be partly sort of exaggeration, but we need to follow these developments very carefully because they have very important implications for national security, and also how China-Pakistan strategic nexus will develop in future. On that, we should have no doubt that those links will be strengthened.
Right. So you're saying the strategic linkages with China will only strengthen. And I would also like to draw your attention, sir, at a time when we were having such problems with Pakistan, and we ourselves have been trying to negotiate an early trade deal with the United States. In fact, we've given so many concessions even outside the trade deal. US went ahead and had a trade deal with China, whereby US duties on Chinese products now fall to 30%. China's tariffs on US goods will drop to 10%. Now, how do you think India is left in this situation when US and China have struck a deal on trade? You've got Donald Trump, the US president, saying that he was a mediator between India and Pakistan. He managed to equate the two together. So where does this leave India, India's ambitions as a global supplier and to be a big supplier for the US as well?
Parikshit, India and China adopted very different approaches when it came to reciprocal tariffs imposed by President Trump. As you know, Prime Minister had visited Washington, D.C. even before that, and we were in touch with USA on bilateral trade agreement. We did not impose any retaliatory tariffs, whereas China imposed tariffs up to 125% on imports in the USA, and it took a fairly tough line vis-a-vis USA. Finally, one can say that both USA and China, for different reasons, blinked simultaneously. And talks which took place in Geneva, within 2 days, they managed to arrive at some kind of truce, which will last for at least 90 days. As you mentioned, US brought down its tariffs on imports from USA from China from 145% to 30%. Already it had given a carve-out for very large segment of imports, electronics, semiconductors, handsets, etc., valuing more than $100 billion last year. China also has brought down its tariffs from 1.5% to 10%. The actual rates will be somewhat different. The bottom line is that the two largest economies in the world, today they're so intertwined. Economic decoupling is not possible. And they both were hurting. And they found some kind of off-ramp, but this is not end of the story. China, US contestation in different domains will continue.
Right. Ambassador Kanta, my final question. You're right, because that's what Donald Trump and the Chinese also said, that we're not looking at generalized decoupling. But finally, sir, very briefly, what does this show about India's diplomatic outreach so far, our geopolitical strategy? Finally, at the end of the day, who were the countries, which were the countries which India could really depend on? Or does this only goes to show that when push comes to shove, or when there is a crisis, India will only have to rely on its own resources? Is Atmanirbharta the way to go?
I think there is absolutely no doubt about the fact that while there can be an aspect of external balancing of China, working with other like-minded countries, finally we have to depend on our own, indigenous capabilities. And those capabilities, whether it be in military domain or economic domain or strategic domain, will need to be built up. This will require partnership with other countries, no doubt about it. But a country as large as India, which believes in strategic autonomy, cannot really afford to depend on others to advance its own, larger national interests. But that doesn't mean we don't have. We have good friends and strategic partners. They understand our concern. They share our concern. And they need to work with them to mutually build up capabilities. We also have a lot to contribute in different areas, and that is appreciated by our partners.
Okay, thank you very much, Ambassador Kanta, for joining us on the program. We're taking a short break, but when we return, US President Donald Trump says he has told Apple CEO Tim Cook that his administration is not interested in Apple building in India. The president's first official visit to the Gulf also takes center stage after US signs mega deals with Qatar and Saudi Arabia. We will be joined by former Foreign Secretary Kanwal Sibal and former Indian Ambassador to Qatar, KP Fabian, on the show. Stay tuned. US President Donald Trump has said that he has told Apple CEO Tim Cook that he is not interested in the company building in India. Trump's remarks came while he was addressing the Gulf Cooperation Council's meeting in Doha. President Trump was in Qatar for the second leg of his West Asia visit. Trump said that he told Cook that India can take care of themselves. Remember, Apple in February had announced that it would invest $500 billion in the United States over the next 4 years. However, government sources have told CNBC-TV18 that Apple has assured Indian government that it proposes to continue to have India as a major manufacturing base for its products. Adds that there is no change in Apple's investment plans in India.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India, because India is the highest, one of the highest tariff nations in the world. It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff. I said, Tim, look, we've treated you really good. We put up with all the plants that you built in China for years. Now you got to build us. We're not interested in you building in India. India can take care of themselves. They're doing very well.
All right, let me go across to Ambassador Kanwal Sibal, India's former Foreign Secretary and Ambassador to the United States as well, and KP Fabian, India's former Ambassador to Qatar. Thank you very much for joining us. Ambassador Sibal, let me just begin with Trump's remarks. Over the last few days, Trump has been surprising us. Of course, again, today perhaps for the fourth or fifth time, he said that, yes, I mediated between India and Pakistan. This could have been a bad situation. I want to trade with both nations. But what was more stark when he said that I have told Tim Cook that, I don't care about your investments in India or manufacturing in India. You can do that, but when it comes to the United States, you should manufacture in US for US. This comes at a time when Apple was actually looking to deepen production in India for the US market itself, move all the iPhone production here. How do you read these remarks in the context of what has been happening also with India and Pakistan?
A couple of things. Trump is extremely loose with facts. He says what comes to his mind. He digests details extremely poorly. As part of this clip which you played, he also had said that the United States is 30th in the number of countries, in the list of countries that export to India, which is absolutely wrong. United States is number 4. Our biggest importing countries are China, after that Russia because of the oil thing, then UAE, and then United States. Over 41 or whatever $billion. So he's wrong on a very basic fact. And then he's got this in his mind, this bugbear of his, that India is the tariff king. He keeps repeating that. And then he sort of misleads everybody and himself by saying that in the talks that our delegation has had with the United States, we have agreed to zero tariff. It's just not possible. What we have agreed to are the terms of reference. Can you imagine India saying zero tariff on agricultural goods? No way. But he just misleads himself. He misleads the public. He misleads the audience. He misleads the United States of America. He misleads the Indian government and public also by saying all these kinds of things. And then this thing about Tom Cook and Apple and everything else. Now, I don't know to what extent the American industry will be browbeaten by Trump into changing its global policies, manufacturing policies. I don't think that the United States government is like the Chinese government or like Xi Jinping. He could give a kick in the butt to Alibaba and everybody else and make them do what he wanted. The US multinational corporations have global worldwide interests. They have to look at the bottom line insofar as their shareholders are concerned. And if Tim Cook has taken the decision to shift the manufacturing from China to India, this was because of the tariff war between United States and China, and also the prospects of entering the Indian market, where the spread of internet and use of smartphones is phenomenal in India. Maybe barring China, no other country in the world with the kind of numbers we have. And therefore, Apple is not just going to wash its hands simply because of the obsession of Trump. And if Tim Cook has promised to invest in the next 4 years $500 billion in the United States, that should satisfy Trump. And this dismissive way of talking about India, let India take care of itself and this and that and that. No regard for the sensitivity of the Indian leadership, the political repercussions of what he says. The fact that we are discussing this as a result of his callous and ill-thought-out remarks. He should be more mature. But he just gets carried away. And he says whatever comes to his mind, he thinks he can do all this with impunity. It's unfortunate. But having said all that, we have to take this with a pinch of salt. Because we've seen that he does all kinds of things, and then he walks back. And he's not afraid of walking back on what he's been saying publicly. So therefore, we should not get too flustered. Wait and humor him and have a focus and continue to deal with the U.S. multinational corporations.
A very important point, sir, because you have to make sure that they take their business interests, and it's not so easy. Even if he wants Apple to go ahead and manufacture in the US, it's not so simple. There is a reason why Apple has gone abroad to countries like China and Indonesia, places like Vietnam, to manufacture or get their components from. It was not making supply chain sense to do so in America. Let me also get an Ambassador Fabian at this point. Ambassador Fabian, I'll come to what Donald Trump is looking to get from Qatar, from UAE and Saudi Arabia in a bit. But what would be the lesson with the manner in which Donald Trump has acted whole of last week with reference to India and Pakistan? He clearly is being seen, and we're seeing this in Middle East also. He's looking to say good things about any leader in any country which is willing to invest in America, which is willing to support MAGA or throw in billions and billions of dollars. Now, how should India deal with this? What should be the lesson for India vis-a-vis Donald Trump in the months to come?
Thank you. I think we have to understand the psychology of President Donald Trump. He is actually a real estate tycoon who has succeeded, and I give credit to him for getting re-elected into the White House. Now, second thing is that his choice of words is not always, what shall I say, lucid or correct. He said that he was mediating between India and Pakistan. Well, as we all know, mediation is possible only when two parties who are having a dispute or are at war ask or agree to a third party doing a mediation. Now, in this case, India never agreed to accept it or ask for it. So mediation was wrong. At the same time, I believe we should give him credit, because after Pakistan got beaten by India in a military sense very badly, it was in a dilemma what to do. Should it escalate? Should it de-escalate? Or should it ask for a ceasefire? And when Pakistan was in that dilemma, President Trump or his vice president or his secretary of state, it doesn't matter, America pushed Pakistan in the right direction, namely ask for ceasefire. And then what happened?
Right.
We told America that is good, but let Pakistan tell us. And Pakistan told us through the DGMO channel, and we agreed. So there was no mediation.
Absolutely.
Now, coming to Apple, if I may say a word, you see, President Trump will be there for another 3 years plus. Now, investment, CEOs, company CEOs, they take a long-term view. Now, what President Trump is actually saying, again, not exactly not to invest in India, but don't invest in India and think you can export to America. That is what he is saying. Now, the thing is this, we do not know whether that threat will be carried out. As Ambassador Sibel said, we cannot always be sure what he will do tomorrow. But having said that, let me say that Apple will continue with its investment in India, because that is a rational decision to take.
All right. So let me get final comments, sir, from both Ambassador Sibbal and you. Ambassador Sibbal, this three-nation visit to the Middle East, this has also raised a lot of questions about Donald Trump's manner of going around things. But what has he actually got versus what he actually was out to achieve with this Middle East outreach?
Well, judging from press reports, he seems to have achieved quite a lot. Because as you remember, he had already said some weeks ago that Saudi Arabia has promised to invest $600 billion in the United States. And this seems to have been confirmed during his visit. And insofar as Qatar is concerned, at least the reports say that they have promised to invest $1.2 trillion in the United States. Now, this includes buying a lot of Boeing planes, in fact, the biggest contract for Boeing planes in history, apparently, as well as in the areas of defense, and I'm talking of both countries, artificial intelligence and what have you, energy too. So he seems to have achieved a lot, at least on paper, in terms of future investments from these countries in the United States. And he and his people around him are actually indulging in a great deal of self-praise, how Trump's policies of browbeating other countries to invest in the United States so that there can be more job creation in the United States, which has been the single point almost of his campaign. So there's a lot of self-congratulation. And maybe there's some truth in this because these countries would be interested in keeping the United States on their side, and they have a lot of money, and therefore they can invest in the.
Okay, we've completed run out of time, but thank you very much to Ambassador Fabian and you, Ambassador Sibbal, for joining us. With that, it's a wrap on this special broadcast. More news and updates right here.
Hello and welcome to this special broadcast. I'm Shireen Bhan. Operation Sindoor is the new normal for India's stance against terror, said Prime Minister Modi as he reset the terror doctrine. His address to the nation on Monday was his first since India's military strikes against Pakistan in retaliation to the Pahalgam terror attack. Prime Minister Modi added that India would not fall for nuclear blackmail and that terrorists and their enablers would be seen as one. He also called Operation Sindoor the Make in India moment for India's defence sector.
न्यू एज वॉरफेयर में भी अपनी श्रेष्ठता सिद्ध की। इस ऑपरेशन के दौरान हमारे मेड इन इंडिया हथियारों की प्रामाणिकता सिद्ध हुई। आज दुनिया देख रही है 21वीं सदी के वॉरफेयर में मेड इन इंडिया डिफेंस इक्विपमेंट्स, इसका समय आ चुका है। ऑपरेशन सिंदूर आतंक के खिलाफ भारत की नीति है। ऑपरेशन सिंदूर ने आतंक के खिलाफ लड़ाई में एक नई लकीर खींच दी है, एक नया पैमाना, न्यू नॉर्मल तय कर दिया है।
Operation Sindoor has set a new normal. That is the Prime Minister in the address to the nation. Meanwhile, United States President Donald Trump, who's currently in the Middle East as part of his West Asia tour, has said that Apple CEO Tim Cook had a conversation with him and Trump told him that he was not interested in Apple building in India. Trump's remarks came while he was addressing the Gulf Cooperation Council leaders meeting in Doha. Trump said that he told Cook that India can take care of themselves. Remember, Apple in February had announced that it would invest $500 billion in the US over the next 4 years. But also remember that Apple has been incrementally increasing its production in India. In fact, in the earnings call, Tim Cook had said that in the quarter, most of the iPhones sold in the US would be of made in India origin. Here's President Trump.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India, because India is one of the highest tariff nations in the world. It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff. I said, Tim, look, we've treated you really good. We put up with all the plants that you built in China for years. Now you got to build us. We're not interested in you building in India. India can take care of themselves. They're doing very well.
Well, that's President Trump, consistent with his Make in America point of view. Joining us now on the program to talk about where India stands today post-Operation Sindoor, the big defense equipment moment. Is this a coming of age of India's defense industry, as well as the geopolitical reset that we are currently in the midst of? Sanjeev Puri, President at CII, Baba Kalyani, Chairman and Managing Director at Bharat Forge. Also with us on the show, R. Mukundan, Vice President at CII. Gentlemen, appreciate you joining us here on the program. Mr. Puri, if I could start by asking you, we heard from the Prime Minister in his address to the nation and subsequently when he addressed air warriors at the Adampur Air Base, making it clear that Operation Sindoor is the new normal. It's the new red line for India's response to any future terror activities, whether terror actors directly or enablers of terrors as well. Now, from industry's perspective, how do you respond to what we've seen from the Prime Minister, what we've heard from the Prime Minister, and where India finds itself positioned?
Thank you, Shireen, for having us on the channel. So, first of all, let me start by congratulating the Honorable Prime Minister for his very swift, decisive, impactful, and yet very responsible actions. You know, it started with the targeting of terrorist camps, and then India also responded very effectively against the provocations, caused a significant amount of impact and damage to various strategic sites in Pakistan. So I'd like to congratulate him for the swift action and for demonstrating to the world that India will not tolerate terrorism. It's a zero tolerance. And the new normal, I think, is extremely important because, sustainable growth, quality of life, for them, what is very important is a safe operating environment. And this gives immense confidence to investors and businesses. So the Indian industry really would like to congratulate the Prime Minister, would like to salute the armed forces for their bravery, the professionalism. And I think what is interesting that it has demonstrated the prowess that the Indian defense industry has built over the years. I think it all started again with the visionary leadership of the Honorable Prime Minister, the Make in India program, which has started several years back. And we know from a minuscule amount of exports, we're talking about last year about 3 billion or approximately kind of exports. And the efficacy of all of these equipments were amply demonstrated by the effectiveness of the targeting, the precision targeting, and the extensive and effectiveness of the damage caused. And and this is not merely speculation. This is based on images that have been verified, not only what we've seen in India, but also by overseas media channels where they have access to various satellite images and have very clearly demonstrated the extensive damage that has been caused. So I think it's absolutely Indian industry is in complete solidarity with the Indian government on the actions that have been taken. We welcome it. And I'm sure that this also gives a lot more impetus and energy to the building of the strategic defense sector in India.
Yes, let me take that point forward with Mr. Baba Kalyani, somebody who has, of course, been involved with India's defense sector for very long now. Mr. Kalyani, as I started, is this really in a way a coming-of-age story as far as India's defense sector is concerned? Sanjeev Puri alluded to the export number, and we've seen that export number up 34-fold increase in the last 10 years to over 23,622 crores. But, Operation Sindoor and what it's meant in terms of testing India's military prowess, testing India's defense capabilities, coming out successful on all parameters. We are given to understand at this point in time that we could be talking about replenishment orders worth about 30 to 40,000 crores. And all of this now builds on the indigenization efforts over the past decade. Mr. Kalyani, your first thoughts on what Operation Sindoor has meant as far as India's defense capabilities are concerned, as well as the road ahead.
Well, thank you, Shireen. And first of all, let me share what Sanjeev said and congratulate the Honorable Prime Minister, the political leadership in India, and our armed forces, the National Security Advisor, and everybody else who took part in planning and making this successful. I think what we need to understand, what is very different in this conflict is this has been a technology-enabled and technology-intensive battle, not the normal kinetic war that we were used to with our adversaries across the border in Pakistan. And I think this is what is very heartening for India, heartening for the nation, and what our industry has been able to contribute, both the public sector and the private sector. And more importantly, let's not forget our DRDO, who has been at the backbone designing products and making technology happen. And I think this is a big change that has happened. We all see it in our own businesses where we are making defense equipments. And I think you will see India moving ahead very fast in the technology-enabled battle scene that we had in this conflict. Having said that, I just want to caution that this was a short conflict. I think from our side it lasted 25 minutes, if I have heard the media correctly, and we should be prepared that something bigger happens. We are not caught napping, and we are ready with all our muscle power, all our technological capability, and all our hardware. And I think Indian industry is pretty much up to the mark. We are, more than just the business side. I think as Indians, we are extremely elated and very proud of how this has been handled, how our leadership has taken decisions and have made things happen in a very proper fitting manner.
Well, Mr. Kalyani, since you talked about the length of the operation, just to be absolutely precise, it was 23 minutes to be exact, sir. That is how long Operation Sindoor, the first installment of Operation Sindoor, lasted, 23 minutes exactly. But let me bring in Mr. Mukundan into the conversation as well. Mr. Mukundan, just to take forward what we heard there from Mr. Kalyani, in terms of future readiness, future preparedness, he talked about the contribution of organizations like the DRDO, etc., but perhaps a need for even deeper, more robust private-public sector participation, partnership as well, especially on the defense side as we move forward, because at this point in time, in the geopolitical reset that we're seeing, perhaps self-reliance will be of critical importance.
Thank you, Shireen. Let me also join my two senior colleagues in congratulating and complimenting our government, our Prime Minister, and our armed forces on a wonderful, resounding message they sent across. And this was a very important message, fundamentally, because ours is a fight for peace. Ours is a fight for calm. And I think this was very important to do the way it was delivered, precise and short, as Baba Kalyani explained. And I think very clearly, in the long run, the point about Atmanirbharta, which the government has been saying, is actually most acutely we need to drive home in the area of defense. Because one of the things I did learn through this whole process is that when countries do export their wares, they actually reduce some of the capabilities of the equipments they sell to others. So I think in that context, if you had to be fully capable and measuring up to any form of threat issues which we will face in future, I think we need to design and develop and ensure that we have equipments and the technology which is right up there, matching with the best in the world. What we have seen is the human ingenuity, the human talent which has come to the fore, but we need to back it up with material goods and technological goods. And we are right there, but we must continue the momentum. One of the things which I would certainly say is that what private sector does bring to the table is its ability to put together a time-bound and also very cost-effective solutions to be delivered in a way that I think it not only caters to Indian needs, but also the needs of India as it begins to project itself beyond the shores of India. So really, the government has taken many, many steps in the area of defense, especially in terms of public-private partnership, procurement from Indian companies, encouraging joint ventures with the overseas partner. I think that momentum should continue. And I'm sure that more avenues will open up for us. And this defense spending and defense development, as I call it, should be seen as expenditure and an investment in peace. Many of us mistake that, whether it can go into other sectors like education. Certainly those we need to do. But I think this is one of the critical things. Because development doesn't happen without peace all around. And in ensuring not just peace at home, but also peace overseas, I think we need to progress it, and the private sector and public sector should work hand in hand, and government has taken wonderful steps in this regard.
Mr. Kalyani, if I could come back to you, sir, and talk about the road ahead as far as acquisition is concerned. And, I would imagine that we are likely to see another improvement over the previous year's budget. We did see a significant improvement this time around as well on the defense budget, including the acquisition budget. But, the focus and priority, you talked about this having been a tech-enabled conflict. The focus on drones, for instance, the focus on AI-guided loitering munition, for instance. What would you now like to see being prioritized, both from a development perspective as well as an acquisition perspective, sir?
Well, if you closely look at India's response in this conflict, it was a response which was, all the three services put together along with ISRO and other agencies working together as an integrated response. That's where technology comes into play. So if you look at UAVs are going to be a major part of any battle scenario anywhere in the world. If you look at the Russia-Ukraine conflict, Ukraine is making something like 1 million UAVs per year. I mean, there are hundreds of companies in Ukraine making UAVs. India has more than 500 companies who make UAVs. So I think we have come of age in this area. What is very important is we are able to do precision strikes. And for precision strikes, you need, the satellite surveillance, you need multiple agencies working together, making these things happen. And I think that was very ably demonstrated in those 23 minutes, as you said, what happened. So I think we have the capabilities. We just need to keep enlarging it, because you can imagine conflicts like the Ukraine-Russia conflict. This is going on for 3 years. Now, we had a conflict that went on for less than half an hour. So if we have a longer conflict, then we need to be far better prepared. But I think we are all there with the policies that the Honorable Prime Minister put into place for the last, let's say, 10 years in the area of defense, and all enabled by our Honorable Defense Minister and the whole user industry collaborative effort that is going on between industry, DRDO, and the users, that is the services. We are all moving forward at a very rapid pace. I mean, there are a lot of things that you don't see that are happening in industry, but I can tell you and assure you that we are moving forward at extremely rapid pace. And this is not only good for our defense, but is also good for our overall economic and industrial development.
Why don't you give us a sense of what is happening behind the scenes within the private sector in the defense space, Mr. Kalyani? What exactly is moving forward?
I'll give you, for example, I can't give you specifics, but I'll give you an example. In the artillery sector where we are involved, I mean, we have weapons which are far more advanced than anywhere in the world today. That's one. Second, if you look at in armored vehicles, whether tracked, wheeled, India is moving ahead with new equipment designed by DRDO, but produced by Indian industry, and with much higher technical capabilities than what we have today. And all this is with integration with AI, digital, and everything else that's there anywhere in the world. So I think we are pretty much moving ahead. In terms of electronic warfare, I think whether it's anti-drone warfare, whether it's jammers, whether it's, those kind of things, we are moving ahead pretty fast. There are many companies working in this area. In terms of software-defined radios, again, that's an area where we are moving very rapidly in terms of technology. So every area you are moving in technology up ahead. And the good thing is all this is converging in every equipment that you make. So it's not that in like the old days, you have an artillery gun sitting and firing at the Kargil hill. Now it's all integrated. It is autonomous. It can be controlled without any man being there, and controlled by using data from satellites and everything else. So I think things have gone in the last 5-7 years way ahead, and they're going to go even faster.
Absolutely, we are seeing that already in play. But Sanjeev Puri, if I may bring you and Mr. Mukundan into what we are seeing outside of course, what's happening on the battlefront. In the midst of this, we are seeing this global reset, where if I could loosely say trust is being replaced by trade. I mean, here you have a situation where President Trump is now even talking about a possible deal with Iran while he's touring the Middle East. So Sanjeev Puri, as we look at the world today, how India is best placed to navigate on the trade front in a world which is in a geopolitical flux?
So this is a very important facet that you have brought in, Shireen. That I think that, first of all, India is very well placed because of the strengths, inherent strengths that India has got. India has got the capacity to produce at scale economically of world-class quality. India has the talent, and India is also a services powerhouse of some of these frontier digital technologies also. So India, from its own competitiveness perspective, is well placed. Now, we have seen several policy reforms over a period of time. Several of them have happened that make India a competitive destination. There are several successful examples. I think the world is also looking for supply chain resilience, which becomes even more important in a world where there is, when there are these trade fragmentations and also, the certain geopolitical shifts happening. This becomes very important, and scale can only come from India in many of these areas. So that's, having said that, I think the way to go is what is being done is we need to stitch our own bilateral trade deals in alignment with national interests. And as we do economic integration, I think we have to be cognizant of countries that are also working against our interest. And we have to, certainly CII would encourage its members to move away from them, to reassess. There are countries that supported Pakistan in this conflict. And of course, with one of them, we do have a material amount of trade. And I think it's not in India's interest not in national interest for us to pursue that. We should be reassessing what are alternatives that we have got.
Are you suggesting Sanjeev Puri, that India break trade relationships with Turkey, with Azerbaijan? Azerbaijan, of course, is too small. Even Turkey, in the larger scheme of things, is about $10 billion. But are you suggesting that we break, trade ties with Turkey?
Look, before the conflict happened, we had a trade of about 40 million with Pakistan, or something of that order, right? It was small. So all I would say right now is that we must reassess, and we must definitely look at alternatives. We should certainly reduce, or if possible, eliminate economic integration with such countries. Why should I? I mean, it goes without saying, why should you be creating economic activity for places that are working against national interest? So national interest must come first and foremost. And I'm very happy to see, a lot of Indian consumers in this true spirit of nation first are kind of cancelling their the tourism or the holidays, vacation they wanted to take in some of these countries. That's, I think, absolutely the right thing to do. Why should we be creating economic activity for countries that will work against our interests? That's the principle. India's self-interest is the first, and therefore very strong reassessment and as much as possible realignment, I think, is something that I would encourage everybody to think about. And
yes.
Coming back to what the question that you raised, I think fundamentally in this whole the very hyper dynamic evolving trade scenarios, I think the way to go is to, one, focus on domestic drivers of growth, which the government is very well doing and has done over several years. And the advantage is India is a very consumption driven economy. The second pillar we need to strengthen is our integration with global value chains. Exports is just 12% of GDP. How do we take that number up? And towards that, I think the bilateral trade agreements that India is pursuing, that's the right way to go. I think that's the way to have one-to-one arrangements with countries where there are synergies and where there are mutual benefits. That's the way we should be pursuing those. And I think some of the ones that are in the pipeline now are the ones that will create immense value for the economy.
We spoke the day that the UK agreement was done, the India-UK agreement was done. Mr. Mukundan, talking about bilateral agreements, let's talk about the US. We just had Donald Trump once again reiterate that, in fact, telling Tim Cook that he doesn't want Apple to build more in India. Also suggesting that, look, if you're building in India for India, that's fine, but anything beyond that may not pass muster. Now, that's his point of view. Whether Apple agrees or not is a different story altogether. But what do you take away from that messaging? Also, do you believe that a 0 for 0 tariff policy is the right approach? Again, Trump suggesting that India has offered zero tariffs. He said quite literally, they've said that there will be no tariffs. The Indian government so far maintaining that it's too premature to comment on any deal contours. Do you believe that a zero tariff policy is appropriate?
Firstly, Shireen, I think this is a world of trade partnership, as you mentioned. And I think we've already signed up with UK and FTA, and I think we are looking to sign FTA with the European Union, and I think also some kind of a deal with the US. So I think when we talk about free trade, I think there is going to be some give and take. And if that leads to zero tariff on some tariff lines, I think that is the way the world is going to shape. But that is the opportunity for India. India's opportunity is to be not just the service center of the world, but also the factory of the world, but also the manufacturing center of the world. And all the decks are stacked in India's favor. We have the talent. We don't have an aging population. We have workforce which is actually very productive. And we now have improving infrastructure. You look at it from all perspectives. I think everything is going for us. And really, the basic message which we must be pushing forward in the world stage is India is open for business. And effectively, we are looking for partnerships with like-minded countries. And really, what we want is a progress through peace and progress through partnership. That is really what we want. Even this skirmish which we had with our neighbor was a fight against terrorism. It was not a fight with the neighbor. And I think as long as there are principles on which we stand, I think we should then work with countries, like-minded countries. And I think we would certainly welcome a move from government to enhance our trade competitiveness through networks and supply chain, which we want to build. And it's all going to augur well for us. And really, at this point of time, momentum is with us, and we should
you don't see a build-up of conflict between President Trump's policy of Make in America and Make America Great Again with our own manufacturing ambitions, because that is sort of what he seems to be suggesting in that comment that came in with respect to Apple wanting to do more in India in terms of manufacturing.
So, Shireen, I think there is going to be pressure on every country to manufacture as much as it wants in their own home country, and I think we should engage with that. But also, I think our position should be what we can engage with the rest of the world competitively. We should be the supply chain source for the world. So I don't think they're at a conflict, and I think they should work together. And I would certainly say every business entity is going to make an assessment of what it can do. And in that context, I think India has a very, very fair chance to push ahead. And let me just say, if you look at small car manufacturing, we are one of the biggest exporters today out of small car. And it all started with a joint venture which Government of India signed in India. So I think if you look at sector after sector, we have proven where we allow technology to come in, where we learn with new technology, where we increase our productivity, where we open the doors. I think we actually can compete very well with the rest of the world. And I think the government is doing the right thing. We are pushing for Make in India, not just for India, but make for the world. And I certainly think Apple should make for India in India, but maybe that opens up an opportunity for them to supply to the rest of the world.
Well, and they are supplying to the U.S. from India at this point in time. That certainly is the case as of today. But gentlemen, the message there from industry is very clear. The answer, the antidote to uncertainty is a strong, resilient domestic economy. And that needs to continue to be the focus of the government and, of course, of the private sector. Once again, a sharp focus on what is happening with our defense industry. The fact that the military prowess of the country has been tested and we have delivered successfully, that needs to be built on, and a more robust private-public sector partnership in each of these areas. Sanjeev Puri, Baba Kalyani, R. Mukundan, always a pleasure. Many thanks for joining us here on CNBC-TV18 to take stock of where we find ourselves post-Operation Sindoor and what it means for our economy, and more importantly, what it means in terms of the coming of age of India's defense industry. We'll take a break. A lot more coming up. Don't go anywhere. We're back in a moment.
Sholay. I've seen it many times on the big screen, but I want to see it again. And probably Mughal-e-Azam as well. Pass. I'd say probably Andaz Apna Apna. यार ये मैं आंसर करूँगा तो प्रॉब्लम हो जाएगा.
What have you got up your sleeve?
Well, we've got The Anarchy, which is a TV series adaptation of William Dalrymple's epic saga on the history of the East India Company. It really is a story that has to be told with that epic scope and scale, the way that the Game of Thrones or The Crown have been told.
So have talks begun with the Netflixes and the HBOs of the world?
Talks have just begun.
What are we talking about in terms of resources that you require to be able to put something down? Ballpark.
The per episode costs for shows like Game of Thrones and The Crown range anywhere from 8 million to 20 million an episode.
Now you believe that India has been poised to have its crossover or breakout moment, just as we've seen with the Parasite and so on and so forth. Why has it been so elusive?
Because we've been victims of our own success in a way that traditionally India has never really had to reach out to the world.
What's exciting you about the stuff that you're seeing being made today?
A show like Kohra, for example, right? It's very local, very rooted. But I think the beats of the way that the story unfolds is told in a very international way.
Are you also seeing a diversity from where these scripts are coming in?
I think the number of people from the smaller towns, I'd say even sometimes from villages, who reach out to us with, even if it's a concept note, it might not be a full screenplay, is quite significant.
What was the one that surprised you? What was the one that you were absolutely sure of?
Barfi was one which was the most difficult to pin down, but you knew it at a visceral level, you reacted to the material. Chennai Express actually was another film where, you know, there was a full narration that happened with a group of 20 people, and we were laughing off and like falling off our chairs.
What was the casting call that you made that kind of worked out the way that you had imagined it to?
I think probably Dangal. And at that time, of course, Irfan, he was someone we had in mind. He would have done a wonderful job. But then I got a call from Amir at that time. Many other stars of his stature might not have been okay with playing an overweight wrestler who's like a bit of a has-been, who's living out his dreams through his daughters.
Hello and welcome to another edition of Young Turks Reloaded. I'm Shireen Bhan. The Indian media, entertainment and film business is poised for the next big wave of disruption. After a wave of corporatization and consolidation, industry is now grappling with a booming OTT market, a rising live entertainment economy and a film business that's yet to fully recover from COVID and the onslaught of video streaming. Today, we roll out the red carpet for a man who spent a good part of the last 2 decades mastering the art of storytelling. From delivering box office hits like Dangal and Chennai Express to producing game-changing series like Rocket Boys, he's now ready with his next big project. Siddharth Roy Kapoor, welcome to the Young Turks podcast. Thanks very much for joining us on the program.
Thanks so much for having me.
So let's start with the big reveal. What have you got up your sleeves?
Well, we've got The Anarchy, which is a TV series adaptation of William Dalrymple's epic saga on the history of the East India Company. It's one of those books that you just can't put down.
Yeah.
And when I first heard that William was working on this, book, I actually found out about it a few months before it was going to be published. So I reached out to him immediately. He was kind enough to give me a manuscript. And I read through it just chugged through it in one sitting, and realized that this was.
Buff?
I am a huge history buff. I am, and it's just
William Dalrymple cannot be done in a day.
Well, it was one of those things which just sucks you in because I've always been very interested by the history of colonialism and of course the Mughal rule, like sort of before that, and the way William writes, he writes with such drama, and the way he treats his characters, he just makes them live and breathe. And so I reached out to him instantly after that and told him I'd love to take on the rights. And, after a bit of back and forth, because he wanted to know what the vision was.
Yeah.
And we realized that we had exactly the same vision.
So
which
what
is
was
about,
the vision that you painted for him?
Well, the vision really is about how contemporary the subject really is. I mean, we talk about these global corporations which are larger than most nation states, being in multiple countries and having the ability to actually influence the world. Here's where it actually happened 500 years ago, where you had a global corporation with its own private army coming and taking over a subcontinent that was 25% of the GDP of the world at that time. And, you've got delicious characters in there, from Robert Clive to the Mughals, to the Dutch, to the French, to the Portuguese, to the Jagat Seths, the moneylenders. So it really is a story that has to be told with that epic scope and scale, the way that the Game of Thrones or The Crown have been told. And I think I've always had the ambition of being able to take our content and reach out to the world with it. And this is a story that we should be telling ourselves.
So this is going to be mounted for a global audience.
This is going to be mounted for a global audience.
And you managed to bag a big name to do that for you.
So we've got Stephen Frears coming on board. I used to watch films like High Fidelity and Dangerous Liaison when I was, in college. And to imagine that the director of those epics is now going to be actually helming the anarchy is just...
And how did that come about?
Well, our partners Whip, actually, which is a US production company, they've made shows like Mayor of Easttown and Dickinson. Paul Lee, who runs Whip, was running ABC when I was at Disney and running India. And we stayed in touch for a long time. And then he started Whip and I started Roy Kapoor Films. And we were chatting about what we could do together. And when I told him about these rights, he said, wow, that's something I'd love to collaborate on.
Right.
So we got together, and through Paul and through Whip, we were able to reach out to Stephen. And he knows William, incidentally.
Okay.
And that helped. And he'd heard of the book, he read it and loved it, and that's how he came on board.
So when do we finally see this being converted into reality on screen?
Well, we're ready with our materials now. We're ready with the writing, and I think the next stage really is to figure out the right home for it, so the right platform. That's a process that's ongoing right now.
So how do you pick the right home for something that you're producing? I mean, give us an example in the context of this with the anarchy. How do you find the right home?
I think the platform that can actually give you the resources to tell the story in the way it should be told, and that gives you the global reach to be able to reach out to everyone who you believe the story will resonate with, would be the right platform. And I think, you can literally count them on one hand, maybe two. There are 5 or 6 platforms around the world that have the resources and have the ability to be able to give you that reach.
So have talks begun with the Netflixes and the HBOs of the world?
Talks have just begun. A little too early to sort of get into details around that, but it is exciting.
I would imagine that exciting. But, again, just break this down for our audience. Like, from the time that you actually decide that, okay, this is a script that you want to actually convert into something that goes to screen, to reaching out to a platform that could potentially house this, what are we talking about in terms of timelines? And then finally, the eventual execution.
It takes time. These massive projects take a long time, because what happens is that you need to find the right creative team to start with, the right writers, the right director. You then go through various iterations around drafts of scripts and pilots and Bibles. Then you find something that, okay, fine, this is something that we now all have bought into. We love what we've put down on paper, and that's when you take it to a platform. From that point onwards, it's really about getting the right platform on board, and then you start your pre-production. So the process can usually take anything from 3 to 5 years.
3 to 5 years, which also means that you have to have deep pockets to be able to sustain yourself for 3 to 5 years.
Well, if that's all you're doing, then yes. Thankfully, you do continue with life as usual while you've got these big projects that you're hatching.
Yeah.
So the good part is that you're making films and series and doing all that, good stuff, while keeping your eye on the prize, which is, large projects like this.
But, for a large project like this, with a global ambition and a global aspiration mounted to that scale, what are we talking about in terms of resources that you require to be able to put something like ballpark?
Well, the per episode costs for shows like Game of Thrones and The Crown range anywhere from 8 million to 20 million an episode. I heard the budgets of the latest Yellowstone, series were actually $20 million an episode. So you're talking significant funds. As I said, there are a limited number of global platforms that can actually have the ability to to fund you in that manner. And those are the ones that you talk to.
And, link this back to what's happening in India when you're delivering for an OTT platform here in India. What do the costs? I mean, they're clearly nowhere in the vicinity of what we just talked about. But what are we talking about?
Well, in India, the budgets are pretty different. So I think you're talking anywhere from, if it's a show that's really quick and easy and, like more intimate and a more controlled setting, it could be anywhere from 50 lakhs to 1 crore per episode. But if it's something larger and at scale, then it could go up to 4 or 5 crores an episode.
This global aspiration that you spoke of, and this has been something that you've been rooting for a long time now. You believe that India has been poised to have its crossover or breakout moment, just as we've seen with the Parasite and so on and so forth. Why has it been so elusive? What makes you believe that we're finally there?
So it's been so elusive probably because we've been victims of our own success in a way, because we have such a large captive market of our own that traditionally India has never really had to reach out to the world.
Right.
You've had the Indian audience and you have the diaspora audience that accounts for millions and millions of people wanting to watch the stuff that you're producing.
Yeah.
And so unlike Italian cinema or French cinema or German cinema, which has had to find new markets, we haven't had to do that. But I think the time has come now where you have a whole generation of filmmakers who've been schooled in an international style of storytelling, but who are still rooted and want to tell stories from their own country. And I think that actually gives you the ability now to really believe that you can reach out to the rest of the world. But I feel the more rooted your stories and the more local your stories, but with a global style of storytelling, those are the ones most likely to succeed.
So what's exciting you about the stuff that you're seeing being made today that gives you the hope and the belief and the confidence that we are ready to make that inflection?
With a lot of the stuff that we're making, especially on streaming platforms today, I think, you've seen stuff that is being told with a pretty global sensibility. I'll just give you a few examples, like a show like Kohra, for example, right? It's very local, very rooted, but I think the beats of the way that the story unfolds is told in a very international way, right? So I think it's about finding local stories and finding internationally appealing ways and global ways to be able to tell it.
When you look at a story, you look at a script, what draws you? What's the first thing that draws you to a story or to a script that kind of tells you in your gut that this is something that you want to take forward, this is something that you want to make? Which have been some of the examples where something's jumped up at you and it's been a success, but also where it hasn't and it's gone on to surprise you?
So the first thing is I react as an audience, right? I react as just someone who enjoys movies or enjoys shows or, just like a viewer. And so when I read something and I feel like, oh, wow, this is something that I would really want to watch, that's the first thing that really has to stand out for me.
And how many scripts do you get in a week?
Oh, we get a whole lot. I mean, we have a team that really, their only job is to sift through the material that comes in. I'd say anywhere from 10 to 15 scripts a week, probably, if not more.
Are you also seeing a diversity from where these scripts are coming in? I'll ask you this in the context of a conversation that I had with the founders of an audio streaming service. And they said that they're getting stories coming in from the interiors of UP, from Chhattisgarh, and those are the ones that are actually turning out to be their big blockbuster hits. What are you experiencing?
The same thing.
Really?
The same thing, which is very heartening. I think the number of people from the smaller, the smaller towns, I'd say even sometimes from villages who reach out to us with, even if it's a concept note, it might not be a full screenplay, is quite significant. And we have a website and we have an email link that helps people to be able to just send us their material. And that, I think, has shown us the diversity in terms of the places from which we've been getting that content.
So what was the one that surprised you? What was the one that you were absolutely sure of and it delivered on that expectation?
I think probably Barfi was one which was the most difficult to pin down, but you knew it at a visceral level, you reacted to the material. Because, Anurag Basu has this amazing ability to be able to conjure up a world without really putting that much down on paper.
Yeah.
So he actually talked us through what he had in mind as far as the film was concerned. And he didn't have a complete screenplay, but just the characters and the world he was able to sort of envision and what more important than envision, actually communicate, just blew us away. So that was one of those leaps of faith that I'm so glad we took. Because it could have been very easy to say, yeah, just come back to us with a final screenplay and then we look at it. But it was one of those films where we said, no. We've made Metro together. We'd made Life in a Metro before that. And we had the confidence in him to be able to take that forward. Chennai Express actually was another film where, there was a full narration that happened with a group of 20 people, and we were laughing our off and like falling off our chairs. And it was just, one of those films which you know that if this is executed in the right way, it's going to be a rip-roaring success.
It's interesting that you talked about the fact that it was a narration, it wasn't even a full screenplay or perhaps not even a finalized script. And I remember watching, I can't remember who it was, but these film stars saying that, when they actually saw, and this is like maybe 20 years ago, or even 15 years ago, saying that scripts were actually being written on set, dialogues were being handed over to you before you actually got onto set. How much of that process at the back end has changed, especially with corporatization and so on and so forth?
That's changed very significantly. Yeah. Today you have, fully completed screenplays with dialogues ready well in advance before you go into prep. Actors expect it, the HODs expect it, everyone expects it, and more importantly, those funding the film expect it, and rightly so. But you do need to leave a certain amount of flexibility for creativity to strike, right? So I think it's important while a scene is being played out, if, the writers on set or the writers called in, and there might be certain things that the actors and the director feel they want to play out differently. You always need to leave that
for some spontaneity.
But that can only happen when you're really well planned.
Yeah.
Because that room for spontaneity needs to be still within a controlled budget, within, a certain number of days of shoot. And that, I think, is important to leave space for.
So as a producer, what's the stuff that you sweat today? What's the small stuff that you let go? What's the stuff that you sweat today?
I think budgets, obviously, is something that everyone looks at very closely, and you should look at very closely as a producer. The script is something that you should really, really look at very, very closely, because you need to be completely convinced about every line that's in there. Either you get convinced or you're able to convince, but one way or the other, the entire team associated with the project needs to be on the same page. The casting is something the producer needs to be very, very closely involved with.
How involved are you personally with the casting?
I'm pretty involved with the casting. Having been around as long as I have, having the relationships one does, it's important to be able to pick on, pick up the phone on the people that you want to be able to cast and give them a feeling of how passionate you are about the material, so that they understand that it's something that they should give consideration to as well. So for the key cast, that's something I'm quite involved in.
What was a casting call that you made that kind of worked out the way that you had imagined it to?
I think probably Dangal was that one time that was a very important casting call, because I remember that we had a young girl in our creative team who came up with the idea, having read an article in the Times of India. And she came up and said that, that we want to make a film on these. I mean, wouldn't that make a great story?
Yeah.
The Fogat sisters. And I said, absolutely, you must go and, check it out and go and meet the family. She did. And she said, you know what? It's about the father and the daughters, not just about the daughters. And she came back and we spoke to Nitesh Tiwari. We just made a film with him just before that Chillat party. He loved the story. He went away and wrote a great screenplay. And then we started brainstorming on who to cast. And at that time, of course, Irfan was someone that we'd worked with already on Pan Singh Tomar and Metro and so many. He was someone we had in mind. He would have done a wonderful job. But then I got a call from Amir at that time saying that, he had time to sort of listen to scripts. And I immediately thought, what about this for him? And that's one call that actually really helped, because I think he was able to see the potential in it. Many other stars of his stature might not have been okay with playing an overweight wrestler who's like a bit of a has-been, who's living out his dreams through his daughters.
Yeah.
But he immediately saw the potential in it. Of course, in typical Amir style, he asked us if we'd wait for 5 years.
What was your response?
Our response was absolutely, because I think when you know him well enough, you know that he might say that, but it might be difficult for him to resist something that he loves that much. And so pretty much after a year after him saying yes, 5 years later, he came back and said he'd do it.
I think my research tells me been involved with 6 Indian movies that have made it to the Oscars.
Yeah.
So why do you think, or what do you believe has been that, the ingredient or the secret sauce that you've kind of meshed into the work that you did for these films to make it where they did?
Well, it's hard for me to be able to define that. I think it comes from the sensibility probably of the choices that one makes along the way. And thankfully, those are the ones that get selected by the Film Federation of India to be the ones that get sent for the Academy Awards. But it probably is because one has a bit of a global outlook on things. And I'm always looking for ways in which to be associated with content that has the ability to resonate beyond our borders. That probably might be the reason.
Speaking of the Oscars, the rules have changed now. You're going to have to watch every movie.
Every movie, I know.
But what do you believe that? Do you believe that that's a good thing to do? And how do you see this changing things?
I do actually think that's a good thing to do, because I think it's only fair for a film to get judged as compared to everything else. And it's probably not okay for members to be able to vote, having watched only 10 or 15 of the films, that are up for grabs. So it's definitely going to be a much more demanding process of the Academy members. But I was watching a lot of those movies anyway, so I think for me it shouldn't be too bad.
How much time do you actually spend consuming?
A lot. And firstly, I just enjoy consuming content. I think whether or not I was in this business, I'd still be doing it.
You do it irrespective.
Exactly.
Yeah.
I mean, I grew up watching copious amounts of films, so that in that sense, nothing's changed.
Nothing's changed, but a lot has changed as far as this business is concerned, and that's what I want to talk to you about. Where do you believe we're at? As I said, we've gone through that phase of corporatization. We've gone through a phase of consolidation now, especially as far as the television side of the business is concerned. Where do you believe the industry finds itself today?
It's at an interesting crossroads today. I think we've gone through a period of consolidation in the last couple of years, where you've seen a lot of consolidation amongst the top sort of corporates in the space, which has led to a certain less aggression in the calls being taken, the number of things being made, etc. Probably because organizations tend to go a little quiet when they are consolidating, merging, acquiring, etc., etc. And I dare say now that water's found its own level on that score, I think the next few months are going to see a lot more activity. The second part, of course, is that consumer habits have changed, and we have to acknowledge that. So I think what COVID did is really made people realize how convenient it is to be able to watch content at the tip of your fingertips.
Yeah.
And now to get out of that cycle takes much more. So to get someone to pay money to watch a film in a cinema hall, to go through the effort of booking the ticket, getting out of their house, braving the traffic, braving the ads that come before the film, braving an interval, all those things, it needs to be something really compelling. And which is why you've been seeing in the last few months a bit of a feast or famine situation. So the films that are doing well are doing incredibly well. I dare say they're doing better than they might have done even before COVID.
Okay.
But the films that are not working now have no flaw to how badly they can do. Which therefore means that the game has been upped as far as we're concerned, and which is a good challenge for us, because it means we need to give people something compelling and then they will come.
Speaking about giving people something compelling, there seems to be almost a disconnect between what audiences want and what filmmakers are delivering. And why do you believe that's the case?
Probably in Hindi cinema, what has happened in the last few years is that we've been trying to be all things to all people. And therefore becoming nothing for no one, in a sense, right? Because we have such a large audience we believe we need to cater to, it becomes a little difficult for us to be able to figure out who our core audience is. And I know that's a little bit of a broad thing to say, but writers need to just write based on what the story they want to tell, and don't let that get diluted by feeling like I need to reach this audience and that audience and the cities and the villages and the rural and the urban and the global, just tell the story that you want to tell and tell it with complete conviction. And I think then you will realize that audiences will come.
So do you expect 2025 to be a better year, both in terms of the quality of content as well as the pipeline of content? Because we've had a problem with both post-COVID.
I think so. I think 2023 was an incredible year. I mean, you had 5 movies crossing the 500 crore mark at the box office, which has never happened in Indian cinema before. 24 was a little bit of a lower year, and now 25, I'm hoping, will once again prove that, the audiences have come back to the cinema halls. Because for the movies that work, like I said, the sky's the limit today. And that gives me a lot of hope that if, the big movies this year fire and do incredibly well, and you always have a few surprises. So some of the smaller movies come in and just, like 12th Fail or like Munjia, for example, come and just surprise you. That really is the hope.
Speaking about making strategic bets at this point in time, and I want to talk about the economics of putting something together, either for the cinemas or for OTT at this point in time. What are the challenges as a producer for you? And do you believe that the costs will have to be reimagined as well and be repurposed for this new reality that we're talking about?
I do think so. And to some extent, we're already seeing a little bit of recalibration there when it comes to costs of actors, of heads of department.
Actors are taking salary cuts.
Well, I wouldn't say salary cuts, but they're definitely looking at now coming in more on the back end and taking less on the front end. So,
what does that mean exactly?
So which means actually enjoying the success of the film, if it works. So taking less upfront and then becoming partners in the success.
So it's going to become more revenue share going forward?
Yes. So there's a component of, obviously, something that's built into the cost already, which is a fee. And then there's sharing in the profit. And therefore, the upfront fee can be lower to reduce the cost of the project.
Yeah.
And then in success, everyone gains. So that, I think, is becoming much more prevalent as we go forward.
How much is the cost of talent of the key stars as part of the overall mix as far as costs are concerned for perhaps a big project?
If it's a big project, it could be as much as 30 to 40%.
30 to 40% is just the actor's cost?
Yeah. The lead actors. But, when you look at it, a lot of the viability of that project is based on those actors being in it. So I think when you look at it that way, you take out the drama from it and you take out the fact that, oh wow, it is 30 and 40% paid out to individuals. It's the same thing in Hollywood as well, right? If Tom Cruise is doing Top Gun, Maverick, a lot of that budget of Top Gun Maverick is going to be his fee, right? But that's because that film is going to get a massive opening because of Tom Cruise. And it's the same thing with our films. I mean, if Salman Khan or Amir Khan or Shah Rukh Khan or Hrithik Roshan are in a film, a lot of the economics are based on their presence in the film.
What about women?
Yeah.
Are the women getting paid any better?
They are getting paid better, but there's always room for
nowhere close to
parity.
Yeah. What is the difference that we're talking about today?
It's quite significant. It's quite significant. I mean, if you looked at it completely, without any lens, I do believe that it still is commensurate in terms of the commercial potential of those projects, because audiences have told us that they will come in certain numbers for certain kinds of movies. And therefore that, I think, is the up and down that does exist, whether you like it or not. But can there be more parity? Yeah, sure, they can.
In terms of monetization, I mean, what could be the next sort of wave of adding revenue streams? What are you considering at this point in time? What's working? What are you looking at?
We haven't really fully exploited the ability to take our content into revenue streams outside of just the sort of distribution of that content. So, for example, now our key revenue streams are theatrical, satellite, music, and streaming, right? But we don't really have that much merchandising, gaming, licensing. These things are much more looked at as marketing tools rather than revenue streams at this point of time. And I think we've made huge strides in these areas in many other industries rather than the film industry. And it's time for us from the film and television industries to be able to actually now look at those as really tangible revenue streams.
Are you starting to look at that?
We will, but it depends on the kind of project, right? If it's something that has that franchise value, that has the value of where the characters or the plot is something that lends itself to being consumed in different formats, those are the ones that you should pick.
The kind of OTT consumption that we're seeing, and I was just looking at some reports which is suggesting that we could grow again by another 20% from where we are today as far as online streaming is concerned. As a producer and catering to that business, are you doing things differently? Is there a more refined, evolved playbook in light of the lessons and the experiences that you've already had?
For sure.
Yeah.
Just in terms of the storytelling as well. I mean, there's a lot of information that comes to us from our platform partners because they've got the algorithms, they've got the data, they've got the viewership data, they understand drop-offs of audiences, length of time spent on a particular piece of content, why they're dropping off.
Is it true that you're asked to kind of choreograph scripts with imagining that somebody is going to be on their phone constantly while watching a series?
Well, thankfully it hasn't got to that. No. But there is definitely that feeling in the back of any writer's mind that, okay, this is a very ambient viewing experience because people might be doing 20 other things simultaneously, checking out a reel, ironing their clothes, chatting with someone while they're watching my content. And therefore, I need to be that much more compelling to be able to draw them in and get their full attention.
chasing capital, raising capital, I mean, is that the least favorite thing for you to do?
I wouldn't say that's the reason I got into this business. That's for sure. But it is very important, right? Because if you want to tell the stories that you want to tell, you want to have the wherewithal to be able to tell them. And I think our industry offers some really scalable opportunities. We've got the ability to actually be the next Korea when it comes to being able to take our soft power out to the world. And I don't think India has really scratched the surface there in terms of being able to take our stories.
But we've been
global.
talking about India being the next Korea for a few years now.
That's true.
So again, I come back to what I asked you. Why do you believe that we haven't got there, and what do you believe will ensure that we finally do?
We probably haven't acted on that ambition yet. Korea's been at it since the early 2000s, if not earlier, right? And they've had a lot of government impetus there as well. They actually have the government actively involved with them in that exercise, both in terms of hard funding as well as the softer part about helping them find distribution partners, etc., etc. And I think if we're able to do the same,
so do you want the government to get involved?
Well, if it's about supporting the industry and helping the industry to be able to either find tangible financing, like sort of opportunities, and helping us being able to find distribution, for sure. Yeah.
So, we've got the big wave summit here in Mumbai, which is basically going to bring together, of course, all the Indian stakeholders, but global stakeholders as well. What's your hope with that?
I think it's a great start. It's a really great start. The first thing it tells me is that the government's thinking about the entertainment industry, right? That I think is a massive step forward. Just the fact that we're having this summit, I think in itself is something that we should all be very happy about. What we do with it is really up to us, because we need to build on it. We need to treat this first year as just the first year in the exercise and not expect magic to come out of it. But it's when you do this year on year, you bring the right people in, you have markets there where people can interact and talk to each other about global, financing opportunities, co-production opportunities, creative opportunities. That's when real things will develop from it. And I hope that that's the start of the government really looking at how they can leverage the soft power of our country, right? And the soft power that is given to us by our massive media and entertainment industry in terms of perception. Not massive yet in terms of revenue, but we can get there, to be able to help us to reach out to the world.
When we talk about the revenue opportunity, I mean, what is the size of the business today, and where do you believe, if we continue at this pace without any government intervention, for instance, what do you believe it could potentially be?
Well, I think I dare say 1% of the GDP or less than 1% of the GDP right now, which is not that big. And it punches way above its weight when it comes to perception and noise, right? Because it's an industry everyone loves sort of talking about. But it also presents you massive headroom for growth. That tells you that that's a huge potential. Considering our population, we're reaching out to 3 to 4% of our audiences in a theater with our biggest hits. What does that tell you? That definitely means that 95% of the population who might have enjoyed watching our films does not have the opportunity to do so because they don't have theaters where they live. That's a massive opportunity as well. So I know we talk about lower occupancies, but those lower occupancies might be because of oversaturation in certain places and under exploitation in others. So I think the sky's the limit in terms of where we can go.
So what is the next, of course, the anarchy is the big one as far as your global aspiration is concerned. But outside of that, I mean, what is exciting you about where RKF finds itself today?
Well, we're doing a lot of really interesting things when it comes to films and series right now. We've got a show called Matka King that we're doing for Amazon, which is, based on Matka, which was the illegal gambling syndicate that started in India in the 60s and went into the 70s as well. We've got one more show that we're doing with Amazon, which is on the floors right now. There are shows that we're talking to Netflix about that might go into production soon. We've got, various theatrical films that are in active casting right now. We've got The Anarchy as well. We've got a few other global projects that are under active discussion at this point of time that, like The Anarchy, will be set up internationally. So there's a lot going on.
Potential headwinds for the industry, and I'll ask you this in the context of what we're now seeing happen in the Supreme Court, where a plea is being heard on whether there should be regulation of OTT content, and the Supreme Court has actually issued a notice to the centre saying, are you looking at OTT regulation? As a producer, How concerned are you about that possibility, which now seems very real?
I think it's important for the redressal system that's been set up right now to be allowed to operate. It's a really good medium that's been found between the concerns that the government might have had earlier with the proliferation of OTT platforms. You've got a three-tier regulation system. From what I hear, it's working really well. You haven't had that many issues come up to the final tier. They've been sorted out even before that.
Is there, for the lack of a better word, self-censorship already?
I don't know if I'd call it self-censorship, but there's definitely more of an acknowledgement of the things that are hot button issues and just trying to veer away from them or if you do go towards them, then doing it with full knowledge that it might cause a concern.
Yeah.
So there's definitely a lot more of that that's
Do
happening
you consciously and actively stay away from hot button issues?
I do. Yeah. I do. Because, there's a lot of time, effort, money that goes into a project from a lot of people. And I think it's pretty heartbreaking when you go through all that effort and then it finally comes to naught because you probably should have been smarter about what you selected right at the start. And it just doesn't make sense. I think we're going through a very sensitive time as a country. For one reason or the other, not sure what it might be, but people are ultra sensitive about how certain groups might be perceived when it comes to certain issues, when it comes to religion, when it comes to nationalism, when it comes to caste. These are issues that just tend to create problems because there are certain interest groups that come up at the time that a film is happening that might want to gain prominence in PR and have no other opportunity to do so, so they latch on to a film. And these are sometimes things that a government can't do anything about, because if some local group is creating an issue, they can be silenced, but they can't really be put down completely, right? You can say things that might ask them to pipe down, but if they choose to create a disruption, that just causes a sort of situation which you don't really want.
So what is sort of off the table then in this context for you? What are the sort of scripts or the sort of subjects or issues that you will not do?
See, it's not like will not do, it's about the intent with which you're doing it. I think because that's often seen. It's if you're talking about caste or religion or class or nationalism or things like that, if you're doing it in a way that is not pointlessly creating a conflagration in order to be able to drum up a controversy, then that's often something that the CBFC will see and that the redressal boards will also understand. But if it's being done in a little bit of a cynical way in order to create a bit of a disruption, then those are things that come to the fore. So it's not like I'd like to stay away from anything, but it's more about the way in which we tell that story that needs to be a bit more sensitive.
But do you think that the reality of regulation, not in this redressal way, but actual regulation, just like the way that films do, is something that we should be prepared for, ready for, as far as the OTT platforms are concerned?
See,
and
as
how
far
will
as
that
I'm
change
concerned,
the commissioning process?
Ideally, I don't believe we should have censorship. I think everyone should be allowed to tell the stories that they want to tell. I think we're a mature enough society. We're mature enough people. But the fact of life is that there is a certain heightened sensitivity. So we have to just accept that, whether we like it or not. And so it's a given that there will be a CBFC and there will be a redressal board. I don't think you need regulation beyond that. I think it's best for there not to be regulation, because with regulation comes a very doctrinaire approach to things which will try to codify certain things that sometimes it's very hard to codify creativity.
Yeah.
And you'd rather treat each case individually.
For instance, what constitutes as obscene, which is one of the observations and questions being discussed in the Supreme Court.
Exactly.
Yeah. But, as the sort of next wave of disruption, as the next set of trends that one should focus on, what do you believe are going to be the genres that you believe might take off from here?
That's a good question. I think mythology we haven't really explored as much as we should, probably because budgets did not allow us to do that. I mean, you had a lot of it happen on television in the Doordarshan days and even after.
Yeah.
But I think told in your Lord of the Rings, sort of fashion, told with that pomp and splendor and with the right VFX and graphics and, spends really put towards it, we've got a treasure trove of stories that are just waiting to be told.
Are you going to tell them?
I hope so. I hope so.
Anything that we should be ready for?
Well, I think I'm working on something on the Mahabharata that's a pretty interesting episode within the Mahabharata. Because sometimes you tend to want to tell the Mahabharata, but just the task is so daunting that you feel, how are you ever going to be able to do it? It's going to be 10 years of someone's life. It's going to be multiple films. But we, I think, have managed to come across one episode within the Mahabharata that we're very excited about telling.
Okay.
And that actually has a logical beginning, middle, and end that, encapsulates, that has all the characters in it.
And this is going to be a film or a series?
A film.
A film. So mythology, what else?
I'd say horror is sort of evergreen in India. We love our horror films. And so, even when you see films that come in from the West, like The Conjuring, for example, work supremely well in India. So horror well told. I think you're seeing the horror comedy genre having its moment right now anyway. But horror definitely, thrillers. I wouldn't give up on drama theatrically.
Okay.
Like 12th Fail, I think told us that drama well told in an entertaining way and in a compelling way can still work in the cinema halls. A lot of people are feeling like dramas and rom-coms are now the exclusive preserve of streaming.
Yeah.
But I don't really believe that. So I'm quite optimistic about pretty much every genre.
Speaking of genres as well as the kind of movies that gave us joy. I mean, we're now going through a phase where re-releases are likely to be revenue drivers to try and get footfalls into cinema halls.
I just saw Andaz Apna Apna yesterday.
A classic. How many times have you watched that?
I can't even count.
What is the movie that you watched the most?
Sholay.
Sholay. How many times?
I mean, it's impossible to... I was watching it pretty much every 3 to 6 months at one
point. Are you serious?
Yeah.
Every 3 to 6 months?
Every 3 to 6 months. I started watching it when I was a kid at Minerva, where it had played the longest that I think any film has ever played, other than Dilwale now, has played at Maratha Mandir. And I used to take my poor grandfather there and torture him through having to buy tickets in black for me every few months.
Evergreen. So what's the recent film that you can... sort of haven't got enough of?
A recent film that I haven't got enough of. I've stopped watching movies multiple times in the recent past as much.
Because they're not as compelling?
Not as compelling, probably. But, again, Andaz Apna Apna, which I just mentioned. But yeah, that's still 30 years old.
Yes.
But not that many in the recent past that I've watched multiple times, I have to admit.
One casting call that you haven't made is to Vidya. Why is that?
Well, we as a family have this semi-formal pact not to work together. Yeah.
Not to work together.
So my brothers and Vidya and I have this sort of, it's not like carved in stone or something, but we just feel it's healthier not to.
So this was a conversation that you had, or this was a conversation that they brought up?
I think it came about over time where we just realized that we'd rather be there for each other through our ups and downs as family rather than actually being in there together in the trenches on the same project. Because the ups and downs in the business can get quite, emotional, and to sustain you don't want to be crying on each other's shoulders. You want one person crying on one person's shoulder at a point of time.
5 years on, where do you believe RKF will be in its ambition, in its aspiration, as well as in its financials?
Well, the financials are hard for anyone to be able to project 5 years out, but where I definitely think we'd like to be is being able to tell great stories, compelling stories, both to our audiences in India as well as around the world, and also to global crossover audiences. So really to be able to be that one Indian content studio that is for India, but also is reaching out to the world.
Is that the aspiration, the Indian content studio for the world? Make in India for the world?
Indeed.
Yeah.
It is.
Well, it's been an absolute pleasure. Thank you so much for speaking with us, and we wish you the very best of luck with that ambition, with the anarchy, and a lot more. And we look forward to hearing back more from you. But thanks very much for joining us.
Thanks
here
so much.
Thanks so much.
Fun.
Well, with that, it is time for us to wrap up this edition of the Young Turks podcast. From all of us here on the team for now, goodbye. Thanks for watching. We'll see you again next week. Till then, thanks for watching.
investment trust American Tower celebrating its 30th at the NASDAQ. It is eToro celebrating that IPO from yesterday, Jim. Closed almost 30% above the IPO price.
Wow, there's real money being made, and I feel like that this is the beginning. We have an
The Gates Foundation, one of the largest charitable foundations in the world, is marking its 25th anniversary. Now, the Silver Jubilee comes with a big commitment. Bill Gates is pledging to give away, in his words, virtually all of his wealth over the next 20 years, which means the foundation plans to spend $200 billion over the next 2 decades. Now, this accelerated timeline has meant a change to the foundation's charter, which had stated that the organization would sunset 20 years after the death of Bill Gates. The last big change to the foundation had come in 2021, when Bill and Melinda Gates announced their divorce. Melinda Gates resigned as co-chair in 2024, which left Bill Gates as the sole chairman of the Gates Foundation. Now, from combating infectious diseases to agriculture research and reproductive health, the Gates Foundation has been at the forefront of solving some of the biggest issues in the world today. And joining me now to discuss the foundation's future and his pledge to give away virtually all of his wealth is the man himself, Bill Gates. Bill, many thanks for joining us on CNBC-TV18. And let me start by congratulating you on 25 years at the Gates Foundation. But Bill, why this decision to set yourself a new deadline of 20 years to give away virtually all of your wealth? What has prompted this decision? Why this change from the original position?
Well, looking back on these 25 years, it's amazing what we've been able to accomplish. You know, together with partners, just, you know, the one statistic of cutting the number of children who die every year in half has been phenomenal to be part of that. And so as I was thinking about that, I decided that we should essentially double down and spend all the rest of the money I'm lucky enough to have through the foundation on these causes over the next 20 years. And that'll allow us to be very aggressive, make some fantastic progress, and, you know, we'll have real clarity. A lot of resources for 20 years, and then others can step in with whatever we haven't been able to finish off.
If I may, Bill, is this decision to accelerate or speed up the giving that you're doing linked to the overall environment that we're currently seeing, where there is a retreat from multilateral institutions, from multilateral arrangements, from development aid? How much of this acceleration perhaps is also linked to the change in the environment as we see it today?
No, this decision was made before all of these reductions were clear to us. I would say in the short run, it means the work we do is going to be challenged. You know, although I expect every year we'll have progress in India and some of the countries we work in. In Africa right now, these cuts to the aid budgets, the debt situation, some of the instability means the next 4 or 5 years will be difficult. But over the time period that all my money will be given, I still expect to see pretty incredible progress. You know, so in the short run, I am very disappointed that aid generosity is down. But with the innovations in the pipeline, you know, with, I think, going to people and saying that those aid budgets should come back to some degree, I'm, you know, super excited about what we can achieve in these next 20 years.
Bill, you know, you talked about doubling down on the significant resources that you've already committed. $100 billion was the previous amount that you did over the last 25 years in spending. You're doubling down on that, $200 billion between now and 2045. So help me understand, these are big numbers. Prioritize for me how you intend to use this money and what are you hoping to achieve in terms of impact?
Well, the first 25 years, we got childhood deaths down from 10 million to under 5 million a year. And we also took the two other diseases, HIV and tuberculosis, and the deaths were cut substantially for both of those. We also came up with ways to save mothers who are giving birth. And so we're really putting most of the resources into the global health work. We hope to be able to cut the number of children who die more than in half again, and also to make dramatic reductions in all infectious disease. We need to finish our polio eradication. Still a lot of hard work left there. And we also think some other eradications, guinea worm, malaria, a number of diseases could be taken all the way to zero. And so by having, for the next 20 years, over $200 billion in resources, double what we spent in the first 25 years, we'll be able to partner with scientists, and we have a great partnership with the Indian government to help them achieve their ambitious health goals. And this field, the field of global health, will be able to perform miracles, and our resources will be a meaningful part of that.
Bill, you spoke about the ability to deliver miracles. What have been some of the hardest fought battles over the last 25 years? You talked about some of the important outcomes, especially on the global health front, that you've been able to achieve. What's been the hardest part of making those a reality? Resource is one thing. Execution is another thing altogether. What's been the tough part on the execution front?
Yeah, so for the foundation, we both work on the R&D side, so like creating new vaccines. And so, with Serum, a great Indian partner, a meningitis vaccine was one of the first new ones the foundation did. Later, a rotavirus vaccine that was very low cost, a pneumococcus vaccine. Then with other partners like Bharat, a rotavirus vaccine that also brought prices down. So it's the vaccine work, both in the R&D and the delivery, is probably at the top of the list of the impact that we've had. Vaccines, you need to keep them refrigerated, you need to make them cheaper, you need to convince mothers to bring their children in. So, there are plenty of challenges just in that one area.
Bill, you talk about India. Now, you've been spending a fair amount of your time here in India. And of course, the foundation has been working in India for a good part of the last 25 years. Let me ask you about what excites you about what's happening in India today. How important is India going to be for the Gates Foundation over the next 20 years?
Well, certainly India's a very, very important place for us. It's our biggest overseas office, and it plays two big roles. One is that the Indian government has very aggressive goals for improving health, and so we get to partner and try out the latest advances in medicine, and that we've seen great results from that. But the actual creation, the R&D of the new tools, whether it's diagnostics, vaccines, drugs, new seeds to help farmers, or ways of taking AI and helping with health and agriculture as well as education. India is going to be a place where there's so many smart people, so much desire to see these improvements that will pioneer a lot of things first in India, and the brilliant work there will then benefit the entire world. Paradigmatic of that is the work in digital finance, where Aadhaar and the ability to pay digitally, India really did an amazing job on that, and now we work with the Indian government to make that available to all countries.
But Bill, you've been spending more and more time here in India and doing lots of fun, interesting things, not just linked to the foundation, but even outside of the work that the foundation is doing. What about being in India, about making the connections here in India, the people that you're spending your time with inspire you today? I mean, is this a new romance with India that started over the last few years?
No, I've always been fascinated by India, and of course, Microsoft has had a fantastic relationship in terms of the huge development offices that we have in India, as well as amazing people like Satya Nadella that have come and made huge contributions to the company. And so as I moved from Microsoft to the foundation, I took that understanding of the great talent that's there with me. And so, you know, I get to India on a regular basis and get to meet with the partners there. You know, the majority of the world's vaccines by volume are made in India. We've had, you know, so many important partnerships with that, and that's really growing. You know, the quality of research in India, you know, its desire to go even beyond vaccines with the tools that are provided, you know, it's very timely. And, you know, part of that is Prime Minister Modi's been very generous at sharing with me his goals, and so we can talk about how the foundation helps with that.
You know, Bill, you've referenced vaccines, and I want to ask you this in the context of the last conversation you and I had, which was in September in New York last year. Now, there you had talked about being a salesman for Gavi, the Global Vaccine Alliance, in its quest to raise funds. You've been central to Gavi's ambition and aspiration of providing affordable vaccines to the world. At this juncture, with the very real possibility of funding drying up, specifically from the US, how concerned would you be about Gavi's future?
Well, I'm very, very concerned. It would be tragic if Gavi weren't able to raise as much or more money for this next 5 years as it's had for the last 5 years. And yet, it's pretty clear that we're going to see a reduction. You know, I continue to talk to all the governments about the impact. You know, there's nothing more amazing than you know, making sure all the children of the world have these miraculous vaccines. So we'll see what we're able to raise, but it's looking tough. You know, I'd say the next 5 years, the whole aid picture, whether it's Gavi or Global Fund, are going to mean that, you know, we might go backwards a little bit before we resume the progress we've seen since the turn of the century. And, you know, that's just a mistake, and I'll be speaking out very loudly, you know, try to get the U.S. back in, try to get others to maintain or even increase, in some cases, their giving.
But do you feel confident or optimistic about that? You said you're going to try and draw people back to the table. But at this point, with the global retreat that we are seeing, especially from development goals, Bill, how much of a slide back do you believe we should be prepared for? Are we set for?
Well, we have two forces. One is the power of innovation, you know, that is new tools, whether that's new drugs, new vaccines. We have AI to even help with the delivery, to talk to patients and give them advice about care seeking, you know, things like the ultrasound that'll help figure out about the whether a pregnancy needs special care. You know, so the innovation side is, if anything, going faster than ever. The generosity on resources for the delivery side, the next 5 years are going to be tough. And that might mean some of our statistics that have been improving, we might have a period where they'll get somewhat worse, particularly in Africa. And that's tragic. That shouldn't happen. If you look at the full time frame that all my money, you know, will be given over, I'd say we will be much better off by the end of that than we are right now, despite this period where the aid budgets are really going to hurt our work, particularly, as you said, things like Gavi and Global Fund not being fully funded.
Well, we are going to head into a break and continue our conversation with Bill Gates on his big pledge to spend $200 billion as part of the Gates Foundation over the next 20 years. Welcome back. You're watching the CNBC-TV18 exclusive. We're in conversation with Bill Gates on the big pledge of accelerating the spending being done by the Gates Foundation, $200 billion over the next 20 years. You know, Bill, the last 25 years, the Gates Foundation has worked very closely with Warren Buffett. He's been instrumental in the $100 billion that you've spent in the journey so far. Is there a disappointment that he isn't going to be a co-traveler, a fellow traveler over the next 20 years for you at the foundation?
Well, I'll certainly be very sad not to have Warren's regular advice. I mean, Warren is so wise, so generous. You know, he's been a great friend to me. You know, his example as a philanthropist, I think, has influenced many people besides myself. As you say, he's a huge contributor to the foundation. His family is very committed to the causes the Gates Foundation works on, and so they'll continue to be, his children will be great partners of ours in many of these areas. But no, it'll be tragic if Warren's not around. He's 94. I hope he lives this whole 20 years, but you know, he might not.
Well, speaking of milestones, it's 25 for the Gates Foundation, it's 50 for Microsoft, and it will soon be 70 for you in October. As you look back and reflect on the many milestones that you've achieved personally and in your careers, if you had a chance of a do-over, would there be anything that you'd change, anything that you'd do differently?
Well, I'd be very reluctant to go back and change things since I've been so unbelievably lucky. You know, my parents, who I got all my values from, and you know, they made sure I got a great education. You know, I've had amazing friends like Paul Allen, who helped found Microsoft, Steve Ballmer, who allowed Microsoft to be so successful, and now an unbelievable number of great partnerships at the foundation with the incredible team there, and partners all over the world. So. I'm the luckiest person in terms of what I've been able to be involved in. So yeah, I've made plenty of things that I've had to learn and do better, but I don't think I'd want to risk going back and making any changes.
Well, speaking of wanting to do better, you're no stranger to criticism, and it's been constant, but perhaps post-COVID even more so. Questions about the influence that organizations like yours build on decisions that have been taken. Many call it the tyranny of the unelected. How do you now respond to that criticism, Bill, and how do you believe the foundation should learn and position itself over the next 20 years to take some of that feedback and criticism on board in some constructive way?
Well, I think the agenda of saving children's lives, and making sure they're well nourished so that their brains and bodies fully develop, fortunately, that's not a super controversial agenda. All the governments we work with, including India, have goals to reduce those deaths, and so we're able to work together. Vaccines themselves, we test them to make sure they're incredibly safe, and so there is some controversy about those. But for example, with polio, there's not a single kid in India who's been paralyzed since 2011, when the final case, which was tragic, was taken care of, and so we get pretty strong support for the work we're doing. Sometimes seed technologies or contraception, we have to make sure we're communicating well about those things. I wish there were more people involved in, critiquing what we're doing in malaria and TB and HIV. Some of the work we do can actually be pretty lonely because it doesn't get the attention, the resources or the number of people engaged. So, I'd love somebody to criticize our TB drugs or vaccines or diagnostics and, share their ideas, because TB is back to being the world's biggest killer, and there's just so few people funding the work there that we wish there were more.
You talked about TB, malaria, and you're hoping that we see breakthroughs on both those fronts. But outside of health, the innovations on energy, the R&D work that's happening on Alzheimer's, I know that there's been a large part of your mind space and as well as your resources that have occupied these areas in the last few years. What are you most optimistic about, both on energy, specifically nuclear energy, and the work that's happening on things like Alzheimer's, the tuberculosis vaccine, etc.?
Well, if I had to pick one, I'd say, getting to the bottom of malnutrition and really solving that might get to the top of the list. It's a tough competition because we've got a HIV vaccine, a TB vaccine that you mentioned, a malaria vaccine, all very important. I also support new energy innovation. I do that through for-profit investments, including, for example, Tata Power, that's working on new lower-cost nuclear reactors. And so climate change, avoiding the worst of that, and getting cheaper energy is important. But I'd say the malnutrition would be at the top of the list.
Well, it's clear that you're definitely not retiring anytime soon, Bill. What keeps you going? I know pickleball is definitely not going to be something that's going to occupy a lot of your time outside of the foundation's work. But what keeps Bill Gates going today?
Well, I'm very lucky. I love reading. I love, traveling. I have great sisters and friends, and I love tracking the innovation, meeting people who are out in the field doing the tough work. So it's fascinating, and even though we'll have setbacks overall, the possibility of what we can achieve in these next 20 years keeps me going, makes me want to travel and work hard.
And the possibilities that you alluded to, what we're seeing on the AI front at this point in time. But for AI to really address the world's real challenges, healthcare, finding solutions to the many access deficits that exist, what are we talking about? Are we 5-10 years out before we start to see an inflection point on some of these big, real transformational challenges?
Well, there's no doubt in the next 5 years, it'll be pretty radical, both in terms of how we discover new things, where the AI will help, and even healthcare delivery, where the patient will be able to talk with the AI and share everything that's going on with them and how they should interact with the health system. And so, no, that's near term. We have a lot of partners who are doing pilots even this next year.
Well, you've been part of the private sector and, of course, then moved to the development world. If I were to ask you for your message to the private sector in the current volatile environment that we're in, to other philanthropic organizations as well, organizations that you're perhaps partnering with or you're hoping to partner with in the future, what would your message be to them? What would your message be to governments today? You said you want to ensure that your voice is heard. What would you tell governments around the world today as we perhaps face what could loosely be called a leadership recession?
Well, the value of helping other people is pretty strong in all the world's religions. And so, that should extend to the poorest, those most in need. And so the idea that we're having less money to buy vaccines for the world's children is a bit of a surprise. And, my advice is, hey, let's reverse that and accelerate the progress we've seen, which, we should all be so proud of.
Well, Bill, with that, thanks very much for joining us here on the Global Dialogue today. Thanks very much for giving us a roadmap of where the Gates Foundation is headed. It's going to be an accelerated timeline for you to spend $200 billion over the next 20 years. It's a significant amount of money and, of course, a big change as far as the foundation's charter is concerned. Bill Gates, always a pleasure. Many thanks for joining us here. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with more.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. This week, we are going to put the spotlight on investing in global equity markets via global funds, or you can call them international funds. Now, mind you, these are funds that are being run by Indian asset managers. So why do you need to look at these funds in the first place for your portfolio? What is their taxation structure? And what funds could perhaps be suitable for investors given the risk appetite and the risk-taking ability? Well, this is what we talk about, and to help us demystify this world of international investing, we have with us Nasir Salim of Flexi Capital and Niranjan Avasthi of Edelweiss Mutual Fund. Gentlemen, great to have both of you on the show. Thank you so much for joining in. And I thought perhaps it's an apt time, right? Because I don't think we've seen so much of volatility in the Indian market, in the international market. The headlines are changing by the minute. And you realize that perhaps for an involved investor, it might make sense to have some exposure to shores that go beyond India as well. So let's get your opening thoughts. And Niranjan, you folks at Edelweiss have so many of these global funds, from China to US tech to I think even Europe, right?
Yeah.
Why should one go global?
Yeah. First of all, thanks, Surabhi, for having me. Broadly, over the last 2-3 years, we have seen huge traction for investing globally. And, especially in last 1 or 2 years, when we have seen global markets, Indian markets going through volatile times, it is very, very important to study this category and take exposure. 2-3 reasons, One, if you see last 10 years, India has been amongst the top 3 performing markets maybe 3 to 4 times. US has been there 6 times and China has been 2 times. Now, if you want these winning markets to be in your portfolio, you need to invest beyond India. And if you have them, it's basically easier to navigate, cycles in the market. The second is, if you see India as a market cap, contributes maybe 3 to 4% in the MSCI World Index. It's broadly 3-4%. US, on the other hand, is roughly around 65 to 70%. China is around 14-18%. Now, if you look at a portfolio, you can't ignore a large cap in your portfolio, right? From a market perspective, these are large cap names, or these are large cap nations out there which you need to have in your portfolio. Second, if you see the top 100 market cap companies in the world, 50 plus are from US. Only 2 are from India, and maybe 16 are from China. Now, again, you can't ignore these, heavyweights, big global companies. And for all these, you need to invest globally. Last, but very important, you need to build some dollar assets. If you see our INR against dollar over the last 30 years, it has depreciated every year by 3 to 4%. In last 10 years, US S&P 500, if you see, has given somewhere around 12.75% returns, whereas in INR terms, it has given 16%. So 3.25% return just adding up just because of INR depreciation. So these 3 are very, very important reason why you should have